to see indications that that's something to watch very closely. So trade policy is still getting negotiated. It's still getting implemented. The administration has a clear point of view, but there's uncertainty around where this all lands. And there's no question in my mind that it's having an impact on growth. That impact on growth is hard to quantify specifically, and I think it's also very dependent on where a lot of this lands. There's obviously litigation now going on around some of the reciprocal tariffs. We have to watch that closely. There's still trade deals that have to be negotiated, particularly here in North America. So I'd say there's still uncertainty. There is an impact to growth.
Now, a federal judge granted temporary restraining order blocking President Donald Trump's firing of Fed Governor Lisa Cook for now. Now, the ruling means that Cook will remain on the board of the central bank until her case is heard. Steve Leisman has more on this.
Fed Governor Lisa Cook prevailing in every major legal point in a decision last night from a D.C. District Court judge, clearing the way for her to keep her job and participate at the upcoming Fed meeting, but the White House suggesting the case is not over yet. Judge Giacab issued a preliminary injunction against the president's firing of Cook, writing, quote, "The public interest in Federal Reserve independence weighs in favor of Cook's reinstatement. That independence is critical in helping the nation's banking system to promote stability." Cook had been, of course, accused of mortgage fraud for stating in documents that 2 homes were her primary residence. The president fired her in August. She immediately brought suit to stay the firing. The Justice Department opened an investigation, but Reuters reported recently that in the past 8 years, only one such case similar to Cook's has ever been prosecuted. Judge Cobb found that Cook is substantially likely to win on her claim that the president violated the Federal Reserve Act in firing her. On the 3 main elements, she found that firing for causes limited to actions taken in office, the court can review the president's decision in this regard, which the administration had argued it couldn't, and Cook was denied a right to respond to these charges. The judge several times relied on a recent Supreme Court comment that the Fed was different from other agencies. The White House spokesperson in a statement saying, "This ruling will not be the last say on the matter, and the Trump administration will continue to work to restore accountability and confidence in the Fed." Remains to be seen if the administration can be successful in getting an appeals court to overturn Cobb's ruling before this meeting next week, or if it even tries, the case could be headed to the Supreme Court. If the Supreme Court affirms this decision, it would for the first time create precedent around the Fed's independence and the ability or lack thereof of the president to fire a Fed governor.
Steve Leisman, thank you for that update. Take a short break. On the other side, we get you excerpts from our conversation with the chairman of Raymond as the company completes 100 years. Stay tuned. Welcome back. Now, Commerce Minister Piyush Goyal has said that India's active negotiations are underway with the European Union on reaching a free trade agreement. Speaking at an event in New Delhi, Goyal also said that a trade partnership cannot be one-sided.
No business deal, no partnership, no friendship can be one-sided. It has to be a win-win for both. In India, friends, we have a saying that you can only clap with two hands. And that's the kind of relationships we are creating with the rest of the free world, with the democratic world, with the developed countries, and with our friends.
Now, in the latest on the Russia-Ukraine front, the President of the European Commission, Ursula von der Leyen, has spoken on the ongoing war, saying that Europe will stand in full solidarity with Poland and calls for more sanctions on Russia. Listen in.
Europe stands in full solidarity with Poland. Putin's message is clear, and our response must be clear too. We need more pressure on Russia to come to the negotiation table. We need more sanctions. We are now working on the 19th package in coordination with partners. We're particularly looking at phasing out Russian fossil fuels faster. We're looking at the shadow fleet and at third countries.
Now, Raymond has completed 100 years in business, and our colleague Shilpa Ranipeta caught up with Gautam Singhania, the chairman of the company, to discuss the growth drivers going forward, the impact of tariffs, GST and the festive season. Listen in.
Raymond started a small woolen mill in 1925 in Thane, and from there it's come a long way as three separate companies: lifestyle, real estate, and engineering and auto. Moving forward, I don't know what's going to happen over the next 100 years, but certainly we focus to create shareholder value, and hopefully 100 years later, it's impossible to tell, but we should be many times.
Now you have three independently listed entities. What would you define as growth drivers for the company going forward? Where do you see the most amount of growth coming from for you?
I think each one has its own strategy. We'd like to see each company grow at least 20% a year in the top line. 15% a year in the top line and 20% in the EBITDA. So each business has its own strategy.
Right. Okay, fair enough. And, how do we view the textile business also going forward, given the macro uncertainties that we're seeing with the U.S. tariff situation currently?
So the short term, there is going to be some issues, but, long term, people are going to need clothes to wear. India has a large population of 1.4 billion people. And with the GST 2.0, the rationalization of GST, I think there's going to be a lot of demand fueled, so which is good for us.
Right, but then when GST also garments above 2,500 still attract an 18%, do you see that having any impact, and how do you see the festive season then panning out?
No, it's already gone up from 1,000 rupees, so the larger part has come lower. Okay. And the festive season is looking good just now, so I think there's a buoyancy. We've seen our bookings have been good so far, and let's see how it goes.
Right. Just coming back to the tariff question, how are you sort of right now, navigating the short-term impact that you see, and how do you see the U.S. market also then going forward?
So you're looking for new markets. That's the whole game, is to look for new markets.
Which are the new markets?
All of Europe is there. Okay. We're looking more in Japan. There's so many markets that are there. The US is not the only market in the world. Right.
And how are you seeing the real estate market also going forward? There was some discussion today about the redevelopment in Mumbai also, and how that's probably not been panning out the way. How do you see the future? Because you have a large focus on the redevelopment part as well.
So we're not really that much in the redevelopment. We're focused on affordable luxury, and I think the affordable luxury sector is good.
Right. Okay, fair enough. And sorry, finally, for the engineering business also, if you could just quickly spell out the growth drivers that you see going forward. I know there are different under that also, but where do you see the most amount of opportunities?
I think
is it defense?
Aerospace and defense is really clearly the growth sectors there.
Right.
And with that, we call time on this edition of Power Breakfast. From me and the team that put this show together, thank you so much for watching. Bazaar Morning Call on the other side to set you up for this all-important trading session.
Every morning, the countdown begins for the markets with meticulous research and analysis designed to help you capitalize on the trading day. Beaming live from the CNBC TV 18 Motilal Oswal studio.
Good morning. You're with us here on a fresh new edition of Bazaar Morning Call. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant. With me, my colleagues Nigel and Surbhi. Guys, morning.
Hi, morning.
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 So it's been a pretty decent week so far. The bulls have managed to kind of claw their way back, and we have 2 more sessions to go. So hopefully they'll prevail.
Hopefully, and there's perhaps more repair and recovery in terms of where we head from here. Let's just take it from the top then, quickly. I mean, in terms of news flow from what has happened with President Trump or anything of that sort, I mean, there isn't very much new. So you've got Wall Street overnight action, which is subdued, but S&P, NASDAQ both closing at record highs once again. Small change, about 1/3% higher is where both those markets finally left off at. You also had just a bunch of other things. So Oracle was the big story, right? And we'll talk more about that. Actually, that is the big story overall. 36% gain. Larry Ellison, the legendary founder of Oracle, on the back of this massive move on the stock price, briefly becoming the richest man in the world, pipping Elon Musk. On the back of it, NVIDIA was up 4%. And this kind of sort of, brings into focus, sharp focus, the entire AI infrastructure theme in a pretty sort of prominent way. And this is going to show up in other markets. Look at Taiwan, look at the Korean markets, etc. as well. They've all broken through new highs. And it's the same point that we've made over the last many weeks now, which is the fact that, the lack of AI, sort of led pure AI themes in a market like India, is it actually hurting us being able to take in large amounts of foreign money? It's a question. I mean, there's no clear answers, but I think it's something to think about. The 10-year yield, macro markets, nothing very much. 4 basis points lower on the 10-year. Dollar index was largely flat. Brent oil prices about 2% higher. We're at about $67.49. So that's the entire picture. I'll just quickly tie in the levels here. The Nifty, another positive close, and we've been slowly inching up. Resistance line is 24,980, as I've mentioned over the last many sessions. I mean, rounded off 25,000 is that level, above which I think you get more legs to this move higher. Support stands at 24,760. For the Nifty Bank, we are approaching an important resistance level. The resistance is the 20-day moving average, which is 56,584. And then you got the 40-day exponential moving average, which is 55,101. So these are very near-term levels. And I think these are numbers on the upside as we begin our day. F&O stats with Nigel. He's walked across and he's standing by. Nigel, over to you.
Well, the Qs are not looking too bad, right? I mean, if you look at the institutional number, well, that's a net buy number coming from the institutions. Though you need to keep in mind that, yes, that the Kotak Mahindra Bank, big deal that is part of it. But for the last few trading sessions, what's been a constant is that the institutions have been net buyers. So I like that. The second point is, on the F&O side of things, the FIs for the third straight session, the number of long contracts that were added were more than the number of short contracts that were added. The short position continues at around 90%, but the point is that now long addition has started and that short covering bounce is still pretty much due. So that will be encouraging from a bullish perspective. They'll want to see those shorts getting squeezed out. That's yet to take place, just going by the data that we have. Moving to the Nifty Bank. In yesterday's trading session, after a while, we did see a bit of a short covering bounce did come into play. And I say that because the Nifty Bank ended higher. We came off a little bit from the top, but there were first signs that on the Nifty Bank itself, these shorts are covering out. Remember, when we talk of short positions getting added on index futures, bulk of it was getting added in the Nifty Bank. So now there are some signs that the Nifty Bank, those shorts, they are scrambling for cover after seeing a good run in the last 45 days or so, because shorting the Nifty Bank has made you money. Now those shorts are squeezing out a little bit. Moving to the options data. The 25,000 call and the 25,000 put. That it appears, just by the look of it, between them they added close to 100 crore shares. The combined premium out there on an average will be around 250 rupees or thereabouts. So that's telling you, the markets are bracing for this broad 500-point band that we're looking at. So if you just look at it, someone who's pocketing this 250 rupees, they want the market to stay in this band of around 24,750 to around 25,250. That's the strategy if there is a straddle that's taking place at the 25,000 call as well as put. For today, 24,800 going by the options data, that's the level that I'm looking at. And 25,050, that's the first level of resistance that I'm looking at. So we'll keep an eye out on that. Moving to the other data point that we have, the Nifty Bank. Yesterday, it went to the 20 DMA. It couldn't cross the 20 DMA. It's important that today on a closing basis, you get past this level of around 54,700 because that level is getting a little bit rejected. So you'll want the Nifty Bank to conquer this mark. Important trigger to track. Stocks that I'm looking at for today, RBL Bank. If you look at yesterday's intraday chart, intraday there was a sharp dip and then that dip got bought into. And the stock continues to remain in the F&O band. So there is a good amount of open interest build-up that we're seeing on that particular name. I'll continue to keep this stock on the radar because it still has a few sessions to go before it can come out of the F&O band, though yesterday there was some shedding. And the other one is Tega Industries, a massive, big, large deal that was announced overnight. Nimesh was highlighting it could be very, very large. Indeed, $1.5 billion. They are going ahead and they're acquiring Molycom. It puts the company in another trajectory for the next few years, but maybe, just maybe in the near term, the street could think that they're looking to bite too big. So we'll have to see the stock reaction. Keep in mind, last 6 months, stock is already up 55%. So longer term good, maybe in fact in the near term, there could be a bit of an overhang because of the leverage on the books. So we'll keep an eye out on this one.
Okay, all right, got that. By the way, in Japan, markets are surging. They're going on to record highs. Asian markets largely are doing okay. The specific headline out of Japan is SoftBank. Thanks to Oracle's overnight dramatic run-up, SoftBank shares are rising 10% because remember, OpenAI, Oracle and SoftBank, a lot of these entities come together in the Stargate program when it comes to AI infrastructure. So, well, a lot of excitement across many of the regional markets. The Hang Seng is actually a little quiet, down about 1%. Well, let's look at the equity call of the morning now. Sunil Kaul of Goldman Sachs says the GST cuts could directly support earnings through higher volume growth due to price elasticity of demand from benefit pass-through, and though better profit margins where companies have the pricing power. He says they reiterate our overweight view on consumer sensitives as they have picked up, outperforming the market by 11 percentage points in the second quarter so far, but still down 5% and flat relative to the market over a one-year horizon, suggesting room for further runway. He says they raise cement and consumer durables to market weight on potential GST tailwinds and ongoing mass consumption revival. So that's a view coming in from Goldman Sachs. But I think we have some news on wholesale prices, Prashant.
I think we got the PPI numbers last night, right? And numbers are, I think, better than what was expected. So it basically strengthens the expectation that we perhaps will get rate cuts. That is on the 17th. This is David Solomon, Chairman and CEO at Goldman Sachs, on exactly the numbers and perhaps the Fed decision, which is right in front of us.
I think about where we are, there's still more work to do. And so, I think it's uncertain. I've said it a number of times, I think there's going to be a stickiness around how this all settles out. And I think we're continuing to see indications that that's something to watch very closely. So trade policy is still getting negotiated. It's still getting implemented. The administration has a clear point of view, but there's uncertainty around where this all lands. And there's no question in my mind that it's having an impact on growth. That impact on growth is hard to quantify specifically, and I think it's also very dependent on where a lot of this lands. There's obviously litigation now going on around some of the reciprocal tariffs. We have to watch that closely. There's still trade deals that have to be negotiated, particularly here in North America. So I'd say there's still uncertainty. There is an impact to growth.
Okay, well, that's the global stuff. It's not very much today in terms of the news flow, but we'll have more coming up in a bit from now. So here's a quick preview of what's coming up here in the next 2 hours. 8:35, Mehul Mohanka, MD and Group CEO at Tega Industries. That's the big outbound M&A, which we want to get to you. It's a big one. And Tega, the stock has done phenomenally well. So you'll hear from them at 8:35. 9 o'clock, we'll have Nilesh Ghuge of HDFC Securities for an outlook on the chemical stocks. 9:20, Harish Krishnan of Aditya Birla Sun Life Asset Management Companies, a market match of the day. 9:35, the management of Chola Mandalam Investment and Finance talks to us about the company's second quarter outlook as well as the impact of GST cuts on, the end markets for them. And of course, Gopal Agarwal, CEO of Anupam Rasayan, talks to us at 9:45. Towards the end of the program, it's the conversation with Parvat Srinivas Reddy, MD, MTAR Technologies, new orders in a clean energy segment and the impact of US tariffs are those talking points.
All right, time to slip into a short break. You've got a lot of stock-specific action that we're going to be tracking for you on the other side of the short break. Stay with us.
Welcome back. Let's get the implied open up because Asian markets are mixed, but many of them are up and about. And anyway, our market has picked up some momentum in the last couple of days. So the bulls will hope that they can build on that. Just 15, 16 points higher. Let's see. Quiet start. We'll see if the momentum can come in during the course of the day. Now it's time to get down to individual stocks, and our team is standing by with the CNBC TV 18 list of top stocks to watch. Rima, let me kick it off with you. TCS on the radar.
Indeed, TCS on the radar because CLSA has written a note. This is after meeting the management at their investor conference in Hong Kong very recently. So first on demand, TCS says the demand environment remains broadly unchanged compared to Q1. No change, but they are sounding incrementally more positive about the opportunity from AI. They believe that the overall budget on account of AI opportunity will expand, and therefore it will be a net revenue positive for the company. Secondly, now because Infosys has announced Infosys board is meeting today to consider a buyback, so you should watch for Infosys too. CLSA believes there will be incrementally more pressure now on TCS to also do a buyback, because they're eligible for a buyback. Their last buyback ended in December 2023, so that cool-off period has come to an end. CLSA believes that TCS can do a 20,000 crore tender buyback instead of paying out a huge special dividend, and analysis shows that the last 5 buybacks that the TCS has done has been supportive of the price. So the price generally during that buyback period has gone up between 1 to 3.7% in every single of those buybacks. So when the buyback announcement comes from TCS, if it does, it will be a positive. Back to you.
Okay. All right, Rima, thanks a lot for that. Well, let's hop across to Sudarshan. He's here to tell us about Tata Motors. Morning, Sud.
Good morning, Nigel. So on August 31st, there was a report of the cyber incident at JLR. So first time JLR had released a statement on September 2 confirming about cyber incident, and the fresh statement company has released yesterday in which company has said that even some data has been affected in cyber incident, and the shutdown of its all the operations have been extended. Now, as per BBC reports, cyber attack may cost JLR almost 5 million euros per day, and it believes that this attack has come at the worst possible time because UK government has recently launched introduction of new registration plate, and on the back of this, September was expected to be huge selling month. So it's come at the very very important time. And also the question about cyber attack was raised in the House of Commons, and the reply to the question, Cabinet Minister has said that he cannot confirm or deny that if the attack was state-sponsored. Why it's important for Tata Motors? Because JLR forms almost 70% of the consolidated revenue of Tata Motors.
Okay, well, this is a new one. Cyber attacks and making news in that sense. Watch out for this one as we go forward. Tega Industries, right? That's a big acquisition that we've been sort of highlighting, and the interview comes up a little later. But let's get the news out of the way first. Vamakshi, tell us more.
Well, good morning, Prashant. Absolutely a very big acquisition coming in for Tega Industries. Now, Tega Industries in consortium with Apollo Funds will be acquiring 100% of Molycorp. And now the acquisition is actually a massive acquisition. It's coming at an enterprise value of almost $1.48 billion, or roughly translated to Indian currency, it is around 13,000 crores. Now, keep in mind that Tega's market cap is at 13,800 crores. So the acquisition that they're doing is almost as big as their own market cap. Now, in the SPV, Tega will be holding around a 77% stake, while Apollo Funds will hold a 23% stake. Now, largely, how will such a massive acquisition be funded? Tega will be contributed around $361 million, or roughly around 3,180 crores, out of which 995 crores will come in from corporate debt, while 2,184 crores will come in from the equity raise. Now, keep in mind that there is a board meeting scheduled on September 13th in order to consider fundraising plans. Now, the rest of the amount, which is approximately 951 crores, will be contributed by Apollo Funds. Apart from this, there's a $120 million contingent payment, which will be paid within 45 months. Now, this overall acquisition is quite massive. They believe that they expect closing by 31st of December this year, pending all the approvals are in place. Now, just to give our viewers some context as to how big or how massive this acquisition is, keep in mind that Tega had a revenue of 1,639 crores. Molycorp comes in with a revenue that is 8 times, and the combined entity will have a revenue of almost over 15,200 crores. The EBITDA margin as well for Tega was at 20.7%, but for Molycorp the margins are much lower, 11.5%, and combined 12.5% for the entire entity. Now, this is a massive acquisition, definitely positive, but the street will be looking at some of the operational challenges, plus that because Molycorp is not growing at a rate as fast as Tega, so that is something that the street will be concerned about, as well as the lower margins that Molycorp comes with.
Okay, all right, Vamakshi. We'll keep all of this in mind as we go forward with that conversation with Mehul Mohanka, the MD and Group CEO of Tega Industries. We'll ask him about some of those questions, those operational challenges, and of course the way forward with this big $1.5 billion acquisition. Okay, back to some more stocks in news, and Vinny has rounded up a couple on her list for us. Vinny, good morning.
Good morning. So firstly, I'm going to start with Dr. Reddy's. They've signed a definitive agreement with Janssen Pharmaceutica, which is an affiliate company of Johnson & Johnson. They'll be acquiring Staggeron, which is one of the products of the company, for $50 million. Now, this is a positive that comes in for the company because overall, the Indian market sales also for this product and this brand is around $10 million. There are sales that will be happening in other 18 markets across the globe as well. APAC is included, EMEA is included in the regions. India, Vietnam are some of the other regions that they'll be selling these products in. So positive there for Dr. Reddy's. The other one is Shyam Metallics. We're expecting green here as well. They've had made a strategic foray into crash barrier segment. They're aiming to capture around a market share of 8 to 10% in FY25 to FY26. So that'll be interesting to watch out for them. RVNL, the company has emerged as a the lowest bidder for a project from Western Railways, and this is for a consideration of 169 crore rupees. The execution period is 540 days. That's 1.5 years approximately. Jupiter Wagons, that also we expect in green. They've received a letter of acceptance from Ministry of Railways, and this pertains to around 9,000 LHB axles, and this is for Fiat IR bogies with an aggregate value of around 113 crores. So keep an eye out on all these stocks today.
All right, Vinny, thanks very much for that. So keep an eye out on these names, individual stock-specific movers. Block deals in focus, right? Vivek is standing by now. Kotak Mahindra Bank, HCG, and Bajaj projects in focus. Vivek, take it away.
Well, good morning. Yesterday we saw a whole host of block deals, none larger than Kotak Mahindra Bank, over 6,000 crore of equity exchange hands. Along expected light, SMBC holding close to 1.6% stake. Sumitomo exited the stake completely. Whole host of buyers, key amongst them being one of the top buyers was 361 Asset Management, almost 2.6 lakh shares was the one they bought. ADIA, which is Abu Dhabi Investment Authority, picked up close to 1.3 crore shares. In another fund, they actually bought close to 53,000 shares, and Aditya Birla Sun Life Mutual Fund bought over 2 lakh shares. So, whole host of buyers, these are among the top names. So, again, Kotak Mahindra Bank expects a slight green tick here, given the fact that the overhang of FMCG stake sale is now over. Healthcare Global, very interesting block deal. Remember, CVC, which had actually exited majority of their stake, almost 54% stake to KKR in February, they were left with close to 8.76% stake. Now, yesterday's block deal, they sold close to 79.4 lakh shares, indicating that they exited most of, their stake in the company yesterday. Axis Mutual Fund bought close to 9.5 lakh shares. Morgan Stanley bought close to 8.8 lakh shares. Nippon India Mutual Fund bought close to 44 lakh shares. Now, what we understand is that in other off-market transactions, they've actually gone ahead and completely exited their stake. So, the entire overhang of CVC Partners' stake in HCG is now over. And lastly, Bajaj projects. HDFC Mutual Fund yesterday sold close to 8.9 lakh shares in this particular stock. Expect some overhang on the back of this particular development.
Okay, all right, Vivek, got it. Thanks very much. Let's quickly recap our list of stocks to watch this morning. The ones that have positive news flow would be TCS, Tega Industries, Dr. Reddy's, RVNL, Jupiter Wagons, Shyam Metallics, Kotak Mahindra Bank, and Healthcare Global. Stocks with negative news flow would be Tata Motors and Bajaj projects. Okay, so that's the news flow and the top stocks based on news this morning. Let's also look at some interesting brokerage notes. Sudarshan is joining in for exactly that. So good morning. What do you have for us?
Good morning, Surabhi. So first one in the brokerage corner list is GAIL. If you remember, we have been reporting about imminent tariff hike, and that hike is expected over next few days. Now today, Nomura has come out with a note. It maintains buy call and target is of rupees 225. It believes that tariff hike might give a one-time boost to the company. And as per our reporting, when we had reported that tariff hike can be approved, and it can be approved at the level of rupees 70 per MMBTU versus current tariff of rupees 58 to 59. Even Nomura believes that tariff can be increased to the same level, that is rupees 70, and it can be applicable from April of 2026. And also, if once it's increased, it would be a 20% increase. And on the back of these factors, it believes Petchem segment could recover from FY27, and also it expects 42% increase, 42% YY increase in gas transmission EBIT from FY27. Next is on HSBC has written on agri input companies. It believes that sector is regaining health as industry dynamics have turned favorable, and also outlook by agri majors appear encouraging. And in H1 CY25 performance, major China companies, they had also indicated that prices are bottoming out, and on the back of this, it maintains buy call on UPL and target price is rupees 775. Last one is Citi has written on OMCs. It says it stays in the bullish camp, recognizing several undeniable strengths, and believes that Q2 for these companies is expected to be much better than Q1, and market sentiment is being weighed down by concerns over Russian crude imports. But Citi believes that even if Russian crude imports come down, the impact will be very minimal, and it prefers OMCs over its counterparts in the upstream segment.
Okay, all right. So thank you very much for that. So some brokerage calls, and we'll put out more as we go along. We'll take a quick commercial break here. Next up, that much-promised interview with the management of Tega Industries coming up on the big announcement, a big acquisition that they are making, and what it means for the company, how will it change the trajectory, all of that with Mehul Mohanka of Tega.
Welcome back. Hope you're having a good morning. Well, let's get to the big deal that was announced yesterday. Tega Industries is partnering with the Polo Funds to acquire Molycorp in a $1.5 billion deal. To help us out with how this transaction is and give us some clarity with regard to it, we're joined by Mr. Mehul Mohanka, the Managing Director and Group CEO at Tega Industries. Hi, Mehul. Good morning. Thanks a lot for speaking to us here on CNBC TV 18. Well, let's get to a couple of aspects then. How much of debt comes in from the acquired entity? If you could help us out with that. What is the debt you're going to be getting onto your books?
Currently, the debt at the target level is roughly about $1 billion. And the attempt is to bring the leverage down after the transaction closes.
All right, Mehul, how much do you target to bring this debt down? As you're saying, you're looking at bringing it down. Give us a sense as well on what's the broad borrowing cost?
Yeah, sure. I think, through the consortium arrangement that we have with Apollo, the intent is to structure the debt in a fashion that we leverage it down to around 800 million odd levels from the current billion. And that should help us, deliver some improved benefits in terms of interest cost reduction with the leverage coming off and hopefully even an improvement in the credit rating.
All right, Mehul, I just missed out. What is the current cost of borrowing? If you could help us out with that number.
So the current borrowing cost is roughly around, 835 bips, somewhere in that region. We don't have all the specific details yet, but the attempt would be to try and improve on the current rates.
All right, Mehul, though the valuations are looking attractive, the problem is that Molycorp revenues, they have not grown, in the last few years. So my question to you is, what are the scaling up plans of this acquired entity, that's Molycorp? And obviously, you have hinted at some margin improvement. So give us some color on that as well. What is the margin improvement we're looking at from around this 11%?
Molycorp has generally been a 3.5% growth business year on year, and that's true of its, I would say, 1 decade history. The attempt is to bring two complementary businesses together in a way that we can improve better value proposition to the customer so that they benefit from this combination of two complementary product lines. And that would hopefully help us deliver a better margin profile for both businesses, both Tega and Molycorp. So I think where Molycorp today operates at is at roughly around 11% EBITDA levels. Our aim would be to try and improve that over the next 2 to 3 years to, on an average, anywhere between 13 to 14% levels. Tega, as operates at a CAGR of 15%, delivers about close to 22% EBITDA. So the margin profiles are different, but we hope that on a console basis over a 3 to 4 year period, we would be roughly at about 18% on a console basis.
Mehul, morning, and congratulations on the announcement. It's a big one. Help us with the terms of payment for this transaction, because this is at the end of the day a leveraged buyout. How will this work?
Both Apollo and Tega are going to be funding this transaction through a mix of equity and debt. Tega is going to be putting in about close to $361 odd million for a 77% stake in the business. Apollo would be bringing in the rest. And so that's the overall capital structure at this point.
Okay. Can you, Mehul, just exactly break up the funding? I mean, who's bringing in how much on board?
So as of now, this is still very indicative and early, early into this transaction. So the way we're currently thinking around it is to bring in about $118 million, close to about 1,000 crores in debt in the books of Tega, and the balance about 248 odd million in a primary fundraise.
Okay.
That will be through a mix of pref and QIP.
Okay.
That we'll be bringing to the market. Of course, these are still very indicative in early years. We may think of probably replacing some of the debt numbers with equity if it so happens to be.
Maybe let's talk a little bit more on that equity fundraise then. You're talking about around $250 million, right? $248, $250 million.
Promoters would put in, as my family, we would put in about close to $20 million.
$150 million of equity raise. Got that. So Apollo is going to be part of the SPV, but will they be participating in this particular equity raise at Tega Industries itself?
So there's an indicative interest from Apollo to also participate at the Tega in the Tega cap table, other than just the target. And currently, we are going to launch a roadshow to try and reach out to as many institutional investors, HNIs, who would want to participate in this transaction with us.
Right. What is the level of promoter holding that you're comfortable with?
So all things going well, we expect the promoters to go down from 74.8 to roughly around 64%.
Okay. And which year will the deal become EPS accretive from?
On a conservative basis, we would say it would get EPS accretive from, I would say, between the second and the third year.
Okay. Mehul, it's a big deal. I'm sure you've thought this through. But in case investors in the street are not too happy with it, because it's a large deal, you have to raise a lot of money. There's debt coming in. The entity you're acquiring also has a large amount of debt. If the street doesn't like it, will you rethink?
I hope the streets actually are as enthusiastic as I am. I think a couple of reasons. One is, of course, that all the debt in the target has no recourse to Tega. It is value accretive for Tega and the target as well. We've had, as Tega, we've had experience of running businesses globally. We've turned around businesses. We've acquired businesses. So while the scale is sizable, we remain undeterred based on just the experience that we've had in working in the global environment. So we're very bullish that we're going to be able to pull this off.
Well, absolutely. Good luck to you with that. But just dive a little deeper in terms of what all does this entity Molycorp bring to the table, and what was your thought process? Because you are going in for something, which is pretty large in size.
We first looked at this asset way back in 2017. So this asset first became available in the market in 2017 when their parent, which was an Australian company, decided to sell the business. And in 2017 was when I had a first look at the business, but we didn't have the currency to be able to participate in the transaction, and the current owner won the bid. And since then, they reached out to us to look at whether there's a possibility of how Tega and Molycorp could work together, because they very early on realized that there's some value in combining two complementary businesses. And when they looked at the entire global space, they saw Tega to be someone that could be interesting for them. And that's how the first contact got established. They visited us in India. We had a long, meaningful interaction, but then just the structure, what they were proposing was something that I thought was not very interesting at that time. And since then, they've owned the business for about 8 years now. I have been tracking this business, so it's been something that's been sitting on my mind for many, many years. It's not something that I just jumped into in the short term. We've been thinking through this about how we could put two complementary businesses together. And just this opportunity came along when, it's been an 8-year vintage for the private equity firm. They wanted to exit this business, and they thought that the best home for this would be in Tega. And the fact that we could probably do better with this business over time than what they've been able to do.
Mehul, in the last 5 years, your CAGR has been roughly around 19-20%. Your margins have been at around 20%. But you're clearly very ambitious. We'll have to see how the street reacts. That said, 3 years down the line, what could the consolidated revenues look like, the margins and the debt as well? Give us some guidance for 3 years down the line.
Yeah, so in our model, we've taken like a revenue growth at a very conservative level for the target. We've maintained it at about 3.5 to 4%. They're currently doing about that much. So without putting in too much of high growth pressure on the target upfront, we've kind of modeled it on a conservative basis to be around 3.5 to 4%. With Tega consistently delivering at about 15%, we're looking at leverage to come off by year 4 to about closer to 2 times of EBITDA, 2x, 2.5x EBITDA over 5 years. And we should be at an EBITDA level of close to about anywhere between 17 to 18% from third year onwards on a combined basis.
Okay, well, good luck to you with those plans, and may your all your targets be on track. Thank you very much for joining in and patiently taking all our questions and explaining the deal contours to us. Well, that's Tega Industries, big newsmaker of the day, acquiring Molycorp for $1.5 billion. Well, let's discuss this and lots of other fundamental ideas with Dipan Mehta, Director, Elixir Equities. Dipan, good morning. Good to have you on. I don't know, I mean, I hope you could hear most of that interaction, that interview. It's a large deal, and the promoters are saying that it should become EPS accretive from year 2, year 3 onwards. They're looking at putting in, I think, 250 million was the number he gave us in terms of equity funding and getting more investors on board. Your thoughts on how you'd look at it? Otherwise, the stock's done really well. It's been a wealth creator over the last many years.
Yeah, Sabhi, good morning and thank you for having me on your show. I think all I can say is what ambition. I mean, I was just checking while you were talking, the actual market capitalization is 13,000 crores of this company and is doing a 1.5 billion fully leveraged acquisition. So I'm sure they've thought through it, but from an outside investor's perspective, it does sound a bit risky. And there are always integration issues. And actually, the track record of Indians buying global companies has not been that great, right? From Suzlon days or whatever acquisitions Tatas have done. I don't know much about this deal, but just on the face of it, it seems to be kind of a risky deal from the investor's perspective. I'm sure they have thought through it, but it does put a cloud of uncertainty because there are a lot of integration issues, and managing overseas operations is not that easy, as many companies have realized. And it's not that the stock is really attractively valued, it's richly valued. So I wouldn't say that, just because of this deal, one should look at Tega Industries from an investment perspective. But sure, I think sentiment is better, so you could have a spike today.
I just want to pull that chart up itself, which is on the screen right now, the revenue breakup between the two entities. If you look at it, the revenue currently is around 1,650 crores, right? Now, going by what the management had to tell us, that the core business will grow at around 15% for the next few years, and Molycorp will grow at around 3 to around 4% business. So, ballpark, the revenue should be in that vicinity of around 17,500 to 18,000 crores. And at 18% margins would effectively mean 3 or 4 years down the line, the EBITDA number will be nearly 2x of what the current revenue number is. But that is 3 to 4 years down the line. So, the next few years, it could pan out very, very well. The problem is, are they looking to buy too big? That's what could weigh in the near term. And considering the stock has run up, that could weigh as well. But in the longer term, if they go and execute, then it could be a pretty interesting prospect. So, we'll have to see how that goes. But the run up in the stock, I think, is something that, could hurt as well. Dipan, good to have you on the show. Dipan, let's get your view on tech. That's come back out of nowhere. A few sessions ago, we were pointing out that the Nifty IT index, if you compare the premium that it trades in comparison to the Nifty's valuations, that premium has come down, and the discount it trades in comparison to NASDAQ, well, that has widened. In the last month or so, it's done quite well. Would you believe that it's time to book some profits, or do you think they're starting a fresh leg?
No, Nigel, I'm still bearish on IT stocks, and this particular rally has been triggered by what Infosys buyback has done, and we expect other companies also to do buyback. But end of the day, I think that there's nothing really changing fundamentally positive for these companies. Sure, a better US-India deal may improve the sentiment of all exporters and remove the threat of any action or any tariff on Indian services. But end of the day, these companies are really, the large cap ones are really struggling to grow even at mid-single digits. You may find good quality mid-cap companies, but they are quite expensive. They're actually Persistent or Coforge. But by and large, I think it's still an avoid for us. And such rallies are good exit opportunities for investors who have been invested for multi-years in such companies and suffered, I would say, subpar returns for the past several years or so.
Point taken, Dipan. What else? Good morning. What else is of interest as we're getting a bit of a lift finally from the lower end of this range that the market has been in, and we've inched now closer to about 25,000. What's still looking attractive to you?
Good morning, Prashant. Yeah, I think that this market is going to get extremely selective, and within the sectors also, some stocks may do well, some may not do so well. This entire GST cut also, I think, is going to result in quite a few winners as well. We're looking at retail companies quite closely. One company which comes to mind which will benefit is, and it's attractively valued, a small cap stock which is on our radar, is Keval Kiran Clothing. And if you see the numbers, I think it's among the best performers in the retail segment. I think 50% plus quarterly growth. And it's a company which has been around for a very long time. And valuations also are quite reasonable, very strong brand, good distribution network, backward integration to manufacturing as well, and quite a stable company with good balance sheet and good corporate governance standards as well. So like that, I think selectively we are trying to find industry by industry decent stocks to invest in. Also, I think a lot of the platform companies, and we have another one coming, urban company, looking at that very, very interestingly, maybe on listing if it's reasonable. This is one company which has caught our eye. The way other platform companies have done recently, the likes of Zomato, Paytm, I think that's also got a good, I would say, growth prospect, and certainly merits a look in over there. And then, of course, the large cap companies like Bajaj Finance, L&T, M&M, I think their prospects certainly look very good, especially after this GST cut.
Yeah, the name that Deepan was talking about is Keval Kiran. The code is KKCL.
KKCL, that's right.
For our producers to pull that. Yeah, there you go. That's the one. So 540-ish on that's the one that Deepan was talking about. Survi.
Yeah. Since you're talking platform companies, just reminded me of the new kid, soon to be new kid on the block. Urban company. I'm sure you've had a look at the structure, what the management's been saying. But what about the valuations, Deepan? I mean, does it make sense to you, or what do you do? I mean, wait, let the pop happen, and then decide.
See, I think, valuing these loss-making platform companies is an art. It's not a science. And all we can say is that, if you have a long-term horizon, like I always said, stocks like Urban Company, Zomato, Paytm, these are stocks of the 2027 to 30 years. And I mean, in that particular year, these are the companies which will really be large, a few of them, and give outsized returns, because that's the time when their businesses would have matured and they'd be solidly profitable and still be able to grow at 15-20% or thereabout. So I like such companies, especially Urban Company. I think these days the person who sells, the company which sells, is more important than the product or the service originator. So from that point of view, very positive on this company. Let's see how it gets listed. The best way to play such businesses is to buy a small percentage, a small percentage of your portfolio in such a company, and then track it. Then accordingly, decide whether you want to increase the holding or exit the company, because it's a whole process of understanding these companies as well. So don't take a big bite initially. Start small, see how the company shapes up, and then accordingly modulate your investment.
Deepan, I'll tell you, maybe one of the best things, or what I think the market or someone like you will appreciate, is the management themselves. We had them on yesterday. So the management themselves saying that forget adjusted EBITDA and all of that. We believe in the final profit number, and we are hoping to get profitable in the near future. So that's the approach they're taking. If
I may say something, Surbhi.
Yeah.
A very nice trend which is happening with these loss-making companies getting listed is that they are meeting a new class of investors who are forcing them to get profitable.
Absolutely. Really.
Till now, they're talking with VCs and private equity. Their thought process is different from our thought process over here.
Yeah, and you've been teaching them very, very well, right? Getting real. It's been all about getting real, and they have been getting real when it comes to profitability. Okay. Anyway, Deepan, stay on. We have to take a very quick break. Come back on the other side, and we'll have the technical setup for the market. Sudarshan and Mitesh will join in with the trading ideas of the day.
Okay, welcome back. Let's just look at the delivery stats as if after yesterday's close. Hormuz is here with the big movers and what's behind the price action. Hormuz, morning, take it away.
Morning, Prashant. And starting off with the PSU name, ITDC, and that's because of the fact that it was a big mover on Tuesday. And yesterday, for the first part of the trading session too, the stock extended its gains, but then fell significantly from the highs. Fell almost 8%, ended almost at the flat line as of closing. But the interesting bit is the fact that yesterday's volumes, despite the fall from the highs, were higher than the time when the stock rose on a Tuesday. So yesterday's volumes was equal to the last 64 sessions put together, and this is including the 26 lakh shares that were traded on Tuesday. And in yesterday's session, more than 40 lakh shares were traded compared to a 20-day average of a lakh and a half, and close to 5 lakh shares were marked for delivery compared to a 20-day average of just 24,000. Now, mind you, ITDC does not have any free float in the market. 87% rests with the government, a bit of a stake from with LIC, and almost 7 to 8% stake is with Indian hotels. So very little free float in the market for ITDC. The other one is Alcon Engineering. That did well in yesterday's session. The biggest single day gain since January, has gained in 7 out of the last 9 trading sessions. The volumes were the highest since July, almost 55 lakh shares traded compared to a 20-day average of just close to 2.5 lakh, and 7 lakh shares marked for delivery compared to a 20-day average of just over 1 lakh shares. So, and of course, it is known for the fact that Vijay Kedia owns stake in the company, but he has trimmed that down over a period of time. Now has only 1% at the end of the June quarter. Phase 3 is the other one. It was up 20% yesterday. It is into a similar business line as compared to Welspun Living, into manufacturing of bath linens and so on and so forth. That was up in an upper circuit yesterday, the biggest single day gain on record. Has almost 6 lakh shares traded yesterday, 20-day average of just over a lakh, and close to 2 lakh shares marked for delivery, a 20-day average of just around 42,000 shares. Has no institutional holding, but Ashish Kacholia does have over 5% stake in this company. And lastly, Apex Frozen Foods. Of course, yesterday's buzzwords were textile and shrimp and exporters. Singling out Apex Frozen because was up 17%, the biggest single day gain since July last year. Close to 1 crore shares were traded yesterday, and a 20-day average is just 3 lakh shares. And even on the delivery front, over 6 lakh shares marked for delivery compared to a 20-day average of just 50,000 shares. And the turnover for Apex Frozen yesterday was almost 224 crore, which is close to 30% of the overall market cap of the company.
All right, Hormuz, interesting names there. Phase 3, so that's the most interesting one that I thought you put out. But, a bunch of names there. Let's talk about IT stocks, right? I mean, whole host of news updates here. And Rima is standing by with just a quick update. Rima, over to you.
Thanks so much for that. So 3 things. 1, let's start with Infosys. Board meets today to consider a buyback. This was announced a couple of days back, and since then the stock has been doing well. It's rallied 7.5% in the last 2 days, and the street estimates it will be a buyback in the size of 10 to 14,000 crore rupees. And remember now, according to the rules, it has to be a tender buyback, which means at a particular price, fixed price. The second set of news is surrounding TCS. Now, there is a brokerage note written by CLSA. This is after meeting the management of CLSA at their investor forum in Hong Kong. So the first takeaway from there is that the demand environment, according to the management, remains unchanged compared to Q1. So not much had changed. But they believe the company is sounding incrementally more positive from the opportunity from AI, and they believe this will help expand the overall IT budgets, and it will be a net revenue positive for companies like TCS. Secondly, CLSA believes that now the pressure is on TCS to also come out with a buyback. Infy has announced it. TCS is eligible. Their last buyback closed in December of 2023. So almost 2 years have passed. So now CLSA says it's, they've passed the mantle on to TCS. According to CLSA, TCS can do a buyback of about 20,000 crore rupees this time around. And they've done 5 buybacks in the past. And the historical price analysis during buyback suggests the TCS stock price remains supported. So every time during that buyback period, while the buyback is on, TCS share price has gone up, either 1 going up to 4%. And the last bit of news is Oracle. We've been talking about it yesterday. Yesterday when we spoke about it, it was the share price run up in after hours trade, but it followed up. So yesterday the stock closed with a gain of about 36%, its best single day gain since 1992. And what was the key driver? Their cloud revenue projections. Last year, the cloud infrastructure revenue was at $10 billion. This year, they're projecting it to be $18 billion. And by 2030, this number will stand at $144 billion. We're talking about a 7-8 times jump in a span of 4 to 5 years. This number, this $144 billion, got the street very excited. And the other big headline is that Larry Ellison, the founder of Oracle Financial, he's 81 years old and he's now the richest person in the world. He's overtaken Elon Musk.
I mean, Larry Ellison doesn't get the kind of publicity to some of the other tech titans, but he's in a sense the OG, right?
Yeah.
I mean, 40, 50 years in the business, very low profile, but shot into the limelight with this explosive. I don't think any large company has produced such a significant guidance ever. I mean, in terms of
now there are people saying that is it even possible for the company to achieve it, right? You need electricity. I mean, can the electricity go up, right? Electricity requirement, it has to go up 7-8 times. Chips have to go up.
Yeah.
So for that kind of projection, before now, it's like outstanding, right? It's like everyone's fallen off their chairs looking at that guidance now.
Busters. Well, Rima, thank you very much for that. And that's a big story which we will continue to track through the course of the day. Sudarshan and Mitesh are with us with what they'd want you to do in terms of specific trades right now, technical trades. Gentlemen, morning. Great to have both of you here. Sudarshan, you go first. How are things looking? We are now approaching almost at 25,000.
Yeah, good morning. And we are in an uptrend. So there is a very simple process. You buy every dip, you hold on to your long positions, and you buy a small consolidation if you are not in the market. Let me quickly explain the structure and how it developed. Last Monday, we had a trend day. Till that day, the market trend was downbeat. On Tuesday, after the trend day, the trend changed. And actually, it doesn't feel as if we are in an uptrend. You know, the market is going up 30 points, 40 points, 50 points a day. But we are up 300 points from that day. Sometimes this is how the market behaves. It doesn't give a sense of an uptrend, but it does move up. So don't go after the sense. Understand that the trend is up and stay long.
Okay, got it. All right, got that. What about Mitesh? What's your take on the index?
Yeah. So, I've kept a mildly positive bias as well, while believing that the broader move is still within a range. We are kind of heading towards the upper end of the range. Now, the level which I'm watching on the upside is 25,150. And then there was some consolidation which happened in the month of July around 250, 300 zone. So I think these are the two targets which I'm looking at. We will most likely inch up and head towards those levels. A breakout beyond these levels will, turn the market into a much more positive setup on the medium-term charts and can give you a sustained up move. So for the timing, trade with a positive bias. Look at the markets heading towards the upper end, and if there's not a significant retreat from there, I think we are in for a good few weeks to come by.
Okay, all right. Let's get into individual stocks then. Mitesh, you go first. What's on your radar?
Morning again, Nigel. I have all buy calls today very clearly, in line with the fact that my belief is that we are inching higher. So I have a buy on Jubilant Foods. Here I would recommend buying with a stop at about 645 for a target of around 680. Buy on Bank of India, which had a very good price volume action. So mild pullback, buy around 116.5. Keep a stop below 114. Look for a target of 121 to about 122. Similar setup happened on the charts of BEL. So on a mild pullback, let's say around 387, 385. Buy with a stop below 380 for a target of 400. And the final buy call is from the IT names. And post that Infosys announcement, I think a lot of IT names have given a short-term reversal. So HL Tech joined the crew yesterday. I think that's a buy with a stop at about 1450 for targets of around 1500.
I've got that. Sudarshan, what about you?
Well, it's an all buy list. HDFC Bank is the large cap that comes in my buy list. Buy with a stop under 946. And if you are a positional trader or an active investor, don't keep a stop. Just buy HDFC Bank for the long term. Marico is a buy with a stop under 722. JSW Energy is a buy with a stop under 507. And Mazagon Docks is a buy with a stop under 2704.
Yeah, got that. And there's a pretty significant kind of all these, these sharp movers yesterday, Apex Frozen and, a bunch of other names, Avanti Feeds. Mitesh, anything caught your eye? Not typically the space that we focus on or you've looked for in trades.
Yeah, I think the only one which actually, was Gokuldas Exports and Avanti Feeds. Avanti Feeds, because of the fact that there was a big gap up, the volumes numbers were, I think about 50, 60 times than the average volumes of the last 10, 12 days. So big breakout taking place over here. Typically, you might have some kind of a pullback. So if you get it around 740, 730 range, that's the range to enter afresh. If you're already holding, I would look at a target in excess of around 825.
Gentlemen, thanks very much. Both of you, appreciate it. Sudarshan and Mitesh for those trades coming through right now. We'll take a quick commercial break here. We'll come back with the pre-opening. And of course, we'll have Nilesh Guge of HDFC Securities for an outlook on the chemicals space coming up in short order.
Welcome back. That's a large order. Kalpataru has just announced 2,720 crores, TND Buildings Factories business. And the stock has also been doing fairly okay. Deepan, thanks for staying back. Any new ideas, anything new? Kalpataru news is just flashing on the screen. Auto stocks have had a great rally. So give us some more names, some new ideas.
In this Kalpataru itself, it's a great story. And it started with transmission distribution, and now it's into many other infrastructure projects and phenomenal order book position 3-4 years or so. Another company in the similar line which is worth considering is Transrail. And if you compare Transrail, Kalpataru and KEC, Transrail has the best growth dynamics, reasonable valuation also. And all this renewable energy is really driving the revenues for such companies which are into transmission towers or into transformers for that matter, overall, when they're into any power distribution equipment. So that's, I think, a high growth sector at this point of time. And there are many ideas over there. And again, now look at these, these solar equipment manufacturing companies, the way the orders are coming, whether it's Premier or Vari or Vikram Solar, I think all of these companies, we are seeing a great deal of growth. I think they've been subdued because of the Trump tariffs, and therefore exports to US may get affected. But domestic demand excluding US also has turned out to be very good. And these companies are all going for backward integration to improve their margins. And again, sitting on 3-4 years type of an order book position, reasonable valuations in a high growth sector. So I think these are the pockets that investors need to look for at a time when a large swath of companies, large sectors like software, like FMCG, to an extent pharma, there's hardly any growth. So we have to look for such pockets, such niches, to find the higher returns per se. Oh shit!
What?
Sorry.
No, you're there.
Okay, we can hear you. We can hear you.
I thought I was on mute. Sorry about that. Yeah.
No. We would have. You're perfectly audible. You're perfectly fine. But happens. The rupee is opened as well, 88.12 compared to 88.1. That's essentially the last close. So absolutely flattish is where we are starting. Deepan, in the financial space, gold is the one segment which continues to run higher and higher and higher. What is your sense? I mean, there are those who say, so it's a simple thing, right? If you look at gold, the tonnage with gold companies, gold finance companies, that is not going up in proportion to the AUM growth, which means, it's a broad conclusion that it's the price of gold which is going up, which is enabling existing customers to borrow more. So as you keep going higher and gold prices keep going higher, you think the risk goes up a little bit at the margin? And it's related to gold prices, and if they see a pullback, in terms of actual end losses for customers, but we've not had this kind of a gold rally, so we don't know. But historically, losses, credit costs are very low. I'm talking about names like Muthoot, Manappuram, etc.
See, that's right, and Manappuram is very different from Muthoot and some of the other gold financiers. They're really nice, conservative, highly focused, system-driven gold lending company. And they have dealt with such corrections in the past as well. So, they will have their risk management parameters in place as well. And certainly higher gold prices means that they can lend more easily. These loans are typically short-term loans, very good spreads between the gold loan and what the rate of interest these companies are buying at. In any case, lower interest rates, higher liquidity benefit NBFCs. So very positive on gold loan companies. But Manappuram more than Muthoot. Muthoot has got into many things, and especially their microfinance division that has been bleeding, and they're going into so many other products, and that's kind of, vitiating their focus area. Whereas Manappuram is sticking to its knitting, and that's very positive.
Since we're talking NBFCs, Deepan, we're getting to speak with the Chola Finance today. And obviously, we'll find out what the GST cuts mean for the large chunk of their business, which is autos. But otherwise, how do you view Chola? And tell us if you want any specific questions to be asked of the management. Of course, we'll take that forward.
So first a disclosure, it's one of my favorite NBFC companies.
Okay.
Invested in it for past several years or so, along with Bajaj Finance. And again, I think a superb management, great systems in terms of managing risk. When the entire NBFC sector was going through turmoil, this is one company which managed its NPAs really well. They are slowly and steadily getting into many products, including housing loans and a lot of other products and other loans as well. And of course, the core business of vehicle financing, they have a very nice niche over there. So very positive on the company. I think it trades at a premium multiple, maybe even higher than Bajaj Finance. I'm not sure. So all you can ask them is, how are they managing the competitive intensity? Because gradually this entire lending business is becoming a red ocean. And with PSU banks coming back big time now that their problems are solved, I think the entire banking NBFC really need to see how they can lend safely. That means grow the AUM and yet not have NPAs 2-3 years down the line. That's a big challenge. And that's what we are trying to understand from a whole host of banks and NBFCs.
Yeah, absolutely. They've done well. Year on year growth of almost 24-25%. They've done well in the first quarter as well. But we'll definitely talk about that competitive intensity point, and we'll discuss what their plans are for the rest of the year. Thank you so much, Deepan, for joining in.
So let's keep Deepan on.
Oh, okay. Deepan.
Let's keep Deepan in. Yeah, please.
Okay. Deepan, so I think we still have a couple of more minutes, so we can quickly toss some more questions. I just wanted to ask you about these big large cap auto stocks, which have run up so well. So what should the approach be if someone's been lucky enough and managed to catch that 15-20% run on the stocks? Do you book profits, get out, or is this a longer term story that's fully entrenched after the GST cuts? So, and if you would buy anything in large cap auto, what would it be?
No, I think this auto rally has more legs, and we may be surprised by the numbers which come through, not immediately, but I think by November, December or so, and Jan is always a great month for these companies. But really the preference has to be for M&M. And I would rate M&M as the best auto company in India at this point of time. Again, disclosure, we and our clients are invested in it from many perspectives. First of all, big beneficiary of GST, a big beneficiary of very good monsoon because a lot of sales are from rural areas as well, and excellent rollout of models, and top of the line, strategy when it comes to EVs as well. So I think it's completely turned itself into one of the most vibrant auto companies. Much better than Maruti, which is just still stuck in this hybrids and ICE vehicles. and still do not have a credible EV strategy. So very positive on M&M, and different products will do well for them as well. Like tractors is a smaller division but higher operating profit margins, and they are increasing their market share as well. So as this is one company which you can make as a part of your core holding. And of course, Nigel is on the show. We cannot keep, we need to stop talking about Eicher Motors per se, but that's also done very well. And I think that also has got some more, way to go up. But again, disclosure, we and our clients are invested in these stocks.
No conversation can go by if there's Dipan and Nigel, and if Aishur is not discussed in one way or the other.
I have to confess that today I'm going to be trying out a new motorbike. It's a 650cc, but it's not a Royal Enfield. Just since we are talking about it this evening.
New set of wheels coming. All right,
Next
all
year.
right. Okay. Let's, for the time being, just shift focus and put the spotlight actually on the commodities space, on the chemical space actually. And understand what a lot of this tariff talk has meant for Indian chemical companies so far. We have Nilesh Guge, institutional analyst at HDFC Securities, joining in. Nilesh, let's just keep it very simple and start right there. So, since the tariffs came over, first 25% and 50%, what have been the changes, if at all, in the supply chains and, in shipments from India, in our imports from China, whether you're looking at agrochemicals or, let's say, API? Just tell us what the bare basic changes have been in terms of volumes, the inflow and outflow when it comes to specialty chemicals last few weeks and months.
Yeah, so see, the thing is, the things are evolving. Yesterday also there was a news that there is a bilateral discussion is going on between US and India government. So these things are evolving. Yeah, you are right. 50% tariff from the US on the India. So one should look at the commodity and the specialty chemical in different way. So the impact will be adverse on the commodity. In our opinion, we are of the opinion that commodity will be hit hardly because of if this 50% tariff on Indian manufacturers remain intact. But on the other side, if we talk about specialty chemicals, then it varies a lot depending on the chemical, the end use. For example, if suppose these chemicals are used as a additives, or there is a clear-cut advantage that Indian manufacturers enjoy because of the process innovation, then customers will continue to buy those chemicals. There should not be any impact on the volumes. They will ready to pay, or the customers will be ready to pay the higher prices, including the tariff. But things are evolving. We hope that tariff may come down a little bit after this fruitful discussion between India and US government.
Little bit, Nilesh, if it will come down, that 25% will go. You'll be at 25%, right? And then
Yeah.
that 25% perhaps is worked down.
Yes. So let's just hypothetically, if suppose this 25% tariff remain, then there is a news or the article suggests that Chinese, which are the competitor as far as the chemical industry is concerned. So Chinese manufacturers are competitors for Indian manufacturers, where there is a tariff between 27 to 30%. So there, clear-cut, there is an advantage that Indian manufacturers will enjoy. But at the same time, we should look at the Annexure 2, if there is a advantage or the exemption.
Nilesh, on the back of this, let's say 25% goes, one stock you think which has been beaten down and where you think there is upside? One name.
Yeah, it's difficult to pinpoint anyone, but I will say that commodity manufacturer will suffer a lot.
Will suffer?
Yeah, see, commodity manufacturer, see what will happen if suppose there is a 25% tariff on the Indian manufacturer, which is at par with the, let's say you can say the Chinese manufacturer. Then there will be a dumping from the Chinese. There could be chances that the Chinese manufacturer will dump those products in the market, which are, the non-US market, the other markets.
Nilesh, good luck and good drive. Thank you very much for joining us, and appreciate it very much. I think Dipan is with us. Dipan, you want to just round this off? You heard Nilesh there on the chemical space, but anything? I think you'd like one name, right, in that space?
No, I think that let me just understand how these Trump tariffs are going to actually play out, because if there are going to be tariffs on India, then the competitive position of specialty chemical companies, export-oriented ones, certainly gets affected. But by and large, I think it's a good sector to keep on your watch list. Very impressed with last 2 quarters, what numbers have come through, especially companies like SRF and Naveen have done really very well. And I think a dark horse could be Aarti, which has been, kind of struggling with growth and has had minor and major challenges. But now I think all of them are behind that. And again, a very solid manufacturer, a very strong competitive position in the world as well, cost advantage. So I think this is one sector investors should keep on their radar, and you will see an improvement in the sentiment once there's clarity on the Trump tariffs and then what exact position is there of each company in the global space and how much they're exporting to US and where exactly they stand.
All right. Deepan, thank you for staying on. Really appreciate it and look forward to our next one. So that's Deepan Mehta with the perspective on markets. Let's get some more calls out of the way. Sudarshan is back with us. Sudarshan, what do you have?
It's Mazagon Docs buy with a stop under 2704.
Mitesh, what about you?
I'll go with a long on Jubilant Foods for targets of 680.
Okay. Mazgaon and Jubilant Foodworks are Sudarshan and Mitesh's calls respectively at 9:10. We just want to highlight one more name, right? NTPC. As we run up to the market opening. Vivek is here to tell us why. Vivek, morning.
Well, good morning. The stock has underperformed quite significantly. Power demand has been quite low. Execution challenges has been something that the company has been grappling with. Today, a very interesting note coming from HSBC. They, number one, go ahead and take note and take cognizance of all of these challenges. But what they've done is they've upgraded the stock to a buy rating from a hold earlier. They've also raised the target price to 400 from 385. They believe that the company is at the forefront of power management as well as generation. And they believe the latest arsenal as far as the company's repository is concerned is battery as well as the nuclear opportunity. Now, what they're saying, what drove the underperformance? Slowness in power demand, delays in execution, and they believe going forward that should reverse. Number one, they believe power demand will actually benefit from what is essentially a low base of FY25. Remember, FY25 actually suffered due to a high base of FY24. Now, along with that, the thermal execution challenges that the company faced, that also is now being sorted out. They believe 2 thermal power plants of close to 1.3 gigawatt have already been commissioned. Along with that, the important part is that significant capex of almost 4 trillion rupees that the company has planned is actually under the regulated tariff mechanism. So an upgrade coming in from NTPC or from HLPC on NTPC, that stock will be in focus.
Okay, all right, got it, Vivek. Thank you very much for that. The pre-open session has settled. It's very quiet, 27 points down on the Nifty. Let's quickly check the stocks that have been in news, starting with Tega Industries. Tega's absolutely flat, not giving away anything. So that's how the market is looking at the first glance, looking at the acquisition. We'll see how it goes. TCS is the one to note because now after Infosys' board meeting is today on that buyback. Now it's all eyes on TCS, whether TCS is going to do something similar. The commentary, as CLSA pointed out in the investor call, was sounding a little more optimistic than what we've heard at the end of Q1. Apart from that, RVNL on the order win, up about 1.5%. GAIL was our standout brokerage note of the morning. That stock's up about 1% as well. It's pretty quiet. Jupiter Wagons won a lot of orders. Keep that stock on your radar. It's up 4% in the pre.
All right on cue, we've got the market opening coming up. 22 points lower on the Nifty, 94 lower, 9,800 points lower on the Sensex. So those are first rates coming through. It's a quieter kind of start as compared to what we've had over the last few sessions. You've got the small cap index, though, which is starting with about a 0.25% gain. The mid cap index has also got some gain, but nothing very much at all. It's flattish. So it's actually the small cap space, which is out of the 4 indices, looking a little better this morning. So the Nifty heat map should come up in short order, and we'll take a look at what's opening and how many up and down. I mean, it's almost evenly balanced, right? In terms of neither here nor there, no directional push so far. And I think it reflects on the Nifty 50 heat map, almost 25 up and 25 down. So Adani Ports, NTPC on one end, NTPC we just pointed out, and of course you've got a couple of life insurance and tech companies on the other side. Of course, IT's seen some reversal over the last 2 days or so. Sylvie.
Okay, Adani Ports, by the way, has also done a very small acquisition, one of their subsidiaries. Stocks up 1%, a little over 1% this morning. Looking at TCS next, CLSA believes TCS could be doing a 20,000 crore rupee buyback at some point, further down the road this year, following in Infosys' footsteps. Infosys itself, today is the board meeting. Stock is down about 1%. It's cooling off after its good run so far this week. Let's see what else is working in favor of the Nifty. Eternal, 1%. NTPC, the stock that we just discussed, 1%. ONGC is also up and about, and there's some buying that's returned to Mahindra and Mahindra, which is up 0.5%. But on the flip side, you actually have more of the IT names cooling off. It's not just Infosys. Even Wipro is slightly lower. Eicher Motors down slightly. And some of the bigger banking names like HDFC Bank and ICICI Bank are lower. Quarter to about 0.5% lower, keeping a lid on the gain. So the net result is very quiet. 11 points down on the Nifty. Nigel.
Well, from the broader markets, there are quite a few movers. And let's take a look at Tega Industries. They've gone to bite big. For the time being, the street has been pretty okay with it, actually. The stock is down, I think, only around 1.5% or thereabouts. They are looking at scaling up big time in the coming years. But, in the near term, that could be a bit of a debt worry. Though they're going to be on the roads and, in fact, trying to raise some equity. So I think 1% down is actually par for the course. One would have feared that it could be down far more. This is only initial rates. Let's see how it goes. For the time being, the stock is down 1.5%. Stocks that are doing well. Indo count, zooming away, massive volumes out there. That stock is bursting at the seam. Just take a look at that Indo count, not Indo Borax. I think we should get that one up for you on the screen. Jupiter Wagons, that's the other stock that's doing well. They've received a letter of acceptance from the Ministry of Railways and the Railway Board. Their value is approximately 113 crores odd. So that's why, in fact, that stock is up and about in today's trading session. Diffusion Engineers, that's the other stock, in fact, that's moving higher, I think. Let's pull that one. Recently listed company. That one is holding high with a gain of 3%. Volumes are rather large out there. Oracle, they have disclosed that, what's happening at the parent doesn't have any material bearing on our company. But the street, in fact, is reading it otherwise. Yesterday, it had a big run. Today, it's up another 3.5%. I'll tell you what. Yesterday, there was fresh buying. Today, the shorts could start scampering for cover, and that's why that stock is up 3.5%. MobiWick, another stock that's moved from 240 to 340 rupees. It corrected close to around 5 to 8% in the last few trading sessions. Today, volumes are high on that one. So, flattish start on the headline index, but individual stocks doing a thing of their own. Prashant.
Absolutely. And, it's that kind of a day where you don't have very much by way of movement on the at a headline level. But yeah, stocks are a different story altogether. So we'll have more coming up in terms of individual movers. It's quite 17, 18 points in the Nifty, so just under 25,000 levels. And we're exactly at, a bit of a, I think we're at the moving average as well. So 24,980 or 24,990 is around where the 20 days sits as of yesterday's close. So you're exactly there. In terms of where the market needs to, or what the market needs to sort of go above. All right, what else? More stocks in a bit, but let me also get in Harish Krishnan, co-CIO, Head of Equity at Aditya Birla Sun Life Asset Management Company. Harish, good morning. Great to have you with us here. Thank you very much for your time. I think we're talking for the first time since the GST cuts, Harish. So, it's a much debated topic in terms of how much a boost this will give to overall consumption, basically leaving a little bit more money in the hands of consumers, whether categories where the cuts are will see increase or, the money will find its way into other categories. So just that question, Harish, how have you and your team thought about this? You must have had discussions and has your approach changed in any way?
Yeah, I think clearly there has been a pivot from the government side to move into demand side stimulation. Over the course of from 2018 to 2023 and 24, the focus of the government was clearly on supply side, investment, capex, PLI, etc. And there seems to be a material shift in that orientation. So that is the more important point to kind of look at, especially given how investment theme has done so well in the last 5 years and the consumption theme has underperformed over that same time frame. Most of the funds and portfolios are also significantly invested in that investment theme and underinvested in the consumption theme. So that has got market implications. Now, coming to the actual boost to the economy, apart from the sentiment perspective, I think it's a reasonably good boost, both from a function of the tax cuts that got announced in February, wherein, close to about anywhere between 75,000 to 1 lakh crore kind of potential savings would accrue to the top 15% of households, because those are the ones that actually do end up paying taxes. And this one covers the entire set of population, which would be, again, as per what the government itself has put in, a net benefit of anywhere between, say, close to about 50,000 crores. But that's the here and now. I think the bigger thing is if these kind of things continue, I think it is going to lead to a lot more economic activity. Also, one of the key pushbacks of private investment has been the fact that demand has been a bit soft, and therefore there really is no real tearing hurry to kind of do investments, given the obsession that corporates have for ROEs. I think that also kind of changes a bit. So I think net, it's a very big positive, and it will require a significant change in portfolios. We've already kind of positioned for it. But I think market will start recognizing it more than the here and now of how the festive quarter, etc., kind of plays through, but more from a bigger perspective of how positioning and underinvested the overall space is.
Hi, Harish. Great to have you on the show. I was just looking at the consumption fund that you guys run, and it's fairly well diversified, right? I think it has representation from telecom, some banks like ICICI Bank as well, of course, names like M&M, ITC, so many more. So the question really is, how do you, can you effectively and efficiently also play consumption through the financials? Or is the direct route simply better? Go own the hotels, or own the airlines or the travel companies or the footwear makers? Or is the financial route a good route? And if that's the case, then what sort of financials? Because banks are very diversified. They have large, corporate books as well. And then you have a few names like Bajaj Finance on the retail side here and there. So just help us clarify the link, playing consumers through financial.
So this was the same argument, say, about 3-4 years ago, where that as the investment cycle comes through, you're going to see financials also being a way to play that same thing. And quite honestly, we haven't really seen that happen, more because they were over-owned at that point of time. Financials, were the go-to place for most funds, given the significant weightages they had in the index, etc. And they were significantly over-earning their profits from very high NIMs, very low credit costs, and the stocks just didn't perform. So therefore, to make the connection that now, here and now, consumption will start to fly and banks or lenders are going to benefit from that, I think possibly may not be, the argument that we really have. The argument for financials, of course, is that, you've got today an environment where, about the larger banks, about 4 or 5 large banks have got a significant access to capital. They're trading above book. Most of the rest of the private banking space is just about there. And therefore, in an economic environment where, competition is not coming through very significantly as far as the banking space is concerned, I think that the overall economic activity, which is to potentially double our economic size over the course of maybe the next 7, 8, or maybe 10 years, the banking system will do well. So I don't think it's necessarily just a play on consumption. It's a far bigger investment thesis, that of the supply side within the banking system actually being far more kind of in control and in check, given the regulatory environment that we have. And that's what makes us positive on the larger private sector banks in many of our.
All right, Harish, good to see you. And Harish, just hold on. I just want to focus on one stock. That's Oro Pharma. That one's bucking the trend. That's actually the high point of the day. As we speak, I think it's up close to around 4% or thereabouts. The news report that came in earlier said that GTCR is nearing a deal to buy the generic drug maker Zentiva. Remember, the street was a little bit cautious that Oro is looking to buy an entity that is too large. There was a fear of dilution, fear of debt in the books as well. So in that sense, the street could be viewing it as they are the lucky loser. So that's the reason why that stock is up. Harish, in the past you've spoken about the diagnostic, set of companies. I think you were quite bullish on there. How do you focus on, how do you play this? Pharma, till now it's been protected from those kind of tariffs. The diagnostics, hospital chains as well, they're looking interesting. There's a longer runway, but your take, how do you approach healthcare?
So from a US generic piece, I think there are some significant one-off molecules that have boosted profit pools in the last 18, 24 months that are likely to go away. And that's almost, of the aggregate profit pool, close to about 15 to 20%. And therefore, as we look at the next 18 months or so, I would imagine that the profit growth in the pharma complex, especially focused on the US generics piece, is kind of going to be underwhelming. So we've kind of actually booked profits as far as the US generic piece is concerned. What we are kind of focused on, as you rightly pointed out, is on the diagnostic piece and the domestic pharma piece, where we do think that there are some interesting trends that we see. So coming to the diagnostic setup, COVID gave a leash of life for a lot of unorganized players, given the fact that there was an excessive focus of testing. And this brought in a lot of new competition. A lot of online platforms came in with significant price cuts, etc. And this, obviously impacted the pricing power of the incumbents as well as the potential for making profits. And therefore, we've seen their stocks being on the receiving end over the course of the last 3 years or so. Fast forward to 25 and 26, what we are seeing is that the competitive activity has kind of eased up. Even the aggregator platforms have actually started increasing their pricing as they have started focusing on their IPOs and their potential to create profitability from their significant loss pools that they're currently having. The third aspect is that the incumbents are also focused on getting volume growth compared to just the margin expansion, which to our mind is the right strategy from a longer term perspective. And the fourth aspect is just the hypothesis that we have that in India we are going to see a fad or a significant kind of a move towards GLP-1. And given the fact that this is going to be at a very large base of population, we do think that there is going to be testing that is going to actually take off as doctors, physicians, as well as patients become a bit apprehensive in terms of potential side effects, if any. And therefore, that will also lead to a boost as far as demand is concerned. So this is our thesis as to why we think that diagnostics are reasonably well placed from an overall perspective over the course of the next 2-3 years.
Just I know that's very well put, Harish, and explained. Just a couple of more names, right? Oracle Financial Services is up, but it's the largest volume traded stock. Although I think I saw a flash from Oracle saying Oracle Finance saying that there's no real impact of what's happened in the US from Oracle and what Oracle has done. The Oracle stock parent was up 36%. Here, in terms of the business, there's no impact, but there's, I guess, some rub off. Jupiter Wagon is coming up as the second largest gainer now. Small name, but 8% on Jupiter Wagon. Indocount is another one, which is up 5.5%, 300 rupees. Third largest volume gainer on the NSE. There's Moschip, which is back up about 4% after, I think it took a break for 2 days on its way up, but it's coming back. And look at Tollens, which is Tollens Tires, 11% higher. I think it's a recent listing. 196 or so on this one, and it's within the top 10 volume-led gainers right now. Phase is something which Hormuz put out, and it's got volumes, but it's up 2%. Sigility is another one which is up about 4.5%, and so on and so forth. So lots of movers coming into the mix as we go through the motions. The first few minutes as far as market opening is concerned. Harish, just as we can sort of wrap up now, right? And it's, of course, as you said, it's going to get more and more, as the general belief is, again, selective from here. I know you're a close macro watcher as well, and currencies is something that you watch closely. I mean, look at what's, of course, happened to the rupee here. Any implications off of that as you look ahead?
So, from a release valve sort of thing, the government response to the tariffs that have come through from the US, which have been unfortunate and not clearly as per script, has been in terms of depreciating the currency. So the dollar itself is depreciated against most other currencies, and the Indian rupee is depreciated even against the dollar. In fact, against all trading partners calendar year till date, I think we've seen a fall of anywhere between 5% to 20%. So there has been a significant let-off as far as the currency is concerned. Now, this, to our mind, has implications actually on the IT sector.
I think we're losing the line.
Because the flowing down of revenue growth that they'll be growing at 2-4%.
Harish, go on. Please finish. I mean, I think we're losing the line towards the fag end. Go on.
Yeah. So while there has been this fear of revenue slowing down, but I think the greater fear that we had was, if the rupee were to appreciate close to about 80 because of the dollar weakness, then the margin leg for various IT services is actually in a very poor shape, and therefore there would be a further cut. I think with rupee where it is, I think that pressure of margins actually goes off. The revenue thing, like I said, expectations are quite low. It is an under-owned space. And I think, from a dark horse trade, while in the first 3 months we had private sector banks, metals and cement as the dark horse trades, now we do think that it is going to be IT services as a contrarian dark horse bet, as well as consumer, both in terms of consumer staples and consumer durables. That is where we are kind of incrementally allocating capital to kind of take into cognizance these kind of.
Okay. All right, Harish. We'll leave it on that note for today. Slightly troublesome line as well, but we got the gist of it. Thank you so much for joining in with the perspective. Well, back to the screen. And the screen's very quiet, at least at the index level. Just about 9 points up on the Nifty as we speak. Midcap index is also fairly quiet. So it's always a good idea to look at individual stocks. And there are plenty movers in this morning's action as well. And Jupiter Wagons is definitely one of them, 7.5% higher. Let's bring in, Vinny back. Vinny, you had alerted us when we were doing our top stocks to watch. And Jupiter indeed is, rising high. Railway orders, right? They've got them from the railways. Yeah,
yes,
go on.
Absolutely. They've received orders that is coming from the Western Central Railway side. And now this order is a big one. 113 crore order win is what is coming for the company. This is mainly for supply of 9,000 Fiat axles that are used mainly in the LHB coaches. Now, what does this do for the company? Because this company will further strengthen Jupiter Wagons' railway portfolio. And they've been steadily getting order wins as well in the recent times. So that's also a good sign coming in. And overall, we're seeing a bit of a decline in the stock in the recent times. So today we're seeing a bit of a up move because of that as well. And because of consistent order wins that the company has been getting over a period of time. That is interesting. Now, key will be to watch out for the execution, whether that's going to pick up now from Q2 onwards. Because till now we were seeing execution as an issue coming in for most of these railway companies. Execution is going to be the key. But today the order win is keeping the stock abuzz.
Okay, all right, Vinny, got it. Thank you very much. Actually, don't go anywhere because tell us more about Aurobindo as well. It seems that Aurobindo is out of the fray now in terms of this Zentiva acquisition.
Absolutely. Now, this is what we're picking up from Bloomberg as of now, that GTCR is nearing the deal to buy Zentiva. Now, Aurobindo Pharma, TPG, they were some of these top bidders for Zentiva as well. Now, likely, obviously, GTCR, if that comes into play, then they will be the ones that is buying Zentiva as of now. And seems like they have outbid Aurobindo Pharma as well as TPG as well. Now, previously, Aurobindo Pharma, what we had heard was in the lead for acquiring Zentiva, and that time we'd seen the stock see a fall coming in. Why? Because people were concerned that, this is a big acquisition, what would be the balance sheet of Aurobindo Pharma, and that is why that fall had come in the stock when the news had come in that Aurobindo was one of the likely bidders for that. And when Aurobindo Pharma's management spoke to us on 21st of August, they said that they were in talks with Zentiva, which were in early stages, but they highlighted that they are, going to be very mindful of any acquisition that they make, given that there are so many investor concerns coming in, that the company shouldn't be overpaying. So they were very mindful of that situation. And it seems like now GTCR is the one that will be looking to buy Zentiva as of now, as per Bloomberg.
Lucky loser. Thanks a lot for that, Vinny, for joining in, filling us in with a couple of stocks that are moving around. By the way, just keep an eye out at Adani Power. The stock was down close to around 5%. I'll tell you what, there was a large trade that took place. That large trade got cleared out of the way, and the intraday chart comes up for you on the screen. The stock has recovered close to around 6.5–7% from the day's low. So just keep an eye out on that one. Very, very large trade is what we saw in the initial minutes of trade.
Absolutely. It was also in the news. It's, with, I think, MP Power, LOA, for supply of 800 megawatts of power. So that's on the business side, and then there's a block on the trading side that has just happened. For the time being, we're putting the spotlight on the financial space, and it's time to talk to the management of Chola. Mr. Arun Selvan, President and CFO at Chola Mandalam Investments and Finance, is with us. Great to have you back on the show, sir. So, we want to focus on a couple of specific points. Let's just lay them out for our viewers. Number one, we want to understand how disbursements will perhaps shape up. Will there be improvement? Are your projections higher now for the year after the GST cuts? Of course, in the first quarter, we saw some hint of a little bit of a stress in vehicle finance. Let's find out if those trends are changing, if they're easing off. And then, of course, an outlook on the net interest margin. So, Mr. Selvan, good morning. Let's start with the first one, right? The GST bonanza coming through. But, in a very simplistic term, if I just break down the math, let's say if I was taking a loan from you for, 20 lakh rupees for a vehicle, now with the GST cut, maybe I need only a 15 lakh rupee loan. So in an absolute sense, that's lower, but maybe demand will be higher. Maybe Nigel will say he also wants to, buy a new car. So will higher demand offset the actual, reduction in prices? You've told us 20 to 25% growth, AUM growth this year. Will you be looking to increasing those estimates?
You are absolutely right that, there is a value reduction that will happen because of the GST being lower. There are two sides to this GST, reduction. One is the value, the overall, to answer your question, overall, in our view, the AUM growth, we still will hold it at the 20 to 22% levels for the full year. We will be reaching this, and there should be benefit with the number of units being sold because of the reduction in GST. And while that would have a slightly lower impact on the value, so overall we don't want to change it either positively or negatively because of the GST reduction coming into play.
But sir, earlier you said a rough growth guidance of 20 to 25%. Now you're saying 20 to 22%. So is that a slight trimming?
Yeah. There will be, we need to be, I think we even moderated it to 23%. So 20 to 23% is the numbers which we are right now working towards. It will be predominantly driven by mortgage, and then there will be 18 to 20% growth on the vehicle finance. Mortgage should grow around 25 to 30%, which comprises of the LAP, HL, and the SBPL book, which we combinedly call it as the mortgage book. We had consciously taken call on reduction in the CSEL business. While we have articulated this, the fintech business has come down. And in the SME, we have slowed down on the supply chain. So these two are taking away some, growth from the disbursement side of it, while it will have very small impact on the AUM growth. So the AUM growth will remain, we still keep it at the 20 to 23%. That would be the level we are looking at for the full year. To just answer another part of the GST implication would, also mean lower EMI burden to the customer, which would mean it will improve credit. Just wanted to add that part to it.
All right. Hi, Mr. Selvan. Good to see you in. On Surbhi's point, Nigel is not looking to buy a car. But if in case I do approach your team, I've got very good credit worthiness, never defaulted. So the track record is clean. Got that. All right. Let's focus on the disbursements then. Earlier you were guiding, I think, for around 10-12% growth. Do you think ultimately that will come about? Because, quarter two has its own share of challenges, whether it's the floods, whether the economy is still a little bit weakish. And now you'll have, some kind of uncertainty with regard to the rollout of GST, apologies for that. The second half of the year, though, is expected to be far better. Do you think that 10-12% disbursement will be achievable?
Yes. See, you are right. It has always been a case that this Q2 will always be a slow quarter because of rains and also because it has got a fair share of the period coming under inauspicious months, etc. This is more so in the case of vehicle finance. So you will see this impacting disbursement. But certainly we feel that the disbursement would be better than first quarter across all the businesses. So while it may not be significantly larger, AUM growth would be better. So as we have always been stressing that we look at AUM growth because that is the one which ultimately brings the interest income rather than the disbursement number per se. So AUM growth we still hold at the 20 to 22%. We should reach that number for the full year. And certainly the festival season and the good monsoons would augur well for the Q3 and Q4 numbers. That's the current sort of estimation that we run with.
Got that. Mr. Selvan, good morning. Prashant here. Just a quick point before, of course, I mean, this will help in many ways, GST, I mean, second order, third order derivative impact, etc. So it's all in the positive direction. But otherwise, across the industry, not for Chola, I mean, Chola is really at the top end of things in terms of growth, etc. But loan growth has been a bit of a problem. I mean, it's not panning out in numbers maybe yet, but feedback is that collections perhaps are taking a lot more effort across a range of financial companies, especially NBFCs. Is that true? And is there something which we will see over the next couple of quarters?
Yeah, it is true to some extent. I think that's the second part of your question, which was initially spoken about. Yes, that is a little bit of a higher stress on the collection, more so in the case of vehicle finance. But I think this again is a routine that we have seen earlier pre-COVID. During the COVID periods, we did not see this because the numbers were very high, and so it did not really show up. But we generally will have this cycle coming, like Q1, Q2 will always be a slower quarters. Q3, Q4 will be always a better quarter in the case of, especially in the case of vehicle finance. This sort of cyclical movement has started happening in vehicle finance post-COVID now that things have settled down. So you'll see that, panning out in this quarter as well as and improving in Q3 and Q4 when the festival season starts. This is primarily because the vehicle operators get more loads during the period of festivals and the harvest, which is when they will earn more and they will, be able to service the loan better. These are earn and pay type of customers, especially our customer profile. So there will be these sort of a slight fluctuations between the quarters.
My question was a little more broader, not the segment per se. I mean, if you rewind the clock, right? I mean, tightening by the RBI started sometime, I think, in late 2023, right? Risk weights went up, what banks lent to NBFC, and of course, what NBFCs further lent out. Then this MFI issue trouble started sometime in middle of 2024, right? Q1, Q2 of 2024. That segment, especially the MFI segment, because it touches so many households. I think 7-8 crore borrowers. So the number of households it touches is enormous. The spillover of that, I mean, is that fully understood? I mean, the slowdown in that space, while that segment may see repair and recovery, and we talk about it from a stocks angle, but is that critical for reviving lending growth? There is a bit of a pause. And that needs to start again. That cycle needs to start again. Is that an issue?
See, both the MFI and the personal loan type of lending segment is based on unsecured lending, where there is no underlying security being offered by the borrower. So there is a tendency that these segments would grow faster when there is a lot of demand, and because this leads to sort of over leveraging by the customers. But in a secured lending, ultimately the borrower has to bring a security to the table to take a loan. So in a secured lending, this becomes a little bit more organized or a little bit more controlled, that they have to find a security to start or to come and offer for a lending, whether it's gold, whether it is vehicle, whether it is mortgage. The second thing is when you are lending to a business purpose rather for a consumption purpose or a discretionary spending purpose, then the responsibility that you see with the borrowers is much more significant compared to a discretionary borrower. Or a borrower, or a person borrowing for spending on a discretionary item like buying a expensive bike or buying a consumer durable, which are not really up to his living standards. So this over leveraging tends to happen, especially like recently we're seeing a lot of people going on holidays, borrowing, which is, these things make them borrow and then get into trouble. So this is being what is getting curtailed with the recent actions of RBI, and this is where you are seeing this reduction happening. So the unsecured lending is where you will see more of these failures, and that's what we have also been slowing down on the unsecured side.
Sure. Speaking of unsecured, Mr. Selvan, just give us an overall picture on how asset quality and credit cost is moving, because in the first quarter there was some niggles over there and a slight rise in credit cost. If I have the right numbers for the full year, I think you're guiding for credit costs to be roughly 1.5%. So just tell us how the trends are shaping up in Q2 in across various segments, whether it is vehicle financing, LAP, etc.
Yeah, see, for the full year, the overall credit cost would be in the range of around 1.5 or even 1.6% as somewhere equivalent to last year levels. And if, God forbid, the monsoon gets extended into Q3 like it happened last year, then it can even be slightly higher. But going by the trend to now and going, as I said earlier, the GST impact will also have a better or implication on the collection side, because the ability of the customers to pay becomes more is improved because of that lower burden on the EMIs. These things should start playing out, and that would have a positive impact. So we will be in the range of around 1.6% on the overall NCL level. With regard to unsecured, the increase you are seeing is primarily because we are not growing the book on the fintech. So when the growth is not happening and you are cleaning up the book, this generally tends to move up, and that's what we are experiencing.
Sir, on the credit cost, I mean, your exposure to the north is very less. But given that you are present slightly, could that add some more pressure, upward pressure to credit costs because of the massive flooding and disruption that we've seen?
Yes, it does in the segments like Punjab, Arunachal Pradesh, etc. But thankfully, in those particular states, our exposures have been minimal. But this is something which happens every year. Sometimes there's flood in Kerala, like there are years when there was floods in Kerala or in West Bengal or in. So, if you look at our geographical spread, we are not concentrated on any state where our share of volume is even in double digit, maybe other than Maharashtra. So to that extent, a system is built. That is the whole point of this diversification with regard to business, with regard to geography, with regard to customer profile. It helps us manage risk when certain pockets get impacted.
Got that. A very, very useful conversation. And Mr. Selvan, those holiday loans are real, sir? I just thought they were...
Oh, they are plenty, but we don't do that.
Loans for holidays?
Yes. It's a standard. You can get offers on the on any app.
I have to get leave first. Then I will. All right. Thank you very much, Mr. Selvan. I appreciate you joining us, and important differentiation. And I think that's why you've done well with regards to some of the secured lending that you're doing. But yes, on the unsecured side, it is a bit of a problem. We'll take a quick commercial break here. We're going to come back with Anupam Rasayan management on the other side. Gopal Agarwal, CEO of the company, speaking with us on the company's export outlook and a lot more. Stay tuned.
Welcome back. Well, let's get to our next guest. We have Mr. Gopal Agarwal, the Chief Executive Officer at Anupam Rasayan India, who joins us on the show. Hi, Mr. Agarwal. Thanks a lot for joining in, sir. Just coming to you. But we've got three big talking points that we want to discuss with Mr. Agarwal. One is the export market outlook. Second, the working capital improvement. And third, the commercials of various contracts as well is what we are looking at. So let's get straight to the point then. Mr. Agarwal, thanks a lot for coming on the show. Well, exports are approximately 58% of your order book, right?
Yeah.
A lot of it is coming in from the United States as well. Could you tell us first, what does this 50% tariff mean for you? And what are your customers, your clients telling you, post this imposition of these tariffs? Please go ahead.
So first of all, let me clarify, currently, I would say almost 60% of our export is to Europe. Another, I would say 20-25% is Japan. And as far as US is concerned, it was roughly, I would say, more like 2-3% of our revenue, which is likely to grow to, let's say, 10% of the revenue this year. So from that perspective, it's not that US was a significant part of our exports. Having said that, honestly, we are not seeing, let's say, much of a challenge. As far as the customers are concerned, they have continued, to ask us to kind of build on, let's say, the production. We have not heard from them, any kind of a disruption as such. Wherein they are wanting us to kind of let's say slow down the production or anything of that sort. That's number one. Two, as I said, for us, the exports is across Europe as well as Japan, and on those geographies, leaving let's say US for a moment out, is growing significantly. For the kind of contracts we have signed, currently, let's say for example, my Japan revenue is roughly around 16-18%. With the contract in place, in 2 to 3 years, my Japan revenue could be easily 1/3 of my overall revenue. So from that perspective, we are pretty well diversified as far as our exports are concerned. So yes, would there be kind of a, let's say, some short-term impact of the tariff? The answer is yes, but I don't really see that should really impact not only us, but any of the chemical guys in the long run.
That's good clarification. So currently, US is extremely small, 2 to 3%, but you're saying that it could go to double digits. By when does that happen?
By the year end.
By the year end. All right. Got it. Let's move on then. Your order book, I think if I got that number correct, is around 14,600 crores. You have around 15 orders, out of which 11 are still letter of intents. Could you tell us when do these become final agreements? When do these contracts get commercialized? Some broad idea in terms of margins.
So thanks for asking this question. See, in our case, letter of intent is as good as a contract. The way it works is that before we get into signing a letter of intent, it's an effort of anywhere between 2 to 5 years, wherein the product goes through all the, what would you call, certification, let's say in case of agro registration, in different geographies, it passes through, let's say commercial test, pilot test and all of that. So LOI for us, it's a more of a nomenclature, which is just kind of, let's say, at the fag end of a contract. And in fact, in some cases, we even start supplying commercially, on the basis of LOI itself. Number two, all of these LOI, given most of our customers are MNCs, it does require a board approval from their perspective. So, for all practical purposes, I would say these LOIs are as good as contract.
Can you give us some idea about your working capital? Because you have indicated that there's been a big increase in working capital. So from how many days to how many days? How long do you expect this to last? And what are the options available to try and kind of limit the impact?
So, Surbi, I would say maybe a bit of a longer answer to this. Given the kind of a business we are into it, we are largely a B2B player, working with, I would say, the top-notch MNCs. And our contracts are basically long-term, which run anywhere between minimum of 5 to 7 years. Of course, we have had, situation where, some of our customers and product contracts have been running for maybe over 20 years or 30 years. So that's kind of one part of it. Given in most of our, let's say, contracts, we are either the primary or the exclusive supplier to our customer. So, while I may be supplying, let's say, a material or a molecule worth $10 to $20 million, to my customer, but his end molecule is maybe worth $1 billion. So, from that perspective, I become pretty, let's say, important, to ensure that the supply chain is kind of taken care, without which, his end molecule could be a bit of a challenge. and which is where, as part of the contract, we are expected to maintain anywhere between, let's say, a overall inventory of 5 to 6 months, given the criticality of the product. And, we need to have certain amount of stuff at our plant, certain at Indian ports, certain at foreign ports. So from that perspective, I would say for the kind of business we are into it, and given the kind of EBITDA margin, of anywhere between 24 to 26%, which we enjoy, we do have, let's say, a working capital cycle, which is 6 months. Having said that,
6 months.
Yeah, having said that, there were definitely a bit of a, I would say, headwinds, across globally, for the chemical companies and agrochemical in particular, in last, I would say, 6 to 7 quarters. So to that extent, one has definitely seen a much higher working capital kind of accumulating, for us. But if you would see, my Q1 numbers, very clearly, you have seen a significant jump in our revenue. I mean, our quarter, year-on-year revenue, my Q1 FY25 revenue grew almost 100% compared to the last year.
Absolutely. Absolutely. No, Mr. Agarwal, I understand it's the nature of your business. We're just trying to get an idea about the number. I'll come to the growth as well.
Yeah.
So just quantify this, given everything that's happening and the tariffs for now, they're here. But what is the visibility? How much will you grow your top line by this year? Can you retain margins at around 26%? And what will be the number of working capital days?
So as far as the growth is concerned, again, I think if you take out those 2 years, we as a company have grown at 25 to 30% CAGR, and we will continue to grow at that or even higher, given the kind of a contracts which we have signed, let's say, over last 2 years. That's number one. Two, as far as the margins are concerned, most of our contract, would have margin anywhere between that 22 to 26%. So from that perspective, I think we will maintain our EBITDA margin even going forward. As far as
you will maintain the margin, correct. And the revenue you said for this year?
For this year, as I said, I can't kind of guide you, but you have the Q1 number. If that is any indication, I can tell you. As I said, we are more than going to come back, to the glory days for sure.
All right. What about pharma revenues? They used to be at, I think, around 25 crores, or that scaled to around 75 crores. Could you tell us, is this LOI based, non-LOI based, and where do you see this number headed?
So pharma, our strategy, is very clear where, we are making what we call as KSM, key starting material. And this is basically an import substitute. And as far as the percentage is concerned, this year, my pharma revenue would be 20% of my overall revenue. So pharma has grown, I would say, very significantly for us compared to maybe, let's say, 4-5%. It's almost going to be 20% this year. And we do see, this number growing, let's say, both in terms of absolute and even in terms of percentage. So pharma has been definitely, I would say, one of the what we call good kicker, in terms of the growth for the current year as well as going forward.
Okay.
Yeah.
Yeah, Gopal, back to glory days. Look forward to it and look forward to our next conversation. Thank you very much. Good luck as you execute at Anupam Rasayan. Thank you very much. I just want to make a quick mention of 2 names if we can. I know we have an important conversation, but pull up Indoco Remedies. Stock is shooting up 13-14%. I'm not sure if there's any news flow. That is Indoco. And the other one is Piccadilly. Piccadilly, huge volumes and stocks up 12.5% as we speak. So that is Indoco. And the other one is Piccadilly, which is the alcoholic beverage company, which is at about 717 at this point in time. All right, there you go. That's the one. The big conversation from the auto space, right? Let's now go across to the 65th Siam conference for a CNBC TV at an exclusive. Tarun Garg of Hyundai Motor India, my colleague Parikshit waiting to interact with him. Parikshit, over to you.
Well, yes, the Siam convention has kicked off in New Delhi. It's the annual gathering of top automobile leaders and thought leaders here in the capital. And with us is Hyundai's Chief Operating Officer and whole-time Director, Tarun Garg. Mr. Garg, thank you very much. Welcome to CNBC TV 18. We're kicking off the Siam convention coverage with you. Let me begin by asking you about the GST cut and how is it immediately giving a positive impetus to sales, demand and bookings?
Parikshit, thank you very much for having me here. And at the outset, we at Hyundai Motor India Limited would like to really thank the Honorable Prime Minister for ushering in these huge GST reforms. We believe very strongly that these reforms are not only going to really give a huge impetus to the economy, But specifically talking about the automobile industry, very, very positive. You mentioned about the initial response. I think the response has been extremely good. There's a lot of enthusiasm in the entire chain, you know, not only from dealers' perspective, the customers, the bookings. Last few days, the booking momentum has really gone up dramatically. And we are very happy because, as you know, the biggest festival of India, starting with Navratras, is just around the corner, and then followed by Diwali. Of course, the marriage season. I think these GST reforms have really come at the very, very right time.
All right. Could you give us a sense of the kind of growth that you're looking at in the festive season? I know it cannot be a month-to-month comparison, but overall, this festive season compared to last year, the growth?
So, Parikshit, if you see, the CAGR, 5-year CAGR for the Indian industry has been at about 4.5% to 5%. However, because of the geopolitical situation and whatever is happening around the world, we saw that this financial year, April to August, the industry is at about -2. I believe now there are about 7 months left in the year. I think kick-starting from September, hopefully we would achieve the CAGR growth, you know, so maybe this about 5%. So -2, the swing will be about 5%. So 7% swing from -2 to 5, I'm expecting going forward. September onwards, not only for this financial year, but going forward as well. Let me tell you, I have been in the industry for 32 years. At least last 20 years, never before such a big change has happened. So earlier, excise duty went down sometimes by 4%, 6%, at the max 8%. But this GST is 10% cut, you know, especially for less than 4-meter cars. I think it's absolutely fabulous, and I believe this will be a huge impetus.
So expecting a 5% growth overall in the festive season and for the full fiscal?
Yes, I said for the period coming now. So September to March, probably we can look. Look, it's very difficult to really have a very exact number, but I believe that the swing from -2 to 5 is just around the corner.
All right. Now, in terms of surge in bookings, is there an actual surge that you're seeing both in rural and urban areas? And what would be the quantum of increase?
Yes. So there are 2-3 things which are happening here, in fact. One is rural, as it is last 2-3 years, was doing very well because of the infrastructure, because of the good monsoons, the minimum support price. So at Hyundai, the rural penetration had gone up from 19% to 23%. And also the SUV contribution in rural had gone equal to the urban contribution, you know. So we are seeing now, the good thing is last 2-3 days, it's too early to say, last 2-3 days, both rural and urban are showing a very positive uptick. Of course, customers are booking also in anticipation of the Navratras. As you know, Navratras are very big in West, in North, in Central. And also some of the customers who had withheld the purchases, like for Onam and all, are also coming out now and booking for the post-GST.
Okay. To speak to you about your growth in exports. Now, you are reporting double-digit growth in exports in FY26 so far. How do you see it for the rest of the year?
So I think this is a very, very important point, Parikshit. If you see, I would say that exports anyway, because of the situation in the domestic market and the macroeconomic situation, like I said, the industry was not really growing last few months in the domestic market, but we had an impetus on exports. We are very, very strong. We are outside of Korea, we are Hyundai's biggest base, especially for the emerging markets. We believe now it will be a double engine growth. So exports will continue to grow. You know, like I said, 12.5% growth already April to August. Going forward, we believe we have already given a guidance for about 9% for this year. Now that the domestic also starts coming into growth, this will be like a double engine growth for Hyundai. And to add to it, the new plant is around the corner. I think come October, we'll have the SOP of the Pune plant. We are all very excited because our capacity goes up from 824,000 in Chennai to now 170,000 more. So we are almost reaching close to 1 million. I think we could not have had a better timing for the Pune plant.
Right. Could you give us a sense of when will this Pune plant come on stream?
So, like I said, Q3 of financial 25-26, the Pune plant will come on stream, and the phase 1 will have 170,000 capacity, which starts kicking in right from the first month.
Right. How do you see the GST changes changing consumer preferences in terms of buying cars? Because the EV cost differential has come down. Hybrids also will now be taxed at the same rate as ICE in small and large cars.
So look, there will be many things which will happen now. I think one is, if you see at the base of the pyramid, the car penetration in India is only about 34 per thousand. I believe with the 10% cut in the smaller cars, it will bring in so many new customers. The first-time buyers, which Hyundai anyway is seeing a big jump. First-time buyers in 2020 used to be about 31%. Now they are at 39.5%. I believe we have a potential to go up to maybe 42, 43% in first-time buyers. So more small car selling. The second thing I think which will be much more significant is, if you see the customer affordability remains the same in terms of how much he can spend. However, the car becomes cheaper, which means its initial signs, maybe the customers will now again go back to the higher trims, because last 1 year we are seeing that customers were moving down from higher trims to middle trims to lower trim. But now there's an opportunity, because India is a very, very aspirational country, and again I think customers will want not only safety but connectivity. We are seeing a huge jump in the ADAS level 2. We are seeing that connectivity is going up. We are seeing sunroofs. We are seeing customers wanting the better stereo system. AVNT. So my point is that the aspirations will also come in. So this is the second part of it. The third part of it is, if you see, I think it's a very simple GST structure, no complications, no SAS. I think the opportunity is there for everybody to grab, whether it is petrol, CNG, whether it is, like you said, electrics. You mentioned that the gap is reducing between small cars, petrol and electric. But I would say, if you see the momentum of electrics, last couple of years, electric was somehow stagnant at 2.4%. But this year, if you see, in August, the penetration has already reached 6%. So this is a huge jump. I think the direction is very clear. Customers are really buying it, not only from a total cost of ownership point of view, but also from the commitment to environment point of view. And more charging infrastructure is coming up with the PM E-Drive scheme. And Hyundai also, if you see, whether it is the AC chargers, almost more than 950, DC chargers, 119, the big highways in India, we are going very aggressive. By 2032, we believe that the DC chargers will be upside of 600. So the entire ecosystem is going to support the EVs. We have already announced 26 new models, including upgrades by financial 30, which will have EVs, which will have hybrids as well. So I think the opportunity is there for anybody to grab. India is a very big market. Right. Every geography, every segment behaves differently. I think whether it is EVs, whether it is petrol, CNG, hybrids, everybody will have an opportunity.
So how much of your portfolio will now be in the 18% tax bracket? How much in the 40% tax bracket, and how much in 5%?
So that is $1 million question. As of now, we are 60% in the 18% bracket, and in terms of IC engines, and 40% in the 28% bracket. Let us see, because if you see last few years, customers are moving towards SUVs. But at the same time, I believe, and this is, I'll stick my neck out, I would say in the less than 10 lakh rupees segment, especially the Exter segment, could see a huge growth, because that gives the customers the space, the SUV like body type, the ground clearance, the safety in terms of 6 airbags, the style, as well as the affordability. So I think I am really betting that segment will see a big growth, because that takes care of the price as well as aspiration. Right. And like I mentioned, going forward with our new product cycle coming in, I think we have across the range, we have huge opportunity, and we are going to really go for it.
All right. So would you say that sub 10 lakh is a segment you'll focus on aggressively?
I would say sub 10 lakh anyway is contributing 60% to our sales, and customers have been moving to more than 10 lakhs. If you see, plus customers have been moving to SUVs. I think what this GST cut will do is that SUVs in the less than 10 lakh segment will probably see a very big growth, and there is a huge opportunity there, especially if you are able to give the customers the right features in terms of connectivity, in terms of ADAS, in terms of sunroofs, in terms of automatics. I think this is one very big opportunity.
Okay, well, that's a very interesting conversation with the top management at Hyundai Motor. 2488 stocks absolutely flat right now. We'll slip into a quick commercial break here. On the other side, Somal Mehta will be with us of Mirai Asset Sharekhan for a quick technical check of things coming up. Okay, markets kind of come off and cooled off a little bit. We had a nice run off the lower end of the ranges. So today it's a little flattish and quiet. It's been that way from the morning. We have Somil Mehta of Mirae Asset Sharekhan who's with us now. Somil, good to have you with us. Thanks very much. So what's the plan from here in terms of trades? And let's start with indices. We'll talk about some stocks.
Hi, Prashant. Good to be here on your show. Overall, bias remains positive. We may just be in this range between 25,000, 25,200 is the upper end. Lower end would be 24,600, 24,500. So that's the range. We might just stay in this range. But the plan is that we should focus more on sector-specific, stock-specific action. There are a lot of sectors which are doing good. In the last couple of days, I think PSU banking has started doing well. Defense sector has started doing well. So I'm focusing more on those side. Stock-specific, pharma stocks are doing great. So the plan is to stay more stock-specific and not go into Nifty trading or bank Nifty trading because they are in a range. It's been in a range for a very long time, and the support and resistance everybody knows. So yes, at this time I think we may just take support around 24,800, 24,700, and again resume the uptrend. And I'll be expecting the previous swing highs to break on the upside, which is around 25,600, 25,700. So yes, positive on the markets. Nifty, bank Nifty, both buy on decline should be the strategy.
Yeah, buy on decline should be the strategy. Stocks, Somil, what's on the radar?
Defense, that's the first thing I have in my radar. Mazgaon Talk looks great. Small triangle pattern has broken on the upside, taken support at 200 daily moving average. Looks great. Stop loss should be 2720 and target would be 3000. That would be my first pick. The second one is Concor. Good momentum today. So Concor has broken out of a small consolidation on the upside, taken support at 20 daily moving average. Great setup. Stop loss should be 535 and target would be 590.
I think Sudarshan had a call on Mazgaon as well in the morning. So Mazgaon is one and the other one is Container Corporation. So I'm going to get those trades from you and of course that view as well. Appreciate it. So that's Somil with Mehta with perspective on markets. Let's talk about one name now, Eternal, where we want to just run you through some brokerage calls which are coming in. Hormuz is here with that. Hormuz, over to you.
Eternal doing well today. JP Morgan has raised its target on the stock and an outperform recommendation here, a 390 rupee target now for Eternal, implying around about a 20% upside from yesterday's closing levels. And they mentioned that the recent data channel checks that they have done is confirming the fact that Blinkit is expanding its leadership over peers in multiple ways, and they are also mentioning that they can sustain Blinkit can sustain the higher growth for a longer period of time, and this is without extending their break even or turning profitable timelines. And JP Morgan has also gone on to say that they will prioritize market growth over maximizing profits over the next 2 years, which is also evident from the kind of store expansions that Blinkit has done over the last couple of quarters, and as a result of which they have increased their quick commerce gross order value expectations for FY 26, 27 and 28 by 6%, 22% and 35% in that order, but the EBITDA estimates have been left largely unchanged. So positive commentary coming in from JP Morgan with regards to Blinkit raising their price target. The stock as a result doing well today.
Okay, all right, got that, Hormuz. Thanks very much for the details. We will get into a very quick break after this and then connect with the management of MTAR Technologies. Yesterday, MTAR announced a number of orders, almost 400 crores of orders, which they'll get from Bloom Energy, which is a US-based big company in the clean energy segment. We'll find out more after the break. Welcome back. The next company on our radar is, excuse me, MTAR Technologies. We have Mr. Parvat Srinivas Reddy, MD at the company, joining in to take a couple of questions. And the company recently announced some fairly significant orders that they would be fulfilling for Bloom Energy, which of course is a company in the clean tech space. Bloom is a US entity. So the three talking points: we want to understand the scope of these new orders, the outlook on the rest of their businesses as well, which includes areas like nuclear science as well as defense, and the overall impact of US tariffs. Mr. Reddy, thank you so much for joining in. So let's start with these new orders, about 380 odd crores. You've had an ongoing, association with Bloom Energy in the past as well. I believe that these are components that you'll be supplying for things like hydrogen fuel cells. How large is this business for you? How much of this business, which is clean energy, how much is it contributing to your revenue now? And with these kind of orders coming in, what will be the contribution going forward? Just tell us everything. Margins on these orders, when do you deliver them, and when do you book it in the P&L?
The first thing is the orders what we announced is for the next calendar year. That's from January to June. In 6 months, we have to execute close to 400 crores worth of orders. I can't go into the specifics based on certain NDAs signed, but if you look at the overall picture, compared to this year to next year, it's close to 100% of revenues, more revenues being generated only in the clean energy segment. That's the kind of demand what Bloom is looking for in terms of the order execution for next year. So it's almost like doing twice as much as what we're doing this year.
Absolutely, and it's very significant, sir, because if I look at your FY25 top line, you did 676 crores of revenue. Yes. And now you've booked orders worth almost 400 crores. So it's significant. These will be executed over what time frame? So just trying to understand whether it's more over FY26 or FY27.
It's, as I said, it's over 6 months period from January to June. And then you'll see a similar orders being coming in from July to December as well. So technically, you're looking at almost like 750 to 800 crores of orders, which have to be executed within a 12 months period of span.
So, sir, I mean, since the focus is really building on clean energy, I'm trying to understand the composition of your revenue pie. Will it then be predominantly clean tech, or will your defense business, space business, nuclear, will they keep pace? I'm just trying to understand the revenue mix, say, 12 months down the line.
Obviously, with 100% growth in clean energy segment, you can't expect similar growth in other segments, right? So we have been working on this segment for the last 10, 12 years. And I've been saying this all the time that the kind of development activity we have done, innovation we have done over the years, you are seeing the results now and even in the future. But not that we are doing extremely well in nuclear as well. We're expecting huge orders coming in from nuclear division as well. And that's something we are looking forward to because we have enough technology and capacity to handle that as well. So I think overall, if you look at it, the growth in clean energy segment is very rampant. But we also will have it cannot be as rampant as clean energy, but there will be a substantial growth in nuclear segment as well.
Nuclear is also clean, right? On a lighter note.
Yeah, on a lighter note, yes.
Sir, morning, Prashant here. You did what, 700 crores in revenues in 25, FY25?
Yeah, we did about 675 or 680.
Yeah, 676 or so. What is, say 2 years, so forget 26, 27, 28. What kind of numbers do you have in mind, sir, with all of this sort of coming together?
I mean, we should cross beyond 27, 28. We should be going beyond 1,500 to 1,600 crores very comfortably. The way we are looking at the kind of orders that we are getting and the kind of innovations that we have done, not only in clean energy segment, but also in nuclear and aerospace divisions as well. So we'll go close to that mark.
Yeah. So almost basically next 3 years, you're talking about not 3 actually, 2.5 now, half the year is done for 26. You're basically looking at almost 2.5 times growth.
Yeah, if you look at 27, 28, probably 1,500 crores is what we're looking at. So
yeah,
that's where we are looking at, right?
And margins would broadly be in this region?
Yeah, they would be broadly in this region, probably with a higher revenue growth that we're going to have. Obviously, for the current year, we said 25% would be the growth, but if you look at 26, 27, the growth would be much higher. I can't quantify it right now, it's too premature. But if you look at the kind of orders that we're getting, the important thing is these orders have to be executed within 6 months to 12 months period. Like, for example, in the case of clean energy, it's not like spread over 4 years, 5 years. So that itself is getting you a lot of operational leverage in terms of improved margins. So let's see how it goes. But overall, yes, we will be moving closer to that, crossing the 1,000 crore mark next year for sure.
Just one last question from my side. What's the on the nuclear front? I mean, we are one of the few countries which has been building reactors, right? The building plants, etc. And there's an ambitious plan. There's now SMRs, and you're already supplying to Nuclear Power Corporation, etc. Or you'll start now?
We're already supplying. We are executed some projects. We are doing it for the Gorakhpur project right now, the 700 megawatts. And Kaiga 5 and 6, we are in discussions right now.
And what exactly are you supplying, sir, here on the nuclear front?
It's completely the nuclear island. The most critical equipments for the nuclear reactor is what we specialize in, which is really very key to the entire nuclear reactor. We don't get involved in civil, but on the mechanical side.
What is that? I missed that. For the reactor?
For the entire nuclear island, the entire mechanical equipments, what is it?
Okay.
For the reactor, the coolant channel, the fuel handling assemblies. They're all very key to the whole reactors.
Yeah, some very, very nuanced engineering over there. Final question, sir. This order to Bloom, I mean, these are going to be supplies that go to the US, right? So just trying to understand, what is your total US exposure right now and what happens to tariffs? I mean, it's under what kind of tariff? Not sure if it gets excluded, or if you could just tell us.
It's not excluded. Nothing is excluded right now, right? So it all depends on the demand, what the US companies have and how to take care of that. So because it's on the technology side and the entry barriers are tough, the capacities have to be in place. These things don't take, doesn't happen overnight. It takes 3-4 years or 10 years for people to even think about this.
But the components that you will ship, they will, for now at least, they will attract 50% tariff, right?
They will attract 50% tariff. Yes.
Got it. But it's such a strong sign, right? If there are, if there is precision engineering, if products and services from India are top notch, then there is a demand. Where there's a demand, I mean, the products are going even at 50% tariff. Thank you so much, sir. Great conversation and good luck to you, for all of those plans. Well, that's MTAR Tech, and as we have been speaking, take a look at what the stock has done. It started off from a flattish note, and now it's moving towards the higher points of the morning. Well, with that, it's time for us to wrap down this session of Bazaar. Thank you so much for being with us. Chartbusters comes up next.
Tega Industries, in a joint venture with Apollo Funds, is set to acquire Molycorp for over 13,200 crore rupees. Speaking to CNBC TV18, the management of Tega Industries says that the acquisition will be EPS accretive in the next 2 to around 3 years.
JP Morgan raises its target on Eternal to 390 rupees with an overweight rating, expecting quick commerce service Blinkit to sustain higher growth for the longer period of time. The stock is higher by almost 2%.
GAIL is also trading with gains of close to around 2% as Nomura issues a buy rating with a target price of 225 rupees a share. They're expecting a one-time boost to the company from the tariff hikes.
And we have Aurobindo Pharma, that's in focus as well. Our shareholders are cheering that the acquisition of Zentiva looks to be off the cards. And this after the report suggested that private equity firm GTCR is close to a deal to acquire Zentiva.
Baker Projects rises even as HDFC Mutual Fund sells close to around 9 lakh shares in a block deal. HCG, though, sees cuts after CVC sells equity in the company via large trades. Well, hello and welcome to Chartbusters. We are coming to you live from the CNBC TV18 Motilal Oswal studio. I'm Nigel. With me, it's Vinny. Hey, Vinny, good to see you. The markets are more or less flattish, but plenty of stocks on the broader markets are doing well. So I think portfolios will actually be feeling pretty good.
Absolutely. Hi, Nigel. And it's always good to anchor with you as well. Though the markets are not cheering me coming here today, I think they should also start cheering a bit more the broader end of the markets, like you're saying, right? There's no complaining on that front. Yesterday also that advance decline ratio was more in the favor of advances. Today also similarly, we're seeing that advances is outpacing in terms of the declines. But IT today, bit of that correction because 2-3 days of gains, right? So no complaining on that front as well.
Well, that's right. I'll keep an eye out on a few stocks, Vinny. If I look at, OFSs, that's Oracle Financial Services, that one, if I look at the F&O market, actually the open interest is quite high in terms of a build-up. So that's the one I'll keep on my radar because it could probably go into the F&O ban. It doesn't normally happen, but Oracle's one of those stocks that could possibly go into the ban. So we'll keep an eye on that one. But let's get a call on the index. Sachit Anand Utekar of Trade Bulls joins in for a technical check. Hi, Sachi. Good morning. Good to see you, Vin. On the Nifty, what do you do?
Good morning, Nigel. Good morning, Vinny. I think the trend is well intact. In fact, for the Nifty, the floor is now getting elevated towards 24,880. It has been confidently trending above its 5-day exponential moving average. Yes, we are still concealed within yesterday's price action, but the way the RSI is behaving, the way ADX is positioning for a breakout, I wouldn't be surprised if we see this particular rally getting unfolded towards 25,200 to 20 kind of a zone, in the coming week itself. So the bias for the Nifty remains positive. One should continue to build long positions here. From a trading perspective, one can keep a stop loss at 24,880 on closing basis and review their positions once the Nifty starts trending about 25,040 mark. When we look at Nifty Bank as well, I think there is a good convergence of its short-term averages at 54,340. So one can keep a stop loss there and expect a rally towards 54,760 soon. Even here, the data is indicating that the floor is well set here. And on the higher side, we may see an extended rally towards 55,160 in the coming week.
Okay. Hi, Sachitanand. Good morning. I just want to take a check in terms of, Sagility as well as Adani Power. They both are buzzing in trade today, but with good volumes as well. If you could check the charts of that for us.
Good morning, Vinny. Vinny, the entire group stocks are looking exciting. In fact, Adani Power has completed a breakout from a very prolonged rounding bottom formation. The neckline for the same was placed somewhere close to around 630 mark. And if you look at the way this particular level has been reached, the confidence is very much evident. And I wouldn't be surprised that we see this particular move unfolding towards 740, 760 zone. So I think one should continue holding long positions here. We have already seen some wild swings in the counter. So it's better to keep a stop loss on a closing basis below that 630 mark. On a closing basis, one can accumulate this particular counter and review positions once it starts trending around 730, 740 mark.
Okay, all right, Sachi, I wanted to ask you about CPCL, that's Chennai Petro. the stock post their quarter 1 numbers saw a sharp correction. And the problem was the street was actually bracing for decent numbers. But quarter 2 could fundamentally be good because the GRMs have gone up. There are unlikely to be a big shutdown. So we'll have to keep an eye on that. But what's the view technically on this stock?
Nigel, the price action is evolving well. In fact, we have already seen a very good sustained uptrend since the beginning of this particular year, and we have seen that the stock has also managed to sustain above its 200 weekly exponential moving average support, which is currently placed at around 675. So I think the trend has been very strong, very significant. In fact, on the higher side, we've already seen an uptick today. There are bouts of momentum, and we expect that this particular momentum may continue or may push the prices higher towards 845, 860 kind of a zone. So even from a trading perspective, one can create some fresh long positions, keeping a stop loss at around 726 on closing basis.
And also, what are your top picks other than the ones you just spoke about in terms of stocks that you're looking out for? Which are the top picks in today's trading session?
Really, Adani Enterprises, in fact, I think, there's a significant price development here. We've already seen the stock, trending near its 50-day exponential moving average, which is placed at around 2380. And the way the data is positioned, I think there could be a breakout soon above that 2400 mark as well. So we are expecting that this particular rally may extend towards 2540 on the higher side. And hence, we are recommending building fresh long positions in Adani Enterprises. One can keep a stop loss at 2355. Our disclosure would be that we have recommended this to our clients as well. And the second stock on our radar is Concor. Even here, if you look at the development, it looks like a classic inverse head and shoulder formation. Before this, the stock was in a very severe downtrend. The RSI started, showing signs of improvement. And today we have seen a confident breakout above the inverse head and shoulder neckline, which is placed somewhere close to around 545 kind of a zone. So I think keeping a stop loss at around 547, even here, some aggressive long positions can be built. We are expecting a price target according to the pattern, which is placed somewhere close to around 596 to be achieved in a few weeks. So these are the two counters that we have also recommended to our clients.
Got it. Thanks a lot for that, Sachi. Wishing you a good trading session ahead. Let's turn our attention to our special segment there, where we get a few ideas for profit from Money Control Pro. Neha Dave joins us to help us out with the stock that she's tracking closely. Neha?
Today's stock idea is HDFC Bank. The street continues to keep a close eye on two key variables for HDFC Bank, and that is advances growth and net interest margin, both of which were impacted due to the merger. Following the merger, HDFC Bank's credit to deposit ratio had reached a high of 110%. It has improved since then and reduced to 95% thanks to strong deposit growth and slower loan growth. The management has, however, guided that the bank aims to match the industry level loan growth in FY26 and outpace it in FY27. HDFC Bank's net interest margin continues to remain low, and it stood at around 3.35%, significantly lower than the pre-merger level of above 4%. While the margin trajectory remains challenging, HDFC Bank is well positioned to benefit from the improved system level liquidity and softer interest rate cycle. And that is because the bank has a higher share of borrowings in its total funding mix post the merger. The margins will remain under pressure in Q2 FY26, but is likely to get support in the second half of the current fiscal due to phased reduction in CRR set to take effect from October. Moreover, the margins are likely to improve in the medium term as the bank replaces the high-cost market borrowings carried from the merger with low-cost deposits. Overall, the higher loan growth, better margins and stable asset quality will lead to healthy earnings growth for the bank over the next couple of years, which will pave the way for valuation re-rating. In terms of valuation, the stock is currently trading at 2 times core book value estimated for FY27 after adjusting the valuation of subsidiaries. The valuation is attractive given that the bank delivered return on asset of 1.9% and return on equity of 15% in Q1 FY26 despite the focus on balance sheet consolidation.
Thank you so much for the update coming in there. But on that note, we're going to slip into a very short break, leaving the Nifty right now at 24,987, very flat. We'll come back, get you more stock-specific action as well as more on the market. Welcome back to Chart Busters on CNBC TV 18. You know, in the last 40 odd minutes, we've seen GMDC, Hind Copper, Chennai Petro and Nalco. All these have seen a bit of a run-up in that last 40 minutes, so keep an eye out on that. But apart from that, we're also watching out for Aurobindo Pharma. That's buzzing in trade. Now, what is the reason? Now, what we're seeing is that from Bloomberg, as per the reporting by Bloomberg, GTCR is nearing the deal to buy Zentiva. Aurobindo Pharma was among the leading players to acquire Zentiva. That time we'd seen that the stock had seen a bit of a fall coming in because investors were concerned that maybe this was a very large acquisition. What would come in terms of the debt of the balance sheet for the company? You know, it could weigh on the company. So investors were concerned on this front. Now, with Bloomberg saying that maybe GTCR has emerged as the likely buyer for Zentiva, that the pressure that we were seeing on the stock, that has come off as well for the company. Now, do not forget, when we spoke to the management also in August, they said that Zentiva, they were still looking and they were in talks for that as well. But they were very mindful of that in terms of investors' outlook. And that is why maybe this decision is something they are coming in and GTCR is among the buyers over there. But on that note, let's move on and shifting focus to the 65th Siam convention which is underway. My colleague Parikshit spoke to Maruti Suzuki's Partho Banerjee on the GST rate cuts and festive season sales outlook as well. Listen into that conversation.
I think this is a very big reform which is happening from 22nd of September. It does not only kickstart the auto industry, but across all other industries also. Everybody is going to benefit and the common man is going to be a big beneficiary. On the top of it, I think the two more things I would like to bring in the knowledge is one, the benefit which was passed on through the income tax by the Honorable Finance Minister. And also I think the RBI Governor has done a very good job in terms of reducing the repo rates. So I think it's a combination now of the GST, then the benefit which is passed on through the income tax, and third is the repo rate. So I think it's going to be a bumper sales in this festival time.
All right. So you're expecting a bumper festive season. In terms of how this festive season compares to last year, what kind of a uptick and outlook would you have?
First of all, I think you can't compare month to month because last year the Navratra started in the month of October. And this year the Navratra is early, starts in the month of September. So if you compare month on month, it will be a wrong comparison. But my take is this, if you take the span of the festival of the 45 days, starting from Navratra to Diwali, at least there should be a growth of more than 20%.
More than 20% growth you're expecting over last year?
Retail I'm talking about.
Retails. In terms of the increase in bookings, since the time this GST cut was announced, have you seen a substantial surge in bookings?
If you ask me, yes. I think first of all, the inquiries have gone up to the tune of almost 15%. We are seeing a very good surge in the inquiries. And once the inquiries goes up, the booking also starts coming up.
Could you give us maybe your order book right now?
See, we were having bookings in the beginning of the month to the tune of 1.5 lakhs. And almost every day now, we are getting close to 10,000 bookings.
Right. So, how many vehicles would you possibly be targeting to deliver during Navratri, if I may ask?
I think, Parikshit, our endeavor is to serve the customers. So our channel partners are really working very hard to see to it. But you need to understand one thing, that on 22nd only we can announce the prices. And the invoicing can only happen on 22nd. So our endeavor will be to deliver as many as possible. But getting the finance done, then the insurance and getting it registered in the Vahan and then to deliver vehicles, that part also we are looking into it.
Could you give us a sense of the average price cut across?
See, in the small cars, it is to the tune of 8.5%. For the petrol vehicles we don't have the diesel vehicle. And in the bigger cars, where the GST has dropped from 45%, including the cess, to 40%, the reduction will be the tune of 3.5%.
Right. Overall, for the full year, how do you see Maruti Suzuki completing the year in terms of growth?
I can give you an estimate that we feel in the small cars, I think the challenge was the affordability. So thanks to the GST 2.0 reform, we are going to see a surge in the sales of the small cars. We are expecting that. So small cars, we are expecting a growth of at least 10%. And overall industry, we feel earlier the CAGR used to be around 6.9 to 7%. We feel that this reform will again take us back to the industry growth of 6.9 to 7%.
Right. I would also like to ask you about the demand sentiment. From the channel checks, from the inquiries that you're getting, how is the demand sentiment right now in rural, urban areas all across the country? Is it a uniform increase that you're seeing?
If you ask me, it's now euphoria across the rural also, because fortunately this year the monsoon has been pretty good. You are seeing it. And a good monsoon always results in a good harvest, and that brings in a very positivity in the rural market. So urban is already very upbeat, and we are seeing the rural also, the things are moving in the right direction.
Right. Any headwinds that you see in the market or in the economy over the next few months?
Right now we are seeing the tailwinds actually. Let's not talk about the headwinds.
All right. My final question, sir, would be on your future product launches. How many more product launches in this year? What more can we expect from Maruti stable? And let's not forget, you've launched the Victoris. How do you expect that to contribute to your sales going forward?
I think Victoris has got a very good response. I think within the launch of first 48 hours, we got 100 million plus viewers on our social media. That's a very good response. We have never seen it. It's a fantastic product, especially targeted to the Gen Z customers, because we didn't have a product which was targeting to them. And right now the response which we are getting it is amazing. We are going to announce the price of the vehicle before 22nd of September. So I think this is going to be a game changer in that segment.
Right. You also have a new electric SUV, which is going to be launched within this fiscal. That has been mentioned earlier. What I would like to ask you, sir, how do you expect SUV sales together to contribute to your overall portfolio?
Parikshit, if we see the SUV segment, there is three categories broadly: entry, mid, and the premium SUV. In the entry SUV, we are the market leaders. In mid SUV, there are more than 28 products which we count in. There our fair share was pretty low. And through this Victoris, we are trying to cater to a segment of customer to whom earlier we were not addressing it. So we are very hopeful that this is going to really be giving us good numbers in the mid SUV segment.
Okay. And any final timeline that you can give us for your remaining launches of the year?
You're talking about the e-Vitara?
E-Vitara.
Actually, we don't want to just launch a product actually in terms of electric vehicles. Our commitment is to launch an ecosystem for the electric vehicles. And we are working on it. We are putting up the fast chargers at our dealerships so that the customer, the pain points of the customers, we address it. And then only we launch the product.
But it'll be within this fiscal itself.
Yes.
Right. One more question, if I may add, and that is about the cost differential between EV and ICE going down. And hybrids will now have a uniform rate along with other ICE vehicles, either in the small car segment or in the large car segment. How do you see this changing the market?
Yes, in the hybrid vehicles, I think right now they are at par with the diesel vehicles and the petrol vehicles. But we as a company feel, being a market leader, we need to be technologically agnostic. We need to serve to all set of customers. And hybrid, there is a huge advantage today because still when we did a research with the Indian consumers pertaining to the electric vehicle, the Indian consumer has a concern with regard to the infrastructure of charging. So the hybrid is the best solution for that.
Well, the management of Maruti Suzuki is sounding extremely optimistic about the way ahead. GST 2.0 is going to be bringing back demand. They're talking about their new launch as well, Victoris, that could kickstart the demand for that mid-level segment. And the overall commentary was quite optimistic. Slip into a short break, come back. We'll focus on the markets and individual stocks. Don't go anywhere. Welcome back. Well, most of the indices are in the green. Vinny is the good luck charm, looks like today, because just take a look at that. All those 4 indices in the green. So we have kept the markets aloof. For the time being, we'll wrap up on Chartbusters, but the team of Trading Hour is waiting by. Don't go anywhere.
Good morning. It's the penultimate trading day of the week. You're watching Trading Hour. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always is Reema Tendulkar. Reema, well, good morning. After a 6-day rally, we are taking a bit of a pause today, but there are a lot of stock-specific factors that we need to watch out for. Also the fact that today, of course, is the weekly BSE expiry as well.
Indeed, and the street will await, investors will await the US CPI inflation print. But broadly, what you're seeing is IT taking a bit of a backseat, some profit booking after gaining almost 5.5% over the last 2 trading sessions. So the Nifty IT index is dragging its feet, down close to about 0.8%. And names like Infosys down 1.5%. In fact, that's the top Nifty loser ahead of its board meet to consider a buyback. Wipro, Tega Mahindra, these 2 stocks too are lower by close to about 1%. But other than that, things are on the quieter side. But there's lots of news surrounding individual stocks. Let's talk about Tega Industries because they have announced a big acquisition. We've been talking about it since morning, but let's revisit it in case you missed it. Vamakshi is now joining in with the details. What's the size of Tega Industry? Who are they buying? How much are they spending? And how are they planning to fund it, Vama?
Well, absolutely, Reema. Tega Industries just announced its boldest move yet. Now, teaming up with Apollo Funds, Tega will acquire 100% of Molycorp for an enterprise value of $1.48 billion US. That's over 13,000 crore rupees. Now, keep in mind, Tega's own market cap as of close yesterday was around 13,800 crore rupees. This buy is as big as Tega itself. But how will Tega fund this? Here's the breakdown. Tega will take 77% stake. Apollo Funds will take 23% stake in the SPV. Tega will put in $361 million US, which is roughly around 3,180 crore rupees, funded by a mix of corporate debt of almost 995 crore rupees and a fresh equity raise of around 2,184 crore rupees. In fact, Tega has scheduled a board meeting on September 13th to finalize the fundraising plans. Now, Apollo will put in the balance 950 odd crore rupees, and there's also a contingent payout of around 120 million US dollars or 1,057 crores. Now, this will be paid over the next 45 months if the performance targets are met. But apart from that, how do the financials stack up? So why Molycorp? Well, it makes the grinding media like steel balls, etc. used to extract minerals, especially gold and copper, while Tega makes the liners and wear parts that protect those mills and optimize efficiency. Now, together, they can offer customers a complete mill solution, which translates into great cross-selling opportunities. Beyond just product matchups, there's also strength in the footprint. Now, Tega has 10 manufacturing facilities and a strong presence in Europe, Middle East, LATAM, CIS, as well as Africa, while Molycorp has 13 manufacturing facilities, 3 JVs, plus a potential JV with footprint in US, Canada, Australia, and LATAM, and combined, they will have 26 manufacturing sites worldwide. Now, that's not all. Let's also take a look at how the numbers stack up. Molycorp's revenues are about 8 times that of Tega's, but margins are much lower. So the combined revenues will stand at approximately 15,200 crore rupees with a blended EBITDA margin of 12.5%. Now, the good part is that Tega is buying Molycorp at a much lower EV to EBITDA multiple, about 9 times versus its own multiple of 41 times. Now, if the integration works, this could be earnings accretive.
Got that. All right, that's important. So, as you said, right, I think what stands out is that they're making an acquisition which is as large as them, right? So, how does this Molycorp acquisition fit into the company's strategic rationale? We chatted with the management, plus you would have spoken to a lot of analysts and investors. Take us through the rationale behind it, and now as a combined entity, what would the financials look like?
Well, absolutely, Reema. I just touched upon that. But, this acquisition actually comes with very big risks as well. Now, Tega is acquiring an entity which is larger than itself, which is spread across multiple continents, aligning its operations won't be simple, therefore. Now, the other major concern is Molycorp's debt, which is at $1 billion, but the management is quite optimistic about bringing it down to $800 million. Now, the other concern is around growth. Molycorp's historical growth has been a modest 3 to 3.5%, and the management expects it to stay around that 3.5 to 4% range, which is much lower than Tega's own 15%. Now, additionally, Molycorp's margins are lower versus Tega, but they target an improvement to around 13 to 14% levels in the next 2 to 3 years combined. Now, in the next the combined entity could actually have blended margins of around 18% in 3 to 4 years. So, overall, Reema, to sum it up, this deal is a big, bold step for Tega. Investors will be watching closely to see if Tega can pull off because this move could either be a game-changing leap forward or a very expensive learning curve.
Oh, very expensive learning curve. Only time will tell if that is indeed the case. But for now, Tega Industries is trading lower. Of course, mind you, the stock before this acquisition announcement had gone up by almost 14% in the last 1 month. So, seeing some bit of profit booking there is Tega Industries after the news has played out. But we also spoke to the management exclusively earlier this morning. Listen into what they had to say.
debt at the target level is roughly about $1 billion. And the attempt is to bring the leverage down after the transaction closes. Sure, I think through the consortium arrangement that we have with Apollo, the intent is to structure the debt in a fashion that we leverage it down to around 800 million odd levels from the current billion, and that should help us deliver some improved benefits in terms of interest cost reduction with the leverage coming off, and hopefully even an improvement in the credit rating. We should be able to, the attempt is still early days, but the attempt is to at least shave off anywhere between 25 to 40 basis points of their current terms with their current lenders. I think where Molycop today operates at is at roughly around 11% EBITDA levels. Our aim would be to try and improve that over the next 2 to 3 years to, on an average, anywhere between 13 to 14% levels. Tega, as you know, operates at a CAGR of 15%, delivers about close to 22% EBITDA. So the margin profiles are different, but we hope that on a consol basis over a 3 to 4 year period, we would be roughly at about 18% on a consol basis. In our model, we've taken like a revenue growth at a very conservative level for the target. We've maintained it at about 3.5 to 4%. They're currently doing about that much. So without putting in too much of high growth pressure on the target upfront, we've kind of modeled it on a conservative basis to be around 3.5 to 4%. With Tega consistently delivering at about 15%, we're looking at leverage to come off by year 4 to about closer to 2 times of EBITDA, 2x, 2.5x EBITDA over 5 years. And we should be at an EBITDA level of close to about anywhere between 17 to 18% from third year onwards on a combined basis.
Tega Industries, the big story of the morning, 2.5% lower on the stock, had briefly moved into the green as well, but that recovery has been swiftly sold into. By the way, there is no movement on the index whatsoever, still hovering around that mark of 25,000, trading in a very narrow range, but can't take away from the fact that there are plenty of movers in the broader markets, which we will talk about as the show goes by. But some of the others in the list include the likes of Dilip Buildcon, that's up 6%. Chennai Petro is up 5.5%. Swelect Energy Systems, that stock has gone up almost 14% as we speak. So Chennai Petro is at the highest point of the day. Swelect Energy Systems too is up almost 13% as we speak. But the one that has come off significantly from the highs is Oracle Financial, OFSS. It opened higher. In the pre-market trading was up almost 6-7%, and since then has come off almost 9% from those opening highs and has now moved into the red. At the lowest point of the day is Oracle Financial as of now. What is also not doing well is Car Trade Technologies. For the second day running, the stock is down 6%, and after the decline that the stock witnessed yesterday post that downgrade that came in from JM Financial, it is the second day of losses for Car Trade Technologies, almost 6% lower on that stock as well. Take a short break. On the other side, we put the spotlight on the crypto markets with Manisha Gupta.
Finance. CNBC TV 18 presents Crypto Corner, powered by CoinDCX.
Crypto Corner, we are joined by Ishan Loya, who's a co-founder at TradingSutra.in. Ishan, hi, thank you so much for joining in. And crypto really seems to be buzzing at this point in time. 2025 has been a great year. For a new beginner in the Indian markets, what is it that you would advise? Is SIP better? Do the technical charts work? And is crypto for a long-term investment?
Correct. So first of all, thank you so much, Manisha ji, for this opportunity, and a very good morning to all your viewers. So firstly, when we talk about the early investors, so majority of the people have this query that how we should invest, first of all. Secondly, which coins to invest. So because I have met a lot of people, like thousands of people I have met. So this is the major query. So first thing, let me answer you. For a platform wise, so earlier, maybe last 5 years, 10 years back, there are not a lot of genuine platforms which were available. Currently, there are tons of genuine platforms, let's say CoinDCX and everything, where you could easily start your journey with just 100 rupees. Secondly, which coins to invest. So this is a major thing. People go on towards the meme coins and the more risky coins, like we do in trading, right? So what do we, most of the people will be able to relate with me. Let's say a stock market thing. What you initially try to do in the Nifty Bs or maybe in the Nifty 50 stocks. Here you could use a website which is known as coingecko.com. COINGECKO. So where you could filter out from the basis of market cap. So you could definitely invest that in the top 5, top 10 thing so that your money is safe, because here markets are highly volatile. So as a beginner, I would suggest you should utilize these methods and go on towards a higher market cap things.
Ishan, a question that usually is asked around is that since crypto is so volatile, do the technical charts work at all?
Definitely, technical charts work. So currently we are into this 2025 bull run, right? So 24 halving has already been done. So in 2025, you will be able to see trend following strategies. So what we do in this technical wala part. So trend following strategy is something, let's say, when the newer high is going on. So BTC currently was around $1 lakh. Initially, it made a high of $1,25,000. So this is how, whenever a new high is made, you could definitely utilize it because there are higher chances of going upwards. Secondly, you could utilize an indicator, let's say a simple and popular indicator, which is a super trend, which works definitely good. And I can assure you, ma'am, money is made over here. I have tried it and I have made it, and definitely your viewers also can.
All
so
right.
crypto market is a relatively easier market than any other market.
Oh, that's good to know, Ishan. Also, would you say that crypto is more coming into mainstream, or are we still years away from that? Would you also say that tier 2, tier 3 cities are now getting a hang of it?
Definitely, tier 2, tier 3 cities are definitely getting a hang of it. Like, I'm based out of Nagpur, and definitely I've seen tons of people talking about cryptos, having something in their wallets also. So you can talk about, let's say, Jaipur, let's say Kanpur, and a lot of Hyderabad, where you could see people and a lot of startups, not just that, maybe Web3 startups, and everything will be there. So next unicorn startups will be from this space, crypto space, and that will be from the tier 2, tier 3 cities only.
How are you also looking at the overall understanding? As you said, people are trying to now get an awareness about and are being educated about crypto as well. But crypto has moved on, right? Because we have futures and options and yield farming and lending and leasing and so much more happening here.
Correct. So crypto as a whole is a very huge thing. So you could start bit by bit over here, right? So let's say we have talked about yield farming. So everything is related to different parts. So firstly, you have to capture, okay, you have to go on to stage 1, stage 2, stage 3. First, you are utilizing the concept of staking. You could also get yield returns, what you are trying to say. Like initially, like in the DeFi zone, decentralized finance, what you could utilize, like currently we just put our money into banks and bank is providing us the FD rates. What you could do over here, you could, let's say, buy Solana or buy Ethereum and you could stake it and you could get returns on that. So this is a very upcoming sector where you could see people are utilizing the DeFi zone, which is like peer-to-peer part, decentralized finance.
Ishan, the other thing is the high volatility that crypto gives. And I know you mentioned earlier that it works well for the traders as well. But for somebody who wants to stay invested, this volatility sometimes can be unnerving. Is there enough risk management in place for this?
So definitely risk management is the only grail. So whatever you do, you have to manage your risk, right? So only holy grail is your risk management. Whatever you have, you are doing, whether you are trading, whether you're investing, you have to keep in mind. So maximum what I could do, you could have maybe like 5 to 10% of your portfolio. Maximum of that you could invest in your cryptos, so that, because crypto is a very volatile asset, right? Crypto is something which could be like 10% up in a day and 10-20% down in a day also. So for managing your risk, that should be one of the more priority. Secondly, even if you're trading with a 99% probability rate, still if you're not following the risk management, your strategy won't work, because one wrong trade can wipe out your capital. So make sure to utilize it, and definitely crypto risk management is the major part.
Yes. Ishan, one final question. And as we move ahead from here, while 2025 has been a great year, and as you mentioned, that comes in on the back of Bitcoin halving in 2024. How would you look forward to 2026 now?
So 2026, so as I said, these are phases in the market. So first phase is where the people were accumulating in 2022-23, where the big buyers were accumulating. Second phase was the awareness phase, where currently also people are gaining the confidence, okay, BTC is something which definitely helped them to create generational wealth. Third part would be the mania phase, which is gonna start from maybe October to November, where you will see the coins will rise 10x, 100x also. And last part, maybe by mid 2026, it will definitely reach a peak and it will start to fall over here. So this is how the 4 market cycle works. So currently I am very bullish on the crypto market. So for the next 6 months, 8 months, definitely it is one of the best time to stay invested in the crypto market.
All right, Ishan, thank you so much for joining in, and thank you for that very wonderful conversation. Really appreciate your time here at CNBC TV 18.
Thank you so much.
CNBC TV 18 presents Crypto Corner, powered by CoinDCX.
Welcome back. Things are quiet, at least on the Nifty and the Sensex, but the Midcap Index is outperforming yet again. It's got a gain of about 175 points. What's fueling this up move? The individual movers and shakers, with Hormus, who's at the big wall. Hormus.
Some at least 7 to 8 names on the small cap index are trading with gains in double digits, some of them even going up to 15-17% in the first couple of hours of the trading session. You start off with Ikeo Lighting Technologies, and we mentioned this stock a few weeks earlier as well, when towards the end of August, when the stock was up 20%. Today it's up 15, has gained in 3 out of the 4 trading sessions this week. This is the biggest single day gain that the stock has seen in a month, and almost 22 lakh shares have already changed hands. The 20-day average is just 3 lakh shares already. So despite this move, the stock still remains below its IPO price of 285. Indoco Remedies is the other one, and this is the biggest single day gain that the stock has seen since March, 14% higher here as well. And the stock has done well in the recent past, has gained in 7 out of the last 9 trading sessions. And today we have had 23 lakh shares change hands compared to a 20-day average of just 23,000. That's just 123 lakh, not 2 of them. Whether it's broken above its 50 and its 200-day moving average as a result of this move, but has been an underperformer this year and has been an underperformer over a prolonged period of time. 4 years of negative returns now, including this one, at least for now, for Indoco Remedies. The other one is SMS Pharma, was up yesterday, up today as well. 5th day of gains that the stock has seen today is the biggest single day gain that it has seen since April, 13% higher on that stock, as a result of which the stock has now gained almost 27% in the last 5 trading sessions. Today's volumes, well, 11 lakh shares compared to a 20-day average of just 1 lakh shares. And today's volumes, these 11 lakh shares, which means it has almost crossed yesterday's trading volume, which was around 12.5 lakh shares. And courtesy of this 5-day up move, the stock has turned positive for 2025 after having doubled in 2024. And the last one on the list, Car Trade Technologies, was down yesterday, down today as well, or 15% fall now in the last 2 trading sessions. 6 lakh shares have already changed hands, a 20-day average of 2 lakh shares. But the bigger takeaway is the fact that it is still managing to hold on to yesterday's low, which was 2222, and even today's low is around 2280. So it is managing to hold out yesterday's levels, and analysts also mentioned that the trend is so far stable as long as it manages to hold on to that level of 2222. Rima.
Gadha, thank you very much for that. Just a quick recap then of the of all the news surrounding the tech stocks today. Well, the index is under pressure because it's had 2 good days on the trot where the index rallied about 5.5%. But today, there are 3 bits of news that we'd like to update you on. First, Infosys board meet today where they will consider a buyback. The street expects a buyback in the size of 10 to 14,000 crore rupees. It will be a tender buyback, and it typically happens at a premium. Some say about 18%, 20, 25%, but part of the up move has already played out. So that's on Infosys. The second one is on TCS, and this is after CLSA met the management of TCS at an investor forum in Hong Kong. So first, when asked about demand is unchanged compared to what it was in Q1. But the management sounded incrementally more bullish on AI. So they're saying that because of the AI opportunity, the overall IT tech budgets will expand, and therefore it will be a net revenue positive for a company like TCS. And thirdly, now they believe, CLSA says that there will be pressure on TCS because Infosys come out with a guidance. TCS is eligible to come out with a guidance. They have so much cash. So now CLSA says that we think that TCS could feel the pressure and come out with a buyback, and their estimate is for 20,000 crore rupees in terms of a buyback. TCS has already done 5 buybacks. This would be the 6th one, and typically, because TCS has done tender buybacks, the last 5, the stock has been supported. So they've done the analysis of how the stock fared during all the buybacks. So on the day of the announcement, the stock pops, and even during the entire buyback period, every single time the stock has risen either 1% or up to 3.5%, 4%. That's the second one. And the third one is Oracle. Though the company has clarified, and we've been saying that there is no direct impact of Oracle's parent company's performance on OFSS. It's just that the products are the same. Only OFSS caters to the financial sector, but Oracle made big moves. It followed through. The after-hours trade was suggesting 28% rise. It ended with a gain of about 35%, and now it's closing in on the $1 trillion market capitalization. And not just that, it's resulted in a shifting of global wealth, personal wealth. Larry Ellison, founder of the company, is now the richest man.
Imagine making almost $90 billion in a single day.
101 billion.
At the day's high was 101 billion. But yeah, indeed. Imagine making 101 billion in a day. That is something at a different level, right? He briefly overtook Elon Musk as the world.
He also has a lot of stake, 41% holding.
Indeed, yes. So that's, of course, playing its part as well for Oracle. And, of course, nearing, at the day's high, briefly nearing that $1 trillion market cap as well, as Rima was highlighting. Very positive results, positive commentary as well from the management, and that quite rightly so has reflected on the stock price. Not that the stock had not moved year to date before. It was already up 45% before the results were announced. So this has added to those moves for Oracle, and of course briefly surpassing Elon Musk there, and he lifted. And now the difference between Elon Musk and Larry Ellison is now only $1 billion. So Elon Musk is at 384.
Actually, what I was reading is that Forbes is saying that Elon Musk is still the richest, while I think Bloomberg put out that Larry Ellison has overtaken it. And the difference between the two is how much you value his private investment in SpaceX. So that explains the differential. But neck to neck, right?
Neck to neck, yes.
Yeah, when you're talking about...
At this pace, well, if things go the way they are, it might just happen today itself. With the way Oracle's moving, who knows? But yes, Larry Ellison, Oracle, the talk of the town over the last couple of sessions. And of course, there are a lot of brokerage commentary that came in earlier in the day. One was, of course, on Eternal, and of course, JP Morgan coming out with a positive commentary on that. It's maintained its overweight recommendation, and it's increased its price target to 390 rupees. So that implies 20% upside from yesterday's closing levels. They focus primarily on Blinkit, and they are mentioning the fact that their channel checks have suggested that it is continuing to expand its leadership over the peers in multiple ways is Blinkit, and as a result of which they can sustain this higher growth momentum that these quick commerce players have embarked upon without any delay in turning either break even or profitable going forward as well. Of course, both companies, both Swiggy and Eternal, have laid out timelines as to when they turn profitable on a PAT basis. Well, Eternal, of course, is already profitable that way, and they also mentioned that this, as a result of all of these positive things, they are going to prioritize growth over profit maximization, and their quick commerce estimates for JP Morgan for Eternal, their gross order value estimates for FY 26, 27 and 28 have now increased by 6, 22 and 35% over the next 3 years. So positive commentary coming in for Eternal. The stock opened higher, still holding on to gains of around 1.5%.
Okay, let's move on then. NTPC is also in focus, and again here it's a brokerage note. HSBC. Vivek is here to tell us more what's driving NTPC higher by 1.5% now.
Well, that's right. Remember, NTPC has been a significant underperformer in this particular year. In fact, the entire power space, mainly on the back of the fact that you saw extended monsoon, and that actually led to a significant demand downtick as far as the entire power sector as well as the short-term power market was concerned. However, HSBC today has come out with a very interesting note. First thing is, post the underperformance of the share price, they've gone ahead and upgraded the stock to a buy from a hold rating. They've raised the targets to 400 from 385. They are saying that the company is at the forefront of power management as well as generation. They are saying that the latest arsenal in the company's repository is the battery as well as the nuclear opportunity. They do take cognizance of the fact that there was slowness in power demand and also delays in execution as far as capacity addition was concerned that led to the underperformance. However, they feel that both of these issues will now start getting addressed, and on the back of that, the stock price should reverse. They're saying power demand will benefit from a low base of FY25, which actually benefited from a higher base of FY24. And thermal execution delays, which the company was facing, is now getting sorted. 2 thermal power plants of 1.3 gigawatt have now been commissioned. More importantly, a significant part of the capex of 4 trillion out of the total planned 7 trillion actually comes under the regulated tariff mechanism, indicating that there is stable earnings visibility as far as NTPC is concerned. Along with that, it's going to be at the forefront of the nuclear energy propositions that are being carried out. So a lot of positive figures in place. Post the price correction, they find the stock quite attractive.
Find the stock quite attractive, 1.5% higher for NTPC. Vivek, thank you for that. Still very quiet on the index, still 4 points higher, almost at the flat line. It continues to remain where it started off the session with. It's been 50-point range all through the day today. So it's interesting to see what the FNO trends are indicating, particularly so, 50-point range on an expiry, on a weekly expiry day. Sudarshan is here with the FNO trends from our FNO desk. Yes, Sudarshan, 50-point range on expiry day. Well, is the second half expecting a surprise on either side? What is the FNO data indicating?
As you say, it's a quiet day. Don't you think it's been there for the last 6 trading days, even if market has been closing higher? And it looks like that even today on the expiry day also will manage to close higher. And it would be the longest gaining streak in the several months that we'll see if Nifty manages to hold above or around 25,000. But the problem that Nifty is facing, again, once intraday it crosses the level above 25,000, but it fails to hold. If yesterday IT was supporting it, today IT is one of the biggest drag on index. And even there is not much support from financials. Nifty Bank again trading around flat line. Now there is not much indication from volatility index also. It just remains around below 11, but it's flat. So how are things looking at the options front? It's the same thing that we are seeing in the cash market. If you take a look in both cash and put options, similar things you will see. So 25,000 call, premium OI buildup is being seen, but premium has fallen. 24,900 put, same thing. OI buildup is being seen, but premium has fallen. And it's the same for 24,900 put, where premium has fallen to 51 from previous close of 63. So support for Nifty, immediate support remains around 24,900. But if we fail to hold that, next support comes around 24,830. And resistance remains around recent high that we had seen of 25,150. What about Nifty Bank? Currently it's trading around 20-day moving average of 54,680. So support will remain intraday low of that is 54,400, and resistance or say major buying can be seen in Nifty Bank only if it crosses the level above 55,000. So resistance I have taken off 55,762. That is 50-day moving average. Two stocks that I have taken. You have been talking about Oracle Financial. Do you know today open interest in OFSs is up more than 31%. So there in all likelihood stock may go in F&O ban. Apart from that, Piramal Pharma is seeing fresh long. So keep an eye on both these names.
Going to F&O ban Oracle Financial. Sudarshan, thank you for that update there. Interesting from the F&O desk on a relatively quiet first half of the weekly expiry. But what does the second half have in store on the charts as well? Let's get Jay Thakkar from ICICI Securities to answer just that. Jay, good morning. Thank you for joining in. That 25,000 continues to be a brick wall for the index as of now. But do you believe that there is enough strength to go past that wall in the second half of the trading session? Your call here and on your specific stock recommendations as well.
Good morning to you, Humaz and Rima. Well, see, that's a very tricky question. I would say, Humaz, on the weekly expiry day, now what happened of Sensex, obviously. But then, on this weekly expiry day of Nifty, we saw that Nifty traded within a range of, say, 50 points. It was in the range, broadly did not break 24,800, as well as 24,900 on the upside, and we saw approximately 24,868.50 kind of an expiry, and for that Sensex would be 81,500 today. If it is likely to if the expiry of the Sensex is likely to be that of Nifty. However, one thing Hormaz one should be looking at is that at 25,000 there is good put additions as well. Although Nifty is trading below those levels on spot, the futures is above those levels, and we are seeing if 25,000 levels are held on futures, I think the probability of Nifty inching towards 25,200 is quite high, because slowly, gradually, what we have seen is that the FIIs sell figure in the cash market has reduced, at least in past couple of trading sessions, 6 to 7 trading sessions. The net long percentage has now moved beyond 10%, so that is also positive. The VIX, obviously, it's at the lower levels, which was expected to move higher, didn't go up, is stable. So, at least it can help to bounce back. It can help Nifty to bounce back slowly, gradually. As I said, Hormaz sectoral performance is seen wherever we had shorts. So probably, maybe Nifty Defense, Nifty Energy today, Nifty PSU Bank Index, Nifty IT, which you have seen. So the only one which is left now is the banking and financial. Maybe financial is also one thing which we have seen perform quite well. So Nifty private sector banks particularly is down by almost like 8 to 10%, and that's been underperforming for Hormaz. And if that come back, makes a comeback, even for that matter, and till 55,000 levels, I think it will help Nifty to push beyond 25,000 and inch towards 25,200 levels. So I think that if not today, but for this weekly expiry for Nifty, eventually 25,000 levels will be taken off, is what I think, and it will inch towards 25,200. Now, since we have this view, and from the short covering point of view, I have a couple of buy recommendations. A few of them are from the defense name. One is on BD at futures. I think it's looking good at these levels. It can inch towards 1650 levels in the short term, based on short covering, and even for that matter, Mazgaon Dock. As a disclaimer, we had recommended Mazgaon Dock, and we have advised to book profits out there as well. But then still, it's looking good at least until the levels of 3,000 on the upside. So these two stocks from the defense names are looking positive, and from the Nifty Energy back, I think Siemens is looking positive at the current market price. It's been consolidating since a couple of trading sessions now, but it's likely to provide a breakout Hormaz on the upside. So Siemens on the upside can inch towards the levels of 3,400. On the lower side, 3,100 is a good support. So there is a better risk reward there.
Jay, thank you for sparing time and joining us with your views on the index and on specific stocks as well. Flashes on your screen, some more exclusive information coming in that market regulator SEBI is looking to float a consultation paper to consider ending the weekly FNO contracts, and the consultation paper on ending the weekly expiry is likely to come out within a month, and we'll get more details on this, but it is planning to transition to a monthly expiry with a defined glide path, and they may consider the same day expiry across all exchanges. There's a lot of back and forth over Tuesday and Thursday, eventually with NSE now moving to a Tuesday expiry, BSE moving to Thursday. The SEBI board is likely to have been briefed on a longer derivative tenure, is likely to be briefed at the board meeting that is supposed to take place tomorrow, and the consultation with the exchanges is likely to begin from next week. So important exclusive information, and the consultation paper may also propose some curbs to reduce the retail participation in the FNO segment. So even more information there, and thresholds could be proposed to limit the retail entry into the derivatives market. Showing up on the stock reaction on BSE now at the lowest point of the day, 3.5% lower on the stock. And so we'll get you more details for this as the day goes by. But for now, the important information is that a consultation paper to curb weekly expiries and take a glide path towards monthly expiries will also be proposed in the consultation paper. The SEBI chairman had also made this remark on the 21st of August as well. BSE for now 3% lower on the stock. Take a short break. On the other side, continuing our conversation with the markets with Deepika Mundra from MNG Investments. Stay tuned, we'll be right back.
Sources are indicating to CNBC TV18 the broad intent in the government is to reducing the rates, and it is likely to propose to keep as many as commonly used items in the 5% slab.
What we are given to understand from sources is the fact that the industry has written to Finance Ministry seeking some key changes in the GST structure to expand the tax base. Well, in what could be a major overhaul of India's indirect tax regime, the government is likely to propose a simplified 3-rate structure in the GST regime in the upcoming GST Council meeting, potentially eliminating the 12% slab.
The government is considering GST relief for a slew of sectors, including textile and the medical sectors.
GST Council meeting on 3rd and 4th of September will have to give an approval paving way to what PM mentioned to a 2-slab structure, that is 5% and 18%, and a special rate of 40%. Well, the upcoming GST Council meeting on 3rd and 4th of September is likely to see a major GST overhaul, especially trying to give a consumption boost to the domestic economy. Firstly, a unanimous decision moving from a 4-slab structure to a 2-slab structure and a special rate, 5%, 18% to kick in from 22nd of September.
I'll give you this number which is important. 99% of all the goods and services which are touched by GST are now either in 0 or in 5 or in 18.
Welcome back. Let's address the big story that you can see on your screen, where SEBI is planning to float a consultation paper to bring an end to weekly expiry and perhaps introduce longer tenured contracts. This will be a big blow for BSE, CDSL, all these capital market plays, which have been thriving on rising retail volumes, could now feel the pressure. Yash has picked this up from his sources and joins in with the details and the thinking behind this. Yash.
Well, Rima, so it was on August 21st when the SEBI chairperson Tuhin Kanta Pandey had expressed the intention to have longer tenure derivatives. A continuation of that intention of SEBI, what we've been given to understand from our sources, is that market regulator is likely to float a consultation paper to end weekly derivatives expiry, and that consultation paper could come out as soon as in the next 1 month. What we've been given to understand is that SEBI plans to have a transition ultimately towards having monthly expiry, but with a defined glide path when it comes to that intention of having a monthly expiry. Also, what we've been given to understand is that one thought which SEBI would also consider is to have a same-day expiry for all exchanges. So any point on that glide path, as well as the end destination of having monthly expiry, the thought could be to have a same-day expiry across exchanges, that is for NSE, BSE and any other small exchange who wishes to have an expiry on that day. Also, tomorrow, that is September 12th, the SEBI board would be meeting, and importantly, though it's not a part of the agenda, what we've been given to understand is that the board would be briefed and informed on, moving towards this decision or action of removing, ending weekly expiry and moving towards monthly with, of course, as I said, a glide path towards it. Another important aspect is that SEBI could also consider various options, and this could be a part of the consultation paper, to restrict retail participation when it comes to the derivatives market. There are various, ideas, thoughts and suggestions which market regulator has at this point of time, as I've been given to understand, and all those would be considered. But essentially, it's a thought which surrounds around the central point of having some kind of threshold when it comes to allowing or not allowing retail participants to sort of participate in the equity derivatives market. There are various suggestions also which SEBI is considering when it comes to increasing the depth of, the cash market volume. So that's another important aspect which market regulator SEBI is considering. But importantly, the move will start soon towards ending weekly expiry. Consultation paper likely within the next 1 month. Exchanges, importantly, will start getting consulted and being roped in the discussions starting next week itself. So important, move coming from market regulator towards that intention of having longer term equity derivatives.
Indeed, important developments, and Yash has been on top of these developments right from the start, with the SEBI chairperson making that intent to that on last month on the 21st of August, as he was mentioning. BSE now down around 3.5% at the lowest point of the day. Take that point forward with Deepika Mundra from MNG Investments, who's joining in now. Deepika, good morning. Thank you for joining in. What do you make of this? You heard Yash about this phasing out of the weekly expiries. What does that do now to a lot of these capital market names, say the likes of BSE and a lot of these discount broking firms as well, who have relied a lot on retail participation for their volume growth and so on and so forth?
Hi, Marmas. Thanks for having me, and good morning to everyone. So firstly, market structure changes, right? And the capital market plays in particular have been trading at fairly premium valuations over the last 12 to 24 months. And when market structure changes, some of these valuations get challenged. So I think that the capital market plays in India are structural. We have seen financialization of savings, which is likely to continue, but changes in regulation as such is going to bring in volatility. So definitely not the best time to always get into these talks at peak valuation. Probably wait for the right opportunity here.
So you all don't have it as a part of your portfolio, any of these capital market plays, Deepika?
No. So in the financial space, we are overweight the private banks. We are selectively overweight life insurance, but currently not exposed to the capital market space.
Talk to us about defense, right? It made a lot of sense a couple of years back. It generated a lot of wealth. There was so much spending by the government. But now the narrative seems to be that this public spending will shift towards consumption. Capex spend will shift towards consumption, and that will maybe put a lid on the kind of astronomical growth we've seen in defense stocks. With this concern, how should one approach defense stocks? Because it is one of your preferred plays.
That's right. So I'll address both the points, actually, both in consumption as well as on defense. What we have seen in defense after a long time is that there has been an order book build-up and stocks first react to order book. But we've also seen that the execution has been fairly good across the board. So I think that's something that we like. It's been reflected in the earnings. And given the geopolitical situation around the world, we see continued impact on defense stocks, which is likely to be positive, right? India potentially being an exporter to the world in the defense categories. So all those things put together make us positive. We don't think that these stocks are going back to their old valuations anytime soon of sub 15 times PE. We think this is a structural opportunity. On consumption, while yes, the government has of course tried to stimulate it, it's just that not everything will benefit. So there we remain actually quite selective in the consumption space, favoring more premiumization rather than staples.
Deepika, the other preferred play that you have is you're trying to play the premiumization theme here, be it travel or auto. Telecom is one of your preferred plays, but of course you would prefer play this theme only via the market leader or through a proxy like Reliance Industries, because one of the other players, of course, is struggling as a going concern. What about the telecom space excites you here? Is this the prospects of more tariff hikes coming in or the increased adoption of 5G? What's your case here?
So here, for instance, well, the tariff hikes are already well known. Some of them have already taken place. What we like about telecom as a space is while the capex intensity is coming to somewhat of a pause, we're going to see significant potential for free cash flow generation. And these are the companies that have the ability to participate in data centers and some of the newer growth areas in the economy as well. But yes, we like all the other things too, which you mentioned earlier, travel in particular, and even within healthcare, we like healthcare services because that also offers an opportunity for premiumization and spending.
Telecom, what is the base case? The 3+1 structure continues. Will we continue to have 3 private players? Because that also influences an investment in a company like Industars, for instance. And what are your thoughts on Jio IPOs? Because that's coming 1 year down the line.
Yeah, Rima wouldn't be able to comment on individual stocks, unfortunately. But the industry structure in telecom, like we have in airlines, is quite favorable. Having 2 or 3 majority players ends up ensuring some sort of industry discipline, unlike what we had seen in the past. So we think that's a structural positive for the sector.
How are you playing the travel theme, Deepika? You're playing it through hotels, you're playing it through the tourism names, or a proxy, say the luggage manufacturing companies. They are not someone that they have done significantly well over the last year and a half or so. Most of them have been struggling. How do you play this theme? Hotels, proxies, or luggage?
I think the good part about the Indian market now is that it gives you so many optionalities, right? There are a whole string of stocks which didn't exist 5 to 7 years ago, which now are there in the travel space. What we like in hotels is the demand-supply discipline. So we think that the supply for new properties, particularly on the luxury side, is likely to be more limited for the next 3 to 4 years as versus the demand. Airlines, again, like we discussed already, the industry structure is fairly disciplined. And then again, there are also the platforms. So, and platforms across multiple sectors offer you an opportunity to do things which are, subsector agnostic or brand agnostic. So the travel platforms also is another way to play the space.
Great conversation, Deepika. Look forward to more such. Thank you very much for joining in. The Nifty and the Sensex, which were just flitting between the red and the green line, have dipped into the red, and a couple of these metal names are weakening. Hindalco, JSW Steel, Tata Steel have seen their gains erode, and the stocks have moved into the red now. There you have it. The Nifty Metal Index has glided lower. Get into a break. We'll come back. And on the other side is our special segment, Under the Lens, with Sonal.
Welcome back. On to our special segment, Under the Lens. Salazar Techno Engineering is the stock under the lens today, with Sonal putting that under the spotlight. Sonal.
Thank you so much for that. Yes, Salazar Techno Engineering, the stock is under the lens. The stock surged nearly 23% in the past 5 trading days, though it remains down about 51% over the last year. Company is a steel structure and EPC player that also builds telecom infrastructure, and clients include the likes of Airtel, Jio, Indus Towers, KC, Welspun Energy, Tata Projects and BHEL, to name a few. The company, remember, listed in 2017. It was a heavily subscribed IPO with subscription reaching that 250 times level. Now, do remember, some corporate actions here underwent a 10:1 split in 2022 and 4:1 bonus in 2024. On the numbers now. Revenue has climbed from 596 crores in FY22 to 1447 crore rupees in FY25, and in Q1 we've seen numbers around 300 crore rupees. If we talk about EBITDA, it has been more mixed after peaking in FY24 at 126 crores, fell to 111 crores in FY25, and in the quarter gone by, it sits at around 30 crore rupees. Profit after tax also swung. FY24 PAT was 53 crore, but FY25 saw a fall, and Q1 PAT is roughly 8.8 crore rupees. Management points to the consolidation of EMC Limited, a loss-making acquisition, as a key reason for the FY25 dip in PAT. Cash flow and capital efficiency show some strain. Operating cash generation dropped to 19 crore rupees in FY25 from around 47 crore rupees earlier. Working capital days stretched to 81 from 60, and ROCE eased to 11% from 16%. The company reported no dividend in FY24 and FY25. This is after paying modest dividends in the years earlier. Strategically, Salazar has been investing a 60 crore capex program focused on plant and fabrication capacity, commissioning a 96,000 tons per annum galvanization plant, and the acquisition of EMC Limited for about 178 crore rupees. This is to bolster high voltage transmission capabilities, basically looking at the power sector. Management sees growth runway across 5G, telecom rollout, there's power transmission and railway electrification as well, renewables and heavy steel structures. Also, while researching, I went through some interesting filings, which suggested social media chatter in 2024 alleging paid promotions by influencers, where the company had denied any involvement. Additionally, promoter holding has slipped to about 48.9% in June 2025, which compares with 53.4% in December 2024. So it has been continuously reducing, as you can see on your screen. On valuations, the stock trades at roughly 90 times FY25 EPS and demanding a multiple that investors will want to reconcile with growth visibility and also margin recovery going forward.
Interesting. Sonal, thank you for that on Salazar Techno Engineering. With that, we call time on this edition of Trading Hour from Rima and me. Thank you for watching. Halftime report on the other side.
Stocks trade ranged, but the market breadth is distinctively positive. Energy and utilities lead gains, while IT and auto drag.
Tega Industries inks a term sheet to buy global grinding media player Molycorp at an enterprise value of $1.48 billion. Tega will raise equity and debt to buy a 77% stake, with Apollo Global pitching in for 23%. The big bet will scale Tega's revenue about 9 times, but also add $1 billion in debt.
Prominent lender Chola Mandalam Investment flags rising stress in the unsecured segment as well as in vehicle financing. An extension of the monsoon may push stress up further, adds Arun Selvan, the CFO.
Automakers see a bumper festive season ahead of following the GST rate cuts, given the rise in inquiries. Maruti and Hyundai bet that small cars sales will see a pickup, with Hyundai expecting a sharp increase in first-time buyers. Hello, good afternoon and welcome to Halftime Report, coming live from the CNBC TV 18 Motilal Oswal studios. I'm Vidhi Motiwala, with me Sonal Butra as well. Sonal, good afternoon, but the afternoon today, or the day, has been very dull, right? The markets are not doing that much. Muted day of trade, red and green, that's what it's flip-flopping between. Below 25,000 even today as well.
Oh yes, that continues to be the case, right? The 25,000, that continues to be a very important level to watch out for on the Nifty. We've seen some recovery that has come by from the lows, but again, it is below the highs of the day as well. These are some of the stocks which are making some move. We have Sun Pharma, which is off the lows of the day. We also have some stocks like ITC, which is at the day's high. Axis Bank is at the day's high. Bharti Airtel is the other one which you should be watching out for. So the consumption space, that continues to be on our radar. Look at that Axis Bank. There it goes, up around 1.5% as we speak. So if you look at the Bank Nifty, that should be on your radar. Bank Nifty is the one which is leading to the gains that we are seeing from the lows as well on the Nifty. So that index is up around 85 points. But it's been very stock specific. We have a lot of big news updates to address as well. And Tega is one of them. It announced a big acquisition. Vamakshi is here to give us the details, the amount they are putting in, how they are funding it, and a lot more. Vamakshi.
Absolutely, Sonal. You know, Tega Industries just announced its boldest move yet. Now, teaming up with Apollo Funds, Tega will acquire 100% of Molycorp for an enterprise value of $1.48 billion, and that's over 13,000 crore rupees. Now, Tega's own market cap as of close yesterday was 13,800 crore rupees. So, therefore, this buy is as big as Tega itself. But how will Tega fund this? Here is a breakdown. Tega will take 77% stake, Apollo 23% stake in the SPV. Tega will put in $361 million, which is roughly 3,180 crore rupees, funded by a mix of corporate debt worth 995 crores and a fresh equity raise worth 2,184 crore rupees. Now, in fact, Tega has scheduled a board meeting on September 13 to finalize the fundraising plans. Apollo will put in the balance 950 odd crore rupees, and there's a contingent payout of $120 million, or 1,057 crores over 45 months if the performance targets are met. So why Molycorp? Well, it makes the grinding media like steel balls, etc. used to extract minerals, especially gold and copper, while Tega, on the other hand, makes the liners and wear parts that protect those mills and optimize efficiency. So together, they can offer customers a complete mill solution, which translates into greater cross-selling opportunities. Now, beyond just the product matchups, there's strength in the footprint as well. Now, Tega has 10 manufacturing facilities and a strong presence in Europe, Middle East, LATAM, CIS and Africa, while Molycorp on the flip side has 13 manufacturing facilities, 3 JVs as well, and plus a potential JV with footprint in US, Canada, Australia as well as LATAM. Now combined, they will have 26 manufacturing sites worldwide. But that's not all. Let's also take a look at the numbers. Now, Molycorp's revenues are about 8 times that of Tega's, but the margins, as you can see, are much lower. So the combined revenues will stand at approximately 15,200 crores with the blended EBITDA margin of around 12.5%. But the good part is that Tega is buying Molycorp at a much lower EV to EBITDA multiple, which is about 9 times versus its own multiple of around 41 times. Now, if this integration does work, this could be earnings accretive. In fact, the management said that it could be EPS accretive in the next 3 to 4 years. But make no mistake, there are big risks. Now, Tega is acquiring an entity which is much larger than itself, is spread across multiple continents. So therefore, aligning operations won't be simple. Now, the other major concern is Molycorp's debt, which is at $1 billion. But the management is optimistic about bringing it down to $800 million. The other concern is around growth. Now, Molycorp's historical growth has been a modest 3 to 3.5%, and the management is expecting it to stay around in the same range, that is 3.5 to 4%, which is much slower as compared to Tega's own 15%. Now, additionally, Molycorp's margins are lower versus Tega, but they're targeting an improvement to 13 to 14% range in 2 to 3 years. And in the next 3 to 4 years, they believe the combined entity could have blended margins of 18%. So to sum it all up, this deal is big, there's no doubt. It's a big, bold step for Tega, and investors will be watching closely to see if Tega can actually pull this off, because this move could either be a game-changing leap forward or a very expensive learning curve.
Okay, well, Makshi, thank you so much for that. Surely keeping an eye out on Tega going forward as well. But today, that's the stock we'll be keeping an eye out on. But let's also listen in to what the management had to tell CNBC TV 18 in an exclusive conversation that we had earlier with them.
Debt at the target level is roughly about $1 billion. And the attempt is to bring the leverage down after the transaction closes. Sure. I think, through the consortium arrangement that we have with Apollo, the intent is to structure the debt in a fashion that we leverage it down to around 800 million odd levels from the current billion. And that should help us, deliver some improved benefits in terms of interest cost reduction with the leverage coming off, and hopefully even an improvement in the credit rating. We should be able to, the attempt is still early days, but the attempt is to at least shave off anywhere between 25 to 40 basis points of their current terms with their current lenders. I think where Molycorp today operates at is at roughly around 11% EBITDA levels. Our aim would be to try and improve that over the next 2 to 3 years to, on an average, anywhere between 13 to 14% levels. Tega, as you know, operates at a CAGR of 15%, delivers about close to 22% EBITDA. So the margin profiles are different, but we hope that on a consol basis over a 3 to 4 year period, we would be roughly at about 18% on a consol basis.
All right, that's the big deal and the big story that we are tracking. But this is time for our movers and shakers segment. We'll track a whole host of stocks which are buzzing in trade on the back of brokerage notes, news updates, and a lot more. First up, let's talk about Aurobindo Pharma. Winnie, what's happening here?
So Aurobindo Pharma today is in focus. We saw it run up as much as 5%, right, at one point of time. Now, what's the news flow that's come in? This we're picking up from Bloomberg. They have mentioned that GTCR is nearing a deal to buy the generic drug maker Zentiva. Now, why is it important for Aurobindo Pharma? Because Aurobindo Pharma was one of the leading players in acquiring Zentiva. There was a news flow that had come in previously that Aurobindo Pharma was actually among the top in terms of the bids that were made for Zentiva. There was TPG as well, who they were competing with, and obviously GTCR was one of these other names as well. What came in as a news flow that time, we saw a stock fall coming in because Aurobindo Pharma investors were worried that maybe this is going to be, much bigger than what the company can handle. How would the balance sheet actually turn out if they actually end up acquiring Zentiva? So today there's a bit of a relief that is coming in, and the pressure that was there on the stock because of this. That is something that is ending. When we spoke to the management of Aurobindo Pharma on 21st of August, they clearly said that yes, they were in talks with Zentiva. They were in early stages of talks. There was no final decision that has come in yet. But they said they'll always be very mindful of investors' concerns and will never overpay for an acquisition. So that is what has come in today as well. And seems like GTCR is among the top buyers now.
All right, so that explains the move on Aurobindo Pharma, but I'm watching out for GAIL. Now, remember, we are waiting the tariff decision, and that is something which would be positive for the company overall. There is an indication from Nomura. They have a target price of 295 rupees on a share. They see 30% upside from current levels. They say tariff hike might give a one-time boost, and they expect the tariff to increase to $70 per MMBTU, 70 rupees per MMBTU. That is to be applicable from April 2026 itself. An integrated tariff hike anyway above above 20% would be positive, but anything below that, markets could be disappointed because the company itself has asked for a 30% increase. The petchem segment, that could see a recovery coming by from FY27, and that's why they're also expecting 42% YOY increase in their gas transmission business to come by FY27. So a lot of levers for the stock to go higher. We'll have to see how they fructify. For now, Nomura continues to be very bullish on this particular name.
Okay, that's interesting. We'll keep an eye out on GAIL, one of the few stocks that are buzzing away in trade today. But let's move on and go across to Vivek to take us through in terms of what's moving around in trade as well. Vivek?
Well, thank you so much for that. It's an action-packed session, especially in the broader end of the markets. A lot of action and largely seeing quite a lot of bounce backs, especially in terms of sectors that have been laggards so far. So the first sector in trade, that's seen a bit of a bounce back. It's the entire metal pack. Aluminium stocks, that were underperforming the last few trading sessions have bounced back. Names like Nalco, Hind Copper, Hind Zinc, SAIL, Vedanta, all of these stocks have bounced back quite sharply in the session today. The other set of stocks, continuing their up move for the second straight session is the capital goods. And today, the Power Pack too has joined into this particular rally. So names like NTPC, NHPC, BHEL, after a while, actually seeing some buying emerge. Even JSW Energy doing quite well. The oil marketing companies, remember, there's been a positive note coming in from Citi. They say Q2 is expected to be materially better versus Q1. On the back of that, all three oil marketing companies, ISL, BPCL, HPCL, doing quite well in the session. Mascot Dock, some positive news flow coming in terms of an important order win. The company says that negotiations have started with Indian Navy for the submarine project P75. On the other hand, a few laggards as well. First up has to be Gujarat Fluorochem. A fire at the facility is something that has led, number one, to both near-term disruption, and number two, has led to quite a bit of a sell-off, almost 4% lower on the stock today. OFSS, a clarification coming in from the company saying that no material impact seen from the kind of guidance that the global parent has given. After that, that particular stock down 1%, but has cooled off significantly from the day's highest points. And lastly, on the back of a CNBC TV18 exclusive development, both BSE as well as Angel One have slipped quite significantly from the day's highest point. Any curbing as far as weekly option could lead to significant EPS cuts for both of these names.
Okay. All right, Vivek, thank you so much for joining us. So those are some basic stocks on our radar. With that, we'll do one thing. We'll slip into a short break. On the other side, we'll be back in a conversation with Dr. Ramesh Kancharla. He is the Chairman and Managing Director of Rainbow Children's Medicare. There's some update there. We'll discuss this with the management.
Welcome back to Halftime Report on CNBC TV 18. As of now, Nifty still at 24,990 levels, still below 25,000. But in the last few minutes, slight bit of that pickup we have seen right from the red. So that's what we'll watch out for and hope this momentum continues on the upward side. But let's put the spotlight on Rainbow Children's, right? Because that's the stock that we're keeping an eye out on. Now, we have Dr. Ramesh Kanchala, who's the chairman as well as the managing director at Rainbow Children's Medicare, to discuss three important points that we want to talk about. One was the announcement that came in yesterday. They were expanding footprint furthermore in Andhra Pradesh. This is the third hospital that they'll come out over there as well. So keep an eye out on that. Now, expansion in newer regions. Northeast was one of the parts we spoke about a couple of weeks ago. Andhra Pradesh, they continue to expand there. So which other regions are there? And what will be the outlook now for ARPOB, margins? What are we expecting going forward in FY26, given that there are so many launches coming in? So that is what, and hospitals that are coming in. So that is what we'll keep an eye out on. So Dr. Ramesh, thank you so much for joining us on the show. This is the third hospital, right, in Andhra Pradesh that you all have come with. Could you just talk to us about, in terms of overall, what will this mean for the company? When will this be commissioned by? You've said 60 crore rupees is what is going to be the cost for, commissioning this hospital. When will it come in by? When will you start seeing the synergies for this one?
Yeah. So, if we completed the project and all the permissions are secured, we just kind of started our outpatients, and also we're hoping to start inpatients this week sometime. And I think all the teams, everyone is boarded. I think we are ready to operate from now onwards.
Okay, so this will start by this week, right, you're saying?
Yeah.
So then in FY26, what will be the additional or incremental revenue that you're expecting from here? And what is in general the ARPOB that we normally see in this Andhra Pradesh region?
I think the Andhra Pradesh, we have two hospitals. One is a matured hospital, which is in Vijayawada. Another one is in Visakhapatnam, which is about 4-year-old hospital. I think we do a kind of a fairly, in line with our company EBITDA, we do that, which is around 24-25% blended between Vijayawada and Visakhapatnam. So the Rajahmundry is a very potential place. I think there is every household knows about Rainbow Children's Hospital in the state of Andhra Pradesh. So we would expect a good traction, and also this hospital should do very well according to our estimates.
Okay. Dr. Kanchala, I wanted to understand what the trajectory would look like for FY26 in that case. You say the margins will be maintained for this new particular hospital as well. Overall for FY26, what kind of bed addition are you looking at? And what's the margin update as well?
Yeah, technically this is a new hospital, so I don't think it's going to produce a 25% EBITDA on the year one. And normally what we would expect is that this kind of hospitals would do the EBITDA break even in probably 18 months time. So, and then from there onwards, they grow about 20-25% year-on-year growth. So eventually in about 3-4 years, it will join the group to produce a 25% EBITDA. That's what I expect from Rajahmundry. At a group level, I think as you know that now we have acquired a majority stake in Pratiksha Hospital in Guwahati. And also we have done one in Warangal, which is a tier 2 city, a small acquisition. And we still have some more beds to come in this current year, which in the Bangalore 2 spoke units, one is about close to 100 beds in Electronic City, another 60 beds in Ennore, HRBR area in Bangalore. So both of them are going to kind of be operational in Q3 of the current year.
Q3, right? You said because we were expecting by the end of Q2 itself, right? Both these Electronic City as well as Hennur?
That's right. I think there was a torrential rains in Bangalore and also some delays in those things. Early part of Q3 will be one of the hospitals, which is Electronic City. Little later part of the Q3 will be a Hennur project. So that's I don't think there is a huge delay. It's kind of a couple of months plus or minus, because the permissions and various other things are there, local logistics. That's why it's taking time.
Dr. Kanchala, what's the long-term plan? Will you be expanding the inorganic or the organic way? Where will more focus be? And what kind of capex will you be looking at in that case?
No, we have a clear plan laid out. So far, whatever we kind of have been planned about our expansion process, we are on track. The next new major expansions are going to be, of course, the upcoming hospitals in Gurgaon, which are about almost 450 beds. That's Gurgaon. And we have signed up recently with Pune, about 150-bed hospital in Bangalore Highway, Pune, close to Baner. So that's something which is going to, we're waiting for the permissions to come. It's a kind of asset-light model in Pune. So the Coimbatore is work in progress. These are the projects which are in pipeline. In terms of inorganic, I don't think we see anything in the near future. So what we see is that there's going to be a lot of execution from now to the next 1 year time, because we added a significant number of beds in the last 24 months time to current year as well. So there's a lot of execution and also try to build a business on the new beds.
Right. Dr. Ramesh, a two-part question. One is in terms of now, you have this hospital which is coming in here in Andhra Pradesh, and a couple of others by by Q3 is what you've spoken about. So what will this do to your overall ARPOB? Would we expect them to be at that overall level of around 63,000 that we saw in Q1? Or, will it be a bit lower given that newer hospitals are also, will be seeing a rise in terms of your portfolio?
I think our ARPOB was the last year about 56,000, if I remember rightly. And the Q1 was a higher ARPOB what we had. That's because of a less of seasonal business. The ARPOB goes up in the Q1 because of more of surgical, more of obstetrics. And when it comes to Q2, Q3, generally the ARPOB settles down because of a lot of seasonal business. Yearly, I think what we see is that probably a 5-6% of our ARPOB growth, which may be expected. But we are focusing a lot more on ARPP rather than ARPOB because of the ALOS determines ARPOB so much. So we track more and more, rely more on ARPP, which we've been doing a fairly good with a 5 to 6% ARPP growth year on year.
Okay, 5 to 6% ARPP growth year on year is what you'll look out for, and you all have been consistently seeing that 5% growth in ARPOB as well. And your revenues, you're maintaining that guidance, right? Late teens to 20% for FY26?
Well, we expect actually the still early part of the year to see that definitely we would expect to reach a late teens, maybe to the maximum 20%.
All right. Always a pleasure speaking with you. Thank you so much for joining in with your thoughts and insights on what the outlook is for the company going forward. With that, we'll do one thing. We'll slip into a short break. Sudeep Shah from SBI Securities will join in with some trading strategies on the other side. Stay tuned. Welcome back. Some more recovery, some addition on the top as well. So Nifty is comfortably above the 25,000 mark for now, led by the banking names. We'll have to see whether that continues or not throughout the trading session. But we have to talk about the Qs and the F&O space. Nigel is here with us to tell us more. Nigel.
Well, you know, market that's not falling and actually consolidating will be not so bad news from the bullish perspective, because the Nifty will be mildly in the green. But the only problem is this Nifty Bank and the Nifty IT index, they don't seem to be tangoing together, you know, because one day you have one that performs, the next day you have the other one that performs. And in today's trading session, the Nifty Bank actually is performing pretty well. And if you just look at the Nifty Bank and plot it with the 20 DMA, you'll see that the Nifty Bank actually is creeping above that mark. So you like that. You know, you'll want the Nifty Bank to actually conquer the 20 DMA decisively on a closing basis. The problem is the IT index is giving some part of the gains that you've seen over the last few trading sessions. But there appears there's a short straddle that's playing out, you know, and those that are playing the short straddle, they are hoping the next 3 trading sessions, the Nifty sticks to this range of around 500 points approximately. Because you look at the call, you know, the 25,000 call, the markets are up close to around 30 points or 35 points. That strike is in the money, but yet you're not making very, very big money if you bought this particular, you know, call. So that's telling you the writers are at play. On the flip side, the 25,000 put as well, you know, good amount of open interest built up. There are signs of writing out there. But if there's a short straddle, then they're looking to pocket 250 rupees, and 25,000 plus 250 rupees, 25,000 minus 250 rupees, which gives you the range that's up for you on the screen. So that's the broad range you're working with for the next 3 trading sessions, or because the expiry will be on Tuesday. Moving to stocks that are on focus. Infosys, that was the big boy that has led the rally in the last few days. That's coming for some profit taking, some kind of unwinding of positions is what we're seeing on that one. Oracle, now this is a rather interesting one because the open interest built up today is close to around, you know, 25%. I think we should get the futures plate actually up for you. The open interest is up by close to around 25%, 28%. And by the end of today, it will be interesting to see whether or not Oracle is a stock that gets into the F&O band, because the open interest build up is very, very large. BSE, clearly the street is sensing some negative news, and that's why the last few trading sessions, you have seen a good amount of open interest build up on BSE. But a couple of candidates have come in for some short covering. So BG Electroplast, you pull up the futures plate, you know, that will tell you the picture. The stock is up, the open interest is lower. Similar is the case with BPCL, stock is up. And in fact, you know, you have open interest that's lower. But the stock that I'll really keep an eye out on is Oracle Financial. It's seen a big run in the last few trading sessions. Today, the open interest is massive and the stock has come off the top. So that could probably a name that maybe sneak into the F&O band. We'll keep an eye out. Early days right now, but we'll keep an eye out on that one. Back to you.
Okay, Nigel, thank you so much for that. We'll be keeping an eye out on those levels as well as those stocks that have been mentioned by Nigel as well. But let's bring on board Sudeep Shah from SBI Securities joining us right now to talk to us about the technical levels that we should keep an eye out on, as well as some of his individual stocks. Sudeep, good afternoon. Today, what are the levels that we should mainly watch out for? How important is it going to be to close about 25,000 for the Nifty? And also in terms of Bank Nifty, if you could give us any indication on the technical front over there and your topics.
Good afternoon, Vinny. Vinny, yes, while Nigel was just discussing about the derivative data, he was very clear about this 25,000 being a very sticky level because of the option writers. And yes, this zone is proving to be a sticky zone. But what's important is this, that along with that is that 24,850, 24,900 in the last 2 sessions is now being held, despite all intraday sell-offs or any profit booking moves. That is not being compromised. So what I feel is now steadily the base is shifting up. So 24,850 now becomes an important support. Like Bank Nifty is just trying to cross its 20-day exponential moving average. Nifty is well above that. So that means that a lot of other sectors except IT are giving strength in Nifty, and we feel that is the reason we feel that Nifty is slated to go higher towards 25,250, 25,300 in the coming 2 to 3 sessions. On the downside, one can keep a stop loss at 24,850, which is an important support zone. Bank Nifty, it's in an attempt to rebound to reverse. But what we would like to see is that 54,800 being taken out convincingly. So above 54,800, Bank Nifty also would support Nifty in its up move, and Bank Nifty could move towards 55,200, 55,400 in the coming few sessions. And on the downside, the supports would be closer to 54,300.
Okay, get it. So that's for Nifty Bank. And as I said earlier, this is something which is leading to the surge from the lows that we are seeing on the Nifty currently. Any individual names, Sudeep, that you have?
Good afternoon, Sonal. Yes, I do have a lot of stocks are coming up the radar now. You see the defense stocks, metals, PSU has started its up move today. Financial services, specifically AMCs. So within those, within the financial service space, I feel Bajaj Finance tops the list here. It's trading at its all-time high around 970, 973 levels, sustaining above that zone in the last 2 to 3 sessions. So what we feel is that here, if one has a positional view, can keep a stop loss at 945 on the downside, and on the upside, levels of 1010, 1020 could come within next 15 to 20 sessions. The other stock that is there on our radar is also from the financial space, and that is HDFC AMC. Here also there is a decent breakout on the upside, backed with volumes. So 5800 was some kind of extreme short-term resistance in the last few days. We were seeing this level not being crossed, but today it has crossed and it's now sustaining above that. So here we feel that a fresh upside is on the cards here towards 6000, 6050 levels, and this can be bought with a stop loss at 5720 on the downside.
Okay, Sudeep, thank you so much for joining us on the show and giving us your individual stock picks, as well as in terms of the Nifty and Bank Nifty, what we should be keeping an eye out on. But on that note, we're going to step into a very short break, and on the other side, we have Peter McGuire of Trading.com to understand the way forward for gold prices. Stay tuned in.
Welcome back. Let's talk about the commodities now. The gold prices have scaled at $3,600 level. The key question to ask is whether prices of the yellow metal can sustain the current strength. A slew of triggers for the precious metals pack. A weak dollar coupled with firm bets over Fed's rate cut strategy. The case is ripe for investment into the likes of gold and silver. Manisha Gupta caught up with Trading.com's Peter McGuire to understand the way forward for the prices as well. Take a look.
It has been dramatic, and the overall momentum, I think, is going to continue up until certainly December 31. And there's a lot of reasons for that. And I think that you've got to say 38.50 has got to be a headline, and then probably 4,000. I noticed Goldman's is saying possibly even up to 5,000. So look, it's a runaway train at the moment. Don't stand in the front of it because it'll run you over. It's a bull market.
Oh, well, absolutely. That is very well said. Peter, at these current levels, the understanding really is that there are very less sellers into the market. People are still buying at these levels. So what are we really looking at? Many years of bullishness continuing? Because this can't be a short-term trend.
Absolutely. I think that's the key, Manisha. I mean, the shorts, no one's short. No one I talk to is short. No one... as far as, I mean, trading's a different matter. If you were short-term trading and you're looking at a pullback and it goes down 30 or 40 bucks, that's what a short-term trading is. But the overall momentum is certainly very bullish from here, and that will continue with, central bank buying, retail sales. As far as, have a look at what's happening as far as, walking into some of those big shops in Dubai and just buying gold. It seems to be a fever pitch. You've got Costco in the States doing it. In Sydney, there are, the bullion company in Martin Place. You walk in there, I'm sure people are walking out with probably half-kilo bars of silver and gold going down to safe deposit boxes. It's very much a part of our culture, and that won't, I don't think, wane anytime soon.
So, Peter, the sense that we're getting in from the markets is that this is less of a paper trade or a speculative trade and more of a physical trade. People really are acquiring it in physical, is it?
Absolutely. There's no doubting that. I mean, you've only got to look at what's happening across all of Asia, very much into India. And, there are paper traders out there. There's no shortage of those either, because people are prepared to ride a market up and looking for pullbacks and opportunities. They're conscious as far as fundamentals and the technicals. They're aware of seasonality demand. They're the three key drivers when you're looking at trading. Festivals, religious, all over the year. And then you're looking at what's happening as far as central bank policy, what's happening as far as inflation, and I think the US dollar coming off and so heavily off since the start of the year has really added momentum to it, Manisha.
Peter, that's about gold. And what's your sense on silver? Because $41 announced, done, and we're looking at new 14-year highs onto this one as well. Are you looking at more gains? I mean, as you said, there would be short-term corrections that we will continue to see in all of these precious metals and commodities. But where are we ending by the end of this year?
It's got to be probably 45 and north of 45. It's too hard to go out on a limb, Manisha, with 4 months left. Anything's possible as far as price explosion to the upside. But I think 45's got to be a key handle for traders to be mindful of. And, you're nearly there now. It's what, 41.50, 41.60 sort of number for futures. So, I think it's got the momentum to get there. We all understand from an industrial demand, we've spoken together, data centres and electric vehicles and electronics. So that's not ending anytime soon. So the overall picture, I think, is going to be first off, silver's probably got a larger percentage gain in the short term than gold. And I think many traders are very conscious of it. And, if you're a paper trader, you wouldn't like to be short at the moment.
Oh, yes. Peter, even as we're looking at very mixed data, and of course the near-term volatility in many of these base metals perhaps would also continue, have we come to a point where we do believe that the copper prices could be making newer highs in 2026 or perhaps 2027 because there are no new mines, inventories are just about hand to mouth, and we're looking at very strong demand, especially coming in from renewables?
Absolutely, and as we know, underinvestment across that whole sector for years, if not probably a decade or more. So, yes, it's 9,900 on the LME at the moment, I think 9,890. So you've got to say 10.5 to 11,000 key targets, Manisha, and they might be achievable within the next 3 to 6 months. It could be there sooner. We've just got to see, as overall demand. The story hasn't changed, and I think the attraction is there. Traders like it. They trade on COMEX, and we all saw a couple of months ago what happened as far as that. It blew to the upside. But yes, it's still very, very tempting for traders to enter those markets, and I see continuation as far as bullishness across that copper market.
Thanks so much for that, Peter, as well as Manisha, for giving us that conversation in terms of gold and keeping an eye out on the commodity space. But on that note, we'll slip into a very short break. After the break, we'll get you a special conversation on auto cess with Naveen Philip of Popular Vehicles, as well as Arun Malhotra of Nissan, former MD over there. So we'll stay tuned in and have an interesting chat there. Welcome back to Halftime Report on CNBC TV 18. Like I mentioned before, we're going to be discussing the auto sector. GST surely is giving it a boost, but cess, does that become a concern for auto dealers, and where is that headed for the industry? What is the demand trend now going on as well? So to understand all of that, we have Naveen Philip, MD of Popular Vehicles and Services, as well as Arun Malhotra, auto industry expert, as well as former MD at Nissan. Mr. Philip, as well as Mr. Malhotra, thank you so much for joining us this afternoon. Naveen, I'm going to start with you. Now, overall, there's a concern that comes in on the GST front, right? So could you help us understand currently what is the overhang that is there, maybe because of the cess credit that comes in? And, what is the request that is sent from the industry? What are the concerns that are coming in on that front?
Yeah, I think so. So all vehicles, including if you look at starting from an Alto, there is a cess of 1%, going up to a cess of 22% for the larger or the more luxury vehicles per se. So if you look at, there's an input cess that is there on all dealership books, because we have bought vehicles from the manufacturers and this input cess is lying on that account. Now, as per the original notification, I think the cess was supposed to be there till March 31st, 2022, and then it got extended till 2026, which means ideally, if the government keeps that option open, then all dealers and manufacturers, I think, will be able to get the entire output cess also as such. If it is going to be closed as on September 30th, 22nd or 21st, then I don't think we will be able to compensate the output cess per se. And I think across, and FAD has come out with the approximate value of 2,500 crores lying in all dealership books as such. And this is a huge amount for any dealership to bear per se. So I think the ask from the dealership community is for at least give a relief period till December 31st or till the original period that was March 31st, 2026.
Okay. Mr. Malhotra, comment on this. The second point would be if maybe by 22nd of September you're not able to use that cess. Is there any clarity on what you do with that? Will the government be giving you some refund on that? If it lapses currently, what happens with the liquidity situation for small dealers? Do you think it could cause major disruption when it comes to the lower band of this particular sector?
Well, as Naveen mentioned, originally, since cess is disappearing from 22nd of September, it would lapse. Now there was notification of the government, it will be there 31st March. But I think whatever the statements I've read in the media from the Income Tax Department, from the Excise GST Department, they say cess will lapse. Now options are two. Basically, one is the liability which Naveen talked of. The other option is that a lot of companies have stopped billing vehicles, but you can still retail till 21st. And based on the retail, you can get some benefit of the cess on that. But it works on two theories. That one is that you will not invoice new vehicles from the company, which generally won't happen, and others you are able to retail at that point of time. The challenge is that the Shraddh period or the inauspicious period, which is there in 50% per country, has started from 8th. And even customers generally like to take deliveries or need to invoice after 21st. So it's a catch-22 situation. I link it something like a T20 match where the Duckworth-Lewis method is operating. Will the Duckworth-Lewis method, will it lapse on 21st or you'll get the full overs? That has to be seen.
So there is no clarification, so to say, from the government yet. We are still awaiting the notification, right?
Yeah, absolutely. There is no clarification. But as per the original rule which exists, if you are able, when the cess ceases, if you are able to utilize that cess in terms of your retailing till 21st, you will be able to take benefit of that. That is as per the present law. Even on that, there is no sharp clarification. But as far as Naveen was saying, clearly there is some statements from the government that 21st, since cess doesn't exist, it will lapse. If it lapses, whatever the dealers and the new small dealers or the new dealers who don't have a cess credit account, they'll be the big sufferers.
Mr. Philip, then, could you highlight what would be that amount right now for y'all as well? If it lapses, then what is it that you're bearing for the cost for yourself?
So if you look at most dealers, I'm saying large dealers like us would have a cess account of at least running into about 15 to 20 crores, which would be the amount that would be there. And as Arun's mentioned, a part of this would get offset between now and 22nd, but since this is not the most auspicious period, the number of vehicles that can be retailed out would be a question mark. Two, most of the customers, while there's a demand and there's a lot of inquiries for it, they're also looking at what would be the pricing post the 22nd. And the third factor is the road tax amount. So it is only on the new price, the price is lowered, then it's on the new price that the road tax would be applicable. So all these factors put together, people would tend to wait beyond the 22nd. So that is the catch-22 situation that we are in. But as you asked, approximately all large dealers would be having about 15 to 18 crores in terms of the cess account.
All right, that would be a big amount if we calculate per dealer. But in that case, Mr. Philip, you know, a lot of these companies have already started announcing price cuts for cars. Are you seeing those initial inquiries, or because of this Shraddh period, we are still not getting that? And as you said, till 21st, you can still use it. So it's of course that catch-22 situation Mr. Malhotra also mentioned. So what's happening with inquiries currently, and have you all made a representation already to the government?
Yeah. So the FADA and the Siam, I think both have represented to the government. So hopefully there is going to be some relief from that side. But as we said, that till 21st September, in terms of inquiries, the inquiries are very robust. The inquiries at the dealership level are very high in terms of the JSE, across all segments of cars and commercial vehicles per se. But the only problem is in terms of actual retailing out, and people are tending to wait.
Also, Mr. Philip, are OEMs adjusting those dealer commissions post GST cuts as well? And, then what will that do to margins also?
So margins would remain the same. There's no problem in terms of the margins. And in fact, most OEMs, actually all OEMs have started compensating in terms of the price cuts that have been happening. So as you rightly said, all OEMs have announced that the post-GST prices, post-22nd prices are applicable today, and that they're compensating dealers to ensure that that pricing goes out into the market. So we are now hoping that the government would do its part in terms of trying to resolve the cess issue.
Okay. Mr. Malhotra, just a quick one. Festive season, yes, right now Shraddh period is going on, but in festive season, are you expecting to see a pickup? And would we see entry-level segments pick up, SUV pick up? What is your expectation?
So, actually, if you look at it, both at the entry level below 4 meters, which is 65% of the market, there's a drop from 28 to 31% to 18%. But even in vehicles which are above 4 meters, which generally taxation along GST and cess was 45 to 50, there also there's a drop of 8%. So effectively, the prices post from 22nd September, as far as GST is concerned, would go down from 7 to 9%. So clearly there will be upswing, which is anyway it coinciding the festival season. But I think the moot question is, September, October will be great, but is it a consistent momentum, or is it a flash in the pan and then we are back to old ways? Prices do go down by 7%, but the demand elasticity of vehicles of 20 lakhs, if suppose even you go down by 7%, does the customer who's not thinking of buying will start buying? That's a moot question. So effectively, sharp upswings in the next 2-3 months. Later, I think the overall economy, the buoyancy, the entire ecosystem in the world, that will have a major role to play than the GST cut.
Absolutely. Is it just going to be this first 2-3 months? Is it going to continue? That's going to be the key question. But thank you so much, Mr. Philip, as well as Mr. Malhotra, for joining us, explaining us the whole cess situation, as well as in terms of the demand trends for the auto sector. On that note, we're going to slip into a very short break. Don't go anywhere. We'll come back with more market as well as stock-specific action after the break. Welcome back to Halftime Report on CNBC TV 18. As of now, Nifty's come up that 25,000 mark. 25,008 is what the Nifty's at, 35 points up. So almost near that day's highest point around is what the Nifty is trading at. Nifty Bank also is up 173 points in the trading session right now. I just want to pull up the charts for Vari Energies as well as Premier Energies. They've seen a sudden spike up in the last 1 hour, so keep an eye out on those two names as well. But with that, we're going to wind down this edition of Halftime Report. It's a goodbye from Sonal, me, as well as the team who put this show together. Thank you so much for tuning in. Up next, Business Lunch.
Stocks trade range, but the market breadth is distinctly positive. Energy and utilities lead gains, while IT and auto drag.
Tega Industries inks a term sheet to buy global grinding media player Molycop at an enterprise value of $1.5 billion. Tega will raise equity and debt to buy a 77% stake with Apollo Global, pitching in for the remaining 23%. The big bet will scale Tega's revenues to about 9 times, but also add $1 billion in debt.
Prominent lender Chola Mandalam Investment flags rising stress in the unsecured segment as well as in vehicle financing. An extension of the monsoon may push stress up further, adds Arun Selvan, who's the CFO.
Automakers see a bumper festive season ahead following the GST rate cuts. Given the rise in inquiries, Maruti and Hyundai bet that small car sales will see a pickup, with Hyundai expecting a sharp increase in first-time buyers. Good afternoon, you're with us here on Business Lunch. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Hormuz Fatakia. With me as always is Vamakshi Dhuria. Vamakshi, good afternoon. You know, we are still at that 25,000 mark for the index, and it's the weekly expiry of the Sensex contracts, the BSE contracts today. And if you can see, the index has done precious little today. It's traded in a very, very narrow range all through the trading session, and it has not seen any significant directional move. The only impetus will be the fact that it has to hold on to that 25,000 mark. The trading range for the entire day has been just 55 points for the Nifty. It's been that kind of a day for the benchmark index today. But the broader markets, though, they are the ones that are seeing intense stock-specific activity. The mid-cap index too doing precious little. The small-cap index also seeing maybe slightly better price action compared to the Nifty and the mid-caps, but that too has given up most of its gains, all of them trading at the flat line today. But if you take a look at stock-specific activities, just pull up GMDC and the fall that it has seen from the intraday high. If we can pull up the from day's high graphic, and you can see the fall that the stock has had from the highs of the day, 4% lower on the stock right now, but the fact is that it has corrected 13% from the intraday highs in a matter of minutes. At the highest point of the day is around 570, and now within minutes the stock has shaved off 70 rupees, is now down to 500 levels, now 4% lower on GMDC and counting. What is also not doing well though are the capital market names BSE and Angel One. That is, of course, after the exclusive that Yash broke a couple of hours earlier with regards to the SEBI consultation paper. BSE down 4, Angel One down 4.5 as well. But the big story of last evening, which has translated into this morning as well, is Tega Industries. The big acquisition of Molly Corp, which they will acquire as part of a joint venture with Apollo Funds. Vamakshi has hopped over to the wall to give us more details. How much is the money that's going to be putting in? How will that be funded? And so on and so forth. Lots of details in there, Vamakshi.
Absolutely, Hormuz. You know, Tega Industries just announced its boldest move yet. Now, teaming up with Apollo Funds, Tega will acquire 100% of Molly Corp for an enterprise value of $1.48 billion. That's over 13,000 crore rupees. Now, Tega's own market cap as of close yesterday was 13,800 crore rupees. Now, this buy is as big as Tega itself. But how will Tega actually fund this? Here is a breakdown. Tega will take 77% stake, while Apollo will take the remaining 23% stake in the SVB. Now, Tega will put in $361 million US, which is roughly around 3,180 crore rupees, funded by a mix of corporate debt worth 995 crores and a fresh equity raise of 2,184 crores. In fact, Tega has scheduled a board meeting on September 13 to finalize the fundraising plans. Apollo, on the other hand, will put in the balance 950 odd crore rupees, and there's a contingent payout of $120 million US, or 1,057 crore rupees over 45 months if the performance targets are met. So why Molly Corp? Well, it makes the grinding media like steel balls, etc., that is used to extract minerals, especially gold as well as copper, while Tega, on the other hand, makes the liners and wear parts that protect those mills and optimize efficiency. Now, together, they can offer customers a complete mill solution, which translates into great cross-selling opportunities. Now, beyond just the product matchups, there's strength in the footprint as well. Tega has 10 manufacturing facilities and a strong presence in Europe, West Asia, Latin America, CIS, as well as Africa, while Molly Corp has 13 manufacturing facilities, 3 JVs, plus a potential JV with footprint in US, Canada, Australia, LATAM as well. Now, combined, they will have 26 manufacturing sites worldwide. That's not all. Let's also take a look at the numbers then. Molly Corp's revenues are about 8 times that of Tega's, but the margins here are much lower at 11.5%. So the combined revenues will stand at approximately 15,200 crore rupees with a blended EBITDA margin of 12.5%. Now, the good part here is that Tega is buying Molly Corp at a much lower EV to EBITDA multiple, about 9 times versus its own multiple of 41 times. Now, if this integration works, this could be earnings accretive. And in fact, the management also said that they expect the deal to be EPS accretive in the next 3 to 4 years. But, make no mistake, there are big risks involved as well. Tega is acquiring an entity that is larger than itself, spread across multiple continents. So therefore, aligning operations won't be easy. The other major concern is Molycorp's debt, which is at $1 billion. But the management is optimistic about bringing it down to $800 million. Now, the other concern is around growth itself. Molycorp's historical growth has been a modest 3 to 3.5%, and the management is expecting it to stay around that range, 3.5 to 4%, which is much slower as compared to Tega's own 15% growth trajectory. Now, additionally, Molycorp's margins are lower versus Tega, but they target an improvement to 13 to 14% levels in 2 to 3 years from 11.5% currently. And overall, the combined entity could have blended margins of 18% in 3 to 4 years is what the management had said. So just to sum up this whole deal, this deal is a big, bold step for Tega, and investors will be watching closely to see if Tega can actually pull this off, because this move could either be a game-changing leap forward or a very expensive learning curve.
Only time will tell. Vamakshi, thank you for that very detailed breakdown of the biggest acquisition of Tega Industries. But the management of Chola Mandalam Finance also spoke to CNBC TV 18 earlier today, and they flagged the rising stress in the unsecured segment as well as in vehicle financing. Now, they have also lowered their AUM guidance following the GST rate rationalization. Listen into what the management had to say.
Sort of question overall. In our view, the AUM growth, we still will hold it at the 20 to 22% levels for the full year. We will be reaching this, and there should be benefit with the number of units being sold because of the reduction in GST. And while that would have a slightly lower impact on the value. So overall, we don't want to change it either positively or negatively because of the GST reduction coming into play. GST implication would, also mean lower EMI burden to the customer, which would mean it will improve credit. Just wanted to add that part to it. It has always been a case that this Q2 will always be a slow quarter because of rains, and also because it has got a fair share of the period coming under inauspicious months, etc. For the full year, the overall credit cost would be in the range of around 1.5 or even 1.6% as somewhere equivalent to last year levels. And if, God forbid, the monsoon gets extended into Q3 like it happened last year, then it can even be slightly higher.
Well, moving on to an exclusive then, sources tell CNBC TV 18 that the SEBI is set to float a consultation paper to consider ending weekly expiry contracts. Yash is here with all of the details. Yash?
Well, it was on August 21st when SEBI chairperson Tuhin Kanta Pandey had expressed the intention of having longer-term derivatives. Of course, he had said that this would be done through a proper consultation process. Now, taking that intention from market regulator SEBI forward, what we've been given to understand is that the consultation paper, when it comes to removing weekly expiry, is expected to be rolled out within the next 1 month itself. As far as the consultation paper itself is concerned, it is expected that it may suggest some sort of glide path when it comes to removing weekly expiry, where the ultimate goal for market regulator is expected to be to move towards a monthly expiry. Of course, as I said, the SEBI at this point of time is thinking in terms of what that glide path towards having a monthly expiry should be. As far as another important caveat here is concerned, what we've been given to understand from our sources is that one thought with market regulator SEBI is to have a same-day expiry for all exchanges, for NSE, BSE and any other small exchange, if it is done fortnightly or ultimately going towards the final destination of having a monthly expiry. The whole rationale behind removing weekly expiry and, moving on the path towards monthly expiry is to, of course, remove speculation when it comes to the derivatives market itself. our sources maintain that all of these steps are expected to be done in a proper consultative way. Apart from that, market regulator SEBI is also expected to look at ways in which cash market volumes can be enhanced, also ways in which retail participation in the F&O or the derivatives market can be restricted through some kind of threshold. There are various suggestions and ideas which market regulator has with respect to containing retail participation in derivatives market, and all those ideas and suggestions are expected to be considered. But as I said, any move taken either towards removing weekly expiry, moving towards that monthly destination, or containing retail participation in derivatives market would only be taken post a consultation process.
Yash, thank you very much for that very important update there, showing up on the stock prices of both BSE and Angel One. By the way, some flashes on your screen just a few seconds earlier about a block deal in Ambuja Cements. You pull up the stock before we take that break, and there's some 0.8% equity that had changed hands in just a few minutes earlier, and that's as a result of which the stock has taken a bit of a knock in the last few seconds. Almost 1900 crores worth of shares that had changed hands for Ambuja Cements, and the block deal that has taken place. Of course, we'll get to know the buyers and sellers only later in the evening, but that's the transaction that has just taken place. The stock has slumped to the lowest point of the day, 2.25% lower. Take a short break. More news and updates on the other side. Stay tuned. Welcome back. Shifting focus to autos now. The 65th SAM convention is underway, and my colleague Parikshit spoke to automakers Maruti, Suzuki and Hyundai, both of which are expecting rate cuts to boost sales in the GST front, of course, especially in the small cars. They are also expecting a bumper festive season ahead. Let's listen in to both of them.
I think this is a very big reform which is happening from 22nd of September. It is not only kickstart the auto industry, but across all other industries also. Everybody is going to benefit, and the common man is going to be a big beneficiary. On the top of it, I think the two more things I would like to bring in the knowledge is, one, the benefit which was passed on through the income tax by the Honorable Finance Minister, and also I think the RBI Governor has done a very good job in terms of reducing the repo rates. So I think it's a combination now of the GST, then the benefit which is passed on through the income tax, and third is the repo rate. So I think it's going to be a bumper sales in this festival time. If we take the span of the festival of the 45 days, starting from Navratra to Diwali, at least there should be a growth of more than 20%. So small cars, we are expecting a growth of at least 10%. And overall industry, we feel earlier the CAGR used to be around 6.9 to 7%. We feel that this reform will again take us back to the industry growth of 6.9 to 7%.
The new plant is around the corner. I think come October we'll have the SOP of the Pune plant. We are all very excited because our capacity goes up from 824,000 in Chennai to now 170,000 more. So we are almost reaching close to 1 million. I think we could not have had a better timing for the Pune plant. So like I said, Q3 of financial 25-26, the Pune plant will come on stream, and the phase 1 will have 170,000 capacity, which starts kicking in right from the first month. I believe with the 10% cut in the smaller cars, it will bring in so many new customers. The first-time buyers, which Hyundai anyway is seeing a big jump. First-time buyers in 2020 used to be about 31%. Now they are at 39.5%. I believe we have a potential to go up to maybe 42-43% in first-time buyers. So more small cars selling. The second thing I think which will be much more significant is, if you see the customer affordability remains the same in terms of how much he can spend. However, the car becomes cheaper, which means its initial signs, maybe the customers will now again go back to the higher trims, because last 1 year we are seeing that customers were moving down from higher trims to middle trims to lower trim. But now there's an opportunity because India is a very, very aspirational country.
Expecting a bumper festive season are the auto stocks, but we highlighted GMDC a few minutes earlier. The stock has now extended its losses, 6% lower now on the stock, and take a look at the fall that it has had from the highs of the day. 13% lower now on the stock. Mind you, the stock was up 11% last Friday, another 5% on Monday, and since then it has had a 3-day losing streak, and it has given up all of those gains that it had on Friday and Monday, and it is now below those levels. So a significant fall seen on GMDC as we speak. But Roads and Transport Minister Nitin Gadkari also spoke out over the recent social media outrage on the government's ethanol blending program, terming it to be a paid social media campaign. Listen to what he had to say.
सुप्रीम कोर्ट में भी इसके बारे में बहुत साफ निर्णय हुआ है. अब जैसे आपकी इंडस्ट्री वैसे हमारा पॉलिटिक्स भी है, तो ये सोशल मीडिया का जो कैंपेन था वो पेड कैंपेन था, वो अगेंस्ट इथेनॉल था और पॉलिटिकली टारगेट मुझे करने के लिए था. अब मैं जवाब दूं तो ये मीडिया वाले आपके कॉन्फ्रेंस को छोड़कर वही बातें कल छापेंगे. तो मैं इतना ही कहूंगा कि वो जो कुछ था उसमें कोई तथ्य नहीं था, सब बातें क्लियर हुई है.
Well, on that note, let's slip into a very short break for now. More news and updates follow on the other side, so don't go anywhere.
Sources are indicating to CNBC TV 18 the broad intent in the government is to reducing the rates, and it is likely to propose to keep as many as commonly used items in the 5% slab. What we are given to understand from sources is the fact that the industry has written to Finance Ministry seeking some key changes in the GST structure to expand the tax base. Well, in what could be a major overhaul of India's indirect tax regime, the government is likely to propose a simplified 3-rate structure in the GST regime in the upcoming GST Council meeting, potentially eliminating the 12% slab.
The government is considering GST relief for a slew of sectors, including textile and the medical sectors.
GST Council meeting on 3rd and 4th of September will have to give an approval paving way to what PM mentioned to a 2-slab structure, that is 5% and 18% and a special rate of 40%. Well, the upcoming GST Council meeting on 3rd and 4th of September is likely to see a major GST overhaul, especially trying to give a consumption boost to the domestic economy. Firstly, a unanimous decision moving from a 4-slab structure to a 2-slab structure and a special rate, 5%, 18% to kick in from 22nd of September.
I'll give you this number which is important. 99% of all the goods and services which are touched by GST are now either in 0 or in 5 or in 18.
Welcome back. You're watching Business Lunch on CNBC TV 18. Now, in the latest on the Russia-Ukraine front, the president of the European Commission has spoken on the ongoing war, saying Europe will stand in full solidarity with Poland and calls for more sanctions on Russia. Listen in.
Europe stands in full solidarity with Poland. Putin's message is clear, and our response must be clear too. We need more pressure on Russia to come to the negotiation table. We need more sanctions. We are now working on the 19th package in coordination with partners. We're particularly looking at phasing out Russian fossil fuels faster. We're looking at the shadow fleet and at third countries.
Well, that's the European Commission president calling in for more sanctions on Russia. But putting the spotlight on the Federal Reserve, then let's also listen in to what David Solomon, who's the chairman and CEO at Goldman Sachs, had to say on the central bank's independence and his thoughts on the next moves by the Fed.
First of all, I think that central bank independence, not just here but around the world, has served us well. And I think it's very, very important. I think Fed independence is very, very important around monetary policy. I think the people who are in the Fed and make these decisions, and by the way, it's not an individual, it's a committee of people that vote, I think they take it incredibly seriously. And I think as you look forward and you look at appointments, and by the way, we saw Stephen Murrin at his hearing talk about the fact that he thought Fed independence on monetary policy was very, very important. So presidents and administrations throughout history have had a point of view about policy rates, and they voice them. The people that go and act on monetary policy, I think, do it to a very high standard, and I'm confident that they're going to continue to do it. But I think it's important for all of us to appreciate how well central bank independence has served us. There's no question that when you look at the labor numbers, there's a little bit of softening, and I'm pretty confident that we'll have a 25 basis point cut. Whether or not we have a 50 basis point cut, I don't think that's probably in the cards. So I would expect a 25 basis point cut, and I think you could see one or two other cuts, depending on how economic conditions play out from here. But there's no question we're going to see a slight change, in the policy rate as we move into the fall. And I think it'll be really data dependent on how things evolve as we go through the rest of the fall as to how that plays out.
Well, David also spoke about the US president's tariff policies, trade negotiations, and how it's impacting growth of the US economy. Listen in.
I think about where we are, there's still more work to do. And so, I think it's uncertain. I've said it a number of times, I think there's going to be a stickiness around how this all settles out. And I think we're continuing to see indications that that's something to watch very closely. So trade policy is still getting negotiated. It's still getting implemented. The administration has a clear point of view, but there's uncertainty around where this all lands. And there's no question in my mind that it's having an impact on growth. That impact on growth is hard to quantify specifically, and I think it's also very dependent on where a lot of this lands. There's obviously litigation now going on around some of the reciprocal tariffs. We have to watch that closely. There's still trade deals that have to be negotiated, particularly here in North America. So I'd say there's still uncertainty. There is an impact to growth.
Well, that's all we have on this edition of Business Lunch. Don't go anywhere. Midcap Radar comes up next.
Good afternoon. Welcome to Midcap Radar live from the CNBC TV 18 Motilal Oswal studio. I'm Sonal Bhutra. With me as always is Vivek Iyer. It's been a very quiet day today, quite choppy as well. So the Nifty up around 40 points is above the 25,000 mark. But, we've seen that recovery from the lows. We'll have to see whether that sustains or not. For now, yes, closer to the day's high. The mid-caps are, though, languishing. And a lot of stocks on our radar. So we'll discuss that through the course of the day today.
That's right. Good afternoon, Sonal. So, can we do 7 straight sessions of gains? That's the big question, especially as we head into the final 2 hours of the session. Quite a lot lined up on the show, so let's start off with the top headlines. Stocks trade ranged, but the market breadth is distinctly positive. Energy and utilities lead gains, while IT and autos drag. Mid-caps lag.
Shareholders cheer as Aurobindo Pharma's acquisition of Zentiva looks to be off the cards. This after reports suggest that private equity firm GTCR is close to a deal to acquire the generic drug maker.
Gujarat Fluorochemicals under pressure as a fire incident was reported at the company's key plant. Stock down over 4%.
Tega Industries inks a term sheet to buy global grinding media player Molycorp at an enterprise value of $1.48 billion. Tega will raise equity and debt to buy a 77% stake, with Apollo Global pitching in for 23%. The big bet will scale Tega's revenues by about 9 times, but will also add $1 billion in debt. All right, those are the top headlines, but let's talk about the market moves. As I said, above the 25,000 mark, and if that continues, we could see 7th day of green on our screen at the day's high currently. But the mid-caps, they are underperforming the benchmark. So the mid-cap index is absolutely flat if we look at it, with some positive bias, but it's been between the red and green line. Look at that. It's been flat for the last couple of trading minutes. Bank Nifty is the one which is supporting the Nifty as we speak, 0.3% higher on that one, and a lot of large banks are surging as we speak. From the mid-cap space, if we look at some of the movers, we had done a piece on SPEL Semiconductor in our Under the Lens segment. That stock is up another 5% today, but do remember it is a company which has a market cap of more than 1,000 crore rupees for annual revenues of just around 8 to 10 crore rupees. But that stock continues to do really well. It's not SPL Industries, it's SPEL Semiconductor that I'm talking about. But yes, that is one stock on our radar. But mid-cap movers, as we always talk about the special segment that we have, Vivek is here to take us to the mid-caps that are moving around in trade. Vivek.
Well, thank you so much for that. Broader end of the markets, the advance decline ratio is quite active, quite strong. And in fact, quite a lot of strong moves, quite a lot of recovery from recent lows as far as underperforming sectors are concerned. What is the first sector on our radar? Well, the entire metal pack. Remember, last couple of trading sessions quite muted, but today the entire pack has recovered quite sharply. Names like Nalco, Hindustan Copper, Zinc, all of them have recovered. Even a name like NMDC in the last hour or so has seen significant buying activity. Aurobindo Pharma, we alluded to the fact that the street is cheering the lift of the overhang as far as a large acquisition is concerned. On the back of that, that stock higher by 4.5%. The oil and gas space doing very well today. Chennai Petro, in the broader end of the markets, NSE 500, one of the top gainers, up 3.5%. Newland Labs, remember, 15,000 rupees stock, up 3.5% today. And GSPL, again, one name from the oil and gas space, hopes of tariff, adjustment both for GAIL as well as GSPL is something that's driving these names higher. On the other hand, quite a few stocks seeing some selling pressure as well. The entire IT pack, an important clarification coming in from OFS is saying that no material impact from the parents' change as far as guidance is concerned. On the back of that, all of the IT stocks, especially mid-cap names, have cooled off from the yesterday's highs. Names like Angel One, BSE, the entire capital market players, all of them near the day's lowest point. Any change as far as, or any curbing as far as options activity is concerned on the weekly basis is something that is seen as quite negative as far as EPS is concerned. Gujarat Fluoro, the fire impact, and Sona BLW Precision overhang as far as promoter fights is concerned or promoter dispute is concerned is something that is keeping this particular stock quite subdued.
All right, those are some interesting names. Thank you so much for that, Vivek. But let's get a technical check on the market. Siddharth Rai Mangla from Stockbox Technologies is joining us for that. Siddharth, good afternoon. Thank you for joining in. What's your next important level to watch out for on the Nifty and any individual names?
Hi, Sonal. Good afternoon, and thanks for having me on the show, first of all. See,
If we talk about Nifty, Sonal, this entire week, we have particularly seen one thing very special that has happened. See, for every session, we have seen the support shifting higher. On Monday, 24,700 was an important support. Tuesday, 24,800. And yesterday, we saw Nifty comfortably sustaining above and spending the whole session about 24,900. Today, even though we're not seeing a very big move, but it's a very good signal that Nifty is trying to stay and spend time around 25,000. Now, if the Nifty manages to spend some time in this 25,000, 25,050 range, I think, Sonal, the next important levels to look for will straight away be around 25,250 and 25,350, because the momentum will then be even more stronger than we are seeing it right now.
Okay. Siddharth, we've got a view as far as the index is concerned. Individual trading ideas, what do you have for our viewers? Buy ideas, or do you have a mix of buy and sell as well?
Yeah, sure, Vivek. See, I have two ideas and both are on the buying side. The first stock is Tata Chemicals. See, the stock, today's candle is especially very strong and very beautiful. We have seen an open low being made. That means the stock started rallying around the same levels where it opened. And now we have also seen a good breakout. So Tata Chemicals can keep this momentum going. So now the spot is trading around 958. We can buy it here. The stop loss will be 949 and our targets will be, first target is 985. Second target being 999. And the second stock is IGL. See, the last week was not good for this whole space, but for the past two sessions, we are seeing a strong turnaround in this whole space. But I think IGL is going to be especially outperforming the space in the upcoming days. So IGL can also be bought. Right now, the spot is around 214.25. We can buy it here. The stop loss will be at 210, and the targets will be first target 225, the second target being around 229.
Actually, I was going to take a follow-up on the CPSE space as well, because CPSE was not doing well, but you mentioned out of that you like IGL. So I would move on to Axis Bank then, Siddharth. What's your take there? How is that particular chart looking?
Yeah, definitely. So, see, I think the whole banking space, in fact, we have seen a strong turnaround in the past two sessions, especially today. Even if we look at the Bank Nifty, the pattern today is very strong. And Axis Bank, you were talking about Axis Bank, and I think Axis Bank can be one of the outperformers from the private banking space from here. The only resistance here is the 1090 level. If it manages to go above and spend some time above 1090 levels, the next big levels we'll see here will be around 1150. Yeah.
Okay, thank you so much, Siddharth, for joining us, giving us a view on the markets, your trading ideas, and also a quick take as far as Axis Bank is concerned. Well, an important reminder for our viewers, you can unlock a world of exclusivity, expertise, and influence. Become a member of CNBC TV 18 Access, our premium members-only experience on cnbctv18.com. The membership includes access to CNBC TV 18's flagship events, interactions with our journalists, along with curated studio tours, e-learning sessions, as well as masterclasses, along with curated lifestyle benefits.
Hyper-local a completely new meaning, isn't it?
There is one consumer base in the same geography that are looking for cheese. There is another consumer base that is looking for paneer. So the way our assortment comes in, it allows for that level of identification.
Is it still about the 10 minutes or has that changed significantly?
A consumer that depends on quick commerce, when they come up and fire search for the item that they look for, needs to be available in less than 10 minutes.
Welcome back. You're still tuned into Midcap Radar. We have to talk about the big acquisition that took place last night. Tega Industries has announced the big acquisition of Molycorp, which they will acquire as a part of a joint venture with Apollo Funds. We spoke to the management. Let's listen into what they had to say. This is an exclusive conversation that we had earlier today.
Debt at the target level is roughly about $1 billion. And the attempt is to bring the leverage down after the transaction closes. Sure, I think through the consortium arrangement that we have with Apollo, the intent is to structure the debt in a fashion that we leverage it down to around 800 million odd levels from the current billion, and that should help us deliver some improved benefits in terms of interest cost reduction with the leverage coming off, and hopefully even an improvement in the credit rating. We should be able to, the attempt is still early days, but the attempt is to at least shave off anywhere between 25 to 40 basis points of their current terms with their current lenders. I think where Molycorp today operates at is at roughly around 11% EBITDA levels. Our aim would be to try and improve that over the next 2 to 3 years to, on an average, anywhere between 13 to 14% levels. Tega, as you know, operates at a CAGR of 15%, delivers about close to 22% EBITDA. So the margin profiles are different, but we hope that on a consol basis over a 3 to 4 year period, we would be roughly at about 18% on a consol basis.
Well, a very large acquisition that the company has done, and a very interesting conversation that we had with the management earlier. Well, as we speak, the mid-cap index has slipped into the negative territory, although marginally, and what's actually dragged the market lower has actually been the capital market names. Earlier today, we told you about how SEBI may be looking at curbing options expiries. On the back of that, two stocks we highlighted, both BSE as well as Angel One. But along with that, have a look at some of the other names. Look at CAMS, that particular stock has moved to the low point of the day. Nuvama, that particular stock too has moved to the low point of the day. Some stocks that have actually managed to buck what's essentially a weak market in the broader end today has actually been some of the auto names. TVS Motors has spiked from its recent lows, and that particular stock is now trading near the day's highest point. One stock that particularly stands out is actually OFSS, Oracle Financial Services. That stock yesterday was up 10%, and after that, today actually saw a gap up opening. But post a clarification from the management, that stock has cooled off significantly from the day's highest point. But moving on, the 65th Siam convention is underway, and CNBC TV 18's Parikshit Luthra caught up with Mahindra and Mahindra's Nalinkant Golagunta and began by asking him about the latest GST reforms and demand trends this festive season. Let's listen in.
For us, the GST reforms is really a way to provide an opportunity for customers to have the vehicles at an affordable price. And so what we have done is we said, listen, if on 22nd September, there's going to be a benefit which the customer is going to enjoy, we're going to find ways to support them even earlier than that. So we announced that we're going to give a similar kind of scheme from September 6th. And too early to say the impact, to be honest. But the walk-ins have come in, and quite a bit of excitement and queries have gone up. But it's too early to predict how it's going to turn out in terms of the festive season. But we're quite optimistic that it'll be a great festive season.
Overall, for the rest of the fiscal and for the full fiscal year, how do you expect the demand to increase on a sustained basis?
Yeah, so if you remember, one of the things we had done at the beginning of the year is we put out a forecast on what our growth will look like, which is mid to high teens growth for our SUV portfolio in terms of volume. It is an aggressive number. If you remember, I think there's a lot of people in the press and in the industry who were questioning that when an industry is going to be flat, Mahindra has put out an aggressive target. So it is an aggressive target, and this kind of helps us go towards and achieving that number. If you see the first quarter, we did about 22% growth in terms of volume. So we've been on a good clip so far, and we are staying with that mid to high teens growth of volume, and this will help us get there.
Right. So would you stay with this forecast for the rest of the year?
Yeah, at this point in time, very early to say if there's any change, but we'd stay with the forecast, yes.
What's going to be the focus of capital investments from the group?
No, absolutely. So you're talking beyond the product development efforts we're putting. So for us, at this point in time, the primary effort on the domestic front is expanding our service network. As you know, we have had 20% growth couple of years now. And this year, like I said, we're looking at mid to high teens growth. So for us, ability to serve the customer is foremost for us in terms of service network. And that's something we've been growing at a healthy pace, about 10-15% on a yearly basis. So we'll continue to go down that path and make sure we are providing that kind of capillarity of the network, if I may call it that. Beyond that, I think the focus is now starting to become a lot more important for us on the international front. South Africa has been a very strong market for us. It's now our second largest market. Australia is starting to do well as well for us. And so we're starting to put plans in place for growing beyond that. UK is something we have on our horizon. We're looking at a 18 to 24 month time frame for going into UK. BEVs help us get there.
Could you also give us a sense of the customer sentiment right now?
We are already the number one in terms of revenue market share in the EV space within 2 quarters as well. So the demand on that is doing extremely well for us. Now, on the rest of the portfolio, with the GST cut, which we are passing on to the customers, you suddenly have a very strong value proposition on the Bolero portfolio, on the Scorpio portfolio as well. And as you know, rural has been doing very well for us as an industry. And so this should give us growth coming from that part of the segment as well.
I'd ask, coming back to the GST issue, Mahindra Group has stopped billing vehicles to the dealer right now because of the compensation cess issue. When does the billing process actually begin? And will you be able to meet that festive demand during Navratri, considering there is going to be a gap?
Yeah, so that's the fine line we have to play on at this point in time. We took a call late part of August to take a look at this carefully because we knew that there was no clarity on the cess side from the government yet. And so going ahead and putting the dealers under even more pressure than what they had on the top end of the spectrum, where the cess component is almost 20%, would be something we didn't want to do. So we've taken a cautious approach on that. And we, of course, both as an industry association, Siam, as well as FADA, have made representations to the government to provide clarity on the cess. So that journey is going on. We'll see how that plays out. But until 22nd, we're going to be cautious on that front.
Right. So is this going to restrict the amount of inventory you'll be able to put into system?
No, so we have taken steps to ensure that we'll still be able to meet the festive demand.
Mahindra Group looking at some sort of strategy or share the loss with dealers in some way?
Yeah, so as an industry, it's a fairly big number. It's going to be hard for any of the players to take the burden in one shot. One of the things we are doing is the schemes we put out right now, right? So that there's no reason for customers to wait till 22nd. So we are hoping that gives an opportunity for folks to go ahead and buy the vehicles even before 22nd. That takes the pressure off for us, especially on the larger vehicles. But beyond that, honestly, we're looking for direction from the government at this point in time on what clarity they can bring to the industry.
Right. And any more launches lined up for this fiscal?
Yeah, of course. We have a couple of more EV launches coming up later part of this calendar and early part of next calendar as well.
All right, that's the word coming in from M&M. GST rate cut has, of course, improved inquiries, but that cess issue at the dealer level continues to be a pain point. And we spoke to a dealer today, and they indicated that they will make representations to the government regarding that cess credit. But with that, we'll slip into a break. But remember to tune into the all-new CNBC TV 18 Prime, bringing you insights from policymakers, business leaders, and economists shaping both the world and India's future. CNBC TV 18 Prime decodes global shifts and their impact on Indian businesses, giving you unparalleled insights. Tune in to CNBC TV 18 Prime at 12 noon for the Global Reset, at 1 p.m. for the Big C, and Global Lens at 8:30 p.m. Welcome back. Still tuned into Midcap Radar on CNBC TV 18. Markets continue to be above the 25,000 mark, but a lot of stocks in the broader markets on our radar. Aurobindo Pharma is buzzing in trade. There is some news around Zentiva acquisition. Winnie is here with all the details. The stock has surged to the day's high now, Winnie.
Yes, Aurobindo Pharma is trading at the day's highest point as of now. Now, the news flow that came in this morning, and this is from Bloomberg that we're picking up, the GTCR is nearing a deal to buy the generic drug maker Zentiva. They've emerged as the likely buyer coming in, and Zentiva is an important one. Like previously, what we had seen, that Aurobindo Pharma was among the top and leading players in terms of the acquisition. So there was Aurobindo Pharma, there was TPG, and there was GTCR as well. Now, when this news flow came in the first time, that Aurobindo Pharma is likely maybe looking at the acquisition of Zentiva, what we saw that the stock saw a fall coming in. That was mainly because investors were concerned that maybe this is going to be a bit big of a deal. How would they pay this? Or, what would be the debt? Or, how was the balance sheet going to look like after this deal? So, bit of a relief that comes in, because if the Bloomberg news flow that is saying that right now that GTCR is actually the likely buyers of Zentiva. So, what we had also spoken to the management, they highlighted clearly that yes, they're looking and in talks for Zentiva, but they will always keep in mind the investors' concerns as well and would not overpay for any acquisition. So that seems like that's the story that's playing out right now. And on the back of that, Aurobindo Pharma buzzing.
Absolutely right, Winnie. And even as we speak, the stock has spiked to the day's highest point. Clearly, the street is cheering the fact that maybe the leverage will not happen as per what the management might have done earlier in case the deal had gone through. Well, moving on, earlier today, we spoke to the management of Chola Mandalam Finance, and speaking to us, they flagged rising stress in the unsecured segment as well as in the vehicle financing segment. They also lowered their AUM guidance following the GST cuts. Let's listen in to what the management had to say.
Sort of question, overall, in our view, the AUM growth, we still will hold it at the 20 to 22% levels for the full year. We will be reaching this, and there should be benefit with the number of units being sold because of the reduction in GST. And while that would have a slightly lower impact on the value, so overall, we don't want to change it either positively or negatively because of the GST reduction coming into play. GST implication would, also mean lower EMI burden to the customer, which would mean it will improve credit. Just wanted to add that part to it. It has always been a case that this Q2 will always be a slow quarter because of rains and also because it has got a fair share of the period coming under inauspicious months, etc. For the full year, the overall credit cost would be in the range of around 1.5 or even 1.6% as somewhere equivalent to last year levels. And if, God forbid, the monsoon gets extended into Q3 like it happened last year, then it can even be slightly higher.
Well, some sobering commentary coming in from Chola Mandalam Finance, especially for the next couple of quarters. But with that, it's all the time we have on this edition of Midcap Radar, Mutual Fund Corner, when we return.
Hello, good afternoon and welcome to Mutual Fund Corner on CNBC TV 18. I'm Vinny Motiwala, with me Sonal Bhutra as well. Sonal, good afternoon, and a lot that's happened and coming from the AMFI data as well. So first, let's talk about that before we jump into what we're going to be discussing today with our guests as well.
Oh yes, so we'll be discussing what's the activity been like in active and passive funds. But before that, let's talk about the data that came in from AMFI yesterday as far as mutual fund flows are concerned, because we did see some tapering off when it comes to equity fund flows overall. Now remember, last month we saw record high flows at 42,672 crore rupees. There's been some ebbing in that number. So 33,417 crores, that's been the equity flow number. Large cap funds, yes, there's been an improvement. So that decline that has come by, we'll discuss why that happened this time around. But large cap funds did well. We do have the mid-cap funds as well that saw an improvement on a month-on-month basis. That's also a multi-month high number for the mid-cap names that we are talking about. Small-cap funds as well. So all these factors did well. So what really went wrong this time? Let's look at other factors. Actually, the SIP number, that's been the big hit. We have been for last couple of months been saying, oh, record high SIP, record high SIP. This is not something we could say this month because it has come off by 200 crore rupees on a month-on-month basis at 28,265 crore rupees. Now, where has this decline come in from in the equity flows? Thematic funds, that has seen a decline from 9,400 crore rupees. It is now at around 3,900 crore rupees. Even NFOs, now remember last month we saw high base because of Jio, BlackRock, AMC issuing those liquid funds, and that saw great response as well. But this time around there's a sharp decline because of the high base that we've been talking about. If we talk about hybrid funds, that's where some decline has come by, because this was one category everyone was eyeing. But now there has been some decline there as well at 15,293 crore rupees. Balance advantage funds also saw a decline. There has been a decline in multi-asset allocation funds as well. Arbitrage funds, that also has seen a decline. And if we talk about the debt funds, there has been an outflow this time around. So overall, if we talk about the number, equity flows have come off from record highs, and it's not because of the usual large cap, mid cap or small cap. It's because of the other categories, be it multi-asset allocation, be it hybrid funds, which were actually the favorites a few months ago, have started seeing some decline come by there as well. And assets under management as well have seen a decline on a month-on-month basis, of course, because of the pool getting some month-on-month decline overall. So that's been the synopsis of what happened with the monthly data. We'll keep tracking that for you. But now let's get on to our conversation and welcome our guests on the show, Chintan Haria, Principal Investment Strategy at ICICI Prudential AMC, and Tanvi Kanchan, Head NRI Business and Strategy at Anand Rathi Shares and Stock Brokers. Chintan and Tanvi, good afternoon. Thank you so much for joining in. But lady, let me start with you first up. What has been the activity when it comes to passive funds this year so far? How much has the AUM increased? What kind of interest are we seeing from the investors here?
Hi, Sonal. Thank you so much for having me here. I think we have seen a very improving trend in terms of active versus passive. Indian markets, if you see 5.5 years back, passive funds barely had about like an 8% allocation towards total AUM, that the bifurcation was between active and passive. Whereas now you're seeing passive funds slowly creep into the percentage allocation that they have over active funds. So as on date, you're sitting at about 16% of allocation towards purely passive fund. And this inflection point, that is the major shift that happened between active and passive allocation in the Indian markets, you saw a very steep change from 2022, where a lot of money started going into passive fund strategies, a lot of money started going into index fund strategies. So that's where your major allocation, as on August data, stands with about 16.5% of the total industry allocation towards passive funds.
Right, Tanvi, point taken. And Chintan, coming to you for the same point, right? Anything that you would like to add to that? And, what kind of interest have you actually seen coming in from investors on this front as well? Anything additional in the recent months that we've seen in terms of a trend? And in the past, how have these performances been of passive fund versus active fund in the last few months that we could talk about?
Yeah, thanks, Vinny, and hi, Sonal. If we look at India as a structural market for the last 15 years or so, we moved from a time where people used to say fixed income towards equities. Now, within equities, we basically started bifurcating into mutual funds and direct equity investing. Within mutual fund, it is now being active versus passive. So I think this discussion around active versus passive is, of course, borne by the fact that we have much larger product suite now in the passives. I think just in the last 1 year, more than 100 passive funds have been launched. That's because all the AMCs are now filling in their bucket in terms of having the options for the investors to put money. Having said all that, we do believe that active funds, because of the structure of the Indian market, have a lot to offer. And so in India, both active and passive will coexist for the longer run, because unlike some of the Western markets or even the Asian markets, India has a diversified equity sectoral bouquet which is available. And so fund managers who are actively managing their funds always have something to create alpha from. So in India, which is anyways under-penetrated as far as financialization is concerned in equities, only 7% of our total savings is in equities. We do believe equity and active and passive both will continue. The trend in passive is, of course, encouraging. It's mainly led by, of course, the pension assets coming into the markets. And so of the 12.5 lakh crores, if you look at it, a large portion is still led by institutions and pension funds. So the actual on-ground retail HNI activity in passives is improving and increasing. But still the active is where the larger chunk of the money is going. And I still believe that both active and passive will grow in India because the scope to grow in India in terms of active passive is growing. And the numbers which you were mentioning about mutual funds and, the fall in the, let's say, the incremental flows that has happened between July and August. One thing we must remember is that if you just look at 10 years back, these numbers were sub 3,000 crores a month. So 33,000 crores a month is still not bad. And this continues to be a strong rebuttal to the FIs who've been selling in India.
Of course, it's not bad. It's just that everyone's been so used to an increasing trend on a month-on-month basis that it has come in as a bit of a disappointment after seeing record numbers. But of course, after record, after peak, something or the other keeps seeing a decline. So we understand that. But the SIP number, of course, has been a big data point to take forward from this month's number as well. But Tanvi, let me come to you. Have we seen better performance from passive funds versus active funds in the last few months? What has the trend been like so far?
So if you even take a longer term CAGR, you take a 3-year kind of a performance, and you track your broader active funds with your benchmark indices. So whether you take a large cap category of Nifty 50, do a 3-year CAGR and also compare it with your active funds, you see your benchmark indices at somewhere in the range of 12.5%, whereas your active fund managers have generated a return in the range of 19 to 20%. Similarly, if you take a small cap index, that is 150 or your Nifty small cap, your performance has been in the range of around 20%, whereas your actively managed funds still have generated an alpha of around 2 to 3% to the tune of 23-24% in terms of return generating capability. So when you're seeing the data points in India with regards to broader indices, at least, leaving the thematic, leaving different kind of, these strategic indices that have come in, if you take just a broader index fund, you're still seeing active fund managers able to generate an alpha over and above their passive counterparts. And as Chintan very rightly said, that there is still a level of information arbitrage that is present in India as compared to our peers or our global counterparts, where to generate an alpha in the market becomes very difficult in the global space or in the developed market space as compared to India. Here you have a much more structural theme. Here you have a much more longer term theme that kind of gels well with the investment philosophy of active fund managers, where they not only chase returns. One is the return generating potential of the portfolio. The other is also the risk measures. The active fund managers are able to have a lower standard deviation in the portfolio, a certain level of beta to the portfolio vis-a-vis the benchmark is maintained. So with regards to both the strategies, again, on a longer term, we have seen active fund managers do generate a certain level of alpha on their portfolios.
Absolutely. There's some generation of alpha for the long term that comes in for active versus passive funds. But Chintan, if someone has to pick now in their portfolio, how should they be allocating, or how should they choose, passive funds versus active funds, or over a conservative, medium risk, high risk investor? For all these type of investors, how should they be dividing this now?
So I think investor behavior is very interesting. When the markets are doing well, even the most conservative investor becomes an aggressive investor and vice versa. So rather than focusing on the category in which an investor belongs, let's possibly take it a general outlook that asset allocation is the key to long-term success. And within asset allocation, as the bouquet suggests, you will have a certain allocation to dynamic asset allocation schemes. We generally say 40 to 50% should be a good allocation to dynamic asset allocation schemes because they will probably give you a steady long-term base on which then you can create alpha through the other part of the portfolio. And the other part of the portfolio will have 25 to 30% in value categories, special situations, mid caps, small caps, as the case may be. And then there is 25% left for passives, and within passives, I'd include silver, gold ETFs as well. So I think a portfolio mix of having a good, steady allocation to dynamic asset allocation schemes. Within dynamic asset allocation schemes, of course, now you have aggressive and defensive options. So you can mix that. Along with that, you have the active schemes in mid cap, small cap, and diversified equity. And in the passive schemes, nowadays we're seeing people being very active in terms of sectoral and thematic allocation. So if someone had a view that, okay, the GST cuts are going to benefit the FMCG or the consumption sector, they can invest in the FMCG and the consumption basket to the passive funds which are available within that space as well. So we are seeing a tactical allocation, but it's still infancy stage in India in terms of the passive allocations. We have a long way to go, and we do believe that both active and passive will have their space in an investor's portfolio. But the mix will keep changing. Today, of course, the flavor of the season is silver ETFs and to an extent gold ETFs. But if an investor always had a balanced portfolio, they would get the benefit of all asset classes performing in India.
Oh yes, what a move on silver, right? We've been talking about gold, but silver surreptitiously came and has made a one-way move there. But Tanvi, let me come to you on this question itself. If one has to choose, of course, every investor appetite is very different, but how much of their portfolio should be into passive versus active for different risk categories?
So I think it's something with regards to behavioral finance as well, where you look at time horizon, you look at your investment preference. Again, the active versus passive should not be either or, it should be a combination of both. So when you're even looking at a broader portfolio for a conservative investor, you can look at adding, say, a larger percentage allocation towards large cap followed by mid and small cap strategy. So a passive fund can be with regards to large cap, whereas a small, mid, and maybe a gold or a silver ETF can be added with regards to diversification there. So you can look at like a 70-30 blend with regards to passive and active. If someone's extremely conservative, then going up the chain with someone who's moderately aggressive, you can look at a 60-40 with 40% allocation towards passive funds. Again, even within passive funds, you can look at different trends that are there. You can look at different thematic trend, sectoral trend that does gel well with the kind of investment outlook that one has. You did see a lot of NFOs come in defense. You saw, a sort of outperformance of these particular NFOs also, but then there was also a very big hit that they took. So someone has to be very cognizant when they're taking a call on which sector, which scheme. So basis that, I think a broader portfolio allocation or blocks can be built on the basis of thematic, large cap, even allocation between your commodity ETFs and so on and so forth. So
okay, that's the view coming in there, of how one should be looking at active passive. Have all of that in your basket as well. But on that note, we're going to actually sip into the short break that we have to take right now. Don't go anywhere. We still have this discussion left. We have to discuss a lot more in terms of opportunity that lies here as well. So stay tuned in for that. Welcome back to Mutual Fund Corner on CNBC TV 18. Now, let's continue the discussion on active as well as passive funds as well. We still have with us Chintan Arya as well as Tanvi Kanchan as well. So continuing the discussion, Chintan, let's start this time with you in terms of overall, where does India stand in passive investing versus maybe you would compare in terms of global benchmarks or global countries?
So if you look at the global landscape, there are pretty much only two countries where passives have picked up massively in terms of retail investing. One is US and the other is closer to home, that is Korea. But if you look at the US market, it's 50% of the global market cap, right? So US is huge. I think more than $60 trillion of market cap versus $100 trillion globally market cap. And within that $60 trillion market cap, a lot of it, almost $12 trillion is ETFs, because of the fact that in US, the ETFs get taxed at a beneficial way compared to the mutual funds. So in ETFs, you don't need to pay tax on your unrealized gains in US. While if you're holding a mutual fund, even on your unrealized gains, you have to pay a tax. And hence the entire industry in US over the last 7-8 years, maybe 10 years, has shifted towards ETFs. And in US, you have active ETFs as well as passive ETFs. So some of the trends in US are that active ETFs, or rather the active mutual funds, have also been converted into active ETFs because of the fact that they have a taxation advantage. That's peculiar to US, and hence you've seen US passive ETFs going up significantly. In India, if you look at it, the trend is pretty clear. Institutions and also the advisory, which basically is also growing, plus family offices, which have their own structures, are preferring investing through ETFs and index funds wherever they have a strong view and they want to participate in a known theme. Those are, I would say, tactical allocations. They are not necessarily strategic allocations, apart from the broader indices, which have 500 or 50 stocks. So in India, the landscape is changing. But if you see in India, probably the largest weight in the broader indices would be in the range of 11 to 12% or maybe 10%. While something in Taiwan would have the largest stock is about 56%. In Korea, it is also quite high at more than 25-30%. So India offers that diversity, and hence active and passive will both coexist, because active fund managers will deliver alpha, while the family offices and those who want to take those calls strongly on certain sectors and themes can go the passive route, and that gels well with the kind of breadth of products which are now available. Earlier, it was only, say, IT ETF or banking ETF which was available. Today, if you look at it, you have an option of oil and gas ETF, FMCG ETF, IT, banking, infrastructure, etc., etc. So the wider the choice, the more investors get a chance to invest in the market through the ETFs. But it will still be led by institutions and pension funds as far as India is concerned for a while. Because in India, still the retail on ground does not necessarily understand the markets that well. And so seeing a significant increase in the institutional side on ETFs, while the mutual funds will continue with the distribution and advisory going the way it is right now.
Yeah, and as you pointed out, in US, the tax benefit really works. It's a pass-through in terms of dividends that is given to the investors, and that's why they prefer ETFs over mutual funds. If that happens in India, maybe we could see them warming up a lot more to ETFs in general. But Tanvi, let me come to you. And this is something I would like to ask you, Chintan, as well. And if we can do it quickly, because you mentioned consumption FMCG themes could work right now and investors could look at that particular theme. But aren't some of the passive funds sectoral? So how do you look at that considering the volatility we keep seeing in sectoral funds? Who should go about it? Tanvi, let me start with you, and then Chintan, please come in on that as well.
Sure, absolutely, Sonal. I think you're seeing the kind of inflow dry up as well in certain sectoral funds. And this is something that is changing with regards to trends. So when you're looking at sectoral funds, you also need to look at what are the sectoral funds that are cyclical in nature. You had a huge influx coming in defense. You had a huge influx coming in pharma as well. You saw defense and pharma both generate about 46-47% kind of a return and then dry up immediately thereon forth. This structural change has also happened because pre-COVID and post-COVID, you had about 4 lakh odd demat account with regards to India. And then post that, you had a huge influx where there was almost 20 odd crore of addition. So 4 crore to 20 crore is what you saw an addition in terms of pre and post COVID, just purely the number of people coming in the Indian markets. So the major trend that also continued over there was the sectorial thematic funds that did kind of over or supersede your broader large cap, mid cap, small cap kind of a market cap funds that were there. So you did see a very major shift in trend. However, whenever someone is looking at these particular sectors, they also need to be very cognizant of the risk that these sectors do carry and the kind of returns that they're expecting from these particular sectors. So
Right.
you will have to be extremely, you'll have to look at your portfolio in terms of rebalancing as well. Right now, the GST does have a positive impact. The US tariffs had a negative impact towards certain sectors. So when you're looking at a sectorial or thematic allocation in your portfolio, you'll also have to be very cognizant with regards to the level of rebalancing you're looking at in your portfolio. So that's something that investors looking purely in sectorial or thematic investments with passive fund strategy will also have to somewhere use a passive fund as a way of getting an allocation and then rebalancing.
Okay. That's a view coming in there. But, with that, we're actually absolutely out of time on this edition of Mutual Fund Corner on CNBC TV 18. Tanvi as well as Chintan, thank you so much for joining us on the show. And viewers, thank you so much as always for, joining us, watching the show as well. But remember that next week, I think we should start doing queries as well. So please send us your queries so we'll solve them as well. But thank you so much from Sonal, me, as well as the team who put the show together. Thank you so much for tuning in.
Market headlines. To understand the reasons for the day's movers and shakers. And Get your portfolio ready for tomorrow. Beaming live from the CNBC TV 18 Motilal Oswal studio.
It is a mixed picture. Hang Seng is the underperformer today.
Another positive close, and we've been slowly inching up. Resistance line is 24,980.
The intent is to structure the debt in a fashion that we leverage it down to around 800 million odd levels from the current billion.
22 points lower on the Nifty, 94 lower, 9,800 points lower on the Sensex.
Clearly, there has been a pivot from the government side to move into demand-side stimulation.
In our view, the AUM growth, we still will hold it at the 20 to 22% levels for the full year.
I think kick-starting from September, hopefully we would achieve the CAGR growth, so maybe just about 5%.
Across all other industries also, everybody is going to benefit. And the common man is going to be a big beneficiary.
After a 6-day rally, we are taking a bit of a pause today.
SEBI plans to have a transition ultimately towards having monthly expiry.
It's been a very quiet day today, quite choppy as well. So the Nifty up around 40 points is above the 25,000 mark.
Well, that is the day so far, and a lot's happening, lots to track, individual stories more than what's happening as far as the broader market is concerned. Just above 25,000 is where the Nifty is now holding. This is Closing Bell. We are coming to you live from the CNBC TV 18 Motilal Oswal studios. I'm Prashant Surbi, Rima with me here in the studios. Nigel is joining us from the newsroom floor. Guys, good afternoon.
Hi, afternoon. 7th day of gains. The gains are not much to boast about, but at least we've conquered 25,000 today.
Absolutely. And I think this is the market right now, the phase that it's in. It's not about pomp and show. It's about taking the small steps and, climbing on top. Because so far for the week, and this day is not even close, we're already up 1%, and the gains are fairly broad-based as well. If you see most, across most parts of the market, including financials. Nigel.
Well, that's right, and we'll have the Sensex contract expiry as well that will play out. So let's see if that can make some kind of an impact. But for the time being, you'll have to say it's been a rather good trading session.
Oh, absolutely. And, lots of individual movers, right? And I think it's all about, actually, this year broadly has been about individual movers. It depends on what you kind of own. It's not been about very large and broad moves in any sector. Per se, but about 50-odd points, about 150-odd points on the Sensex, and a bunch of those sectors coming up on the screen as well. The auto index. We'll have an interesting conversation from the top boss at Tata Motors shortly, but that's what we have coming through at this stage. Rima, what else is happening? I think we, of course, will go across to our story, which is the weekly options, and there's a bit of a reaction coming through on BSE.
Indeed, BSE is down nearly 5% at the day's low. Angel One has seen a knock. That's grinding down close to about 5%. And other than that, you've got profit booking visible in IT. The Nifty IT index had moved up 5.5% over the last 2 trading sessions. And sectorally, that's the only one which is a bit of a drag. And that's down close to about 0.7%. Let's tell you what we've lined up for you on Closing Bell. Action-packed, 1 hour coming up. The markets have managed to extend gains going into the final hour of trade. The Nifty is above 25,000, and it's the financials today leading from the front, while IT has seen some selling pressure. The other big story, sources tell CNBC TV 18 that SEBI is all set to float a consultation paper to consider ending weekly F&O contract. Shares of BSE Angel down and out following this news flow. And Tega Industries is the other big news maker. The company has entered into a joint venture with Apollo Funds to acquire Molycorp for about 13,200 crore rupees. Shares take a hit despite an optimistic management commentary. We'll get you excerpts of our chat with the management in just a bit. And reports suggest a deal may be in the works for private equity firm GTCR to acquire Advent International-owned drug maker Zentiva. Shares of Aurobindo Pharma, that was previously leading the acquisition, are up and about in today's trading session, while shares of GAIL are also extending gains following the news that the outcome on the pipeline tariffs may come over the next few days. Brokerages estimate a tariff hike of anywhere between 10 to 20%.
Okay, all right. So those are all the stocks and themes on our radar. Let's quickly get started. We've got, I think, Mitesh with us now. So get some trading ideas going. Mitesh, tell us, index stocks, and also throw in a word on these capital market plays because of the story that we'll just come to. For instance, BSE is now down 5%, Nuvama is down 3%, Angel is down 5% as well. Again, rumblings around what regulatory changes are perhaps coming up ahead. So just a view on these stocks and, of course, overall trades for the last hour.
Yeah, so I think on the index, I've advocated that we head towards the upper end of the range. We're doing that. We've crossed or just around trading around this 25,000 mark, but the next logical target could be around 25,150 and then 25,250, 300 zone. I think that will be a very difficult level for the index to clear in one go. So maybe you should take some profits as you get closer to 24,150 and more as you get closer to about 24,250, 300. Now on the capital market plays, I think very clearly negative news flow, which means that the short-term sentiment has turned negative, but a couple of these names are also, have been in a declining mode. For example, if you look at the charts of Angel One, ever since making a high around 32, 80, 90 zones, the stock has continuously made lower highs and lower lows. And if you look at the long support areas over here, I think, they will kind of pitch in around these levels of 2060 to about 2080. There may be another 4, 5, 6% kind of a downside left over here. For BSE, similarly, I think the stock also, last time it bounced back from near the 200 average area. It made a low of around 2090, which was on the 29th of August, and 200 average area was around 2070, and currently it's the 200 average area is around 2090. So that is the first support. But in case BSE breaks 2090, then I think pencil in another 5 to 7% or 100 to 150 point kind of a correction happening on the downside. On the stock calls that I have a buy on Cyient. I think the IT names have turned very well, and that's where the focus is. So Cyient for me is a buy. Keep a stop just below levels of. Sorry, I think just allow me to load the chart. I think it's just taking a bit of time. Yeah, sorry. So Cyient is a buy with a stop at 12.10, and I would look at a target of around 12.75 here. And Hindustan Zinc, see, I think this stock was slightly underperforming the rest of the metals pack, but today I think it's given a positive crossover. The candlestick pattern is very bullish, so buy here as well. Keep a stop at about 437. Look for targets in the range of about 456 to about 460.
Sorry, those are trades individually. Angel, did you have a view? You put out a view, right?
That's right, I did.
Okay, and of course I heard you on BSE. Yeah, Angel, by the way, is at an important juncture. 2350 or so was the low which was made in March of 2024. Then you had, then that was largely held with minor breaches on the downside, and you were back at those level once again. It's a downward sloping slight trend line, but you're there. So we'll see where this one goes as things progress from here on. On things like Motilal, etc., are we seeing? Okay, Motilal is absolutely flattish to slightly lower. I mean, I guess, Moti is, of course, doing very well on the mutual fund side, etc. as well. It's got a much more diversified business, private equity, not just a pure broker like some of the others that we mentioned. Mitesh, thank you very much for joining us. Good speaking with you, and we'll come back to you for more. This is the exclusive that I think many of these stocks are reacting to. Sources tell CNBC TV 18, SEBI is set to float a consultation paper to considering ending weekly expiry contracts. All consultation, all under consideration, nothing decided. I just want to make that clear up front. Yash is with us with what he's picking up. Yash, over to you.
Well, it was actually on August 21st that market regulator SEBI chairperson Tuhin Kanta Pandey had expressed the intention of having longer-term derivatives. Now, taking that intention forward, according to our sources, SEBI is expected to release a consultation paper on removing weekly expiries, and this consultation paper could be released as soon as within the next 1 month itself. What we've also been given to understand from our sources is that the ultimate intention for market regulator SEBI is to move towards monthly expiries from the current weekly expiries, but with a defined glide path to move towards that intention of monthly expiries. Also, at this point of time, one thought which SEBI has on its desk is to have a single day expiry for all exchanges exchanges, be it NSE, BSE or any other small exchange, whether it is a fortnightly expiry or ultimately monthly expiry. What we've been given to understand from our sources is that exchanges, NSE and BSE, could be roped in to seek their comments on removal of weekly expiry, and that could happen as early as next week itself. Apart from that, market regulator SEBI is looking at various ways in which retail participation in the derivatives market could be restricted. This could be done through putting some kind of threshold onto it. Also, ways are being looked at in which cash market volumes can be enhanced, but sources maintain all these moves which SEBI is currently contemplating will only be undertaken through a proper and a deep consultation process.
Yeah, no, absolutely. Yash, thanks very much for that. Let's get in Rajesh Baheti now into the conversation. He's Managing Director, Cross Seas Capital Services. Rajesh, welcome back. It's an issue which we've discussed on and off, I think, since last year. I trust you heard Yash in his story. Once again, it'll be consultation, it'll be in a paper, and then there'll be back and forth, and it'll take a few months as we understand it. But the paper itself within the next 1 month is what Yash is saying. Your first thoughts, Rajesh?
So I just want to, take a little bit more time to analyze this. Now, if the weeklies per se were undesirable, then they wouldn't have been allowed in the first place. So what we are seeing here is that something has now become a victim of its own success. Having said that, I think there are many ways to milk a cow. What I feel, and what a lot of other brokerages feel, that the retail participation at the bottom of the pyramid, the problem that the government seems to face is that those guys lose money. And one of the solutions, I've personally gone to SEBI and advised them and told them that it is our postulation that the losses that the retail is facing is mostly on account of buying options rather than selling options, because selling options requires a whole deal of money in terms of margins that you need to keep. But you can buy options with as much as even 1,000 rupees or 2,000 rupees, depending upon the option price and the contract size. So we have suggested to them that if you kind of reduce this arbitrage by putting a capital adequacy norm, that you must have an X balance with the broker, with the exchange, before you're able to be allowed to trade options. It might remove that bottom of the rung population from participating in the options market. So in my opinion, that would be a better approach rather than restrict products, because each product has its own benefits and costs, and there are many events that are closer in terms of decision making, where the weeklies play a very important role in hedging your contracts rather than paying the higher premiums on the monthlies. And these products were allowed to be introduced. Obviously, they've just become a victim of their own success. They were not per se undesirable.
Rajesh, sorry, your in one line, your suggestion is what to the government that you've already made, right? To SEBI, I'm assuming.
I have personally gone to SEBI and made the suggestion that you create a capital adequacy, minimum capital adequacy of say 100,000 rupees. That even if you want to buy an option worth of say 5,000 rupees, you must have a clear minimum margin balance of 100,000 kept with the exchanges or with your broker, which is upstream to the exchange, before you're allowed to trade an F&O. So it kind of makes buying options more expensive compared to selling options, and it will restrain people who don't have that capital adequacy from being able to buy options for as cheap as 5,000 rupees or 10,000 rupees.
Rajesh, okay, that's a very interesting suggestion. You raise the bar. You bring in a threshold, which makes it slightly more difficult for average retail investors to play in the options field.
Absolutely, at the lowest rung of the pyramid, and that's where I think the government is seeing the problem.
Yeah.
I don't think
By the way, Rajesh.
I lose money.
Yeah, Rajesh, Yash's story talks about this and that, which is the weekly options bit, which is under consideration, but also
uniform monthly
some kind of measures to disincentivize and make it harder
for retail to come into F&O.
Rajesh is saying, he's got both, which is
okay.
But again, once again, this is all under consideration, all consultation.
Absolutely,
nothing is final. Just want to say it again and again.
Absolutely, that's an important caveat. So, Rajesh, that's one part of it. You've made a suggestion that could make it that much more difficult for regular retail to participate in F&O. But the other, part of it was whether the sheer volumes that were playing out, whether that itself would eventually lead to some sort of, system instability, if at all. Just the sheer volume that was playing out on expiry day. And whether there was that angle to it as well, because what Yash is also picking up, that perhaps even the monthly product, there is some consideration right now that just do one monthly expiry across exchanges. It's not like NSE can choose one particular day of the month and BSE or some other exchange can choose another day. So is there that element to it as well? Just ensuring safe and stable working of the market mechanisms with such large volumes?
I personally don't think that the weekly options has led to any instability in the market. I think the markets, in fact, India still trades at a premium to the EM basket. Premiums might have come down. We've not seen any big moves as such that has happened because of the weeklies. There was a problem with certain entities that might have been gaming the market. I think that's under investigation. So just because somebody has gamed the market, that you can do with any market, any expiry. So keeping that aside, I don't think it has caused any harm, apart from the fact that it's become a kind of a victim of its own success. I've repeated that before also. So per se, I don't think the product is harmful to the market. You have a certain problem with a certain strata of people that are coming in, which you want to avoid, and you want them to stop losing money that easily in the market. I think when you talk about this and that, it has already been tried. The multiple weekly expiries are now down to a single benchmark, one contract per exchange, once a week. We've gone to that, and I think it's time to a little bit change on this side on entry barriers. And then take the data again, and nothing needs to be done all at once. So you take the data. If you've achieved what you wanted to achieve, there's no need to tinker with the structure of the market.
Rajesh, we'll leave it there. Thank you very much. A good perspective on the entire matter. We'll wait for the consultation paper now in terms of what is likely to happen. Thanks very much. I think we're going to take a quick commercial break now, right? We're about 40, 45 points higher. 25,015 is where we are at. And, things are settling slightly higher, but there's no huge excitement one way or the other. Individual stocks, another thing altogether. We take a break. We are back with Dinshaw Irani. He's our Alpha Manager of the day. Coming back with him.
Welcome back. The mid-cap index is flat, but individual stocks, Sigachi 18% up, Jain Irrigation 10%, Green Panel 17.5%, very large volumes. Morpen Laboratories has gotten back into the green. Indico Remedies 13%, SMS Pharmaceutical up 15%. These are stocks where you are seeing some movement live in the last few minutes. But the other one in the pharma pack, which deserves attention, is Aurobindo Pharma. It looks like the Zentiva acquisition is off the cards for the company. Vinny joins in with the details and why the street likes this.
Hi, Rima. Yes, so seems like, that's something the street is cheering as of now. So what we heard from Bloomberg, this is according to Bloomberg reports, that GTCR is nearing a deal to buy Zentiva. GTCR was one of those players who had, who was also in the bidding for Zentiva, GTCR, TPG, as well as Aurobindo. And previously we knew that Aurobindo was likely, amongst the highest bidders coming in for Zentiva, but seems like those stocks didn't work out, and now according to this report, GTCR has emerged as the likely buyer for this. Now, when we had heard that, Aurobindo was actually looking to buy that and the stock has seen a fall coming in. Why? Because investors were concerned about how this would impact their balance sheet. It was a big acquisition. So in terms of the concern, in terms of debt would come in as well. So that was a big fear for the street. And when we spoke to the management, they said that yes, they were in talks with Zentiva, and they were still in early talks the last time we spoke to that. But seems like that didn't work out, and the management said that they would always, watch out for investors' concerns and would not overpay for any acquisition. So seems like the deal is off, and that is why the street is cheering it.
Absolutely. Winnie, thank you very much for that. Hormuz is now here with spotlight on the top movers in the market. Hormuz, take it away.
Yeah, a couple of those names found their way to Rima's list as well just a few minutes earlier. We'll start off with Swelect Energy Systems, and this is also the biggest single-day gain that the stock has seen since September of 2024, as well as the highest volumes since that period that it has seen in a single trading session. Of course, it's gaining after a two-day fall, and today's volumes of 11 lakh shares is well above the 20-day average for the stock, which stands at just 85,000 shares for a Swelect Energy Systems, a 20% upper circuit for the stock. But despite this, the stock is still down 15% on a year-to-date basis, and this comes after a 91% surge that the stock had seen in 2024. Green Panel on the list as well today, the fourth straight day of gains for the stock. This is the biggest single-day gain that the stock has seen since November of 2019, and on volumes that are the highest in a single trading session on record. And we have had almost 1.5 crore shares that have changed hands today, and the 20-day average is only 65,000 shares. In comparison to that, we've had 1.5 crore. As a result of this move, the stock has also moved above its 50 and 200-day moving average. Again, despite this move, the stock is down almost 20% so far this year, and it was down last year as well with a 12% decline. I'm trying to point out GMDC, not because it is a big mover today, but the fact that it cooled off substantially from the highs of the day. At one point, the stock was down almost 13% from the day's high when it fell almost 6%, then saw a bit of a recovery from the intraday highs. And because of this move today, the stock has given up all the gains that it saw as of last Friday and on Monday. Last Friday, the stock was up 11%, Monday was up another 5.5%, and today's volumes are the second highest on record for the stock. We had almost 4.5 crore shares of GMDC change hands today. 20-day average is just 55 lakh shares, and today's turnover so far, which is 2,200 crore rupees, is 15% of the company's overall market cap. And Tega Industries, a stock that has been in the news for the wrong reasons in the recent past, that stock is up 20% as well. It's the biggest single-day gain since January of last year, and this is the highest volumes that the stock has seen on record. Take a look at the volumes here. 7 crore shares have changed hands on Sigachi compared to a 20-day average of just 26 lakh shares, and it is trading above its 50-day moving average of 36, and the next important level on the upside comes up to around 42.5, and the stock from its IPO price has more than doubled. The issue was also subscribed well over 100 times, so plenty of double-digit gainers today in the broader markets, was a lot of them seeing record volumes in today's session.
Thank you very much for that. The other big story today is Tega Industries. Now, the company announced a big acquisition of Molycop, which they will acquire as a part of a joint venture with Apollo Funds. But the stock today is lower because the market cap of Tega Industries is equal to the market cap of the acquired company. So is it too big for the company? That's the question investors are asking. But the management sounded very optimistic. Listen in to what he had to tell CNBC TV 18 in an exclusive conversation earlier today.
Debt at the target level is roughly about $1 billion. And the attempt is to bring the leverage down after the transaction closes. Sure, I think through the consortium arrangement that we have with Apollo, the intent is to structure the debt in a fashion that we leverage it down to around 800 million odd levels from the current billion, and that should help us deliver some improved benefits in terms of interest cost reduction with the leverage coming off, and hopefully even an improvement in the credit rating. We should be able to, the attempt is still early days, but the attempt is to at least shave off anywhere between 25 to 40 basis points of their current terms with their current lenders. I think where Molycop today operates at is roughly around 11% EBITDA levels. Our aim would be to try and improve that over the next 2 to 3 years to, on an average, anywhere between 13 to 14% levels. Tega, as you know, operates at a CAGR of 15%, delivers about close to 22% EBITDA. So the margin profiles are different, but we hope that on a consol basis over a 3 to 4 year period, we would be roughly at about 18% on a consol basis. In our model, we've taken like a revenue growth at a very conservative level for the target. We've maintained it at about 3.5 to 4%. They're currently doing about that much. So without putting in too much of high growth pressure on the target upfront, we've kind of modeled it on a conservative basis to be around 3.5 to 4%. With Tega consistently delivering at about 15%, we're looking at leverage to come off by year 4 to about closer to 2 times of EBITDA, 2x, 2.5x EBITDA over 5 years. And we should be at an EBITDA level of close to about anywhere between 17 to 18% from third year onwards on a combined basis.
Dinshaw Irani is now joining our CEO, Helios Mutual Fund. Dinshaw, great to have you with us here. Thanks very much. My question is about Tega. I trust you heard the conversation. You've seen the deal, the big acquisition, etc. You've been in the market a long time, and Indian companies are now starting to do these leveraged buyouts. Still rare, but this one is one of them, in a large size. I mean, any thoughts, Dinshaw? It's not a Tega specific question or what industry they're in, etc., but the way it's structured. Yeah.
Yeah, but thank you for having me on board, Prashant, and very good afternoon to you and your viewers. Yeah, that's one thing that I think we've not seen in a while, these LBOs kind of deals, which I think is a very big positive because that makes the market very vibrant and opens it up. In fact, today only we had a meeting with the Israeli regulators that come across, and they were trying to wonder why nobody's investing in Israel and stuff like that. But anyway, the fact is that India is becoming a very attractive destination even for raising capital as such. So I think that's something that has to be looked forward to. In fact, as I told them, that look, $4-5 billion of flows every month happening in mutual funds is not a small deal at all, which was unheard of earlier. So obviously we are becoming very attractive in that way as such. So, but I'll leave it here. I won't even comment on Tega, by the way.
Hi, Dinshaw. Good to see you in. What about y'all got everyone's fancy when y'all focus on the EV space and the EV theme out there? A couple of them, I think, proper disclosures have already been made. Ola Electric, that's got a long way to go from here as well.
Actually, Nigel, not only Ola, we also picked up Ather at the time of the IPO itself. We were anchors there. And I remember you guys asking us questions on that, or rather me specifically, on why we picked up Ather. So I think we are very convinced on that space. That is, going forward, that is the space that you want to look for, at least in the two-wheeler. And we are very convinced that even Ola Earlier, we didn't pick it up. Actually, we picked it up sometime in August itself after the quarterly numbers came out. And our conviction went higher when the management came and reiterated that they will be improving their margins going forward, and how the contribution is going to improve, and how the new product is going to be a very the generation 3, that is going to be a far better version of Gen 2 and Gen 1, obviously. So it was obvious. And by the way, after we picked up, the stock remained there for a while. But I think after the 15th of August, when they came up with the Gen 3 demo in Delhi, and obviously the new battery launch, I think that's when the stock really reacted upwards. And we were convinced that this is going to be the way forward. And obviously, there's much more to go in this than what we've seen before.
So that is on EVs. Dinshaw, hi. Good to have you in. So consumer. We've discussed financials. We know you love financials. But this whole market seems to be, taking a big punt on consumer. Now, I don't know if that's what it is. If it's a passing fad punt, or if it is something that can make you lasting money. I mean, if it's worth pivoting a little bit in the portfolio towards other names, I mean, other auto companies, it could be other platform companies. You tell us, or how are you thinking about it?
So, Survi, actually, we're fairly convinced. I mean, as in the sense that with the changes in the GST, in fact, by the way, my analyst team today is in various parts of UP trying to gauge the festive demand itself. And whatever they've been calling in with, they're very convinced that it seems the retail is all geared the way they're stocking up. They're geared for a bumper festive season. And obviously coming on the back of these price cuts because of the GST cuts, I think that's going to be a really fun festive season for most of the retailers. So we were very convinced earlier only when the announcement happened on 15th of August, we realized that this is where you want to be. And that's why we didn't go and bulk up on what we were, rather buy new names. But we already were in these consumer discretionary, if you will, names, very different kind of names like tourism and stuff like that. And obviously healthcare, which we would classify as consumer discretionary because that's how it should be. I mean, hospitals I'm talking about should be classified as. So those are the kind of names that we are in. Obviously, the platform companies have done well, and they will continue to do well on the back of this, because once you have savings left, this is where you're going to spend it on also. And as I tell everybody that if a foreign investor comes to India, he will be the last guy who will go and buy a cement company or a steel company, because he's got to go back and tell his investors that I went to India and I bought these differentiated plays rather than the same run-of-the-mill which you can get in your own country. So I think that is where the real fun is going to happen. So.
Yeah, no, absolutely. Any thoughts on another name? Dinshaw, Piccadilly. It's in a space which you attract alcoholic beverages. There's a allotment which has happened to some high net worth individuals. I'm sure you've picked up on the news.
Prashant used the word track very carefully. I was wondering which adjective you'll use. A space you like, a space you consume. But he's gone with track. He's playing it safe. So Piccadilly.
Yeah, but no, we not. So basically, the fact is that there are only a handful of names in this particular segment. We hold one of them, but that's only in one of our funds, which is in the mid-cap fund, where the small cap play on alcoholic beverages is there. But otherwise, we're not that clued on to this sector, as Prashant put it. But yeah, as a consumer, I'm a fairly good consumer of that. So I'll leave it here.
It's like a confessional. Yeah, but it's a what, 6,500 crore market cap company. I mean, perhaps in the listed space, perhaps the smallest, right, in the branded space. And just looking at the price, it had gone up to almost $1,000. Not 1,000 actually. The high was about almost 985 was the high. And it's come off a little bit, but 720 now after this 14% kind of a move that we have. Anything else on your radar? What's the new Ola or Ather?
If there was, you'll see it in my end of the month portfolio, Prashant. I won't be telling you anything upfront.
But you're anchor investors in Urban Company, right? You all participated.
Yes.
So tell us the rationale behind this investment.
So it's the same, Rima. I mean, if you see the kind of platform that he's offering, actually it's a platform company, right? I mean, you get varied services across. You don't need to spend capital on introducing new business lines. You just need to have that service in place and people will buy. In fact, nowadays they've started the Insta-made services and all, which is phenomenal because my wife also uses it regularly. Actually, the 15 minutes the maid comes to your house for a couple of hours and stuff like that. That's phenomenal service. So there are lots of options available here, and I think it's got a long way to go as such in terms of the potential market that it has at its discretion. And in fact, globally also, if you see these kind of service platforms are fairly handful of them. So it's a very unique platform which India has to offer, and probably a monopoly in its space right now as of now. I mean, quite a big, huge player in the place right now. So.
And Dinshaw, this also is, telling us how the whole platform ecosystem is coming of age in the listed market, the public market universe, right? Because from Eternal, now you have Swiggy, and then you have PB Fintech, and there's obviously Paytm, and now there is Urban Company. So it's becoming a class in its own self. Maybe we'll have a fund on this also very soon. But within these new age consumer tech platform companies, which are the ones where sort of you have maximum ownership or maximum conviction? Because they come from different sectors.
Right. So basically, Surbhi, the fact that we look at platform companies very differently. I mean, what we try to see is whether that company offers convenience. Is that convenience cashable? I mean, can you cash that convenience? And is it a mass convenience? If all three segments are yes, I mean, answers are yes to this three questions. The fourth one, which is the most important, is it easily replicable? If it is a yes, then obviously that company is not what you're looking for. So it's obvious that we pick up these players, and that's why you'll see only niche plays in our portfolio as such. We got most of the platform companies, some we don't own. We got a PB Fintech, we have a Paytm, we got Urban now, we got an Indigene, which is a pharma-based platform play. We got Cartrade, which again is a very differentiated model in the space of monopoly, actually now literally in that space, though it's been suffering for a while, but for a couple of days. But I think that's one of the downturns that you see in life. So we've seen all these, and that's why we're very particular in what we pick. Obviously, I'll leave it here, and that's why we like that's how we analyze our platform companies.
Okay, all right, got it. Interesting. Thanks very much, and thanks for the candor. Really, really helpful. I must compliment, it's very helpful when, mutual fund managers can go out and at least talk about why they like what they like and where the conviction is coming in from, rather than, more general conversation. So this is very, very helpful. Thank you so much. Thank you for joining in. Well, on that note, we do have to take a very quick break. Come back on the other side and we'll get you a check on all the dealing room chatter coming up. And of course, final trading ideas with Mitesh as well.
Welcome back. Well, markets are unable to get really past the 25,050 odd hump. So we've come off a little bit from the top and the mid-cap index has moved into the red. But Nimesh is with us to tell us what is he picking up. Nimesh, what are you picking up in terms of flows and the markets?
Well, Nigel, it looks like it's a day of consolidation, extremely range-bound day of trade. Again, as you rightly pointed out, a big resistance on that 25,000 odd level. So that's playing out for the last many days. But from a flow perspective, it's very, very muted is what I understand. But the number may look large because of the very large blocks. As we speak, there was a very large block on GMR airports as well. Nearly 6 crore shares have got changed, and I'll talk about that later. But that's the reason why you might see a big number from an institutional point of view. For the second day running, there seems to be some buying interest back in the PSU name. So the PSU index has gained another 1% today. And that was part of my feedback yesterday as well, that if there is some bit of buying, that's in the PSU basket. And that's showing up in today's market as well. On the other side, because of the story that we put out, capital market stocks are under pressure today. BSE is down 5%, so is Angel. And generally, there is a fear now that once that weekly expiry goes out, you might see a bit of hit on the earnings as well. So that's playing out as far as the financial stocks are concerned. Broadly, as I said, diff consolidation, not much to speak about. But just to reiterate, the institutional data may again look big because of some large blocks.
All right, got that, Ramesh. What about individual stocks? What do you pick up?
So I'll start with the blocks then. The first is Adani Power. There was a large block in the morning trade, nearly 1% equity got changed hands. And that stocks did see a bit of a recovery as well. I understand when one of the leading long-only FI was a seller and a single buyer, a domestic mutual fund was a buyer in the Adani Power block deal. So that's the first name. Similarly, there was a large block in Ambuja Cements as well. When the stock has recovered from the lows, there was a large block in Ambuja Cements as well. In Ambuja Cement, I understand, the FI could be the potential seller there. But unlike in Adani Power, where there was a single buyer here, a clutch of family offices, some domestic mutual funds, and some HNIs were buyers in the Ambuja block. So that's a color as far as Ambuja block deal is concerned. A couple of names where is delivery-based buying happening in the last couple of days. Britannia stands out, as well as Mastech stands out in terms of delivery buying from larger institutions. For Britannia particularly, I understand one of the leading domestic mutual fund has been aggressively buying as a part of the consumption theme. So that's playing out in Britannia. And as I said, there was a very large block in GMR airports as well. 6 crore shares have got changed hands. So if they can show the stock price movement, again looks like one of the very leading long-only FI could be the potential seller there. Still don't have the details on the buyers, but just to mark that there was a very large block in GMR Powers in the last 10 minutes of trade.
Interesting names there. And by the way, Nimesh, I don't know if I'm reading too much, but on the seller, on the selling side, should we draw a straight line between GMR and Adani in terms of common seller? Possible? Because there are common shareholders.
Possible. So that's what I'm saying. It looks like the same long-only fund has sold into GMR airports as well, but it's just got done in the last 10 minutes. I haven't got a chance to really confirm from multiple sources whether that was indeed the seller or not. But that entity owns a very large stake in GMR airports as well. So maybe that's you can draw a parallel. But again, if there is a disclosure, it will come that that particular entity was a seller. But I know for sure as far as buyers in Adani Power and Ambuja is concerned, as I said, for Adani Power, a single buyer, a leading domestic mutual fund, and for Ambuja, it's a mix of HNIs, family offices, as well as domestic mutual funds who bought today.
Real-time feedback, Nimesh. I got sent a name which I don't want to mention, so people are listening, hearing you carefully. But in terms of the counterparty, the buyer, that is, the single buyer.
As far as Adani Power is concerned,
we'll get to know the details.
I'll try to get a color on GMR airports as well.
Yeah, we'll get to know the details. I mean, I think it should come up later in the evening. All right, well, let's talk about BDSC trades. Mitesh is with us with exactly that, what to buy or sell today for a reverse trade tomorrow. Mitesh, what do you have?
I think Mazgaon dropped. Sudarshan had also mentioned the stock earlier in the day. It's picking up strength as we end the session. So BTST here with the stop at 27.78 for targets of 28.15 or thereabouts. And NHPC is the other one. Today, I think the candlestick is a breakout kind of a candlestick. So we'll take a BTST here. Keep a stop below 81.70 for targets of around 83 to about 83.5.
Got that. Let's talk about GAIL. That's also higher in trade. I think it's buzzing. This is, after there is a likelihood of a tariff revision higher. Sudarshan joins in to tell us more.
So that tariff hike is pipeline tariff hike for the GAIL is imminent, and as per sources, we understand that the decision by PNGRB might happen very soon, and it's been on the fast track. So we have been reporting for the last few months that tariff hike can come, and the increase can be of up to 20%, and from the current tariff of around rupees 58 per MMBTU, it can be increased to rupees 70 per MMBTU. So might be on the basis of that news, the stock has been buzzing. Now recently, like a few brokerages also have written on this. So first one was Investec. It's saying that it's hoping for a 20% increase, but in its estimates, it has factored in 10% increase. Jefferies believe that if there is a 10% increase, it will boost transmission EBITDA of FY27 by 13%. And if there is an increase of 20%, then transmission EBITDA can increase by 26%. And fair value for 10% increase is rupees 235. And fair value, if it is increased by 20%, then it increases to rupees 250 per share. And today, Nomura has come out with a note. It's saying that tariff hike might give a one-time boost. And as per our reports, we also understand that tariff hike can come and can be of rupees 70. Even Nomura is saying that it can be of rupees 70 per MMBTU and might be effective from April of 2026. And this integrated tariff hike of 20% can boost transmission EBITDA by almost as much as 42%. That is, Nomura believes that.
Okay, thanks very much, so for that. That's a fair bit of data coming through on names like GAIL. What's the latest trends from the F&O space? Let's go across to Nigel, who is tracking that data closely. Nigel, over to you.
Well, both the opening batsmen, that is the Nifty Bank as well as the IT index, they are facing some kind of resistance at higher levels. So the tech index, it saw some kind of resistance at around the 50 as well as the 100 DMA. That chart will come up, and from there it's pulled back a little bit. And on the Nifty Bank as well, it's hovering around the 20 DMA. This is a very, very crucial mark. You'll want the Nifty Bank to go ahead and conquer this 20 DMA. If it can do that, that will be the fresh breakout signal actually. For the time being, it's hovering around those levels. On the options data, just take a look at it. The 25,000 put, that's clearly seeing writing. The premium has crashed out there, and you always want the nearest possible strike to see a good amount of open interest build up. From a bullish perspective, that's happened. But just take a look at the 25,000 call. The premium hasn't moved up out there. The premium is roughly around 115 rupees, 120 rupees odd. So you've got the direction right, but yet, in fact, the premium hasn't moved up. That's telling you there is some writing at that particular level. So at around the 25,100 odd mark, there is going to be a crucial resistance that's going to be coming in at that level, going by those call writers at around 25,000 call. Moving the stocks that we're looking at, Abuja Cements. The street is sniffing that large trade all through the morning. That's happened at around midday. It'll be interesting to see what happens, post-market in terms of the names that come out and how will the street react to that. So that's seeing fresh shots into the system. However, there is some long addition we're seeing on NBCC because the big open interest build up out there. The stock as well has moved up. And you have a bit of a short covering bounce that's happening on NHPC in today's trading session. So keep an eye on that name. Last time I checked, stock up close to 3%, open interest down more than 5%. And the possible stock that comes into the F&O band, an unlikely name, Oracle, that's the one that's seen a big open interest build up yesterday. Today from the day's high, it's come off close to 6 to around 8%. And the last I checked, the open interest as a percentage of MWPL, that had moved to more than 100%, which means that it effectively comes into the F&O band unless something drastic changes in the next 15 minutes. So that's the name to look forward to later this evening. Back to you.
Thank you. Mayuresh Joshi is now joining in to take us through the last leg on the show. Mayuresh, first, share your thoughts on Tega Industries and this big, bold acquisition that they've done.
Afternoon, Rima. No, I think the acquisition is huge, and again, I think compared to the market cap of Tega at the current juncture, I think it's a huge pill to swallow in terms of the market size or the market cap itself. However, I think the permutation combinations in terms of how the business dynamics and the synergies will work around over the next few quarters and the next few years is something to be seen. Obviously, I think the management has alluded to the fact that the business is with lower margins. And therefore, I think Tega's own operating margins between 2022 and the acquired business at 12.5 might mean that the management is probably a little bit more practical in terms of a 16 or a 17% margin, assuming that the 11% moves to 13% with some operational efficiencies kicking in. From a business perspective, I think it makes absolute sense because they are into the grinding media part of the business, while Tega's core business in terms of mill liners will mean a composite and a holistic solution to the end users. And therefore, I think from a business perspective, I think it should rather garner sufficient amount of volumes across geographies. And the valuation acquisition is also pretty decent. However, I think just the sheer size and the kind of debt that they will be picking up onto their books makes me believe that you should probably watch out for the next 2 quarters in terms of how operational synergies are building in onto the balance sheets, obviously with approvals coming through. And then do the revenue synergies also start kicking in. So I think a wait and watch for us as far as Tega is concerned.
Yeah, no, absolutely. I think what we're going to do is we'll take a quick break, right? We can do that. And we'll just come back. There's 12 minutes still to go for market closing. And we'll sort of throw some more stocks Mayuresh's way for perspective. Stay tuned.
At this point in time, it seems to have emerged as a 3-horse race.
Every one of us probably has grown up on a parlay or a Cadbury or a surf, right? And then you realize that you are one amongst them.
You're the parlay and Cadbury of this,
like, you know,
of this
just
generation.
Swiggy is a verb in many parlances.
What is the dream 5-10 years out for Swiggy and for Instamart?
100 million people coming to our platform and transacting 15 times.
Now, what would you consider as the big pain points?
There are a lot of flirters in our quick commerce business.
What are they flirting with you for?
They come for Rakhi, right? I think compared
and
to
then forget about you.
Not forget. They still come back, but they have not transferred all of their buying onto Instamart.
Welcome back. Well, the management of Chola Mandalam Finance, well, they spoke to us earlier today. They scaled back their guidance a little bit. They also gave us some color in terms of the way ahead. Let's listen in to what they had to tell us.
Sort of question overall, in our view, the AUM growth, we still will hold it at the 20 to 22% levels for the full year. We will be reaching this, and there should be benefit with the number of units being sold because of the reduction in GST. And while that would have a slightly lower impact on the value, so overall we don't want to change it either positively or negatively because of the GST reduction coming into play. GST implication would, also mean lower EMI burden to the customer, which would mean it will improve credit. Just wanted to add that part to it. It has always been a case that this Q2 will always be a slow quarter because of rains and also because it has got a fair share of the period coming under inauspicious months, etc. For the full year, the overall credit cost would be in the range of around 1.5 or even 1.6% as somewhere equivalent to last year levels. And if, God forbid, the monsoon gets extended into Q3 like it happened last year, then it can even be slightly higher.
Okay, all right. Well, let's get in Mayuresh Joshi's view. Hi, Mayuresh. Good to see you in this afternoon. What's your view on Chola?
Hey, afternoon, Nigel. No, again, I think the management was pretty clear post last quarter's numbers that the asset quality pressures, where asset quality had clearly deteriorated, gross stage 3, net stage 3 assets quarter on quarter for the last quarter had come to 3.15, 3.2, if I'm not mistaken, 1.8 on the net stage 3. While the PCR also deteriorated quarter on quarter, close to around 44%, which makes us believe that the kind of deterioration that you probably saw translating into asset quality issues, will that come back probably in a better fashion as we head into the second half? All of us know that second quarter might be a little bit soft. And because of that, I think the kind of guidance that the management has also given for credit costs to be at 1.5% compared to 1.4% in FY25, I think that is one monitorable as well. So again, I think the management's ability to deliver healthy AUM growth, asset quality pressures coming off, obviously diversification in their product mix, and expectations that if they're able to do this in terms of 18 to 20% AUM growth, which might mean that the profitable growth might be around 25%, leading to ROAs of 2.5, ROEs of 18%, where the adjusted price to book on an FY27 basis will then land at 3.5 times. Will all depend in terms of numbers delivery. So our own sense is that we'll wait out for Q2 numbers and then expect that Q3, Q4 with GST rationalization and expectation of vehicle demand, consumer demand coming back might lead to better credit growth and reduction in asset quality issues.
By the way, speaking of GST, check out lead Travenues Tech, Exigo, one of the stocks that has been steadily rising as a beneficiary, seen as a beneficiary, obviously, of the higher spends on travel. They, of course, run Exigo 6%, 7% today. In this week itself, it's up about 10%. And in this month, it's up almost 20%. So it's been a good going for the stock. Mayuresh, any interest? Exigo, the other one is RateGain. Anything else you like in this travel and tourism space?
So I think we continue liking hotels. Afternoon to you, Surbi. I think our own sense is that hotels as a group should continue doing well. And with the rationalization that has happened up till 7,500 odd rupees, I think that will give an impetus to the organized players compared to the unorganized players, where there was definitely an arbitrage because of the higher taxes that were getting played out. Obviously, I think the expectation in terms of end user demand expected to go significantly higher. And the strategy that a lot of these hotel players have probably adopted in terms of an asset light model, going for managed properties and being very, very selective in terms of their brownfield stroke greenfield expansion, means that leverage has not built up on their balance sheets quite significantly. And that is a boost in terms of both the margin performance as well as bottom line growth. Therefore, I think we continue liking stocks like an ITC Hotels, which we continue holding in our local and global portfolios. Even Lemon Tree as an example, which has a good mix of managed and owned properties, where expansion plans of almost 7,500 odd rooms over the next 2 to 3 years. In that mix itself, both in managed as well as owned, might mean to better EBITDA performance going forward. And that mix across their property offerings, right from entry, right to the premium side of their business, might mean that they have got a good product mix as far as their business verticals are concerned. So yeah, I think we've been very, very optimistic on the hotel space. ITC and Lemon Tree is something that we continue preferring.
Mayuresh, amongst the platform plays, which ones do you own?
Rima, honestly, none so far.
None.
But the hope here is that they might continue doing well, and I think that seems to be a base case scenario, whether it's Eternal or Swiggy. The expectation largely with festive season coming around, and the hope in terms of the delivery volumes picking up quite significantly, both in terms of the quick commerce part of the business as well as the food delivery business, might mean better numbers and better volume growth as far as Q3 is concerned. Again, I think the accelerated investments that both these companies are doing in terms of their dark store openings should largely conclude over the next couple of quarters, which mean that the accelerated capex should largely be behind as we head into the next financial year. Valuations is the only thing which is of a concern to us, and therefore I think these stocks might continue doing well. But from a portfolio positioning perspective, I think we have no holdings specifically in any platform.
Okay, all right, Mayuresh, thank you very much for joining in and giving us all the advice this afternoon. It's a quiet session, but it's a session that is more about individual stocks than the index per se. The index itself has put on about 30 points, not too much. Even the mid-cap index is quite flat today, so you really have to go beneath the surface to find your winners. Anyway, on the large cap screen, Adani Enterprises has had a good session. Almost 3% up on Adani Enterprises today. Shriram Finance up to 2.5%. Axis Bank, SBI, Bajaj Finance. These are some of the other names on the financial side that have had a positive session. A couple of PSUs today on the upside. NTPC, Power Grid, ONGC. All these names have managed about a 1 to 1.5% sort of a gain. There's also State Bank of India, 0.7% higher. IT is a mixed bag. TCS managed a 0.5% gain. On the other side, Infosys has cooled off. Infosys is down 1 to 1.5%, which also brings me to the losers list. Bajaj Auto, Eicher Motor, Hero Motor, so some of the auto names continue to cool down. Count Tata Motors in that list as well on the downside. And then names like Titan, Lever, Trent, some of the consumer names also seeing some profit taking. So that's the picture on the large caps, but a lot of mid-cap high flyers, Rima.
Indeed. So on the way down, let me start with BSE and Angel One. These two stocks took a knock on the back of the SEBI consultation paper on ending weekly expiries. It's a consultation paper that we picked up from sources that SEBI is thinking about it, but stocks took a bit of a nosedive. And the other set of losers include that in the mid-cap IT space. Profit booking visible in Hexaware, Birlasoft, Tata Elxsi, Infosys, Mastech. Stocks down anywhere between 1 to 2%. Other losers include Ola Electric, GMDC, Salasar Tech, Adani Power, and on the way up, Green Panel, Sigachi, JN Irrigation, double-digit up move on some of these names. SMS Pharmaceutical, Vari Energy, JSWAL, Nico also stand out for the kind of price and volume action. The bell's gone. The Nifty's managed to cling on to 25,000, Prashant.
I think we're going to wrap up on this edition. A closing bell from all of us here. Goodbye. Thank you for staying with us. Mayuresh and our next set of anchors will take you through markets forward in just a bit.
Dalal Street ends at a 3-week high to clock its longest winning streak in 5 months. Nifty holds about 25,000. Broader market gains in line with the blue chips.
Automakers see a bumper festive season ahead following the GST rate cut as it gives rise in inquiries. Maruti and Hyundai bet that small car sales will see a pickup, with Hyundai expecting a sharp increase in first-time buyers.
Tega Industries inks a term sheet to buy global grinding media player Molycorp at an enterprise value of $1.48 billion. With this, Tega expects to scale its revenue nearly 9 times and will add $1 billion in debt.
Hello and welcome to Markets Forward, your go-to show where we aim to get you all the key data points to gear up for the next trading session. I'm Vivek Iyer and with me today is my colleague Vinny Motiwala. Good afternoon, Vinny. Well, a topsy-turvy day, but 7 straight gains. 7 straight sessions of gains is what the Nifty has managed to clock in.
Absolutely. A good day. I think at least we closed about 25,000, right? Which everyone is keeping an eye out on, whether that's going to go. So today, Nifty managed to close 25,000 is what we kept out for and watched out for in the trading session. Apart from that, even the broader end of the market, let's look at that. That was at one point of time seeing a bit of an outperformance versus Nifty. But now at the end of the day, closed in line with what the Nifty was doing as well. Came off the day's highest point, at least in terms of the broader end of the market. On that note, let's pull up the advanced decline ratio as well, right? Because advanced decline ratio, where we've seen a larger gap and more stocks in favor of advances in the morning. Now, almost nearing each other, the advanced decline ratio, almost 1,300 stocks on the advanced side, 1,200 stocks on the decline side is what we saw coming in for the advanced decline ratio. So not much of a gap that we saw by the end of the day coming in terms of today's trading session. But Vivek, more stock-specific action also is something.
That's right. Quite a lot of action now. For one, have a look at the Nifty Metal Index. The entire metal pack today bounced back quite sharply. So look at Nalco, look at Hindalco. Some of these stocks managed to recover quite sharply from recent lows. Aurobindo Pharma, that was the other name that managed to do quite well. The entire power pack, all of the power stocks, including the capital goods names, so NLC India, NHPC, NTPC, all of these stocks were doing quite well in the session. But on the other hand, or on the flip side, you did see the Nifty IT taking a bit of a breather. OFSS gave a clarification saying that they're not materially impacted by what happens in the parent company in the US. So on the back of that, OFSS, Emphasis, all of these stocks saw a sharp correction from the day's highest point. And on the back of a CNBC TV 18 exclusive stating that there could be some curbing as far as options are concerned, you did see the capital market stocks take quite a bit of a breather. So Winnie, BSE, Angel, Nuvama, all of these stocks took quite a sharp knock in today's trading session.
Absolutely, and all that we'll be discussing through the show as well. So watch out for that. But let's start with the first segment then for today. And we have Hormaz joining us from the big wall with the top movers and shakers of the day. Hormaz, over to you.
Quite a day. It may be a quiet day, but it was quite a day indeed for the markets. And there were a lot of stock-specific movers, particularly among the broader end of the spectrum. And look at the stocks that had more than double-digit gains today. Take a look at Sigachi, 20%, Green Panel, 20%, SMS Pharma, gains of around 10%, Swelect Energy, 20%, Indoco Remedies as well at one point was up 16, 17, still ended with a 12% gain. So there were plenty and more that moved around in the broader markets and on very strong volumes as well. PSU names continue to do well for the second day running, and more it were across the spectrum, most of them on the energy front. Look at GSPL, look at GAIL, Indian Oil Corporation, all of them ending with gains of around 2 to 4% in today's trade. A lot of newsmakers as well today. Aurobindo, after potentially missing out on an acquisition, has ended 6% higher. The street likes that. Jupiter Wagons after the order win, of course. BSE and Angel One after the CNBC TV 18 news break, down 5% each. And Kalpataru Projects, of course, after the order win that they announced earlier in the day. Were stocks that had a 52-week high in today's session. Fedbank Financial was one of them. And Ixigo continues to make new highs in today's session, as does Nesco and Affle too, doing a good day today, 3.5% higher for a 52-week high. Of course, there were some underperformers as well. Good Luck India down for the second day running after the management cut its guidance on our show yesterday. Precision Camshafts moved very strongly in the first two trading sessions of the week and now has seen profit booking in the last two. Stovecraft, Voltime Transformers, a lower circuit today, and Avanti Feeds, the big rally of yesterday, fizzling out today, seeing some profit booking from higher levels. Back to you guys.
Well, thank you so much, Hormaz, for joining in and taking us through all of the stocks that made the moves, both on the frontline indices as well as the broad end of the markets. Well, it's a good time to go across to our guests on the show, both Mayuresh Joshi as well as Ruchit Jain. Welcome, gentlemen. Thank you so much for joining us today. Ruchit, let me come across to you first. Nifty has managed to go ahead and notch 7 straight sessions of gains. On that note, do you see further upside, or do you feel at current levels we could see a bit of consolidation?
Yeah, hi, very good afternoon. Yes, we have seen some decent pullback move from the recent lows. But if you look at the broader trend, I think since last 2 or 3 weeks, the markets have traded within that range, in which although it has formed a good support base around the 24,500, 24,400, but we are not able to surpass yet the 25,000, 25,100 range. And I think the major cause of worry that the market is watching is the USD INR, which is has depreciated recently. So I think we usually see an inverse correlation that whenever USD INR depreciates sharply, our broader markets tend to see some sort of relative underperformance. And that's the worry for the market. So we think that it's more of a time-wise corrective phase which is going on in the market. Once the market surpasses this hurdle of 25,000, 25,100 on the upside, then we would see a good momentum resuming in the broader markets as well as in the indices. But till then, I think we would see more of a consolidation phase or a time-wise correction could continue in the short term.
Okay, you're expecting a bit of a consolidation or a time-wise correction in the short term, and 25,100. Then above that, maybe you're telling us we could take some bit of a sigh of relief. But Mayuresh, 25,000, at least that's what we managed today. Other than that, PSU banks, that's been trending in the last couple of days. Any thoughts on PSU banking side? Do you think, we're going to again see that run-up coming in? Anything you like there?
Mayuresh, I believe you're on mute.
Sorry for that. Apologies. Afternoon, Vinny. I think the base case scenario that is getting built in is Q2 might be a sustainable quarter, which means that the kind of softness that we probably saw in Q1 might continue, but it might have some of the effects waning off, specifically when it comes to NIM compression, when it comes to CASA deterioration. And therefore, I think it can be a reset quarter for the banking stocks in general, including the PSU banking stocks that you have asked for. Having said that, I think a few of the PSU banking names had a very decent performance even in Q1. And the large part of expectations that are getting built in is that deposit growth should largely be steady for a few of these names because of the sticky base that they carry. Advances growth should come back very, very strongly with GST rationalization, consumer durable demand expected to come back, as well as private capex showing some green shoots. Provisioning for PSU banks has been exceptionally strong. And therefore, I think the kind of provisions that they're carrying on their balance sheet, any kind of recoveries and write backs over and above that will mean a direct write back to the bottom line, directly impacting ROEs and ROEs in a very positive fashion. So our own sense is that a few of the PSU banks were outliers. A few of the stocks outside SBI, something like a Bank of Maharashtra or a Bank of Baroda, have given decent set of numbers. And those numbers might continue improving as we head into the next few quarters.
Well, thanks for that, Mayuresh. But do stay on with us, gentlemen, given the fact that quite a few interesting stocks which we will be discussing going forward on the show. Well, one such stock is Tega Industries. That stock fell today after the company inked a term sheet to buy out global grinding media player Molycorp. The acquisition will be made at an enterprise value of $1.48 billion. Vamakshi, who tracks this particular space quite closely, is taking us through the quantum of the agreement and why Tega Industries was under pressure today.
Absolutely, Vivek. A mega acquisition announced by the company. So Tega Industries as well as Apollo Funds will be acquiring 100% of Molycorp. Now, this acquisition, like you said, is at an enterprise value of close to $1.5 billion US, which is around 13,000 crores translated to Indian rupees. But just to give you some perspective, Tega's market cap as of close yesterday was at 13,800 crores. So therefore, the acquisition is as big as Tega's own market cap. Now, how are they likely to fund this acquisition? Well, Tega will hold around 77% stake in the SPV, while while the remaining 23% will come in from Apollo funds. Now, Tega will be contributing somewhere around $361 million or 3,180 crores, out of which there will be a corporate debt of 995 crores, and the rest, that is 2,184 crores, will come in from the equity raise. Now, keep in mind that a board meeting is scheduled by Tega on 13th of September in order to consider fundraising plans. The remaining money will come in from Apollo funds, and they also have a contingent payment of around $120 million. Now, this acquisition is quite significant. Now, keep in mind that Molycorp revenue is almost 8 times as far as Tega's revenue is concerned. The combined entity will command a revenue of 15,207 crores, and a majority of which will come from Molycorp. The margins, though, for Molycorp are much lower at 11.5% as compared to Tega's 20.7%. Now, though this acquisition, both generally bode well for company given the kind of growth, but out here there are 3 main concerns. First one is that this is a huge acquisition, so how the integration of this acquisition will happen, that is something that we'll be watching out for. Again, there might be some operational challenges, so again, that the street is keenly watching out for that. But apart from that, there's huge debt on Molycorp's book, $101 billion to be precise. Now, the near-term target is to bring it down to 800 million, and of course, Molycorp has low growth as well as a lower margin profile. So those are some of the concerns, which is why the stock was down today.
I think where Molycorp today operates at is at roughly around 11% EBITDA levels. Our aim would be to try and improve that over the next 2 to 3 years to, on an average, anywhere between 13 to 14% levels. Tega, as operates at a CAGR of 15%, delivers about close to 22% EBITDA. So the margin profiles are different, but we hope that on a consol basis over a 3 to 4 year period, we would be roughly at about 18% on a consol basis.
Okay. That's a word coming in from the management as well, to keep an eye out on Tega Industries going forward after this big acquisition. Let's move on and also talk about Aurobindo Pharma. That was gaining in trade, and why? Because they didn't make an acquisition. What now Bloomberg is saying that GTCR is nearing a deal to buy Zentiva. Previously, Aurobindo Pharma was among the leading names in this acquisition talk as well. When we had spoken to Aurobindo Pharma on 21st of August, they said there were talks going on with Zentiva, but they were still in early stages. And as of now, for that inorganic acquisition, right now what they said now in that time, that they will be very mindful of investors' concerns. Investors were concerned that time that, maybe this could lead to maybe some debt or on their balance sheet. The balance sheet would become heavy, which would lead to a concern. And that is why when the first time that announcement came or news came in that maybe Aurobindo was looking at Zentiva, we saw the stock fall. Today, the stock is rising because CR seems like that is the likely winner for this bid for Zentiva. And this is according to Bloomberg. So today, the stock was holding on to 6% gains, almost around that mark in today's trading session. But Mayuresh, let's start with your thoughts coming in. One, for Tega Industries, how are you looking at it? Is that something that interests you? Also, Aurobindo Pharma in the pharma pack.
So, Vinny, I think for Tega, as Vamakshi appropriately explained, I think it's an acquisition far beyond their appetite at this point of time. Obviously, I think it's a very complementary kind of a business because one, I think the clients that might now come through might be more holistic in nature, grinding media, mill liners. I think it's a complete solution that Tega might be able to offer. And therefore, I think from a business perspective, going forward as the integration happens, it will be value accretive. However, I think from an immediate short-term perspective, the sheer size of acquisition is huge for Tega's appetite, and that increases the leverage component. And therefore, I think once the approvals go through, how do revenue and cost synergies play out is something that the street would like to watch out for. Because I think across geographies, having these synergies come through might take some element of time. Again, I think the key pertinent point outside this is the margin profile, and the margins will definitely come down on a consolidated basis once both these entities start reporting console numbers. However, I think with sheer volumes expected to grow up, and though I think the numbers for the acquired company is growing at 3 to 4%, I think it might be a significant value addition as far as revenues are concerned. So in our opinion, I think let's wait and watch in terms of how these synergies play out. not taking a very bold call on Tega Industries at this juncture. For Aurobindo in particular that you ask, I think the expectations in terms of how revenues will grow ex Revlimid is going to be extremely critical. Aurobindo believes that they can launch their own first biosimilar by the end of FY26. They still believe that the EBITDA band can be between 20 and 21%. And ex-US, I think the expectation in terms of revenue growth is something to be watched out for. So these are the pointers that will probably play out for Aurobindo Pharma as far as the core business is concerned. And therefore, I think it's very, very critical that Q2 numbers come out to be reasonably better for some element of re-rating onto these stocks. So we'll be closely watching out for Q2 numbers for Aurobindo.
Well, thanks for that, Mahindra. Tega Industries, following suit from Sudarshan Chemicals, buying out a much larger European company there as well. But now moving on to a CNBC TV 18 exclusive, we learned from sources that market regulator SEBI is set to float a consultation paper to consider ending weekly expiry contracts. Yash Jain is here with the details. Yash, take us through what exactly you are picking up.
Well, it was actually on August 21st that market regulator SEBI chairperson Tuhin Kanta Pandey had expressed the intention of having longer-term derivatives. Now, taking that intention forward, according to our sources, SEBI is expected to release a consultation paper on removing weekly expiries, and this consultation paper could be released as soon as within the next 1 month itself. What we've also been given to understand from our sources is that the ultimate intention for market regulator SEBI is to move towards monthly expiries from the current weekly expiries, but with a defined glide path to move towards that intention of monthly expiries. Also, at this point of time, one thought which SEBI has on its desk is to have a single day expiry for all exchanges, be it NSE, BSE or any other small exchange, whether it is a fortnightly expiry or ultimately monthly expiry. What we've been given to understand from our sources is that exchanges, NSE and BSE, could be roped in to seek their comments on removal of weekly expiry, and that could happen as early as next week itself. Apart from that, market regulator SEBI is looking at various ways in which retail participation in the derivatives market could be restricted. This could be done through putting some kind of threshold onto it. Also, ways are being looked at in which cash market volumes can be enhanced, but sources maintain all these moves which SEBI is currently contemplating will only be undertaken through a proper and a deep consultation process.
Well, thank you so much, Yash, for joining in and telling us through this exclusive story, a very important story, especially to track as far as options trading is concerned. Well, one particular sector that did well today, in fact, after a prolonged period of underperformance, was the power stocks. And within that, thermal power major NTPC gained over 1% today. The main reason for that was that today, our brokerage firm HSBC turned bullish on the stock. They went ahead and upgraded the stock rating to buy from an earlier hold stance, and they raised the target price to 400 rupees from their earlier 385 rupees. Number one, they say that the main reason for the prolonged underperformance was given the fact that FY26 so far power demand has been quite subdued, and along with that, the company has faltered, especially when it comes to capacity addition execution. Now, what is it that they are saying? Number one, the slowness is something that should now reverse. Along with that, they are saying the latest trigger in the company's repository will be forays into battery as well as the nuclear opportunity. They are saying power demand will benefit from a low FY25 base, much like it got penalized on a very high FY24 base. Along with that, they're saying thermal execution is now happening, and close to 1.3 gigawatt of commissioning has been done by the company recently. More importantly, they say that out of the total planned capex of 7 trillion rupees, 4 trillion rupees is actually under regulated tariff mechanism, indicating that there is stability as far as earnings forecasts are concerned. They believe NTPC also will be at the forefront of nuclear development. Ruchit, first thing what we want to understand is, do you see a bit of a bottom formation coming in as far as the power sector is concerned, especially NTPC? Today you did see names like BHEL also move higher.
So I think from a very short-term perspective, it seems that the stock could see some more consolidation, what we have observed over the last couple of months. But if I look at a bit of mid to longer-term charts, then I think good time-wise as well as price correction has been seen after the stock made a high of around 430 in September 2024. That is about a year ago. So if one is looking for to add it to a portfolio from a mid to long-term perspective, then the risk-reward ratio is certainly favorable to go long at current levels. So only for investors who can wait for at least 2 to 3 quarters, I think they should consider going long on NTPC at current levels.
Okay. Okay, that's the view coming in from you on NTPC over there. But Richard as well as Mayuresh, thank you so much for joining us on the show as always and helping us understand how the day has gone by as well as individual stocks. What are they expected to do going forward? On that note, we're going to actually sip into a very short break and we'll get you the top corporate voices along with the key market events to watch out for in tomorrow's trading session after the break. Welcome back to Markets Forward. Well, let's now go across to key corporate voices. First up is Chola Mandalam Investment. The management earlier today marginally trimmed guidance for asset under management to 20 to 23% from the earlier projected 20 to 25%, largely on the back of GST rate cuts. The AUM growth will predominantly be driven by the mortgage business. The GST cut will lead to marginal reduction in terms of loan value and will be positive on collections due to lower burden on EMI. They anticipate second quarter to be slow on the back of rains and other events, but expects festive season and good monsoon to augur well for a good second half. Further expects credit costs could be around 1.6%. Automakers are quite upbeat about GST rate cuts this festive season. Hyundai expects the GST cuts to attract first-time buyers and boost aspirational purchases. The car maker expects to see strong growth among cars priced below 10 lakh rupees. Hyundai believes this growth will help while EV sales as well as that's not all. Its Pune plant will come on stream in the third quarter and will reach close to 1 million capacity. Well, earlier today, we also had Maruti Suzuki management on the channel. They expect GST reforms to demand in the auto sector uptick and also other industries. Adds that the GST cuts, along with benefits from income tax and the recent repo rate cut, will provide a strong boost this festive season. Retail sales are projected to grow over 20% during the Navratri season compared to last year. They added that customer inquiries have already up since 15% since the GST cut announcement. Current bookings stand at 1.5 lakh units with 10,000 new bookings coming in daily. We also spoke to Rainbow Children's Medicare. The management has outlined its growth plans. The company expects to maintain the margins at its new hospital and confirms that operations at the Rajamundry facility will begin this week. The management also sees strong traction in Andhra region, having added a significant number of beds over the last 24 months. The management has though said that the growth for FY26 will be in the mid-teens to high-teens level. And finally, before we wrap, we bring you some key market events to watch out for. Vamakshi is standing by the wall with the key events to focus for tomorrow's trading session.
Well, absolutely, Vivek. Tomorrow's a Friday, so we'll be looking forward to the weekend. But, jokes apart, let's take a look at the economic cues that will be in focus. We'll be, of course, keeping an eye out on the CPI data that comes in from India. Apart from that, UK's GDP data will also be something we'll be monitoring. But, the capital market stocks were in focus today. It will continue to be in focus tomorrow because the SEBI board meeting is scheduled tomorrow. So we'll be keeping an eye out for any sort of outcomes that come from there. Other than that, PSU banks will also be on our radar. out because government will be convening a 2-day banking reform meet called Manthan with PSBs on September 12th as well as 13th, and may discuss mergers, and PSB consolidation is also likely on the table. So that is an important meeting that we'll be watching out for. And from the primary markets, take a look at urban companies, Shringar House of Mangal Sutra as well as Dev Accelerator, because if you want to subscribe to these IPOs, it's the last day tomorrow. And lastly, CP Radhakrishnan will be taking oath as the 15th Vice President of India.
Okay, Mamakshi, thank you so much for that. Important events to watch out for, but surely no joke in terms of it being a Friday as well. But with that, we'll wrap up this edition of Markets Forward. Thank you so much for tuning in. We'll come back and there will be more on Markets and News Plus.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end in the green for the 7th straight session, but the gains are limited. This is the longest winning streak in the last 5 months. Rupee hits a record low against the dollar as it moves closer to the 89 mark. Commerce Minister Piyush Goyal says the first tranche of the India-United States trade deal should be finalized by November, adds both sides are satisfied with the progress on talks. Top officials from the European Union set to arrive in India to wrap up negotiations for a free trade deal. Reuters reports the European Union is unlikely to impose 100% tariffs on India and China proposed by US President Trump to pressure Russia to end the Ukraine war. India's leading automakers brace for festive boost on the back of mega GST cuts. Maruti Suzuki highlights a 15% surge in customer inquiries since the announcement. M&M says they are taking steps to ensure that dealers have enough stock. Hyundai is upbeat about the GST cuts, bringing in many more first-time buyers.
सोशल मीडिया का जो कैंपेन था वो पेड कैंपेन था, वो अगेंस्ट इथेनॉल था और पॉलिटिकली टारगेट मुझे करने के लिए था।
Road Transport Minister Nitin Gadkari defends the decision to mix 20% ethanol with petrol, claims there was a paid political campaign against him, which has proven false after Supreme Court rejected petitions against E20 fuel. Tega Industries is set to acquire US-based mining equipment maker Molycorp for $1.5 billion. Tega will acquire 77% stake and Apollo Global will pitch in for a 23% stake. The deal is likely to help Tega's revenues grow ninefold, but also add $1 billion in debt. ChatGPT maker OpenAI signs a $300 billion deal to buy computing power from Oracle for 5 years in one of the largest cloud contracts ever signed, according to the Wall Street Journal. Oracle shares soar, making Larry Ellison the richest man in the world for a brief period. Nepal simmers days after an anti-corruption stir led by Gen Zs toppled the government. Prohibitory orders and curfews continue across the country. Close to 15,000 inmates reportedly flee from various prisons. Several names doing the rounds on who should head the interim government. United Nations Security Council set to hold an emergency meeting after Russian drones violate Poland's airspace. This is the first major incursion on a NATO country. Poland plans to impose a no-fly zone. Charlie Kirk, a conservative commentator and an ally of US President Trump, shot dead while speaking to students at a university. The manhunt for the killer continues. Trump calls it a dark moment for America. All right, let's start with the day's market action. Sensex and Nifty gained for the 7th straight day, hitting the highest level in 3 weeks. This is the longest winning streak in the last 5 months. But the gains were limited and the midcap index barely managed to end in the green. The Indian rupee plunged to a new record low against the dollar. Now, $1 US now costs more than 88 rupees. In fact, the rupee is moving closer to the 89 mark against the greenback. 10-year bonds remain largely steady and the yields softened marginally in trade today. And now to the latest in the India-US trade negotiations. Commerce Minister Piyush Goyal says the first tranche of the trade deal should be finalized by November this year. Addressing a press conference in Bihar, Goyal added that discussions have been going on since March and both the countries are satisfied with the progress made so far. Now, this comes a day after Prime Minister Narendra Modi and US President Donald Trump exchanged conciliatory messages amid the tariff standoff.
फरवरी 2025 में माननीय प्रधानमंत्री नरेंद्र मोदी जी और राष्ट्रपति ट्रंप जी ने मिलकर हमें निर्देश दिया था कि दोनों पक्ष के मंत्री फॉल 2025 यानी नवंबर 2025 तक एक अच्छा करार करें। उस करार का पहला अंश फर्स्ट ट्रैंच नवंबर 2025 तक फाइनल करें और लगभग मार्च से इस विषय पर बड़ी गंभीरता से बड़े अच्छे वातावरण में बातचीत चल रही है, प्रगति हो रही है और प्रगति से दोनों देश संतुष्ट हैं।
The European Union may refrain from imposing tariffs on India and China for buying Russian oil, despite US President Trump's request. As per a Reuters report, EU imposes tariffs only after conducting a detailed investigation to establish a legally sound justification. The EU bloc has only imposed tariffs on Russian fertilizer and farm products in the context of the Ukraine war. Now, Trump's request to EU came at a time where the bloc is nearing the finalization of a trade deal with India. Now, top EU officials are set to arrive in India this week. India's top automobile companies held their annual convention in Delhi today. Union Road Transport Minister Nitin Gadkari inaugurated the event. Now, automakers are hoping for a boost in demand after the recent GST cuts. Minister Gadkari said he has requested the Finance Minister to provide concessions for those scrapping their old vehicle and buying a new one. Gadkari also defended the decision to mix 20% ethanol with petrol. He claimed there was a paid political campaign against him, which has proven false after the Supreme Court rejected petitions against E20 fuel.
सुप्रीम कोर्ट में भी इसके बारे में बहुत साफ निर्णय हुआ है। अब जैसे आपकी इंडस्ट्री है वैसे हमारा पॉलिटिक्स भी है तो ये सोशल मीडिया का जो कैंपेन था वो पेड कैंपेन था, वो अगेंस्ट इथेनॉल था और पॉलिटिकली टारगेट मुझे करने के लिए था। तो मैं इतना ही कहूँगा कि वो जो कुछ था उसमें कोई तथ्य नहीं था, सब बातें क्लियर हुई है। परसों मैंने प्रधानमंत्री जी को भी रिक्वेस्ट की, फाइनेंस मिनिस्टर को भी कही है कि स्क्रैपिंग को बढ़ाने के लिए जो गाड़ी स्क्रैप करेंगे और नई गाड़ी लेंगे उसमें कुछ जीएसटी के बारे में हम सोच सकते, तो विचार करिए। ये भी बात हमने वित्त मंत्री के सामने रखी है। मैं आप लोगों को भी रिक्वेस्ट करूंगा कि जो नई गाड़ी खरीदी करेगा स्क्रैपिंग सर्टिफिकेट देकर, उसको अगर कुछ अच्छा डिस्काउंट अगर आपके पास आता है और ऑफर करेंगे रिजनेबली अच्छा, तो इससे बहुत विन विन सिचुएशन है।
India's leading automakers are bracing for a festive boost on the back of the mega GST cuts. Maruti Suzuki has recorded a 15% surge in customer inquiries since the announcement. M&M has said they are taking steps to ensure that dealers have enough stock. Meanwhile, Hyundai is upbeat about the GST cuts, bringing in many first-time buyers.
I think this is a very big reform which is happening from 22nd of September. It is not only kickstart the auto industry, but across all other industries also. Everybody is going to benefit, and the common man is going to be a big beneficiary. On the top of it, I think the two more things I would like to bring in the knowledge is, one, the benefit which was passed on through the income tax by the Honorable Finance Minister, and also I think the RBI Governor has done a very good job in terms of reducing the repo rates. So I think it's a combination now of the GST, then the benefit which is passed on through the income tax, and third is the repo rate. So I think it's going to be a bumper sales in this festival time.
I believe with the 10% cut in the smaller cars, it will bring in so many new customers. The first-time buyers, which Hyundai anyway is seeing a big jump. First-time buyers in 2020 used to be about 31%. Now they are at 39.5%. I believe we have a potential to go up to maybe 42-43% in first-time buyers. So more small car selling. The second thing I think which will be much more significant is, if you see the customer affordability remains the same in terms of how much he can spend. However, the car becomes cheaper, which means its initial signs, maybe the customers will now again go back to the higher trims, because last 1 year we are seeing that customers were moving down from higher trims to middle trims to lower trim. But now there's an opportunity, because India is a very, very aspirational country.
Until 22nd, we're going to be cautious on the front.
Right. So is this going to restrict the amount of inventory you'll be able to put into system?
No, so we have taken steps to ensure that we'll still be able to meet the festive demand. So there are a few steps we are taking on the front as well. So you'll see that as it plays out. It's like I said, it's not an easy puzzle to solve for, but that's what we are here.
A quick look at more headlines. Tega Industries has signed a term sheet to buy US-based mining equipment maker Molycorp. According to the exchange filing, the deal is valued at $1.5 billion and will be executed via a special purpose vehicle formed by Tega and Apollo funds. Tega Industries will become the controlling shareholder with 77% stake, and Apollo Global will hold 23% stake. The deal is scheduled to be completed by the end of 2025. Kotak Mahindra Bank ended in the red after a big block deal. Japan's Sumitomo Mitsui Bank has sold 1.62% stake in the firm at 1,940 rupees a share. The block deal was worth a little over 6,250 crore rupees. The deal drew participation from leading global and domestic institutional investors, including Abu Dhabi Investment Authority and BlackRock. Private equity player GTCR has agreed to acquire Czech generic drug makers Zentiva from Advent International in a $4.8 billion deal. Bloomberg reported that the transaction has been finalized and is expected to be announced in the coming days. The company manufactures a wide portfolio of generic and over-the-counter medicines. Shares of Aurobindo Pharma jumped over 5%. The Economic Times reported last month that the Indian drug maker was leading the race to buy Zentiva for $5.5 billion. Now, Amazon has rolled out Amazon Now, its 10-minute delivery service for everyday essentials in select areas of Mumbai. Now, this follows a successful launch earlier this year in Bengaluru and Delhi. Amazon India VP Samir Kumar said more than 100 micro-fulfillment centers have been set up across 3 cities to enable ultra-fast deliveries, and hundreds more may be added by the end of 2025. Now, Oracle's shares rallied a whopping 36% to post its best day since 1992, adding $244 billion to its market cap. The big move came after ChatGPT maker OpenAI said that it had signed a $300 billion deal to buy computing power from Oracle for 5 years. This is one of the largest cloud contracts ever signed, according to the Wall Street Journal. Rachna Dhanrajani is here with the details. Rachna.
Right, $300 billion, that is the historic figure reported by the Wall Street Journal for OpenAI's cloud deal with Oracle, making it one of the largest contracts ever in the tech industry. Starting in 2027, OpenAI will spend about $60 billion a year for 5 years to secure 4.5 gigawatts of new data center capacity under Project Stargate. To put it in perspective, that much energy is enough to power more than 4 million homes. So the $300 billion, the number seems to be a part of a much larger surge in Oracle's cloud backlog. CEO Safra Katz told analysts in the call that the company's remaining performance obligations, or the RPOs, have now risen to $455 billion. She explained that this growth comes from contracts with companies including OpenAI, xAI, Meta, Nvidia, AMD, and others. She also said that this surge allows Oracle to raise its cloud infrastructure targets, projecting revenue to grow from $18 billion this year to $144 billion over the next 4 years. Oracle stock has surged, and Larry Ellison's long bet on cloud now places the company alongside Amazon, Microsoft, and Google in the AI infrastructure race. For OpenAI, this deal is ambitious and carries risk. Current revenue of the company is between $12 to $13 billion, which is just a fraction of the annual commitment they've made to Oracle. And this is after relying heavily on Microsoft's Azure. OpenAI is now spreading workloads across both Azure and Oracle, and hence formalizing a multi-cloud strategy. This deal shows how AI is changing the rules. Compute power has become the new currency, but building a data center on this scale carries financial risk, environmental challenges, and the possibility of an AI infrastructure bubble. So is this a visionary deal or a risky overreach? For now, it is both. What is certain is that the race for AI dominance is no longer just about algorithms. It's about who controls the world's most powerful computing infrastructure. Back to you.
Right, and speaking of Larry Ellison, now Oracle shares surged following $300 billion with OpenAI. Oracle co-founder Larry Ellison briefly overtook Elon Musk as the world's richest man after this. Ellison's wealth soared $89 billion post the Oracle results. This lifted his total net worth to $383.2 billion, according to the Bloomberg Billionaires Index. However, Tesla CEO and SpaceX founder Elon Musk has regained the title of the world's richest man hours after the deal. Elon Musk's net worth stands at $384 billion now. Meanwhile, Nepal continues to simmer days after an anti-corruption stir led by Gen Zs toppled the government. Prohibitory orders and curfews continue as it finds itself in the midst of political uncertainty. Several names are doing the rounds on who should head the interim government. Close to 15,000 inmates have reportedly fled various prisons across the country. However, the Nepali army foiled several prison break attempts as well. There has been a rise in looting and arson as well. The residence of billionaire Upendra Mahato, one of Nepal's richest, was targeted as well. On your screens, you can see several ministers and their families and their family members being airlifted by choppers as they try to escape from protesters. All right, on that note, we'll take a short break. Coming up next, new GST rates announced by the GST Council will take effect on September 22nd. Timsy Jaipuria will speak with Sanjay Mangal, Chief Commissioner of Meerut CBIC, on the rationalization of rates and the implementation on the other side. Stay tuned.
Welcome back. The new GST rates announced by the GST Council will take effect on September 22nd. The GST regime has been simplified to a two-rate structure of 5% and 18% in a bid to boost consumption. However, a special rate of 40% will apply to luxury and sin goods. The Revenue Department has held meetings with the industry chambers to ensure a smooth transition and to answer certain queries on how businesses will have to adapt to this new change. I am now joined by Sanjay Mangal, Chief Commissioner at CBIC of the Meerut Zone. A very warm welcome, sir. Thank you for joining us on this show today. Let me begin by asking you, when it comes to relabeling of MRP, which is recommended by the government, in this practically industry feels that it is coming out to be having a lot of feasibility challenges, especially for widely distributed items. Since this is challenging, can an alternative such as offering discounts or increasing grammage be explored by the industry? What should they do?
Timsy, there are two parts of this question. First is the stocks which are lying with them as on 22nd September and which is containing the MRP of the pre-GST rate cut period. So after 22nd September, when they sell their products, when they make supplies, then it has to be at the new rate. But as it will be very difficult on the product which are already in stock and which are already in the distribution chain, Department of Metrology, Department of Legal Metrology under Ministry of Consumer Affairs, they write a letter dated 9th September. They have allowed the industry to relabel the packages, existing packages, relabeling through by putting stickers, by reprinting, or by any such measure, in addition to the existing MRP. So the new packages will contain the original MRP as well as the new MRP, so as to have more transparency to the customer. He will know that the price has been reduced, as well as allow the transitional flexibility to the manufacturers or packers or importers. Now, the packages which are manufactured after 22nd, there it is for the manufacturer or the business to decide how they are going to pass on benefit of reduced GST, whether it is by way of rate reduction or by way of increasing the package size or the grammage. It is for industry to decide based on their commercial considerations.
But not on the existing stock. They can't offer discounts worth a similar amount of the price cut that they want to, pass it on to the consumers, or can they increase the grammage in the existing packages? Is that possible, sir, under the GST rules and laws?
Timsy, for pre-packaged products, increasing the grammage on the existing stock, it's not possible. So it can be done only.
What about discounts?
About discounts.
What about discounts?
In case of pre-packaged products which are containing MRP, offering discounts, conveying that we are reducing the price by conveying by through discounts, it's a non-transparent method. The customer does not know about it. It will be only for the retailer or distributor to pass on these discounts, and therefore it is required that they have to refix the new MRP through a relabel or restamping or reprinting. So I don't think that giving discount on pre-packaged products is possible. Maybe it is possible on automobiles or bigger items where it can.
Okay. So considering the mass consumption items, their discounts should not be a possibility. But yes, for large ticket items, discounts can be a possibility, and CBIC can consider it as a valid way to pass on the rate cuts. Second question, sir, that industry is asking is there any possibility of refund for accumulated credit lying with dealers on stock purchased before the new reduced rates, provided they are sold at the reduced rates?
Now, as we know that a refund of accumulated credit on account of inverted duty structure is available, but that is available only on the goods where the rates of inputs are higher than rate of outward supplies. Now, in case of those items which are purchased before the rate reduction, so they are purchased at a higher rate, whereas they are supplied at a lower rate, the rates are different at different point of time, or it has been clarified through a circular as per approval of GST Council that in such cases it cannot be considered that the rate of inputs is higher than rate of outward supply, and therefore refund of inverted supply is not applicable in such case.
So the refunds will not be applicable in such case?
No, refund will not be available. Yeah, the accumulated credit will have to be utilized for supply in future, and it will be adjusted after some time because it is only for an interim period on the existing stock.
Okay. Another query, again related to the similar topic. The industry is wanting to know that can additional losses arising from credit accumulation or from central and state subsidies linked to GST reduction be adjusted while computing the price increase or the decrease depending upon the new rates?
Now, Timsy, the expectation of government and the council is that whatever is the benefit of rate reduction, it is passed on to the end consumers, so that the benefit is reached at the place where it is expected. Now, how this benefit is passed and what is the amount of such benefit, it has to be calculated by industry. Whether it is exactly the amount of rate which is reduced, or in some cases where, for example, input tax credit is required to be reversed because the item has been exempted, or where there is accumulation, the industry will identify the net incidence of the tax which is reduced on to them, and then they will be expected to pass on the said incidence to the buyers. So industry will have to calculate the net reduction or net incidence, net reduction of tax or net reduction of cost which they have incurred, and then they will be expected to pass on the same to the customers. They will have to keep they should keep some calculations to show it, how they are passing on the benefit to the taxpayer. So just like they were doing it when anti-profiteering authority was there. So they should be able to show that, and they should keep that record. So whenever they are required to show it, they should be able to show it.
Another question, what will be the treatment of accumulated balances of compensation cess credit? Because that has been bothering a lot of sectors, especially the auto sector. How should they deal with this? Similarly for aerated beverages, because compensation cess is ending over there too. So there will be some accumulated balances for them. And what should be the right treatment when it comes to computing their returns?
Yeah, as we had earlier discussed in an earlier GST helpline, this credit of compensation cess, this could be utilized only for payment of compensation cess. So now when the compensation cess is getting over, and it will not be leviable after a particular date, 22nd September in this case, there will be no avenue for utilizing this credit. So as of now, as of the present legal position, this credit will remain in their ledger, and they cannot utilize it either for the payment of CGST or SGST or IGST. And no such provisions are available in law by which it can be transitioned to them. So the industry will have to plan properly. They have still time so that they are able to either dispose of these items before 22nd. I have seen that some automobile manufacturers, they have extended discounts even before 22nd September so as to dispose of this stock, and so that they can utilize their compensation cess. So industry will have to decide their strategy how to utilize this compensation cess.
So very clear message from CBIC that industry will have to re-strategize their sales. Only then they can utilize this compensation cess amount that is in their ledger. Otherwise, as of now, today's legal position is same, that it cannot be utilized in any other head. So my last question, is there any possibility of claiming a refund of input services credit, which is accumulated due to inverted duty structure. That's what the industry is wanting to know, that what happens to services in terms of services being, their credit being accumulated due to the inverted duty structure. For example, toothpaste. I was talking to a company and they said in a toothpaste manufacturing and the cycle, the input service of advertisement is much higher as compared to the other inputs, and that is at 18%, whereas toothpaste will be at 5%. So what will happen in that case? Do these inputs credit account of these services?
As I had told you, as per the present provisions of refund of accumulated credit on account of inverted duty structure, presently this is available only in respect of cases where rate of inputs is higher than rate of outward supply. Now, this refund amount has to be calculated as per a formula which is given in Rule 89.5 and which takes into account mainly the input tax credit on inputs only, goods only, and not on input services. Now, this is a demand of industry for a long time that they should be allowed this refund of accumulated credit on account of input services also. And this issue was also raised before Honorable Supreme Court. But then Council has considered it, and presently it has decided not to allow this refund on account of input supplies. So present legal position and present position as per the clarification given by Council is that a refund of accumulated credit is only allowed in respect of inputs, that is goods, and not in respect of input services. So I understand that in case of manufacturers at least, their main inputs, their main ITC is in respect of inputs. And if the industry has got some amount as input services, they will be able to cross-utilize it in long run.
So very clearly, when it comes to input services, no credit will be allowed. That's the clear message coming in from CBIC, that already this was a pending demand, and a detailed discussion has happened at the GST Council where this demand was ruled out, that it is just not possible in terms of input services. Credits can be given only on inputs of goods. Many thanks, Sanjay Mangal, for joining us. And with that, it's a wrap on this special broadcast. More news and updates continue right here on CNBC TV 18 on the other side.
I'm sitting here in the heart of India's financial markets, the National Stock Exchange, a fortress of technology and trust, a place where billions of dollars of trading is executed across equities, derivatives, commodities in a microsecond. At its peak, NSE executed 2.2 crore trades in a single day and $23 billion in turnover in a single session. It is the world's largest derivative exchange for 6 years in a row, home to 12 crore unique investors. But beyond the tickers, the symbols, the charts, today we go behind the scenes. We look at surveillance rooms, IT infrastructure, cybersecurity, and of course, the National Operations Command Center. And we do all of this with NSE's current MD and CEO, who was also instrumental in setting up of the exchange,
Ashish Kumar Chauhan. Hi Ashish bhai.
Hi.
How are you?
Good to see you.
Good to see you. And I think we are meeting here in your cabin for the first time. Yes. We see you at the atrium, at the opening bell. We see you in our studios. But I think this is your den.
Thank you. Thank you for coming.
It's a lovely office, by the way. I want to start by asking you, Ashish bhai, what does a day look like for you at the NSE?
In a way, our days are 24/7 by 365 because markets run only for a sort of shorter period.
Right.
But we have to prepare and ensure that the markets continue to run, prepare them for the next day. Even the weekends we have to work. So in a way, the life is kind of continually rolling.
Right.
And then, of course, you have a time of the day where you go to sleep. But broadly, you are available on your screen, on your mobile, continuously.
Machines have not taken over yet completely, or have they?
No, broadly.
But they need supervision.
Yeah, they need supervision. And of course, there are changes that happen. So we need to plan for that. The regulations have to be...
So hour by hour, not hour by hour, but maybe 2 hour, 3 hour blocks. When do you get to office and how does it flow?
No, I come, if it's a listing, I come a little early, like 9.
Right.
Otherwise, I come...
Which is pretty much every day nowadays.
Yeah, nowadays. Otherwise, I have a little more flexibility. Sometimes I have to go out to sort of attend events. But broadly, I try to be in office at the exact time so that I'm aware of what's happening. And normally, I try to be available at 9:15, at least on phone, even if I'm traveling. 9:15 a.m. is like the starting time of the market, and you want to be there in case something goes wrong. If it goes right, so there is no issue, but you have to be available. So that's how the life works. And then once you come, lots and lots of meetings happen. You need to read a lot, and then you need to go out for meetings and committees and all. And then at some point in time, you will go out to attend some events in the evenings. Usually evenings, there are a lot of events. And then go home at whatever time you're allowed to.
I mean, activity has just exploded, right? Both on the cash front, derivatives front, etc.
If you recall, when Mr. Modi took over in 2014, because that's the time I still remember some numbers, India had 1.67 crore investors.
Wow.
Today, India has 11.8 crore investors, unique. Both. Because those are the NSE numbers, right? 11.8 crore investors, 25% women. That's 8.5 crore or 9 crore households. And that's almost 25% of India's households now. And that time, India's market capitalization, when he took over, was I think 67 lakh crore. Today is 450 lakh crore, So both have gone up 7 times.
Correct.
And that tells you how much of India has become middle class. Because you come to the markets to invest, and there is a perception that has been created that India, most Indians overtrade. That is not true, because 11.8 crore investors, once you have invested even in one share, you don't trade every day. You can trade once in 10 years and still you are an investor. But out of that, around 25 lakh, maximum 30 lakh people trade in derivatives. And so literally 2% people trade in derivatives. And out of them also, most of the people, almost 85-90% people
also trade in equities as well, cash as well.
Yeah, so it's like they're buying insurance, right? And so for me, lots and lots of misperceptions get created. But overall, the amount of wealth that this organization has generated when it started in 94, on November 3, 94 equities market, it was the total market cap of India was 3.7 lakh crore. Today, it's 450 lakh crore. It is, of course, the transaction processing, reaching out to people across India. Now, 11.8 crore investors are in 99.85% of all pin codes. India has more than 19,300 pin codes.
Correct.
Out of which only 28 pin codes don't have an NSE investor. I have investor in Ladakh, remotest corner, means 6,000 meters in the hills, to Andaman Nicobar, which is near Indonesia.
Right.
I have people in Arunachal Pradesh. I have people in Dwarka. I have people in Kanyakumari. Every nook and corner of India today.
Except 28
pin codes, and out of that, probably 25 are airports where you can't stay full time, so I can't do KYC, right? You can't say that that's your house.
Right.
So broadly, the middle class sization of India is what is basically creating a framework where India saves 30% in that range, 28-30%. Out of $4.2 trillion economy, now we are saving above $1.1, $1.2 trillion.
Correct.
Most of it earlier used to go into gold and
fixed
real
deposits
estates
and banks.
And today, some portion has started coming up in what I call risk asset.
Risk
right?
assets.
Equity is a risk capital.
Yeah.
And they have got some brilliant returns. I mean, Nifty is going to celebrate 30 years in terms of the base date. It started with 1,000 in 1995, November 3, 95 base date. Today, it's close to 25,000. If you take the dividends, it would be probably 30,000 in that range, right? So 1,000 rupees invested has given you 30,000 rupees, right? 13% plus
kind of compounded returns.
13.6, and even in dollar terms,
it's about 12. I think about 25 years, 12% odd. I mean, so which is
but if you take total returns, because you take only the absolute returns, but if you
in
take
dividends included, I think it'll be
that 13.5 or something, and in dollar returns also, it's competing with S&P 500. So effectively, India has done well, and it's not true that all countries where the country has done well, investors have done well. Like China, 30 years back, whatever their index was, today also is very similar.
Correct.
People, I mean, the industrialists have made money, not the investors.
Small
While
investors.
in India, because of the corporate governance framework, which SEBI and NSE have been together able to provide for. And that's why, for me, the capital formation, $5 trillion, one-third of India's wealth, is now wealth of trust at NSE. Right?
You know, you said that activity has grown, what you said, over the last, since NSE was founded, how many times?
I mean, in terms of the number of trades, the BSE in those days, the best days, they couldn't do more than 10,000 trades. Today, I get 2,000 crore orders in 6 hours, right?
So has the infrastructure to do all this also expanded at the same pace? Let's find out. Let's, I think, go to, what is it called? The National Operations Center, right? It's called the NOC.
Yes.
Let's go there and find out how it all works.
Absolutely.
Well, as promised, we are showing you a rare behind-the-scenes sort of, footage or visuals of the National Stock Exchange, the largest exchange of the country by far. And of course, we have help in the form of the MD and CEO of NSE, Ashish Kumar Chauhan. Ashish bhai, so this is the National Operations Center, right? Yes. NOC. It's got a military-sounding terminology to it because it requires precision, it requires discipline, and I think this is where it's all sort of controlled from.
Absolutely.
Tell us a little bit about what we are seeing, and I mean,
this is an entire floor, but floor is divided into different rooms. Each team has their own work.
Correct.
And there is a full backup, even in terms of the number of people, number of computers, number of screens in Chennai.
Right.
So anyone doing anything here as a checker in Chennai, anyone doing something in Chennai has a sort of checker.
But that is only for
it's for disaster recovery. But when disaster happens, when you try to recover, it doesn't work. You have to make them on. So whatever things happen
so
here,
it's fully operational.
It's fully operational, and actually we do mock trading from Chennai every month, at least once, and twice a year, at least for 2 days consecutively, we run the live operations from Chennai. So it's a fully functional thing, but how do you continue to make it run in a heightened sense is by involving them on your day-to-day activities as if they are next to the computers, and which is now allowed by the communication systems. So that's where the team here and team there are like working as one. And in case this place by chance goes down for whatever reason, that team should be able to
seamlessly pick up
and run without anyone.
So as an investor, as a trader, I should not feel the difference. I mean,
Yeah,
basically.
you probably will get logged out, and then you will your broker will log in, and
Right.
it'll be business as usual probably in few seconds.
Right. So what happens from here? I mean, what kind of activity?
This place is what we call business knock,
Right.
where all the companies that get listed or IPOs that happen or daily price bands of companies, the new derivatives contracts getting introduced in equities or currencies or commodities or in bonds, all that thing starts being set up. Even sometimes we have to set up a new broker or sometimes we have to actually stop a broker from functioning because of the SEBI regulations or orders, or sometimes even specific investors are not allowed to trade by some of the court orders or otherwise. So everything happens here. But during the market hours, especially between 9:15 and 3:30, this people who are working here have to do nothing actually. They have to just monitor, and it's like an autopilot. If they are doing something, then there's something has gone wrong, right? So that is where physical manual sort of override is required. Otherwise, their work happens 24/7 by 365 days.
Right.
During the day, they are not supposed to do anything, but end of the day, they have to create files, download to all brokers. Then they have to prepare for the next day all the new contracts coming in, the price bands, other things, 2%, 5%, ASM, GSM.
The much awaited bhav copy comes from here? Or?
Absolutely. So everything which has to do with business
Right.
comes. Similarly, there is another room for cyber security where we get a lot of.
And we're going to go there in a bit. So.
And then we also have hardware operation center, which is basically where we have several sort of machines which we need to ensure that there are no queues. And this was the first public digital infrastructure of India.
Yeah.
This is the first fintech of India. It's still the largest fintech of India. And it allowed India to create capital formation on a scale where no similar sized or similar per capita income having country. I mean, today, after so many years, our per capita income is only $3,000. Although we have become $4.2 trillion economy, but we are still per capita is still no country has with $6,000 also have that kind of market. $12,000 also no market. $24,000 there is one market larger than us called China. But when the prices go down, the government has to go and buy the shares. In India, government is actually hands off, right? So there is no similar market. And if you look at it in a poor country, per capita income country, people investing in other people's businesses is not amazing, unheard of. There are books written in economics which says that poor per capita income countries cannot, or societies cannot have well-functioning capital markets because they cannot save. And if they save, they don't trust their brothers also. In India, this has happened where 20% of India is now all households.
And we spoke about the long track record of returns, which has been spectacular, matched only by, I think, the US, right? As a market over a long period of time.
That's why I call this trust markets. Because trust has developed.
You know, I want to show our viewers the cyber sort of control center as well. So let's go there, and why don't you tell us about that?
Okay, we are in another room now, and this is, of course, also an important place. This is the Hardware National Operations Center, the Hardware NOC. And you can see the screens behind me. This is where they monitor, Ashish bhai, the hardware and
yeah, there are thousands of servers which NSE manages, and each server has different work and different softwares, and so all of them have to work well. And that's where basically each person has his own job, but there are what we call dashboards which are giving you aggregate numbers. So in case again they are not supposed to do anything real life except they do their normal office work. But if something goes wrong, that is the time they need to intervene. Otherwise, during the day, it's on autopilot, and there are softwares which are self-healing and things like that. So overall, it's basically on a good day as like we get 2,000 crore orders, 30 crore trades in kind of different markets. So all the hardware, literally whatever people do here is sent to a nearby site called NearDR, and a Chennai site, literally gigabits of
information
bytes, is transferring.
Okay.
And we have like petabytes of data stored. Some people access from there, some people access from here, and so it's like a very large setup which needs to be monitored on a.
So there's we were in the business NOC, there's the hardware NOC, and
then we have a security NOC, which is
the cybersecurity and security NOC. So let's go there and check it out as well. So that is the hardware NOC, and what we're going to do now is show you the cyber NOC, Ashish bhai. And I think viewers can see what is inside the room. So tell us a little bit about what happens here.
No, in a way, we use many softwares and tools and hardware to ensure that the working of the exchange continues without
disruption,
any disruption, even from the hacking and other activities. So that's where, again, we have a Chennai site that's connected here, and naturally, some of the government agencies also are able to look into what we do. But there are like lots and lots of softwares, tools, and we use, and each person working has a specific job. But again, we have dashboards which tell on an aggregate level what has been there today, how many attacks are coming, if we are running in a red zone or a amber zone or a green zone, and so those are the things.
You were telling me earlier during on the day of Operation Sindoor, I mean, the attacks kind of peaked at.
Yeah, like in 20 minutes we got 40 crore attacks, right? So these are some of the most attacked entities in the world today.
Okay. So this is a significant area of focus in terms of upgradation, keeping.
The costs are also humongous, but without that, you cannot operate, right? So you need to be like any country. If you don't have a defense, whatever you do in the business has no relevance because somebody will come and subjugate you. Similarly, whatever business you do, if you don't have a good information security in today's world.
So strong physical security, as I noticed at the gate, but strong digital security. I mean, there is digital public infrastructure in that sense, so it has to be on without disruption.
Absolutely. And especially outsiders or insiders, knowingly, unknowingly, doing wrong things cannot be.
Has to be monitored, has to be checked and tracked. Well, from the National Operations Center, and we showed you quite a bit, as much as we could, upstairs. We are here now to take a walk down the memory lane with Ashish bhai. This is, of course, the wall with lots of pictures, and I guess Ashish bhai, lots of memories as well, right?
Yes, of course.
Because I spotted that photograph, which is July 1994, when an NSE was inaugurated. And that is, I don't think you can see it, but that is a very young Ashish Kumar Chauhan explaining to then Finance Minister, Dr. Manmohan Singh. What is happening then in that picture?
And next is our chairman, Mr. Nadkarni, who became chairman of SEBI later on.
Right.
He was IDBI chairman beforehand.
Right.
And so, in a way, this project was like very ambitious.
Right.
And everyone was clear this is not going to work.
Right.
Even when it was
right.
thought through, because bankers were trying to implement
right.
a stock exchange which they have never run before. And in an IT, pure IT exchange, which was not the case anywhere in the world before. So
Correct.
it was all sorts of complexities, and we were trying to use satellite telecom and also a lot of things which could have gone wrong.
The idea germinated in 92.
Yes.
And
post Arshad Mehta scam,
right.
The government wanted to create a framework which is not owned by brokers, operated by brokers.
Right.
And that's why they wanted to create an independent exchange owned by investors,
right.
But run by professionals.
Right.
And completely automated so that it will have transparency, fairness, efficiency, and all that. Right.
Correct.
And so in that context, we made presentations to Finance Ministry in 92.
Correct.
Lots of to and fro during 92, 93, 94. So what happened is we first started with the wholesale debt market because Arshad Mehta scandal actually originated in the RBI Secretary General ledger and all. So they wanted to first do wholesale debt market. And so we started operating without inauguration, like a beta test in those days. And I think Google had not come then. So beta was not so popular, but we started trading, real trade.
Right.
And then Dr. Manmohan Singh gave time to come and inaugurate in July. And on that day, he woke up early. He used to be a very diligent man, right? So he decided to visit NSE. The inauguration was in Nehru Center at Worli. And our office was at Mahindra Towers.
Right.
Again, Worli, but probably 1.5 kilometers away. And so I used to sleep in the office most days.
Okay.
And that was an important day, right? So when the dogs started coming to check around the dog squad, then I realized something is happening. I had to tell my bosses that he's coming to visit NSE, and then everyone sort of came hurriedly.
Right.
And so that time I was explaining to him how the IT system works.
Okay. And that is you were how old in that picture?
I was 26 years old then.
26-year-old. I mean, that is just 2 years into your work life, right?
Yeah,
2 or 3 years,
yes.
into your work life. Yes. Must have been a high.
No, it is. I mean, this, as I say, this has been, and setting up NSA has been the greatest privilege of my life.
Right.
And the amount of service it has given to India.
Absolutely.
It is way beyond what one had imagined or what one can even fathom.
And we're going to go now to the most used facility, the NSE, by the general public, by companies, by new corporates who want to list and ring the bell. So we're going to go to the bell there now and check it out as well. Well, I hope we've given you a 360 degree, if not a 360 degree, a 180 degree kind of view of how NSE as an organization runs. I mean, some of the stuff that we showed you, of course, behind the scenes, as I said, the National Operations Center. And of course, we jogged our sort of memories back to when the exchange was founded as well. This is also an iconic place. This is the, Ashish Bhai, the atrium, right?
Yes.
And I think corporates who may be watching this, for a lot of them who are recently listed or even listed for a while, I think they would remember this place. With the ringing of this bell,
absolutely,
the listed journey starts.
Yes.
And it's been such a vibrant place, right?
Yes.
Ashish Bhai, last couple of years especially.
Yeah, every day there are many listings. The largest company usually does bell ringing here. We have other places where there are bells, including in other cities also.
Yeah.
But this is the most coveted sort of listing place today in the
country. You're here, as you told me, for the big ones at least, 9:15.
If I'm in Mumbai, I try to be there.
You try to be there.
For listing, because again, it's an important occasion for the company's life. And as what I call a head priest of this temple, it's my duty
you have to be
there.
present.
Yes.
When do we see NSE's bell going off in terms of listing?
Once the SEBI gives no objection certificate, that's the minimum we require as a regulated entity by SEBI.
Right.
After that, we'll prepare the DRHP and then submit to another department of SEBI, which will go through it. And broadly, it would take probably at least 4 months to prepare the DRHP.
Right.
4 months for them to do queries and ask us any issues,
questions, etc.
Clarification.
Right.
And then so.
But from the day that the NOC is received, whenever it is, we don't know when that is.
Probably 8-9 months is what looks like after that.
To the listing date, basically. So I mean the work in terms of having the background, etc., is work in progress.
In 2016, NSE had filed. That time I was not there in NSE. But 2016, NSE had filed the first DRHP. So since then, NSE has been in a way in a status of some readiness, not always, because it's almost now 9 years.
Right.
But in a way, we are sort of prepared.
And in terms of the size of listings, you said big companies. I think this is going to be the biggest of all.
No, in a way,
in terms of,
and we are also 100% public. See, unlike
right,
other companies, we are already 100% public. I have
Correct.
like 172,000 shareholders already.
correct.
Right, and so 0% is with any promoter. I have no identifiable
And
promoter.
in terms of the shareholding, last 5 years is when the numbers have really exploded,
In
right?
fact, since March only, it has gone up from probably 30,000 to 172,000, right?
Last March.
That is 25 March.
Wow.
Right. So because earlier we used to approve each transaction with fit and proper, and then
Correct. It used to take time. There used to be
it
4, 5,
take
6 months.
and things like that. Now it's all automatic in the depository, so that's why many more people.
So transactions are taking place a lot more. And all those, you said 172,000 shareholders now. So, and they're all waiting and watching
Absolutely.
when this is going to happen. I mean, what, close to 5 lakh crores in market capitalization? At least in terms of, because transactions are taking place.
Transactions.
Right?
But again, when you go to do the IPO, that is the time you need to see.
Depends on
the situation, your profitability and other things.
Right. So, well, I hope that day is not very far. The
you.
NOC comes soon, and as you said, within the next 7 or 8 months after that, it is listing. So let's do some practice, Ashish bhai,
thank you.
in terms of the listing.
Yes, of course, it will not be done here. It will be another
Of
exchange.
course.
Hello and welcome to our special broadcast from the 65th Annual Convention of the Society of Indian Automobile Manufacturers. This is the annual gathering of all top automotive OEMs in the country. Nitin Gadkari, the Road Transport Minister, kicked off the event by urging the industry to focus more on clean fuels and biofuels in the future and give higher discounts to customers who have scrapped their older vehicles. He also hit out at the paid lobby which was targeting him over the E20 rollout. Overall, here at the Siam convention, there was an air of optimism after the GST reductions. Let's listen in.
सुप्रीम कोर्ट में भी इसके बारे में बहुत साफ निर्णय हुआ है। अब जैसे आपकी इंडस्ट्री है वैसे हमारा पॉलिटिक्स भी है, तो ये सोशल मीडिया का जो कैंपेन था वो पेड कैंपेन था, वो अगेंस्ट इथेनॉल था और पॉलिटिकली टारगेट मुझे करने के लिए था। तो मैं इतना ही कहूँगा कि वो जो कुछ था उसमें कोई तथ्य नहीं था, सब बातें क्लियर हुई है। परसों मैंने प्रधानमंत्री जी को भी रिक्वेस्ट की, फाइनेंस मिनिस्टर को भी कही है कि स्क्रैपिंग को बढ़ाने के लिए जो गाड़ी स्क्रैप करेंगे और नई गाड़ी लेंगे उसमें कुछ जीएसटी के बारे में हम सोच सकते तो विचार करिए। ये भी बात हमने वित्त मंत्री के सामने रखी है। मैं आप लोगों को भी रिक्वेस्ट करूंगा कि जो नई गाड़ी खरीदी करेगा स्क्रैपिंग सर्टिफिकेट देकर, उसको अगर कुछ अच्छा डिस्काउंट अगर आपके पास आता है और आप ऑफर करेंगे रिजनेबली अच्छा, तो इससे बहुत विन विन सिचुएशन है.
I think this is a very big reform which is happening from 22nd of September. It is not only kickstart the auto industry, but across all other industries also. Everybody is going to benefit, and the common man is going to be a big beneficiary. On the top of it, I think the two more things I would like to bring in the knowledge is, one, the benefit which was passed on through the income tax by the Honorable Finance Minister, and also I think the RBI Governor has done a very good job in terms of reducing the repo rates. So I think it's a combination now of the GST, then the benefit which is passed on through the income tax, and third is the repo rate. So I think it's going to be a bumper sales in this festival time.
I believe with the 10% cut in the smaller cars, it will bring in so many new customers. The first-time buyers, which Hyundai anyway is seeing a big jump. First-time buyers in 2020 used to be about 31%. Now they are at 39.5%. I believe we have a potential to go up to maybe 42, 43% in first-time buyers. So more small cars selling. The second thing I think which will be much more significant is, if you see the customer affordability remains the same in terms of how much he can spend. However, the car becomes cheaper, which means its initial signs, maybe the customers will now again go back to the higher trims, because last 1 year we are seeing that customers were moving down from higher trims to middle trims to lower trim. But now there's an opportunity, because India is a very, very aspirational country.
Until 22nd, we're going to be cautious on the front.
Right. So is this going to restrict the amount of inventory you'll be able to put into system?
No, so we have taken steps to ensure that we'll still be able to meet the festive demand. So there are a few steps we are taking on the front as well. So you'll see that as it plays out. It's like I said, it's not an easy puzzle to solve for, but that's what we are here.
Shailesh Chandra, the president of the Society of Indian Automotive Manufacturers and also the managing director of Tata Motors Passenger Vehicles and Electric Vehicles, said that the GST reduction is going to help all automotive segments, and they are going to get a better picture of the demand scenario in the next couple of weeks. Having said that, the Siam president also urged the government to continue supporting the electric mobility even beyond March 2026, when the PM e-Drive scheme comes to an end. He said that the industry was well on course to achieve 15 to 20% electrification, at least in the passenger car segment, by 2030. On the issue of rare earth magnets, the Siam president said that it is still status quo, not much has changed, but the industry continues to find alternatives. Let's listen in.
Yeah, I think, it's been a really welcome move and a major reform which was very much awaited. I would say this was a request by the Automotive Association for a long period of time, I must say. It's a welcome move. It is coming just ahead of the festive season. So there will be a big boost in the short term. And in terms of how this whole thing will pan out is something to be observed. But, let me first talk about the short term. There has been a pent-up which has been building for 1.5 months since the time, after 15th August, people have been waiting for the GST reduction and, waiting to book their cars also. So after this announcement has happened, and then you have seen that pent-up being released in terms of bookings and all, right? But also the second factor which is really going to help is, the festive itself, right? Festive season generally you see is 35% to 40% more than the average, demand during the year. So that I think is really going to help alongside the pent-up demand. And third, we'll have to see the GST rate reduction, how certain customers who are not considering buying cars, how they get excited about this. So something which we'll have to observe over a period of time. But definitely I can say that second half of the year, which typically for, say for example, passenger vehicle industry used to be 55% of the total volume of the year, should see a much better percentage, as I would say. That's what I expect. Different segments will get impacted differently. I'm sure that in the car segment you will see the demand growth is going to come mainly in the entry segment and for the middle class income group. For two-wheelers, I believe that this is going to be really a big boost, especially for the rural economy, because I understand that urban was doing a bit better than rural. Now I think with this and monsoon which has been good, the rural demand, especially for I would say less than 125cc product, should really see a good boost. So I hope that with this booster, two-wheeler industry will see a new peak after 2019, what they had seen about 2.1 million or 21 million or so. So two-wheeler we are expecting that to go strong. Passenger vehicle I've already spoken about the factors. In long term the addition is going to come from in the entry side. In commercial vehicle I think there is always will be a lag basis how the economic activities grow, how the GDP grows, and the multiplier effect starts coming into play. I think then we'll see a growth in CV segment also. But passenger vehicle segment also is very much correlated to the GDP. Generally it is 1.2 to 1.3 times of your GDP growth. So there will be short term, mid term, long term that we'll have to see how it pans out, but definitely it's a big booster for the industry.
What is your hope and expectation from the government in terms of supporting the electric mobility going forward? Should they stop subsidies or should they continue only for certain categories?
No, so we have given our thinking on that to the government. I would reserve that, but definitely the expectation would be to extend the support and continue to extend this support, because there is always a threshold level of penetration that you need to attain before you start withdrawing the incentives or benefit. So policy support till you achieve about 20% of penetration level in all the categories is where one should keep supporting, because that is what you will see globally also.
Right.
The countries which have done well in electric mobility have got that kind of a support from the government till you have attained about 20% penetration. That would be the expectation.
My final question, could you give us a sense of, you've spoken about a lot of tailwinds for the industry, but the headwinds, the problems that the industry is facing right now which need to be overcome, especially the high rare earth magnet issue. Has China started releasing those consignments, or is the situation where it was since the 1st of April?
Yeah, I think when this issue came up, it came up as a surprise to many of us, and we were caught off guard to start with. But once you face the situation, you start splitting the problem into parts and then try to solve it. I think initially it was more with the inventories that you had, that most of the companies were managing, and then it moved to coordinating with the suppliers to get access to more material, to wherever from across the world it was possible. Then thinking beyond that, imagining worst case scenarios and all. In two-wheelers you see people have moved to the light rare earth and all that option, but that supply is also not I would say there fully. In passenger cars also I'm seeing most of the members also looking for alternatives of exploring alternate sources of raw material, reducing the raw material usage, or if not eliminating. I think all those options are being looked into, but I think as far as the clearances are concerned, to my latest knowledge, it remains status quo, and we are hopeful. Government is very supportive, I must say that, and therefore we are working closely with the government to see if the situation changes as early as possible. But it is imperative that this issue gets resolved.
So it is still curtailing production to some extent?
I don't think so. Anybody has, except for two-wheeler industry where there had been curtailment of production. I have not seen any other member curtailing the production. Maybe for specific models they would have done, but not to my knowledge.
So in the short and medium term, it seems that the industry will have to find alternatives. There is no immediate solution to the rare earth problems in terms of release of consignment.
We are seeing the next 2 month situation, whether we are covered or not. It's in that manner, and then looking for mid-term to long-term solution, as I mentioned.
One of India's largest commercial vehicle makers, Ashok Leyland, is optimistic that they will be able to increase their sales of commercial vehicles across segments as a result of the GST reductions. They also told us how they will be doubling down when it comes to capex deployments on localizing the electric vehicle supply chains, especially batteries. Listen in to Shenu Agarwal, the Managing Director and CEO of Ashok Leyland.
One is definitely that everybody is talking about that the prices will come down. In our case, the tax has reduced from 28 to 18 on the diesel side, and the EV stays at 5, right? But since 99% of the sales today is diesel, this will have a huge impact on our TCO, on the total operating cost that a customer will bear on buying a truck. That itself changes the dynamics quite a lot. But I would say that this is still not the biggest thing. I think the biggest thing is that this GST is not sector specific. It is touching everyone in the country, every sector, every consumer in the country. And therefore, the overall demand or the overall consumption is going to go up significantly. And once the consumption goes up, whether it is a toothpaste or a brush or a car or a scooter or anything else or cement, or it has to be carried. It has to be carried on a truck. And therefore, the freight traffic is bound to increase. I think the biggest trigger for us is not the cut in the price, but this freight traffic which will increase, which will directly impact the industry in terms of needing more trucks and more buses to be able to carry these goods and passengers.
Right. Now, could you give us your growth outlook in terms of the growth that you were looking at in FY26 in commercial vehicles for Ashok Leyland before the GST cut and after the GST cut?
Listen, it's very difficult to quantify this right now, but if you would ask me this question, maybe end of October, I can give you a very straight answer. But I would say that initially at the start of the year, the industry was expecting about, let us say, 3% growth in the trucks and maybe 4 or 5% growth in the trucks. But I would definitely say it would be a much higher number now.
Okay. Also to ask you about deploying CapEx. Does this increase your ability to deploy CapEx?
Definitely. I mean, already in a way, we were getting ready in many ways, whether it is, working on our alternate powertrain technologies. We have spent a lot of CapEx in the last few years on that. I think our next step is basically now looking at localizing the supply chain of the electric vehicles. You would have heard about our foray into batteries, battery space in India, and we are one of the first few players in India who are getting into this space. And the reason we are getting into this space is that 40 to 50% of the cost of an electric truck or a bus comes from the battery. It is extremely important that we reduce that cost to move the adoption of trucks and buses much faster than what it is. Right? So I think our roadmap is quite clear. First is the powertrain technology. Second is make the supply chain very resilient, and the only way in today's geopolitical world is to localize it. And the third is also now to start looking at circularity, which is very important, and it is much more relevant when we talk about sustainable mobility.
So how much are you going to be investing in these areas?
A lot. Battery space itself would be an investment of roughly 5,000 crores, and I am a little conservative on that number. Because I say conservative because it really depends on the demand of electric vehicles that will come. Some people believe that it will have a hockey stick kind of a demand curve, which means that if the demand goes beyond our imagination, the investment could be much higher. But let us say 5,000 crores there. Our overall capex in product development or technology development has been, including some sustenance capex, has been close to 400 to 500 crores. I think this year we'll end up spending more than 1,000 crores. So we are really revving up our capex and make ourselves future ready.
On that note, we take a short break, but don't go anywhere. When we return, we're going to get you more conversations from the Siam convention with leading automakers in the country on India's export story in light of the FTA conversations, volatile geopolitical situations, and the India-China recalibration of ties. Welcome back. You're watching our special broadcast from the 65th Annual Convention of the Society of Indian Automobile Manufacturers, which is the biggest annual gathering of top automotive OEMs in the country. Over here, I caught up with the Managing Director of Maruti Suzuki, India's largest passenger car maker. Hisashi Takeuchi told me that they're gearing up to export the e-Vitara to 100 countries and also begin domestic sales within this fiscal. They want to have a strong export story and want to cross 4 lakh units in this fiscal itself. They also have the launch of a new flex fuel vehicle on the cards. Listen in.
Actually, GST, especially for small cars, we see the 10% reduction of the rate. Actually, it's 11% including cess. So our retail price, if we are going to transfer all the benefits to the customer, so customer will enjoy at the retail price level almost 8.5% reduction. I think that will push up the sales from current going rate to almost like a 10% increase. I see, that will happen after GST. And not only small cars, but overall, all segments will receive big benefit thanks to the GST. So I think overall, total market will see 7 or 8% increase in the next financial year.
All right. I would also like to ask you about the export picture. You've just rolled out the e-Vitara from your plant in Gujarat for export purposes. Could you give us some numbers as to how many e-Vitaras do you plan to export in the current fiscal? And how many countries are you looking to touch?
Okay. So the number of countries we are going to export is actually 100 plus 1 countries. Gradually we start shipping cars, and the first priority is given to European countries where our dealers are waiting the arrival of EV for long time. So that's why first shipment went to UK, followed by the one to the continent, and then after that we start export to Japanese market. And almost same time, we will keep selling this car in the Indian market as well.
Right. So, if I were to ask you, in this fiscal, how many units of the e-Vitara could you export?
Because the production we are ramping up, so gradually increasing the production output, and sooner or later, I think quite soon we will be reaching maybe 8,000 to 10,000 a month production volume, and then that will go to worldwide as well as for Indian market. Probably, I think maybe 60%, 70% going for export, 30-40% for the domestic market.
All right. Overall, exports have been a focus area for Maruti Suzuki. Overall, not just the Vitara, what kind of export growth are you looking at in FY26?
Like year before, our export was around 2.8 lakh, and last year was 3.3. This year we are seeing over 4 lakh, and so that is like a level of speed of growth.
All right. In terms of future technologies that Maruti Suzuki will work on, especially with the result of the collaboration, long-standing collaboration with Suzuki, could you give us the technology pipeline that will be the focus of the company?
We just had press conference in Japan. This is the annual press conference of our technology roadmap. And in that technology roadmap, we are explaining that we are focusing on how to minimize the energy and resource we use for producing and also driving our cars. And that sort of technology we're going to introduce. One of these is try to make the weight of the cars as light as possible. Because even in the era of EV, the lighter EV will consume the fewer electricity, which is good for the environment. So that is one of the area where we are focusing on. But we have plenty of other technologies that just we announced in the Japanese press conference.
It's been over a year since China's SAIC-owned MG Motor came together to form a joint venture with the JSW Group. called JSW MG Motor India. We caught up with their new managing director Anurag Mehrotra about the company's plans to double down on electric vehicle growth in India and also about the recent positive messaging in India-China relations.
I think it is a very welcome move. The Prime Minister has taken a very progressive step in working towards bridging the gaps with China. I must acknowledge that, and I think in our path to sustainable mobility, it is important to draw on capabilities from around the world, China included. China today is by far the most significant market for new energy vehicles. And in our path to building a sustainable mobility ecosystem in India, it would augur well for us to draw on the capabilities from China while we are building our own capabilities as part of the Viksit Bharat project.
Right. So that brings me to my next question about Press Note 3. There has been deliberation in the industry and the government on whether Press Note 3, which restricts how the investments from China come into India and they can only come through government approvals. Do you feel it's time to revisit that, change that?
I think the government is doing everything within its power to ensure that there is ease of doing business in India, and that is not restricted just to countries which are bordering with India. It is with every country around the world, and I think we are very supportive and have got all the help that is required from the government of India to ensure we continue to grow in the marketplace.
Right. So speak about the rare earth issue. Now that was something that the industry was badly grappling with. Do you think we've overcome that crisis? Have we started receiving consignments of high rare earth magnets from China? What is the pace of getting those supplies right now?
I think as mentioned by Siam itself, the stated position of the industry body is clear that it is an issue that is getting addressed. Earlier today you heard the president of Siam also make a statement around the fact that this issue is getting addressed especially after the visit of the Prime Minister to China. So these are encouraging signs, and we are sure we will get over this hump very soon.
India and the European Union are fast-tracking negotiations on their FTA with the hope to conclude it by the end of this year. Here at the Siam Summit, I caught up with Jyoti Malhotra, the managing director of Volvo Cars, one of Europe's top car makers. He told me that he hopes that the India-EU FTA will bring a level playing field to European car makers and bring down the overall tariff levels. In the long term, Volvo Cars has not changed its focus. The focus will be on expanding its footprint in the India market and also focusing on electrification in a big way.
I would say FTAs are welcome. I think free trade is something which has really helps the whole, I think both sides. That's the whole perspective of having a free trade agreement. And hence I think unless the fine print is out, we can't really say where it is heading. But I can say one thing, that I think we have already done as a country, we have India-UK FTA already in place, and I'm sure this will build on that. And keeping that in mind, I'm very confident that I think EU-India FTA will also come out as soon as possible. We can't really say how much is done and how it will come through, but it is now very close to, I would say, conclusion, and we hope to get it soon. But I think what it does is, the trade agreement, what it does is two things. I think it is not about suddenly things becoming cheaper. I think that's I would say, misnomer. Doesn't happen. What it does, it creates a very easy supply chain on both sides. We can source parts which much more easily and then add value here and then export them back. And I think we need to see it from that perspective, how it really impacts your economy of scale. And I think from an India perspective, I think government has been talking about Atmanirbhar Bharat and Make in India. I think these trade agreements will actually boost that in a big way. And it sort of bodes well because in absence of FTAs, we can produce in India, but we can't export back. This creates an opportunity for us to, I think, do that. And I think that is something which can create a different way of looking at things in India for everyone.
All right. I would like to ask you, till now, what are the kind of hurdles which you faced in terms of growing your footprint in India, and how do you think the India-EU FTA will help you get over that?
See, I think one of the key challenges for us is, we are as an industry, the luxury industry in India is still very small. We are just 1% of the overall auto industry. Auto industry has really grown well. We are still around 1% and thereabout, right? And what it does is that it limits the scale for us, right? So in our global portfolio, there are so many cars. If I need to bring some car in India, even to test, although government has become quite liberal when it comes to homologation, I can bring some cars and I think still sell them, but the duty rate is still very high. Then it doesn't make sense to sell cars at that price and customers don't really buy them. So that's a big hurdle. What FTA can do is, if there is a car which is available in global portfolio which I want to bring in India, I either want to test it or I believe, okay, there is at least some segment of customers who can have that car. FTA will allow us to bring that car quickly at a reasonable price and offer to our consumer. And so that is one very important thing. The other thing is when we look at, okay, what do we do to sort of expand from India? So today when we look at India, we look at only in India, right? With trade agreements, we can say, okay, from India, we can cater to different markets. And that can also bring a different scale to our equation. And these two things will, I think, go a long way in, I think, going forward as we sort of understand it in a better way. But ultimately, it all depends upon the fine print of the FTAs.
All right, on that note, we come to the end of this special broadcast from video journalist Akhilesh Verma, Hruday Patra and me. Thanks for watching and goodbye.
Let's talk money.
Hello and welcome to another new edition of Let's Talk Money. I'm your host, Surabhi Upadhyay. Now, over the last couple of months, the stock market narrative has shifted in favor of consumption stocks. It all started with the income tax cut, which came earlier in the year, and that cut promises to leave more money in the hands of people. Then came the RBI's rate cuts, and now we have the GST bonanza to add to the cheer. The question that we need to ask as investors is that a recent run-up that is, in consumer-related stocks, is this just a passing quote-unquote fad, or is it a durable trend in the making that can help us build more wealth and better wealth? So today on the show, we're going to do a deep dive on a lot of the consumer funds or consumption-related funds that are out there in the market and see if they're indeed worth your while. Should you think of adding them to your portfolio at all? Our guest on the show today is Mohit Gang of Moneyfront. Mohit, thank you so much for joining in. So we put Mohit to the task straight away because all these consumer stocks are flying high. And Mohit, it's interesting, right? After many, many months of talking about capex and industrial and defense stocks, now last 3-4 months, and GST is the latest.
Absolutely.
So much consumer talk. What have you made of it?
Absolutely. So Surabhi, I think it's homecoming for India. After a long while, in a country like India, where demographics is the main key component globally spoken about, we are talking about consumption. This story should have long come to our homeland, but better late than never, right? So I think, honestly, consumption as a theme has started picking up some momentum since the start of this year. And it all started with the great budget, which came in this year's start, where you had a direct tax cut, and which was a dramatic direct tax cut, right? So people up to 12 lakhs of income, perhaps going up to 12.75 lakhs of income, could now take everything tax-free at home. Coupled with that, you had the greatest indirect tax reform, right? So direct tax coupled with indirect tax in form of GST reductions, and the slabs across the board have got reduced on consumer items, life care products, consumer discretionary products, and so on and so forth. And this also is a massive rate cut from that perspective. Then you add on to certain factors, which is obviously the Indian demographics, a good monsoon season, the festive season coming around, right? So which is always the period, the September to December period always has been a consumer bonanza period in India. And last but not the least, I think we are all kind of not talking about the impact of ban on gaming companies, Surbhi. And this is all indirectly linked, but that savings which a normal auto rickshaw guy or a normal local consumer will save by not spending on these gaming apps could tune to almost like 40-50,000 crore a year, and which that extra amount of money will perhaps a large chunk of that will go in household consumption or maybe some bit of savings, this thing, right? So all of this added together is kind of propelling the consumption boost in the economy, and that's why all these consumption funds of late have found immense amount of flavor in the market.
No, absolutely. And, you know, there's so much that's happened. Yeah. The GST cuts that we're talking about, they're on daily, you know, essential items. They're on automotive, you know, autos, basically, both cars and on motorcycles. They are on so many different things. In fact, we just put up some data from CRISIL. So we looked at some reports, lots of reports on what this could mean for individual sectors and companies. CRISIL is saying that overall India Inc.'s revenue is going to grow 6 to 7% this year, which is 25 to 50 basis points, almost half a percentage point higher than what CRISIL was earlier envisaging. So that could be the degree of, you know, the added growth boost that we'll get. And they're saying that price reductions are expected in FMCG, consumer durables, autos. We've already seen many auto companies, for instance, announce those price cuts. So the question here is also, Mohit, that consumption is a very large basket. Yeah. And the thing is, you're also getting into the sectoral category, which you and I have discussed on the show earlier, that you have to be very careful if you will start going and, you know, going down and playing these niche sectors. Is it worth it? Is it worth to at least debate it, or do you think they'll just stay away, be in a diversified fund?
Look, I think it will all vary, Surbhi, as we've always spoken of, from profile to profile, right? Yeah. So if you're an individual investor who is willing to take that extra call in terms of placing a thematic bet or taking a sectoral call, you are in the highest risk bracket, you perhaps have no liabilities and you can tolerate higher volatility in your portfolio with a longer time frame, right? Then I think there is all merit in kind of considering this theme as part of your overall tactical portfolio. I'll still stay away from this theme in my strategic portfolio, which is my long-term retirement portfolio. But from a tactical perspective, if I have to play 10-15% of my allocation tactically in any theme, then I think this perhaps, yes, is the right time to play this theme.
Okay, got that. So first, that's rule number one. Mohit's given out the first rule. Do not go beyond 15% of your portfolio if you're looking to get into a theme, even if it is a consumer theme. Now let's look at some of the fund names. And there are actually plenty out there. So many funds. Let's get the graphics up on our screen. So I'm just listing off. Axis Consumption Fund. And these are some of the funds with a larger AUM, bigger size fund. They're not very small funds. This is on the active management style. So there's Axis Consumer Fund. Bajaj Finserv has a fund, Baroda BNP Paribas, there's HSBC, they have their own fund, Edelweiss, you can see the names on your screen, and these are all actively managed. So basically there is a physical fund manager present deciding what to buy and what to sell. But there are also passive funds, right, on the consumer side. So let's start right there. That's the first point of distinction. If I have to do consumption, then should I be in an active fund or a passive fund?
It's a very, very difficult debate. Look, I think out here for a change, I would go more towards the active guys. Okay. Look, when you're taking a sector or a theme, the passive index by default is an index of around 10 to 15 odd stocks, not beyond that, right? So typically any index on a sector side, if you pick, it will be 10 to 15 odd stocks, and that's about it. And it will always be inclined more towards the heavyweight names out there or the larger names out there. But the larger growth perhaps or the unknown, uncovered stories are found in the smaller and the mid-cap names out there, which my sense is an active guy can better pick. And he has a better maneuverability in terms of moving in and moving out of these names. An index might not change very often. It'll perhaps take 6 months to rebalance or maybe a year to adjust the constituents. So from that perspective, I think whenever you're taking a sectoral bet, I would rather lean towards an active call.
An actively managed fund. Okay, so let's go back to the active tally. It's on our screens. One of the larger funds, there is a quant fund there where the assets under management is over 7,000 crores. So now, Mohit, the next step. Okay, so we've decided not more than 15% of portfolio. Mohit says probably better to be in an actively managed fund when you're trying to play consumption. Then the question is understanding what does a consumption fund actually have? Is it only FMCG? Is it, what kind of stocks? Is it ACs and durables? But when you have, I think you've gone through that whole universe of funds. So, hota kya hai inme? What kind of stocks do they hold?
So look, there are many offshoots of consumption fund which have come out now, and one has to be very, very discerning in terms of what he really wants to pick, which sector or which particular area does one want to play, right? So you have a normal consumption fund which will take care of the old age style consumption, which is more like FMCG, durables, staples, discretionary, so on and so forth. Then you have your new age consumption themes, which is more like your Eternal, Swiggy, and those kind of things, because extra disposable income means you will order more from
Swiggy and Zomato.
Swiggy and Zomato, right?
Yeah.
And you obviously have autos and auto ancillaries and those kind of names, maybe healthcare, diagnostics, and these are all sectors which have got impacted because of lower GST rate cuts.
And the current crop of funds, they're as diversified as this? They have representation from so many different sectors?
Yes, you will have to, again, it varies from fund to fund, but if I were to like really pick the top 5 sectors across all these funds, it'll be consumer discretionary, consumer staples, it'll be telecom, it'll be healthcare, these are, and maybe automotive. To some extent. So these are the top 5 sectors, and then from fund to fund it will vary from which, you will sometimes find energy, you will find some renewables, you will find some component makers and other things, right? So all those things will be a part of active funds, but these 5 uniformly across all the funds you will find.
So then we come to the next question, and that is how to pick the right active fund. What is the right active fund? And here, Mohit, you have to strike a balance. An investor will not want an over-diversified fund, which has the ICICI Bank, HDFC Bank and Reliance, because, then there's no point. You might as well have a Nifty fund, right?
Absolutely.
At the same time, you don't want to be overly concentrated because you don't want to make it too risky.
Right.
So you give us some names, give us some choices and why you like the funds.
Look, again, as you said, there are plethora of choices available. You have to just pick out which matches your theme of consumption, right? So let's say an excess consumption fund. I think the foremost criteria being the vintage of the fund is decent. So none of the funds, as you rightly said, are more than like 3-5 years old. They're all within that bracket of 2 to 4 years, kind of. The AUM of the fund is reasonable. So I think they manage roughly around 4,500 odd crore. You also have a Nippon consumption. You also have a Mirai consumption. So these are also reasonably sized funds with decent track record and everything. Last 6 months performance has been good. In terms of sectoral composition, if you see all the 3 of these will have your ITC, Bharti Airtel, these kind of names, right? In your top 5 picks, you will have Trent, you will have all these maybe DMart and all these kind of names in top 5 picks. But overall, the composition amongst the top 10 stocks kind of mirrors the consumption index. But when you go beyond the top 10, that's where the real diversification comes into play. And all these funds are vastly different from what a normal consumption index looks like, right? So that's where my comfort lies more here, because the tail of all these funds have names which they can quickly move. The allocations are not very high, and those are very differentiating names in each portfolios. So, so let's say you will find some auto components name. Maybe you will find Uno Minda, or you will find a Sona BLW, or you will find those kind of names in few of these consumption funds, right? Because finally, if you buy more autos, these are the companies which will, as ancillaries, benefit from the overall sector. Right? So that's how the selection.
So those are some ideas. Axis, the Axis Consumer Fund, and
Nippon,
the Nippon.
Mirai.
And the Mirai.
Yeah.
Okay, so 3 AMCs and 3 consumer funds that Mohit is going with. Before we take a break, there are also specific funds dedicated to FMCG.
Yeah.
Just fast-moving consumer goods, the staples as they're called. Are they worth a look or no? Or too concentrated?
I think there are 1 or 2 index funds, but look, FMCG as a sector, honestly, though if you see last 10 years of calendar year history, there's never been a calendar year where FMCG has given you negative returns. So it's a very stable, but there's never been a calendar year where FMCG is like the topmost bumper returns or those kind of things. So if you want very steady, stable, dividend-paying stocks, good blue chip portfolios with names like Hindustan Liver and ITCs and Maricos of the world and Nestle's of the world, then you perhaps take that. But it's more a steady, stable portfolio. Having said which, I think anything which benefits from the rural economy, anything which benefits from mass consumption is also a great call right now. So it's not a bad call. If you're really only keen to take consumer staples and FMCG as your key component, then you might just go for an FMCG fund, which is much more narrower than an overall consumption basket. So it's a pretty narrow theme. You have to be really cognizant.
Very cautious and very mindful about what you're doing. Got that. Let's take a break. But let's remember that when you're talking about the consumer fillip or the GST bonanza, it's going to many other sectors, autos, hotels, travel and tourism. So how do we look at all of these possibilities as investors? We'll talk about more mutual funds on the other side.
Let's talk money. Let's talk money.
Welcome back. This week we're talking about consumption as an investing theme. Should we look at a more dedicated play towards consumption in our portfolios, given the big GST bonanza, the income tax cuts, and of course the RBI rate cuts? So, well, Mohit just told you about the slightly bigger, more diversified consumer funds. Now let's make it a little more narrow, because there are funds specifically dedicated to, say, the auto sector in the market. Now, Mohit, and auto stocks have done so well, right? Absolutely. In the last 2-3 weeks, they've been really revved up and all the price cuts are coming in. Absolutely. So do you think that this could be something longer term, more structural in the making? In which case, should I look at an auto fund or no? Because most auto stocks are anyway part of the Nifty, right?
Yeah, absolutely. So look, I think the auto story in India is a very structural story. Look, honestly, I think it's an aspirational story in a country like ours. So everyone wants to own a four-wheeler. So I think that story is pretty aspirational in nature. And by the nature of this, it's a pretty long-term story. But tactically, if you were to pay, because you are in a lower interest rate regime, coupled with your GST reductions on bikes lesser than 350cc and cars lesser than 1200cc, I think it just propels that aspirational aspect a little more and gives that immediate fillip to do a purchase in this segment, right? It also helps your home financing company or the auto financing companies and so on and so forth. But let's keep that aside for the timing. If you were to just see the auto part, the story is again broken up into 2 or 3 segments, right? You have a pure play auto index. Then you have a EV and a new age automotive index or a new age auto kind of
thing. They only have like
thing.
4-5 stocks like Ola or Ather, or you don't have too many listed EV stocks.
Yeah, but the component makers for these are also a part of this thing, right? So there are these Sona BLWs and again Uno Mindas of the world, right? So they also become a part of this thing. And then you have a larger auto fund or a automotive opportunities fund, as you might just want to call it, which is any opportunity which is linked to this entire segment, right? So these are the 3 broad classifications out here. Again, it's a very simple filtration. Would you want to go with an index? The index is an index of 15 odd names. All the large names are there, starting from your Maruti to your Tata Motors to your Mahindra and Mahindra, which any which ways is a part of the larger consumption basket also. If you see Maruti and Mahindra, they are pretty much there in every flexi cap fund, in every large cap fund, in every consumption fund, and in every auto fund, right? And then you go down the chain and you figure out those other names also. But if you go to the automotive component, then you have maybe a player like an maybe actually the index has all these names, and then the last 5 odd names you will have that Ola Mobility or maybe an Ather Energy or some of these component makers. So there isn't big difference, between the new age EV index and the auto index per se when you go to the top 10 names. But when you go beyond that, then there is a difference in the composition. So I'll rather prefer a composite basket or a larger basket of an auto index.
Okay.
Now, between the active and the passive, out here the passive choices are larger. There are multiple passive choices. Active mein there are pretty, I think SBI Automotive Opportunities to my mind is the only possible opportunity which is available, which is large enough. There is an HDFC Transport and Logistics Funds, but it's not so much fitting into the theme. It's a slightly more tangential theme. So I'll rather go with an SBI Automotive Opportunities Fund out here. The names are pretty different, barring the top 5 or 6, which always will remain uniform across any of the funds which you pick up. So bulk of your money will any which ways go to your Maruti and Mahindra and those kind of names. But the bottom half of your portfolio is then your Sona BLW Precision or Uno Minda or all those kind of KEI components and all those kind of names which are more component suppliers or ancillaries to the auto names, right? So again, it's a high risk call. I would rather prefer to play a larger consumption call, Surbhi.
So you won't go for a sectoral, very sort of narrow approach in terms of going in for an auto fund?
It's a pretty narrow approach, right? And it's a pretty fast moving approach also. So you have to just time in your entry and exit pretty quickly in this one. The larger consumption basket, my sense is you will keep seeing incremental reforms in the country which will trigger or propel some form of consumption in the rural economy, in the larger economy, right? So you will keep having those triggers on and off. But auto becomes a very niche play.
Becomes too narrow. Got it. I guess then you will definitely not look at very niche tourism funds, or I don't know if you have a hospitality fund or not. But oh, okay. So just at least give us the names and tell us yes, no, maybe.
So you have two tourism index funds, a Kotak and a Tata tourism index funds. The AUMs are pretty small. Tata still has around 325 odd crores. Kotak one is pretty small. So if you really want to play only tourism, which is your hotels, the primary names are all hotels, and then you will have some ancillary or service providers out there. But again, I think these are all part of the consumption basket also. So ITC remains a larger part of the consumption basket. Even ITC hotels is getting covered in few of the funds. And there are other hotel names or tourism names which gets covered in the larger consumption basket. So again, as I said, it becomes very, very niche play. These are not cheap stocks by any means. The valuations are pretty high, and given the way our earnings are going, I would still stay away from this complete basket. There might be few names which you can bottom pick, but I'll rather play that through the consumption fund.
Okay, so let's sum it all up now. You know, there is overall consumption, there is auto, there is FMCG, there is airlines, there is, hotels, there is healthcare. So if I were to ask you, Mohit, give me 3-4 fund names, specific ideas by which I can build a very dedicated consumer side to my portfolio, what will those funds be?
Surbhi, I think given the kind of universe we are playing with, my first choice out here will be an excess consumption fund. Because it covers all. It covers the new age consumption through your Eternals and Swiggies of the world. It covers the FMCG world through your HULs and Maricos and Nestle's of the world. It covers your supportive industries like your airlines and Trends and DMarts of the world and few other names. Some form of discretionaries and
so it's pretty wide,
pretty
covers
wide
the whole
theme,
lot.
covers the whole lot.
Okay.
If you want supplementary names out there, then it is Mirai and Nippon. So these three in the overall basket. If someone is really
and they're actively managed funds.
These are all actively managed
Got it.
funds.
Okay.
If someone is really willing to take a larger punt, right, and a more aggressive punt, then there is a Motilal Oswal mid and small consumption index fund. So those are all mid and small names in the consumption basket.
And it's a passive fund. It's an index fund.
It's a passive fund. It's an index fund, but these are very, very different names and a very different portfolio and a pretty aggressive portfolio. Right?
Like which ones?
You will have some component makers out there, some auto component makers. You will have smaller ancillaries out there. You will have some paint names out there. So those kind of, and some hotels which are smaller names. So those kind of names you will find in the portfolio.
And if you are choosing any of these funds, their allocation in the overall portfolio should be limited to what?
This is again a tactical opportunity. I'll repeat that again. It's not for everyone. It's only for the discerning investors. Otherwise, I think a flexi cap or a large and mid cap pretty much suffices for every investor and every risk profile and will cover all these themes. The fund managers are already covering all these themes. But yes, if you really are looking for that additional jump in your portfolio or a kicker through a tactical allocation, then yes, by all means, consumption is a theme to look out for.
Okay, all right. Very helpful and lots of food for thought as well. Food, clothing, travel, all of that. on whether the slightly more aggressive investor wants to give it a higher weightage in your overall portfolio. Now, speaking of consumption and the fact that the festive season is around the corner, let's recap the hygiene factors as well for all our viewers out there, because, you know, we're all probably raring to go out there, shop, probably have started doing that. So how to gear up for the shopping season and the festive season in a sustainable manner without breaking the bank and breaking our investments?
Look, I think I'll again go back to personal finance 101 out here. So you and I have done that multiple times over. So if you are getting an additional disposable income by virtue of direct tax cuts and by virtue of your GST cuts, so both combined impact could be pretty significant. I would still say that that savings which you are doing additionally, 50% of that should immediately go into investments, which is your regular SIPs and your regular investment allocations. It could be anything. It could be small savings for all that matters. 30% of that goes into your consumption, which is your improved consumption, which is a better version of your shampoo or a better version of your toothpaste or something which is your increased consumption, or more health food or more protein rich food or something like that. And then 20% of that goes into a discretionary allocation, which is buying that extra gadget for yourself or investing an extra amount of money for a better brand of refrigerator or an LCD or a plasma, or whatever you prefer, right? Or an air conditioner.
So, what are you buying this festive season? The new iPhone, what is 70? I keep getting the numbers
for
also.
Entrepreneurs, there is no direct tax cut.
Okay, all right. Mohit, thank you very much. Very helpful conversation as always. Gives us a framework to think about consumption and consumption funds which are out there in the country. Well, with that, we come to the end of this edition of Let's Talk Money. Remember, keep sending us your feedback, comments, queries, and we'll see you with another theme. Same time, same place next week.
Let's talk money.
Hello and welcome to Business 360. I'm Archana Solanki. Here are the headlines we're tracking this evening. Sensex and Nifty end in the green for the 7th straight session, but the gains are limited. This is the longest winning streak in the last 5 months. Rupee hits a record low against the dollar as it moves closer to the 89 mark. Commerce Minister Piyush Goyal says the first tranche of the India-United States trade deal should be finalized by November, adds both sides are satisfied with the progress on talks. Top officials from the European Union set to arrive in India to wrap up negotiations for a free trade deal. Reuters reports the European Union is unlikely to impose 100% tariffs on India and China proposed by US President Trump to pressure Russia to end the Ukraine war. India's leading automakers brace for festive boost on the back of mega GST cuts. Maruti Suzuki highlights a 15% surge in customer inquiries since the announcement. M&M says they are taking steps to ensure that dealers have enough stock. Hyundai is upbeat about the GST cuts, bringing in many more first-time buyers.
सोशल मीडिया का जो कैंपेन था वो पेड कैंपेन था, वो अगेंस्ट इथेनॉल था और पॉलिटिकली टारगेट मुझे करने के लिए था.
Road Transport Minister Nitin Gadkari defends the decision to mix 20% ethanol with petrol, claims there was a paid political campaign against him, which has proven false after Supreme Court rejected petitions against E20 fuel. Tega Industries is set to acquire US-based mining equipment maker Molycorp for $1.5 billion. Tega will acquire 77% stake and Apollo Global will pitch in for a 23% stake. The deal is likely to help Tega's revenues grow ninefold, but also add $1 billion in debt. ChatGPT maker OpenAI signs a $300 billion deal to buy computing power from Oracle for 5 years in one of the largest cloud contracts ever signed, according to the Wall Street Journal. Oracle shares soar, making Larry Ellison the richest man in the world for a brief period. Nepal simmers days after an anti-corruption stir led by Gen Zs toppled the government. Prohibitory orders and curfews continue across the country. Close to 15,000 inmates reportedly flee from various prisons, several names doing the rounds on who should head the interim government. United Nations Security Council set to hold an emergency meeting after Russian drones violate Poland's airspace. This is the first major incursion on a NATO country. Poland plans to impose a no-fly zone. Charlie Kirk, a conservative commentator and an ally of US President Trump, shot dead while speaking to students at a university. The manhunt for the killer continues. Trump calls it a dark moment for America. All right, let's start with the day's market action. Sensex and Nifty gained for the 7th straight day, hitting the highest level in 3 weeks. This is the longest winning streak in the last 5 months. But the gains were limited and the mid-cap index barely managed to end in the green. The Indian rupee plunged to a new record low against the dollar. Now, one US dollar now costs more than 88 rupees. In fact, the rupee is moving closer to the 89 mark against the greenback. 10-year bonds remain largely steady and the yields softened marginally in trade today. And now to the latest in the India-US trade negotiations. Commerce Minister Piyush Goyal says the first tranche of the trade deal should be finalized by November this year. Addressing a press conference in Bihar, Goyal added that discussions have been going on since March and both the countries are satisfied with the progress made so far. Now, this comes a day after Prime Minister Narendra Modi and US President Donald Trump exchanged conciliatory messages amid the tariff standoff.
फरवरी 2025 में माननीय प्रधानमंत्री नरेंद्र मोदी जी और राष्ट्रपति ट्रंप जी ने मिलकर हमें निर्देश दिया था कि दोनों पक्ष के मंत्री फॉल 2025 यानी नवंबर 2025 तक एक अच्छा करार करें। उस करार का पहला अंश फर्स्ट ट्रैंच नवंबर 2025 तक फाइनल करें और लगभग मार्च से इस विषय पर बड़ी गंभीरता से बड़े अच्छे वातावरण में बातचीत चल रही है, प्रगति हो रही है और प्रगति से दोनों देश संतुष्ट हैं।
The European Union may refrain from imposing tariffs on India and China for buying Russian oil, despite US President Trump's request. As per a Reuters report, EU imposes tariffs only after conducting a detailed investigation to establish a legally sound justification. The EU bloc has only imposed tariffs on Russian fertilizer and farm products in the context of the Ukraine war. Now, Trump's request to EU came at a time when the bloc is nearing the finalization of a trade deal with India. Now, top EU officials are set to arrive in India this week. India's top automobile companies held their annual convention in Delhi today. Union Road Transport Minister Nitin Gadkari inaugurated the event. Now, automakers are hoping for a boost in demand after the recent GST cuts. Minister Gadkari said he has requested the Finance Minister to provide concessions for those scrapping their old vehicle and buying a new one. Gadkari also defended the decision to mix 20% ethanol with petrol. He claimed there was a paid political campaign against him, which has proven false after the Supreme Court rejected petitions against E20 fuel.
सुप्रीम कोर्ट में भी इसके बारे में बहुत साफ निर्णय हुआ है। अब जैसे आपकी इंडस्ट्री है वैसे हमारा पॉलिटिक्स भी है, तो ये सोशल मीडिया का जो कैंपेन था वो पेड कैंपेन था, वो अगेंस्ट इथेनॉल था और पॉलिटिकली टारगेट मुझे करने के लिए था। तो मैं इतना ही कहूंगा कि वो जो कुछ था उसमें कोई तथ्य नहीं था, सब बातें क्लियर हुई है। परसों मैंने प्रधानमंत्री जी को भी रिक्वेस्ट की, फाइनेंस मिनिस्टर को भी कही है कि स्क्रैपिंग को बढ़ाने के लिए जो गाड़ी स्क्रैप करेंगे और नई गाड़ी लेंगे उसमें कुछ जीएसटी के बारे में हम सोच सकते तो विचार करिए। ये भी बात हमने वित्त मंत्री के सामने रखी है। मैं आप लोगों को भी रिक्वेस्ट करूंगा कि जो नई गाड़ी खरीदी करेगा स्क्रैपिंग सर्टिफिकेट देकर, उसको अगर कुछ अच्छा डिस्काउंट अगर आपके पास वो आता है और आप ऑफर करेंगे रीजनेबली अच्छा, तो इससे बहुत विन विन सिचुएशन है।
India's leading automakers are bracing for a festive boost on the back of the mega GST cuts. Maruti Suzuki has recorded a 15% surge in customer inquiries since the announcement. M&M has said they are taking steps to ensure that dealers have enough stock. Meanwhile, Hyundai is upbeat about the GST cuts, bringing in many first-time buyers.
I think this is a very big reform which is happening from 22nd of September. It is not only kickstart the auto industry, but across all other industries also. Everybody is going to benefit, and the common man is going to be a big beneficiary. On the top of it, I think the two more things I would like to bring in the knowledge is, one, the benefit which was passed on through the income tax by the Honorable Finance Minister, and also I think the RBI Governor has done a very good job in terms of reducing the repo rates. So I think it's a combination now of the GST, then the benefit which is passed on through the income tax, and third is the repo rate. So I think it's going to be a bumper sales in this festival time.
I believe with the 10% cut in the smaller cars, it will bring in so many new customers. The first-time buyers, which Hyundai anyway is seeing a big jump. First-time buyers in 2020 used to be about 31%. Now they are at 39.5%. I believe we have a potential to go up to maybe 42, 43% in first-time buyers. So more small cars selling. The second thing I think which will be much more significant is, if you see the customer affordability remains the same in terms of how much he can spend. However, the car becomes cheaper, which means its initial signs, maybe the customers will now again go back to the higher trims, because last 1 year we are seeing that customers were moving down from higher trims to middle trims to lower trim. But now there's an opportunity because India is a very, very aspirational country.
Until 22nd, we're going to be cautious on the front.
Right. So is this going to restrict the amount of inventory you'll be able to put into system?
No, so we have taken steps to ensure that we'll still be able to meet the festive demand. So there are a few steps we are taking on the front as well. So you'll see that as it plays out. It's like I said, it's not an easy puzzle to solve for, but that's what we are here.
A quick look at more headlines. Tega Industries has signed a term sheet to buy US-based mining equipment maker Molycorp. According to the exchange filing, the deal is valued at $1.5 billion and will be executed via a special purpose vehicle formed by Tega and Apollo funds. Tega Industries will become the controlling shareholder with 77% stake, and Apollo Global will hold 23% stake. The deal is scheduled to be completed by the end of 2025. Kotak Mahindra Bank ended in the red after a big block deal. Japan's Sumitomo Mitsui Bank has sold 1.62% stake in the firm at 1,940 rupees a share. The block deal was worth a little over 6,250 crore rupees. The deal drew participation from leading global and domestic institutional investors, including Abu Dhabi Investment Authority and BlackRock. Private equity player GTCR has agreed to acquire Czech generic drug makers Zentiva from Advent International in a $4.8 billion deal. Bloomberg reported that the transaction has been finalized and is expected to be announced in the coming days. The company manufactures a wide portfolio of generic and over-the-counter medicines. Shares of Aurobindo Pharma jumped over 5%. The Economic Times reported last month that the Indian drug maker was leading the race to buy Zentiva for $5.5 billion. Now, Amazon has rolled out Amazon Now, its 10-minute delivery service for everyday essentials in select areas of Mumbai. Now, this follows a successful launch earlier this year in Bengaluru and Delhi. Amazon India VP Samir Kumar said more than 100 micro-fulfillment centers have been set up across 3 cities to enable ultra-fast deliveries, and hundreds more may be added by the end of 2025. Now, Oracle's shares rallied a whopping 36% to post its best day since 1992, adding $244 billion to its market cap. The big move came after ChatGPT maker OpenAI said that it had signed a $300 billion deal to buy computing power from Oracle for 5 years. This is one of the largest cloud contracts ever signed, according to the Wall Street Journal. Rachna Dhanrajani is here with the details. Rachna.
Right, $300 billion, that is the historic figure reported by the Wall Street Journal for OpenAI's cloud deal with Oracle, making it one of the largest contracts ever in the tech industry. Starting in 2027, OpenAI will spend about $60 billion a year for 5 years to secure 4.5 gigawatts of new data center capacity under Project Stargate. To put it in perspective, that much energy is enough to power more than 4 million homes. So the $300 billion, the number seems to be a part of a much larger surge in Oracle's cloud backlog. CEO Safra Catz told analysts in the call that the company's remaining performance obligations, or the RPOs, have now risen to $455 billion. She explained that this growth comes from contracts with companies including OpenAI, XAI, Meta, Nvidia, AMD, and others. She also said that this surge allows Oracle to raise its cloud infrastructure targets, projecting revenue to grow from $18 billion this year to $144 billion over the next 4 years. Oracle stock has surged, and Larry Ellison's long bet on cloud now places the company alongside Amazon, Microsoft, and Google in the AI infrastructure race. For OpenAI, this deal is ambitious and carries risk. Current revenue of the company is between $12 to $13 billion, which is just a fraction of the annual commitment they've made to Oracle. And this is after relying heavily on Microsoft's Azure. OpenAI is now spreading workloads across both Azure and Oracle, and hence formalizing a multi-cloud strategy. This deal shows how AI is changing the rules. Compute power has become the new currency, but building a data center on this scale carries financial risk, environmental challenges, and the possibility of an AI infrastructure bubble. So is this a visionary deal or a risky overreach? For now, it is both. What is certain is that the race for AI dominance is no longer just about algorithms. It's about who controls the world's most powerful computing infrastructure. Back to you.
Right, and speaking of Larry Ellison, now Oracle shares surged following $300 billion with OpenAI. Oracle co-founder Larry Ellison briefly overtook Elon Musk as the world's richest man after this. Ellison's wealth soared $89 billion post the Oracle results. This lifted his total net worth to $383.2 billion, according to the Bloomberg Billionaires Index. However, Tesla CEO and SpaceX founder Elon Musk has regained the title of the world's richest man hours after the deal. Elon Musk's net worth stands at $384 billion now. Meanwhile, Nepal continues to simmer days after an anti-corruption stir led by Gen Zs toppled the government. Prohibitory orders and curfews continue as it finds itself in the midst of political uncertainty. Several names are doing the rounds on who should head the interim government. Close to 15,000 inmates have reportedly fled various prisons across the country. However, the Nepali army foiled several prison break attempts as well. There has been a rise in looting and arson as well. The residence of billionaire Upendra Mahato, one of Nepal's richest, was targeted as well. On your screens, you can see several ministers and their families and their family members being airlifted by choppers as they try to escape from protesters. All right, on that note, we'll take a short break. Coming up next, new GST rates announced by the GST Council will take effect on September 22nd. Timsy Jaipuria will speak with Sanjay Mangal, Chief Commissioner of Meerut CBIC, on the rationalization of rates and the implementation on the other side. Stay tuned.
Welcome back. The new GST rates announced by the GST Council will take effect on September 22nd. The GST regime has been simplified to a two-rate structure of 5% and 18% in a bid to boost consumption. However, a special rate of 40% will apply to luxury and sin goods. The Revenue Department has held meetings with the industry chambers to ensure a smooth transition and to answer certain queries on how businesses will have to adapt to this new change. I am now joined by Sanjay Mangal, Chief Commissioner at CBIC of the Meerut Zone. A very warm welcome, sir. Thank you for joining us on this show today. Let me begin by asking you, when it comes to relabeling of MRP, which is recommended by the government, in this practically industry feels that it is coming out to be having a lot of feasibility challenges, especially for widely distributed items. Since this is challenging, can an alternative such as offering discounts or increasing grammage be explored by the industry? What should they do?
Timsy, there are two parts of this question. First is the stocks which are lying with them as on 22nd September and which is containing the MRP of the pre-GST rate cut period. So after 22nd September, when they sell their products, when they make supplies, then it has to be at the new rate. But as it will be very difficult on the product which are already in stock and which are already in the distribution chain, Department of Metrology, Department of Legal Metrology under Ministry of Consumer Affairs, they write a letter dated 9th September. They have allowed the industry to relabel the packages, existing packages, relabeling through by putting stickers, by reprinting, or by any such measure, in addition to the existing MRP. So the new packages will contain the original MRP as well as the new MRP, so as to have more transparency to the customer. He will know that the price has been reduced, as well as allow the transitional flexibility to the manufacturers or packers or importers. Now, the packages which are manufactured after 22nd, there it is for the manufacturer or the business to decide how they are going to pass on benefit of reduced GST, whether it is by way of rate reduction or by way of increasing the package size or the grammage. It is for industry to decide based on their commercial considerations.
But not on the existing stock. They can't offer discounts worth a similar amount of the price cut that they want to, pass it on to the consumers, or can they increase the grammage in the existing packages? Is that possible, sir, under the GST rules and laws?
Timsy, for pre-packaged products, increasing the grammage on the existing stock, it's not possible. So it can be done only.
What about discounts?
About discounts.
What about discounts?
In case of pre-packaged products which are containing MRP, offering discounts, conveying that we are reducing the price by conveying by through discounts, it's a non-transparent method. The customer does not know about it. It will be only for the retailer or distributor to pass on these discounts, and therefore it is required that they have to refix the new MRP through a relabel or restamping or reprinting. So I don't think that giving discount on pre-packaged products is possible. Maybe it is possible on automobiles or bigger items where it can.
Okay. So considering the mass consumption items, their discounts should not be a possibility. But yes, for large ticket items, discounts can be a possibility, and CBIC can consider it as a valid way to pass on the rate cuts. Second question, sir, that industry is asking is there any possibility of refund for accumulated credit lying with dealers on stock purchased before the new reduced rates, provided they are sold at the reduced rates?
Now, as we know that a refund of accumulated credit on account of inverted duty structure is available, but that is available only on the goods where the rates of inputs are higher than rate of outward supplies. Now, in case of those items which are purchased before the rate reduction, so they are purchased at a higher rate, whereas they are supplied at a lower rate, the rates are different at different point of time, or it has been clarified through a circular as per approval of GST Council that in such cases it cannot be considered that the rate of inputs is higher than rate of outward supply, and therefore refund of inverted supply is not applicable in such case.
So the refunds will not be applicable in such case?
No, refund will not be available. Yeah, the accumulated credit will have to be utilized for supply in future, and it will be adjusted after some time because it is only for an interim period on the existing stock.
Okay. Another query, again related to the similar topic. The industry is wanting to know that can additional losses arising from credit accumulation or from central and state subsidies linked to GST reduction be adjusted while computing the price increase or the decrease depending upon the new rates?
Now, Timsy, the expectation of government and the council is that whatever is the benefit of rate reduction, it is passed on to the end consumers, so that the benefit is reached at the place where it is expected. Now, how this benefit is passed and what is the amount of such benefit, it has to be calculated by industry. Whether it is exactly the amount of rate which is reduced, or in some cases where, for example, input tax credit is required to be reversed because the item has been exempted, or where there is accumulation, the industry will identify the net incidence of the tax which is reduced to them, and then they will be expected to pass on the said incidence to the buyers. So industry will have to calculate the net reduction or net incidence, net reduction of tax or net reduction of cost which they have incurred, and then they will be expected to pass on the same to the customers. They will have to keep they should keep some calculations to show it, how they are passing on the benefit to the taxpayer. So just like they were doing it when anti-profiteering authority was there. So they should be able to show that, and they should keep that record. So whenever they are required to show it, they should be able to show it.
Another question, what will be the treatment of accumulated balances of compensation cess credit? Because that has been bothering a lot of sectors, especially the auto sector. How should they deal with this? Similarly for aerated beverages, because compensation cess is ending over there too. So there will be some accumulated balances for them. And what should be the right treatment? when it comes
as we
to
had
computing their returns?
Yeah, as we had earlier discussed in an earlier GST helpline, this credit of compensation cess, this could be utilized only for payment of compensation cess. So now when the compensation cess is getting over, and it will not be leviable after a particular date, 22nd September in this case, there will be no avenue for utilizing this credit. So as of now, as of the present legal position, this credit will remain in their ledger and they cannot utilize it either for the payment of CGST or SGST or IGST. And no such provisions are available in law by which it can be transitioned to them. So the industry will have to plan properly. They have still time so that they are able to either dispose of these items before 22nd. I have seen that some automobile manufacturers, they have extended discounts even before 22nd September so as to dispose of this stock and so that they can utilize their compensation cess. So industry will have to decide their strategy how to utilize this compensation cess.
So very clear message from CBIC that industry will have to re-strategize their sales. Only then they can utilize this compensation cess amount that is in their ledger. Otherwise, as of now, today's legal position is same, that it cannot be utilized in any other head. So my last question, is there any possibility of claiming a refund of input services credit which is accumulated due to inverted duty structure? That's what the industry is wanting to know, that what happens to services in terms of services being, their credit being accumulated due to the inverted duty structure. For example, toothpaste. I was talking to a company and they said in a toothpaste manufacturing and the cycle, the input service of advertisement is much higher as compared to the other inputs, and that is at 18%, whereas toothpaste will be at 5%. So what will happen in that case? Do these inputs credit account of these services?
As I had told you, as per the present provisions of refund of accumulated credit on account of inverted duty structure, presently this is available only in respect of cases where a rate of inputs is higher than rate of output supply. Now, this refund amount has to be calculated as per a formula which is given in Rule 89.5 and which takes into account mainly the input tax credit on inputs only, goods only, and not on input services. Now, this is a demand of industry for a long time that they should be allowed this refund of accumulated credit on account of input services also. And this issue was also raised before Honorable Supreme Court. But then Council has considered it, and presently it has decided not to allow this refund on account of input supplies. So present legal position and present position as per the clarification given by Council is that a refund of accumulated credit is only allowed in respect of inputs, that is goods, and not in respect of input services. So I understand that in case of manufacturers at least, their main inputs, their main ITC is in respect of inputs. And if the industry has got some amount as input services, they will be able to cross-utilize it in long run.
So very clearly, when it comes to input services, no credit will be allowed. That's the clear message coming in from CBIC, that already this was a pending demand, and a detailed discussion has happened at the GST Council where this demand was ruled out, that it is just not possible in terms of input services. Credits can be given only on inputs of goods. Many thanks, Sanjay Mangal, for joining us. And with that, it's a wrap on this special broadcast. More news and updates continue right here on CNBC TV 18 on the other side.
What's it been like? 11 years of Swiggy and 5 of Instamart.
One of the first things that I did when quick commerce essentially started with Instamart was to say that, it's not going to work. Who needs anything in, I don't know,
in 10 minutes? Yeah, naysayers.
Absolute naysayers for that.
What is the relationship like as far as the FMCG business is concerned with them?
I refer to it as the OTTification of commerce. We are probably the cheapest way for a lot of these brands to put products in the hands of consumers who care for it.
I mean, it's giving hyper-local a completely new meaning, isn't it?
There is one consumer base in the same geography that are looking for cheese. There is another consumer base that is looking for paneer. So the way our assortment comes in, it allows for that level of identification.
Is it still about the 10 minutes or has that changed significantly?
A consumer that depends on quick commerce, when they come up and fire search for the item that they look for, needs to be available in less than 10 minutes.
At this point in time, it seems to have emerged as a 3-horse race.
Every one of us probably has grown up on a Parle or a Cadbury or a Surf, right? And then you realize that you are one amongst them.
You're the Parle and Cadbury of this
just
generation.
Swiggy is a verb in many parlances.
What is the dream 5-10 years out for Swiggy and for Instamart?
100 million people coming to our platform and transacting 15 times.
Now, what would you consider as the big pain points?
There are a lot of flirters in our quick commerce business.
What are they flirting with you for?
They come for Rakhi, right? I think compared to
and then
last,
forget about you.
Not forget, they still come back, but they have not transferred all of their buying onto Instamart.
From 0 orders on day 1 to millions each month, Swiggy is hoping to redefine convenience for India. What started as a food delivery app is today a multi-service platform with over 2.5 lakh restaurants, 5.4 lakh delivery partners, and a growing suite of services from dining out to entertainment. And then came Instamart. Launched in the middle of a pandemic, in just 5 years, it's expanded to over 125 cities, delivering everything from fresh vegetables to smartphones and, yes, even gold. Hello and welcome to Young Turks Reloaded. I'm Shriram Finance, and on the show today, we decode the journey of building category-defining businesses with 2 leaders at the heart of this evolution. Funny Kishan, co-founder and chief growth officer at Swiggy, and Amitesh Jha, the CEO of Instamart. It's 11 years of Swiggy and 5 years of Instamart. Funny, Amitesh, many thanks for joining us here on Young Turks Reloaded. Funny, I'm going to start by asking you, you've pretty much been through this journey, 11 years of Swiggy and 5 of Instamart, and it's literally just 1 year exact to this month for you, Amitesh. Funny, what's it been like? 11 years of Swiggy and 5 of Instamart.
Yeah, no, I think firstly, thanks a lot, Shane, for having us over here. And it's great to be back. You guys have been, as I said, seminal in how startups have been covered over the years. And it's great to be back on the show after a long time, right? I think we were just speaking about it. It's relativity, right, at its best. When you love what you're doing, it doesn't seem like 11 years at times. So lots of memories. I think, when people ask about my professional career, I say, I don't know what I did before because everything.
Yeah, you consulting and then decided that you wanted to get a slice of the startup ecosystem, right?
And so it's been here. So we've grown up together in many ways, whether it's me, Harsh and Andy. We've had our ups and downs. But I was telling this recently someone as well, if I could do it all over again, there's nothing else I would do. I'm perfectly at the place where I would like to be at this point in time. So quite an awesome journey in the last 11 years.
Yeah, well, it has been for you and it has been for the business as well. But Amitesh, 10 years almost at Flipkart before you then decided that quick commerce was going to be your calling. How different is the quick commerce world from the e-commerce world?
Yeah, first of all, it's 14 years. And secondly, I think this is something that I kind of say to a lot of people. It's very, very also very true to my heart. One of the first things that I did when quick commerce essentially started with Instamart was to say that, it's not going to work.
You were not the only one. You were not the only one. I think there were. I can't even remember how many premature obituaries were written about quick commerce.
Yeah, absolutely. We said, it's a fad. It's not going to work. People will buy. Economics will not work. This is something that we have seen multiple times. They burn cash. we know everything about consumers. Who needs anything in, I don't know,
in
10
minutes? Yeah.
That's the concept that we essentially started with. And I was also one of the people who were absolute naysayers to that. But I think one of the first things that happened to me specifically, and that's the reason I also joined this, is first of all, my own habit. I mean, in spite of everything, in spite of being the naysayer saying that it's not going to work, I could not move away from. Once I started, it was an addiction.
Yeah.
And I think that's the primary reason. And I think there are very rare instances. I think e-commerce was also one of them. When people actually started using it, they actually realized that they're going to get things that they normally don't get, and it was a big change in the way people buy. This is the second such change, and that's the reason I joined Instamart, especially because they were the leader. And the kind of things that they do is something which was very, very underappreciated by everyone in the market, except for the consumers.
The expectation at this point in time is that businesses like Instamart and, of course, your peers are also going to do far more than the food delivery business itself.
Of course.
What are we talking about, in terms of the avenues for growth from here on and the headroom to be able to get to that point of exponential growth, for instance, in grocery, which is expected to be the next holy grail, so to speak?
Yeah, that's true, actually. I think a lot of this also comes down to the size of the different markets that we play in, right? I think the grocery and the commerce industry with which we're going after in quick commerce is 10 to 15 times larger than the food delivery market. I think there is a time and place that food delivery also will become large. If you look at the West, food delivery and grocery are kind of equal in size in the US, but that's going to take a little bit of time, right? But as things stand today, the grocery market is $600 billion large. The retail commerce side would be under 300. So it's $1 trillion market that we're talking about. And it's growing, at a very conservative level, 5%, and maybe aggressive 7-8%, right? And even at the lower bound of the range, it's $50 billion of new spending that is getting added into the consumer markets every year. This industry is $10 billion. So we believe that the headroom for expansion is just structural. We don't need to do much. What we need to do is, as Amitesh said, be there for the consumer, a 15-year-old or a 50-year-old, if not more. There is an occasion for which Instamart becomes relevant for you. And that makes the size of the opportunity itself much, much larger than a food delivery, which is probably pigeonholed into a little bit more like 20 to 35-year-old using it.
What are the trends that you're seeing now on the platform when we talk about the kinds of purchases that people are making? The value of the orders has gone up significantly as well. What's the repeat that you're also starting to now see?
Obviously, when we started out, our focus was primarily on two categories. We said perishables.
Yeah.
Things that you require, it could be fruits and vegetables, it could be paneer, it could be milk, things that you require on a fairly frequent basis. And the other one was indulgences, right? Chips, ice creams, colas, stuff like that, right? And when we talk to a lot of these cola companies, chips companies, they do come and tell us we are actually increasing the size of the market in many, many ways, right? So it started out that way. And then, consumer expectations are almost always ahead of what the business can deliver in some of these cases, right? We started people wanting other products, right? And it started off by simply saying cooking essentials like oil and atta and shampoos and stuff like that. And then now we have 35,000 products available to the consumers in 10 to 15 minutes.
You said that the feedback from cola companies, chip makers, etc., was that you're helping grow the market.
Yeah.
But if you talk to FMCG players and you look at what FMCG companies have been reporting, sales growth and volume growth has been flat.
Yeah.
Not just for the past year, but for the past several years. So how do you then decipher this kind of dichotomy of what you're saying and what the commentary is from FMCG companies?
Yeah, actually that's true, right? And see, I'll tell you what, at the end of the day, to be honest, we are still a platform that caters to the top 10, 20, 30 million households in the country at this point of time, right? Maybe there's a point of time when we'll become much more widespread in the base that we go after, but this is about the top 100 million people. We've acquired less than 50 million people in Instamart so far, right? So we're still talking about, the tier 1 or SEC as they speak, right? And if you peel the onion and look at it, the volume growth is flattish. The sales growth and the revenue growth for all these guys is still, depending on the company, between 10 to 20%, right? And that's coming from a fair bit of premiumization push that they end up doing.
Correct.
And in that sense, I refer to it as the OTTification of commerce in many ways. If you think about a few years back when TV and you guys are obviously more familiar with it, but when it's just mainstream TV, a show like a Sacred Games or any of this would be very difficult to actually put out because you have to create something for the masses that plays at scale.
Yeah.
But at this point of time, we are probably the cheapest way for a lot of these brands to put products in the hands of consumers who care for it.
To talk about the point that was just made, I mean, it's giving hyper-local a completely new meaning, isn't it? Right?
Yeah.
I mean, to say that the buyer in Rohini versus the buyer in Saket will want a completely different cart, a completely different assortment. Now, does that add to your complexity? I mean, how do you cater for that?
Yeah, absolutely. See, I think as Funny was really mentioning, it's very hard for any brands to reach the end consumer at a very micro level. They will always try to get to a channel that reaches their last mile as close as they can. What we do is obviously we have an app, so we can actually reach the end consumer at that. So there are two levels of market that we essentially look at. One is obviously a micro market, as we essentially call it, a Rohini or a Saket, to make sure that we have the right assortment for that place. And consumers will give us enough indication of what they are looking for, what they are essentially searching for, to make sure that it essentially happens that way. The other piece is that even in a micro market, there are hyper-local vagaries that generally are not very understood if you are looking from a channel play, which is just looking at putting an item on the shelf. What it says is that there is one consumer base in the same geography that are looking for cheese. There is another consumer base that is looking for paneer. You have to cater to both.
Yeah.
So the way our assortment comes in play, because we have obviously a much larger assortment than your typical modern trade outlet as well, it allows for that level of identification.
While you've expanded your assortment quite significantly, you've also learned from your experiences of doing away with things that were not working for you, which has also helped unit economics, and that's being reflected in the numbers now. What have been some of the learnings there, or what you've done away with, and what you intend to now prioritize?
See, I think the things that we did very specifically are the things that we don't do well. For example, at one point of time, our F&B selection was very, very high. Our largest category is milk. One of the big use cases is that when consumers are looking for it, it could be at the time when you are trying to make an evening tea, that should be available. So for us, it was very, very important to let go a lot of the assortment of milk, which was stale, but make sure that the milk which is the consumers need are available at the time when they essentially require it. That is where the power of the quick commerce actually comes in play. So we have done those kind of assortment rejig that make sure that the item is available when they want it. If you want a flower in the morning, it has to be there. If you want flower in, for example, Ganesh Chaturthi, it has to be there all the day.
And yet you ran out of Rakhis last year.
Yeah, we did. I think one of the things one of the big changes that we have seen lately is that there are specific occasions where consumers who generally don't buy on quick commerce are also moving to quick commerce. And I think for us, that is the biggest green shoot that we can.
But what have been some of the surprising categories that you thought would not take off and have actually taken on much better than your own expectations?
I mean, I think I would just maybe give the segue for Amitesh, but the last year, I would say our commerce for has grown and how, right? If you look at something like home and kitchen, I think we probably have the best selection out there.
Yeah, absolutely. I think beauty and personal care is one of the bigger movement that has happened recently. A lot of that is also because we have the right assortment in place. You don't have assortment, it will not work. But it is mostly led by the end consumer. Ultimately, they go search for it. If it is not available, you get it in our data that says that people are looking for it and they don't have it available. So that was one of the big things. Gold, because that's very important. When I came in September, and I said, are they crazy? The number that they are planning to, because it's gold, right? All of that you'll buy, and what if we are not able to sell? And again, the same thing happened. We ran out of the gold that was actually the highest ASP among all of them.